Hello friends, I hope you are all doing good. Welcome back. Thank you for showing me so much love for Indirect Tax Marathon. So Indirect Tax Marathon is already uploaded and it is available on the YouTube page. So you please go watch it if you have not watched it. And those who have watched it, thanks a lot for showing so much love for that Indirect Tax Marathon classes. In this video, in this discussion which we are going to have, we are going to revise the entire income tax law or direct tax syllabus. Indirect taxes is already uploaded. If any person has not watched it, please go, you can watch it. Direct tax will be discussed in this particular video. Fantastic provisions are there, very beautiful amendments are there, and whatever we are going to see now will be completely fully amended as applicable to the June students. Okay, please note, normally 6 months before your examinations, they have whatever changes are made by the institute, that is applicable for your examinations, normally 6 months before your examination. So the changes which are applicable for the June students will be completely covered in these classes. For now, for those who are writing in December, there will be some extra changes which you have to study. For that, you can watch the marathon which will be uploaded in the December month. But then this can be taken as reference for your upcoming examination and for your daily study purpose or revision purpose. So in this class, we will be revising the entire the direct tax syllabus of your CMA intermediate completely. We will see right from the first topic, introduction topic, till the last topic of assessment, etc. We are going to see all the different topics, and we are also going to see what are the different changes which has happened in from the material or from the notes which you have already studied. Now, please note, if you guys have already taken classes, whether with our institute or any other institute, there may be a possibility that you would have studied from the material which was issued by the institute, from the material which is issued by the institute. Okay, just a second. You would have studied from the material which is issued by the institute, showing inverted form. 1 second, students. So there is a possibility that you would have studied from the material which is issued by your institute in August 2022, because that was the material which was available, and my recording which is available on the ArivuPro website is on the basis of the August 2023 reprint material. Basically, this material is nothing but the same first edition. The first edition of this material was released on August 2022 and reprint was done in August 2023. Now, but I recommend the students who are writing their examination in June 24 or December 24 to kindly refer the revised edition. Please note, first edition was given in August 2022. After that, it was just a reprint of whatever was there in first edition. They had never revised, they had never made any changes in the material. But now the latest material is available. The revised edition is available. March 2024 revised edition is available. So my kind request to you all is, kindly refer this material. Even if you have taken the classes previously, kindly refer this material, because the classes which I have also recorded, these classes were recorded in December 2023. Okay, my classes, whatever I am telling is only with respect to income tax. Okay, because in case of income tax, there are small amendments. The entire topic is not going to change, because the Finance Act which is applicable to your examination will be Finance Act 2023 only. Normally, under income tax law, amendment will normally happen once in a year only. The changes will normally happen once in a year. But still, my humble request is to refer this material, revised edition March 2024, because if you refer the first edition material or this August edition material, then the problems which they would have solved, no, it will be as if it was applicable to December students, December 2023 or June 2023 students. So those who are writing their examination in June 2024 or December 2024, please use the revised material of CMA Institute. That revised material, they have solved all the problems in a completely revised manner by applying the provisions of Finance Act 2023. So this is one point which I wanted to make it clear before we start our discussion. And obviously my discussion, the discussion which we are going to do, will be completely amended as per the Finance Act 2023 and will be applicable for your upcoming examination in June 2024 or December 2024. Okay, now normally we all know the changes which are made 6 months before your examination is applicable to you. But in case of income tax law, normally the changes will happen through Finance Act only. Normally, how will the changes happen, sir? Through Finance Act. Every year on 1st of February, normally every year on 1st of February, what will come, sir? There is something called as a budget which is going to come. The Union Finance Minister, which is nothing but the Finance Minister of India, is going to conduct budget. They are going to conduct budget, and this budget which they are conducting, the budget which is conducted every year 1st of February, this budget will normally tell about the changes which are there under the income tax law majorly, and also some changes with respect to GST as well as customs law. But then major updates of income tax law will come yearly once through this Finance Act, through a budget which is passed in the Parliament on 1st of February. Once this budget receives an assent from the President of India, it becomes Finance Act. Okay, so with this being said, let me straight away start my discussion. So first topic, let us see the basics first. Basics with respect to what are the basics with respect to basics of income tax and the tax rates. We would have seen this basics in our GST discussion also. What do you mean by tax? Tax is pecuniary burden which is laid upon individuals and property owners. So government needs money for undertaking various different activities. That money which government needs, government is going to take that money from us in the form of tax. Then there are two types of taxes, basically direct taxes and indirect taxes. Direct taxes, incident impact is on same person, whereas indirect taxes, the incident and impact is on two different persons. Direct taxes, the person who is earning the income and the person who is paying the money is the same person, whereas indirect taxes, there will be a supply made by one person, and however the tax will be paid by some other person. Direct taxes are normally income based, indirect taxes are supply based, or that is based on goods and services. And direct taxes, the rates can be different from person to person, because here depending upon your income, the rates are there under income tax or direct taxes, whereas in case of indirect taxes there is no difference between the rate does not differ from person to person. The rates is for a specific product. So whoever purchases the product, he will have to pay the same amount of taxes. Direct taxes are progressive in nature. Indirect taxes are regressive in nature, in the sense what, sir? In case of direct taxes, as and when your income is increasing, the amount of tax which you have to pay will also increase, whereas in case of indirect taxes, irrespective of your income, the amount of tax which you have to pay will remain same. Now, sir, why do government levy taxes? Sir? Why are government levy taxes? Because see, government is undertaking various different types of activities. Now, for example, we have government schools and colleges. Who do you think is paying the money for running those government schools and colleges? We have hospitals, government hospitals. There are doctors over there also. The treatment will happen at a very lesser rate. We have defense which is there. We have different roads and bridges which are there. Do you think you have constructed the road outside your houses? Now, all this is actually constructed by government. All these activities are done by government. For doing this activity, government needs money. This money government is collecting from us in the form of tax. Then we saw then constitutional provisions with respect to taxation. There are some article 245, 265 and 246. Article 265 says no tax can be levied or collected unless there is an authority of law. Article 245 says the parliament or the central government has the power to collect taxes for whole or any part of India, and the state government has the power to state government or legislature of the state has the power to make law for whole or any part of that particular state. Now it is Article 246. It is which article, sir? Article 246, which gives the power. There is a schedule in the Article 246 called as Schedule number 7. Schedule number 7 has three lists: Union list, State list, and concurrent list. Now it is in this Union list, State list, and concurrent list, they have given list of different activities which can be undertaken by central government as well as state government, and jointly by central government and state government. Now in this Union list, entry number 82. There is an entry in Union list. There is an entry called as entry number 82. Entry number 82 of Union list gives the power to central government to levy and collect taxes on income other than agricultural income. So it is, please note, very important for your MCQ points. It is entry number 82 of our Union list or first list or list 1, which gives the power to whom, sir? Central government to levy and collect the taxes on income other than agricultural income. What does it say, sir? It says, entry number 82 says that central government has the power to levy taxes on all the different types of incomes except on agricultural income. And entry number 46 of the state list gives the power to the state government to collect the taxes on agricultural income. Sir, but we have studied that agriculture income is exempt. Yes, agriculture income is exempt, meaning central government cannot collect taxes on agriculture income, but state government has the power to collect taxes on agriculture income. As of now, no state government is collecting taxes on agriculture income. Now, sir, what are the different sources of income tax law, sir? So this was basic, sir. Now we are going to start what, sir? We are going to discuss about our income tax law. Now, sir, should I study only Income Tax Act or do I have to study the Income Tax Law? What do you mean by this Income Tax Law? Do I have to study the Income Tax Act? Do I have to see the Finance Act, Annual Finance Act, which is there, etc.? Answer is yes. Now, when I say you have to study Income Tax Law, it does not mean that you have to study only Income Tax Act. You have to definitely study the Income Tax Act. Income Tax Act, you will have to study. Apart from that, along with Income Tax Act, you will also have to study income tax rules, the Finance Act, which is passed every year, Annual Finance Act, circulars and notifications given by the institute, and different case laws and judicial decisions. Now, these are the different sources of income tax law. When I say income tax law, what are the different things which I am referring to, sir? I am referring to the Income Tax Act, income tax rules, Finance Act, circulars, notifications, and case laws and judicial decisions. Now, you as a student, you will have to study all these things. Tomorrow, when you are going to your final students, final level, you will study in detail, the detailed discussion. In depth, you will study about income tax rules also. In depth, you will study about the judicial decisions or case laws also. Presently, at intermediate level, majorly our discussion will restrict to Income Tax Act and some provisions of rule. And for finding the tax rate, we study something called as Finance. Our discussion will be restricted to these 3 points, but majorly the discussion will be with respect towards our Income Tax Act 1961. Okay, so the sources and component of Income Tax Act, Income Tax Law. First is Income Tax Act. It is the main act. It is the main provisions of the law. It came into existence from 1st April 1962. It is applicable to whole of India, including the state of Jammu and Kashmir. Now, income tax rules. Income tax rules. See, main provisions is given in the act. Rules are supporting the main provisions. Rules are doing what, sir? They are supporting the main provisions. They help in better administration of the Income Tax Act. They help in better administration. They will tell you what is the procedure, forms, principal, rates of depreciation, etc. or given in the rules. Now, sir, who are going to frame the rules? Sir, these rules are framed by a body called as Central Board of Direct Taxes, also called as CBDT. Now, there are 2 boards actually: Central Board of Direct Taxes, Central Board of Indirect Taxes and Custom. Central Board of Direct Taxes will make all the provisions with respect to income tax. Central Board of Indirect Taxes and Customs will make all the provisions with respect to indirect taxes, which is GST as well as customs. Then we have Annual Finance Act. Apart from your Income Tax Act and income tax rules, you will also have to study Annual Finance Act. What do you mean by Annual Finance Act, sir? Every year, finance bill is presented in the Parliament by the Finance Minister of India. That finance bill, once it is receiving its assent from the President of India, it becomes Finance Act. Then, for smooth flow of the law, for clarifying any scope or meaning of the provisions of the law, the CBDT keeps on issuing circulars and notifications. You'll also have to refer those circulars and notifications. And judicial decisions, many times it may happen that a particular provisions of the law can be differently interpreted by the taxpayer as well as by the income tax officer, etc. So whenever there is a dispute between both of them, they will go to court, and this court is going to decide that particular dispute. That is nothing but judicial decisions or case laws. So when you are studying income tax law, you will have to study all these 5 things: Income Tax Act, income tax rules, Finance Act, circulars and notifications, and judicial decisions. Sir, what do we do under income tax law, sir? Sir, when we say income tax law, what do we do under income tax law? Under income tax law, normally you are supposed to do 2 things. You will have to first compute the total income of an assessee. We have to compute what, sir? Total income of an assessee and the tax liability on the total income. You will have to compute what? The total income and the tax liability on the total income. There is a normal stick format which is there for total income. You will have to write the name of the assessee, then the previous year and the assessment year. Then you will have to compute the incomes under different heads, which is income from salary, house, property, business, profession, capital gains, etc. That will give you your gross total income. From your gross total income, you will have to subtract deductions under Chapter 6A. That will give you total income. Needless to say, once you do the computation of incomes under all the heads, you will also have to apply the provisions of clubbing a set off and carry forward for arriving at the gross total income. From gross total income, chapter 6 deductions you give, you will get your total income. So under income tax law, first thing which you have to do is computation of your total income. Once you compute your total income, then you will have to compute the tax liability of a person. Okay. Now, section 4 is the charging section. Please note the first topic which is there is completely theoretical topic. Okay. Section 4 of income tax law. Section 4 is what, sir? Section 4 of income tax law is this. Section 4 is charging section. What is section 4 telling? Section 4 says income tax is charged for every assessment year on every person on the total income earned by such person in the previous year at the rate specified in Finance Act. What is this provision telling? I am going to charge something called as income tax. Income tax will be charged for every assessment year. It will be charged on every person. It will be charged on the total income of the person. So income tax is going to be charged on every person on what, sir? On his total income. When will it be charged? It will be charged for every assessment year. And on which total income will I have to pay income taxes, sir? The income tax will have to be paid for the total income which is earned in the previous year, and at what rates, sir? At that rates as specified in the Finance Act. Okay, not okay. See, basically year can be of two types. One is calendar year and financial year. Okay, calendar year and financial year. We are least bothered about what calendar year is. Obviously, calendar year will start from 1st of January and end on 31st of December. And financial year will start from 1st of April and end on 31st of March. As a commerce student, what we should focus on is this financial year. Now, this financial year which is there, under income tax law, this financial year also is further divided into two types. What are this further division of two types, sir? This financial year is further divided into something called as previous year and something called as assessment year. Sir, what do you mean by this word previous year and assessment year, sir? Under income tax law, the year is divided into how many forms, sir? Under income tax law, a year is divided into two forms. What are those forms, sir? One is called as previous year, another one is called as assessment year. Sir, what is previous year? What is assessment year, sir? In simple words, I'll tell you what is previous year, what is assessment year. Previous year is the year in which income is earned. It is the year in which income is earned, and assessment year means the year in which tax is paid. So in simple words, what do you mean by previous year? Previous year is the year in which the income is earned, and assessment year is the year in which the tax has been paid. Previous year is the year of earning income, and assessment year is the year of paying taxes to the government. Previous year is the year of earning income, assessment year is the year of paying taxes to the government. Okay, so whatever income you are earning in the previous year, on that income you will have to pay the taxes in the assessment year. Now, for your examination, those who are writing their examination in June 24 or in December 24, for you guys, the previous year is 23-24. For you guys, which is the previous year, sir? Previous year is 23-24, and for you guys, the assessment year for you guys is assessment year 24-25. Okay, not okay? For you guys, what is the previous year? Previous year is 23-24. Assessment year is 24-25. Meaning, the income for you guys, the income will be earned during this period. Which period, sir? 1st April 2023 to 31st March 2024. Whatever income is earned by a person during this period, he will have to pay the taxes in assessment year. Sir, when will have to pay the taxes, sir? Normally, there are different due dates for filing income tax return. In general cases, in normal cases, the due date of filing income tax return is 31st of July. 31st of July of which year, sir? 31st of July of assessment year. Therefore, for you, it is 31st July 2024. Whatever income is earned during the period 1st April 2023 till 31st March 2024, you will have to pay the taxes in assessment year. What is the due date, sir? In normal cases, it is 31st July of assessment year, 31st July 2024. And in case of audit and in case of companies, if you are an audit assessee, if your books of accounts are subject to audit, or you are a company, then for you, it will be 31st of October of assessment year. For you, what is the due date, sir? 31st October of assessment year. Meaning for your examination, it will be 31st October of 2024. Okay, so what year are divided into two categories? One is called as previous year, one is called as assessment year. Previous year, what do you mean by previous year, sir? Previous year means the year in which the income is earned, and assessment year means the year in which the tax is required to be paid. Whatever income is earned by a person during the previous year, he have to pay the taxes in assessment year. Recently, this year got ended. Recently, which previous year, sir? Previous year, 23-24 got ended. 31st March 2024 was the last date. Just recently, it got ended. Now, for whatever income a person has earned during that period, he will have to pay the taxes in assessment. Me, as a teacher, as a chartered accountant, and different sources of income which I have, all these incomes combined together, on this income I will have to pay the taxes. When will I have to pay the taxes, sir? I will have to pay the taxes in assessment year by 31st of July or by 31st of October, depending upon whether it is audit case or normal case. So previous year, in simple words, previous year is the year in which the income is earned, and assessment year means what, sir? Assessment year is the year in which the tax has to be paid. Now, who has to file the income tax return, sir? The income tax return is required to be filed by a person. Now, every person, who has to do, sir? Every person has to do. Sir, every person, will I also be included? We'll see all those things. A person means what, sir? First of all, let us understand the meaning of person. Are you a person? Am I a person? Is a company a person? Is a partnership firm a person? Let us see the meaning of person. Person includes, it is an inclusive definition. It says person includes individual HUF, firm, LLP, company, AOP, BOI, local authority, artificial judicial person. Person means what, sir? Individual, like you and me. You and me, we are persons. Then HUF is a person. Hindu undivided family is a person. It will have karta, it will have co-partners in it. That is also a person. Then a company is also a person, sir. What do you mean by company? Company means what, sir? Company means the body corporate. Company means a private limited company, a foreign company, or an Indian company, or a public limited company. A partnership firm will also be treated as person, whether that partnership firm is registered with Partnership Act or not registered, including an LLP, limited liability partnership. An association of persons and body of individual is also treated as person under income tax law. Then local authority, meaning all these people, maybe they are doing business in different categories. Maybe they are doing business as different concerns. They will have to file their income tax return. They are all called as persons. Now, one more important point which we have to understand before we actually jump into the actual discussion of income tax law is the meaning of assessee. Sir, who is an assessee? Assessee is that person who is liable to pay tax. We all are persons, but we all are not liable to pay taxes. We all are persons, but we are all not liable to pay the taxes. Who is an assessee? Assessee means any person, any type of person. It can be you, me, company, LLP, partnership, firm, AOP, BOI, etc. Any person who is liable to pay tax or any other sum under this act. If you are liable to pay tax under this act, under Income Tax Act, or any other sum, interest, penalty, late fee, you will be called as an assessee, and it will include deemed assessee, representative assessee, and assessee in default. And it will include what, sir? It will include deemed assessee, representative assessee, and assessee in default. Sir, what do you mean by deemed assessee, sir? Deemed assessee means you are actually not an assessee, but the lawmakers are going to deem or assume that you are an assessee. You are an assessee. Representative assessee means what, sir? You are not the assessee for the subject matter, but you are representing someone else. For example, for deemed assessee, say for example, there is a notice which is sent to me. There is a notice which is sent by the income tax department. Now I am not a person who is liable to pay the taxes, but still I have got a notice. I have still got a notice telling Mr. Income Tax Department feels that Dilip, you are earning some income, but you are not filing your income tax return. So they have sent me some notice now. Now I am an assessee. I am what's a deemed assessee. Though I am not liable to pay taxes, etc., I will be deemed as assessee. Then a representative assessee means what, sir? My daughter, she is a very good singer. My daughter is a very good singer, so she goes and she sings in Indian Idol, etc. Whichever program it is, she goes and sings over there. She has earned some money. Now my daughter is only of 5-year-old. My daughter is only of 10-year-old. My daughter is only of 15-year-old. She does not have any PAN. She cannot file her income tax return. So in that case, what will happen, sir? I will have to represent her and file income tax return on behalf of her. I will be called as assessee, a representative assessee. And assessee in default means what, sir? Meaning I am an assessee. I have filed my income tax return, or I have made some default in filing following the provisions of the law. I have made some mistake or default in following the provisions of the law. I will be called as assessee in default. Now, this is some basic requirement which was the basic things which are required for our actual discussion of income tax law. Now we will see the actual discussion of income tax law. What is actually required for you guys is the tax rates. Tax rates for the previous year 23-24. Tax rates for which year, sir? For previous year 23-24 or assessment year 24-25. For your examination, which will be the previous year 23-24, assessment year will be 24-25. Now the first two topics, no, this basics as well as the residential status, we will be studying from this material, and then after that we have our own very famous, world famous handwritten material which we'll be using, the class notes which is there, we'll be using this for our discussion purpose. Okay, let us see the tax rates, sir. Let us see the tax rates. Tax rates for the previous year 23-24, for assessment year 24-25. We have two types of tax rates basically. Basically, tax rates are of two types. One is called as general tax rates, one is special tax rates. Sir, why sir this differentiation is there? General tax rates are the tax rates which are given every year. Every year you will have to see the budget. Why are people interested in the budget, sir? Why are human beings like you and me or our parents, etc., interested in budget? Because every year when budget is coming, when Finance Act is coming, they are going to tell what is the tax rate applicable for upcoming year. So budget is important because of that reason. Because general tax rate, the normal slab rates which are there, that will be given in the Finance Act, and special tax rate. We have one more type of tax rate called as special tax rates. These tax rates will be given in income tax law itself. These tax rates will be given in income tax law itself. Now, since general tax rates are given in Finance Act every year, through budget every year, this may or may not change. It may or may not change. So every year you will have to see the budget to check whether there is any change in the tax rate or not. Normally, special tax will remain same. It will never change. Why, sir? Because it is given in the Act itself. The Act was introduced in 1961. Right from that time, the special tax rates are there. It is given in the Act itself. Whenever they want to make an amendment, they can make an amendment. But normally, they will not change every year. Normally, they will not change every year. So, on what incomes is general tax rates applicable, sir? It is applicable on all the different types of income except special income. All the different types of income. Normally, whatever income you are earning, general tax rate will be applicable or slab rates will be applicable. Only for some special kinds of income we have special tax rates. For example, sir, we have long-term capital gain, we have short-term capital gain under section 111A, or we have casual income. My daughter is earning from that singing, etc., or lottery betting, etc., or I have any undisclosed income. For these incomes only there is special tax rates applicable. Apart from that, I am doing a business. I am having a business income. I have a house property which I have given on rent. I am getting rental income from house property. I am, say, for example, working for a company, working for 2-3 companies. I am getting salaries for those companies. I am having income from other sources, etc. All these incomes will come under the general taxes. For all this income, I will have to pay tax at what rates are? At slab rates. And special tax rates, there are only some incomes for which special tax rate will be applicable. Sir, what are the tax rates applicable for me, sir? What are the tax rate applicable for us? What is the tax rate applicable for us, those who are writing their examination in finance in the June 2024 or December 2024, sir? For you, the budget will be, for you, the Finance Act. Which Finance Act is applicable? For you, the Finance Act 2023 is applicable. Please make sure this, guys, for you, which Finance Act is applicable for you. The Finance Act 2023 is applicable. Please make sure this point, this is something which is important. Recently, a budget came out. This budget came out on 1st of February 2024, which is nothing but Finance Act 2024. Sir, should I study this for my examination? Answer is no. Don't get confused. You should not study this for your examination. Which is the Finance Act? Finance Act 2023, which is the previous year for your examination, previous year 23-24, which is the assessment year 24-25. Now let us see what is the tax rates. If you are an individual HUF, if you are an individual HUF, if you are who, sir? If you are an individual HUF, AOP, BOI, or artificial judicial person, or you are a non-resident, irrespective of your age. If you are an individual HUF, individual whose age is less than 60 years, HUF, AOP, BOI, artificial judicial person, then depending upon what is your income, the tax rate is there. If your total income is also called as what, sir? Net taxable income. If your total income is up to 2.5 lakhs, you don't have to pay any taxes. And in case of individual HUF, AOP, BOI, artificial judicial person, they will not have to pay any taxes up to 2.5 lakhs. And if their income is from 2.5 lakhs to 5 lakhs, 5%. 5 lakhs to 10 lakhs, 20%. More than 10 lakhs, 30%. Tell me. Up to 2.5 lakhs, no tax. 2.5 to 5, 5%. 5 to 10, 20%. More than 10, 30%. If you are individual HUF firm, if you are individual HUF AOP BOI artificial judicial person, up to 2.5 lakhs, no tax. Up to 2.5 lakhs, no tax. 2.5 to 5, 5%. 5 to 10, 20%. More than 10, 30%. This is the normal tax rate applicable for an individual HUF AOP BOI artificial judicial person, and even a non-resident irrespective of his age, whether he is of 60 years or above, 80 years or above, irrespective of his age, the slab rate applicable to him will be 2.5 lakhs, up to 2.5 lakhs, no tax, 2.5 to 5, 5%, 5 to 10, 20%, more than 10, 30%. If you are a senior citizen, who is a senior citizen, sir? Senior citizen means a resident individual whose age is 60 years or more. For you, up to 3 lakhs, you don't have to pay any taxes. And if your income is from 3 lakhs to 5 lakhs, you will have to pay 5%. 5 lakhs to 10 lakhs, 20%. More than 10 lakhs, 30%. Up to 3 lakhs, no tax. 3 lakhs to 5 lakhs, 5%. 5 lakhs to 10 lakhs, 20%. And more than 10 lakhs, 30%. And if you are a super senior citizen, sir, what do you mean by this word super senior citizen, sir? Super senior citizen means a resident individual. Sir, who is super senior citizen? A resident individual whose age is 80 years or more. Who is a super senior citizen? A resident individual whose age is 80 years or more. Up to 5 lakh rupees, they don't have to pay any taxes. Then from 5 lakhs to 10 lakhs, straight away 20% slab rate. And from more than 10 lakhs, it is 30% slab rate. Now please note, there is one limit with up to which they don't have to pay any taxes. So for normal people, it is 2.5 lakhs. And for senior citizen, 3 lakhs. And for super senior citizen, it is 5 lakhs. This limit up to which they don't have to pay any taxes, no, this is also called as basic exemption. This is also called as what, sir? Basic exemption limit. A limit up to which a person does not have to pay tax will be called as what, sir? Basic exemption limit. Now, the CBDT has given a clarification. It has issued a circular with respect to age. Sir, if a person's birthday is on 1st of April, say for example, 1st of April 1964. So, sir, in this case, whether he will be of 60 years, by end of previous year, by 31st of March 2024, or will he be of 60 years on 1st April 2024? Meaning, what are you trying to say? Sir, whether for this person, the slab rate of 2.5 lakhs will be applicable or of 3 lakhs will be applicable. A clarification was given. If anybody's birthday is on 1st of April, okay, 1964 or 1944, etc., in case of 80 years or above category, in case his birthday is on 1st of April 1964, then he will complete 60 years on 31st of March 2024. Meaning, say for example, in my case, my birthday is say on 26th of May. So I am going to complete 31 years on 25th of May. I am celebrating my birthday on 26th of May because I have completed that age. I have completed 31 years. Now 32 has started. Now the age of 32 has started. Correct? So they have given this clarification. Okay. Any resident with whose 60th birthday or 80th birthday falls on 1st of April 2024 will be said to have completed the age of 80 years or 60 years as on 31st of March 2024. This was one major confusion, but circular has been issued and they have told that your age will be this 60 years or 80 years by 31st of March 2024, and therefore he will be eligible to take a higher exemption limit of 3 lakhs and 5 lakhs respectively. Now, sir, we saw the tax rates. Now what happens is, once your income crosses a specified limit, apart from the normal tax, you will also have to pay some extra tax. Apart from what, sir? Normal tax, you will also have to pay some extra tax. This extra tax is called as what, sir? Surcharge. What is surcharge, sir? Surcharge is an extra tax which is paid by an individual HUF AOP BOI artificial judicial person. This is nothing also called as tax on tax, or it is also called as what, sir? An extra tax. Surcharge is an extra tax. Surcharge is what, sir? Surcharge is an extra tax. Surcharge will be applicable for individual HUF AOP BOI artificial judicial person. Surcharge will be applicable only if the total income is more than 50 lakh rupees. Tell me, when will the surcharge be applicable? Surcharge will be applicable only when the total income is more than 50 lakh rupees. Now, what is the surcharge provision telling? If your total income is up to 50 lakhs, you don't have to pay any surcharge. If your total income is from 50 lakhs to 1 crore, you will have to pay a surcharge of 10% of tax amount. Meaning, say my tax amount came to 5 lakhs. Okay, my tax amount comes to 5 lakhs. Sir, 5 lakhs as per which provision, sir? As per this above computation, it came to 5 lakhs. On that 5 lakhs, on the tax amount, I will have to levy surcharge. Surcharge of 10% if your income is from total income is from 50 lakh to 1 crore. Then if your total income is from 1 crore to 2 crores, you'll have to pay 15% of tax amount as surcharge. If your total income is from 2 crores to 5 crores, you'll have to pay 25% of tax as surcharge. And if it is more than 5 crores, you'll have to pay a surcharge of 37%. You'll have to pay surcharge of how much, sir? 37%. So if your total income is up to 50 lakhs, then no surcharge. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. 2 crores to 5 crores, 25%, and more than 5 crores, 37% surcharge is required to be paid. And on special income, okay, on special income, the surcharge shall not exceed 15%. It shall not exceed 15%. Sir, what do you mean by the special income, sir? It special income does not mean the income taxable at special rates. No, special incomes means the dividend income, income taxable under section 111A, 112, and 112A, meaning dividend income and short-term capital gain under section 111A, long-term capital gain under section 112, and long-term capital gain under section 112A. On these 4 incomes, the maximum amount of surcharge which the lawmakers can collect from you is how much, sir? 15%. Even if the income exceeds 2 crores, even if the income exceeds 5 crores, how much surcharge you have to pay on these incomes? It is restricted to 15% on these 4 incomes. Dividend income, income taxable under 111A, 12, 12A. So in short, if the total income consists of normal income and special income, the higher limit of 25% or 27 shall be applicable only when the normal income is more than only if they themselves are more than 2 crores or 5 crores. Meaning what, sir? The limit of 25% and 35% will be applicable. Meaning now what you will have to do, whatever total income you have to divide that. Special incomes and other incomes, or normal incomes. So special incomes means what, sir? These 4 incomes. You write that separately. And these other incomes, if this other income by themselves are more than 2 crores or more than 5 crores, then the higher limit of 25% or 37% will be applicable for surcharge. Apart from that, we also have something called as what, sir? Health and education cess. This is compulsorily required to be levied whenever there is a tax which you have to pay. Whenever there is what, sir? Whenever there is a tax which you have to pay, on that 4% of tax amount you will have to pay as surcharge. Surcharge is what, sir? Surcharge is 4% of tax, including 4% of tax you will have to pay as health and education cess. Sir, 4% of tax means tax including the surcharge amount. Meaning, say 5 lakh rupees is my tax amount, 1 lakh rupees is my surcharge amount. So on this 5 lakhs, my tax amount, 1 lakhs is my surcharge amount, 6 lakh rupees. On this 6 lakh rupees, I'll have to pay 4% as health and education cess. Health and education cess is compulsory. Surcharge may or may not come, but health and education cess will compulsory come. My tax amount is 2 lakhs. This surcharge is 0. So in that case, my total tax which I have to pay is 2 lakhs plus 4% health and education cess. Health and education cess will come compulsorily, irrespective of whether a person is having surcharge or not. Health and education cess will come. Now, apart from that, an individual will also get extra benefit. An individual will get something called as what, sir? Rebate under section 87A. Sir, what is this rebate under section 87? Rebate means what, sir? An extra benefit which the lawmakers are given if your income is up to some amount. It is available only to a resident individual. Rebate is available to whom, sir? If you are a resident individual, you will get the rebate. When will the rebate be given? If your total income is up to 5 lakh rupees, you should be a resident individual having a total income up to 5 lakh rupees. Rebate will be given under section 87A. How much rebate will be given, sir? Equal to tax amount or 12,500, whichever is less. What is this point telling? If you are a resident individual having your total income up to 5 lakh rupees, resident individual, the word resident is very important. So this is not applicable for non-resident, and the word individual is also very important. This is not applicable for HGF, this is not applicable for AOP, BOI, etc. It is applicable only to a resident individual if his total income is up to 5 lakh rupees. If it is more than 5 lakhs, no surcharge. If it is exactly 5 lakhs, then also available. If it is more than 5 lakhs, no rebate will be available. If it is exactly 5 lakhs, then also rebate will be available. So rebate, how much rebate will be available, sir? The tax amount, how much rebate will be available? Whatever tax amount is coming, the tax amount, or 12,500, whichever is less. Whatever tax amount is the tax amount, or 12,500, whichever is less. Now, other important points. Rebate is required to be reduced before adding health and education cess. Whenever you are computing tax, after computing the tax amount, subtract rebate, then whatever is left over, on that you will compute your health and education cess. On that you will compute what's health and education cess. So rebate is required to be reduced before adding health and education cess. Rebate shall be available against all types of income except on long-term capital gain under section 12AA. Except on long-term capital gain under section 12AA, except on this income, if an assessee has any other type of income, even if it is a lottery income, even if it is a betting gambling income, even if it is a long-term capital gain under 112 or short-term capital gain under 111A, etc. On all these incomes you will get a rebate, but rebate will not be given against which income, sir? Rebate will not be given against long-term capital gain under section 112A. Then rebate under section 115BC. Rebate under 115BC. There is a section called as 115BC. For that, what is the rebate? We will see separately. It will be discussed separately when I am discussing 115BC. We will see it very soon. Now, so this was what was the tax rates applicable for individual HO of AOP, BOI, artificial judicial person. Sir, what about the companies, sir? What about companies? The tax rates for companies. Companies, what is the tax rates applicable for a company? Normally the tax rates applicable to domestic companies 30% and foreign companies 40%. Domestic company has to pay the tax of how much, sir? 30%, and foreign company has to pay the tax of 40%. Domestic company has one extra advantage. What is this point telling? Note, if the turnover or gross receipts of domestic company, gross receipts of domestic company is up to rupees 400 crores in the previous year 21-22. Please note, not in your examination previous year is what, sir? 23-24. Okay, for this the tax rate of 25% will be levied. Normally for domestic company, what is the tax rate, sir? 30%. But they are going to levy tax rate of 25% if the turnover of the domestic company or gross receipts of the domestic company is up to 400 crores. It is up to how much, sir? 400 crores. In which year? In the previous year. 21-22. So in the previous year 21-22, if the turnover of domestic company is up to 400 crores, then tax rates for the previous year 23-24 will be 25%. Sir, is this provision applicable for foreign company also? Answer is no. This 25% rate is applicable only for domestic company if the turnover is up to 400 crores. In which year? Previous year 21-22. Sir, what if in this year my turnover is only 100 crores, sir, which is less than 400 crores? Will 25% apply? No. This year it does not matter how much your turnover is. 21-22, how much your turnover, that is important. If this year you have started the business only in this year, then also the rate of 30% will be applicable. Surcharge also is applicable for companies. Surcharge will be applicable if the total income is more than 1 crore rupees. If the total income is more than what, sir? If the total income is more than 1 crore rupees or and up to 10 crore rupees, surcharge of 7% will be levied. And in case of foreign company, 2% will be levied. If the total income is more than 10 crores, surcharge of 12% will be levied for domestic companies and 5% will be levied for foreign companies. Health and education cess, needless to say, it will always come. It will be levied on 4% of tax including the surcharge amount. Sir, what about partnership firm, LLP, local authority? What is the tax rate applicable to them? Therefore, tax rates for partnership firm, LLP, it is 30%. And surcharge will be levied if the total income is more than 1 crore rupees. Surcharge is of 12% of tax, and health and education cess will definitely be levied at 4% of tax amount including surcharge, irrespective of their total income. What is the tax rate for cooperative society, sir? For cooperative society, up to 10 lakhs of total income, no tax will be levied. Up to 10 lakhs of total income, the tax rate of 10% will be levied. Sorry. So even if 100 rupees income they are earning, 10% tax will be levied. If the total income is more than 10,000, not 10 lakhs. I'm really very sorry. Because we have seen the amounts in lakhs only, that lakhs is coming. Up to 10,000 rupees. Array, students, inge par. Up to 10,000 rupees, no, up to 10,000 rupees, the tax which they have to pay is what's a 10%. Even if 100 rupees income they are earning, they'll have to pay a tax of 10 rupees, 10% tax they have to pay. If their total income is more than 10,000 up to 20,000, 20% is the surcharge. And if it is more than 20,000, there is no up to over here. If it is more than 30, if it is more than what, sir? If it is more than 20,000, the tax rate of 30% will be levied. And surcharge will be applicable for them also. When will the surcharge be applicable, sir? Surcharge will be applicable if the total income is more than 1 crore up to 10 crores of 7% of tax. And if the total income is more than 10 crores, it is 12% of tax. Needless to say, health and education cess of 4% will definitely be levied for them also. Now, apart from this, we also have a small, beautiful concept called as concept of marginal relief. What is this marginal relief concept, sir? Whenever your income is slightly more than the surcharge limit, when will this marginal relief come? Whenever your income is slightly more than the surcharge limit. Say for example, my income is 51 lakhs. Normally up to 50 lakhs, there is no surcharge. When it crosses 50 lakhs, surcharge will be applicable. My income is say 51 lakhs. My income is 50 lakhs, 50,000. My income is 50 lakhs, 10,000. In such cases, the concept of marginal relief will come. Fantastic concept it is. The concept of marginal relief will come. Marginal relief is applicable when, meaning marginal relief means what, sir? Because your income is slightly more than the surcharge amount, the amount of tax which you have to pay may increase because of applicability of surcharge. The amount of tax which you have to pay may increase because of applicability of surcharge. So what they are giving is, we will give you relief. We will give you that extra whatever tax you are paying. No, we will give you the relief of that extra tax provided you give us the extra income. Concept of marginal relief. Marginal relief is applied when total income is slightly or marginally more than the amount on which surcharge is applicable. Marginal relief is applicable when the total income is slightly more than or marginally more than the amount on which surcharge is applicable. That is, if the total income is slightly more than 50 lakhs, 1 crore, 2 crore, 5 crores or 10 crores, depending upon which type of assessee you are, whether you are an individual, of company, etc., the tax on such income may be more than the additional income. What may happen is, because of applicability of surcharge, the tax on your income may be more than the additional income. To compensate the loss suffered by the assessee, margin relief is given. Margin relief will be available to all the assessees to whom this surcharge is applicable. Margin relief is nothing but the difference in increase in tax, that is the extra tax which you are paying with increase in income. The difference between increase in tax and increase in income is taken as margin relief. So how do I do the calculation of margin relief? First, calculate the tax including surcharge on the actual total income which you have. Then calculate the tax including surcharge on the total income, assuming that the total income is 50 lakhs or 1 crores or 2 crores or 5 crores. So how will I make an assumption? Say for example, if your total income is 50 lakhs 10,000, then in the step number 2, you will compute the tax on 50 lakhs. If your income is 1 crore, 1 lakh, then you will have to compute on 1 crore. If your income is 5 crores, 1 lakh, then you will have to compute in step number 2 tax on 5 crores. Meaning it should be slightly more than the surcharge limit. You will have to see what is the surcharge limit which is applicable to that particular case, and accordingly you will have to compare with that. Now, what is the increase in total income? Now, the difference between step number 1 and step number 2, you take the difference between step number 1 and step number 2. You take what's the difference between step number 1 and step number 2. That will give you increase in tax. That will give you what, sir? That will give you what is the increase in tax. Now you should see increase in income. Increase in income, you should compare what, sir? Increase in total income. You should compare your actual total income with that limit, surcharge limit, 1 crores or 50 lakhs or 2 crores, etc. Now you will find increase in income. So step number 1, step 2, step 3 will give you the marginal relief. This is a fantastic concept, very important concept from exam point of view. Special taxes, special taxes, special taxes, special taxes. There are some incomes for which what is applicable for that special tax rates is applicable. Section 112 talks about what, sir? Long-term capital gain. For long-term capital gain, tax rate is 20%. Long-term capital gain for 3 items. Which are these 3 items, sir? These 3 items are your listed equity shares, equity-oriented mutual fund, or units of business trust of India. For them, the tax rate is 10% for income in excess of 1 lakhs, and for short-term capital gain in normal cases, for short-term capital gain for these 3 items, same 3 items, listed equity shares, units of business trust of India, or units of listed mutual funds, etc., 15%. And normally the short-term capital gain is taxable at slab rates. So short-term capital gain can be of 2 types. Long-term capital gain also can be of 2 types. One is normal long-term capital gain and long-term capital gain of the special 3 specified items. And similarly, normal short-term capital gain and short-term capital gain for that 3 specified items. Then 115 BB, which is nothing but tax on casual income, is flat 30%. 115 BB tax on online money gaming is also 30%, and 115 BBE tax on undisclosed income or deemed income is 60%. Now, normally your income tax amount as well as your total income amount, you're required to round it off to the nearest multiple of 10. You're required to round it off to the nearest multiple of 10. Meaning, if the total income or the tax amount is up to rupees 4, the last digit is up to rupees 4, round it off to the previous multiple. If it is 5 or more, round it off to the next multiple of 10. So income tax, say for example, income tax is 156,234. So 4, so round it off to 34. So it is 30. 37, 7 is next number. So 40. 5 also next number. Now, the most important amendment which has happened in your entire syllabus is with respect to income tax law. Major amendment is with respect to 115 BAC. There is something called as what, sir? There is something called as 115 BAC. This was an optional regime all this time, but now they have made it as default regime. Very, very important. This was an optional regime. Now it has been made as what, sir? It has been made as default regime. It has been made as default regime. 115 BAC. This section is applicable to individual, HUF, AOP, BOI, artificial judicial person. In simple words, this is applicable to those assessees for whom slab rate is applicable. To whom is this 115 BAC applicable? So 115, very, very important section. 115 BAC is applicable for those individuals for whom, for those people for whom slab rates are applicable. This section is applicable to both resident and non-resident. It does not make any discrimination whether you are resident and non-resident. The beauty of this section is the tax are payable at slab rates, but here there is no restriction on age limit. Irrespective of what is your age, the tax rates remains same. The tax rate will remain same irrespective of the age. Irrespective of what, sir? Irrespective of the age of assessee. Irrespective of age of assessee, the tax rates will remain same. What is the tax rates, sir? Tax rates are also completely changed. So now the topics like this, you compare your August 23 edition, or you compare your August 22 edition or August 22 reprint edition, etc. What I was talking about over here. So if you compare with them, no, if you compare, I mean, it is showing in wrong format. If you compare with that reprint edition or this August 2022 editions, then you will find that what we are learning now and what is there in the material is completely different. It is completely different. It is completely different. So just a second. Why is it? Okay, it is different. So I am asking you to please, whenever you are studying this income tax law, no, from your material, please refer to which material, sir? Please refer to March 2024 edition. So who should refer this? June and December 24 students. No other changes will happen. Whatever changes they have made, they have already made in this book. No other changes is going to happen. So tax rates under 115 BAC. Total income up to 3 lakh rupees. If your total income is how much, sir? Up to 3 lakh rupees, you don't have to pay any taxes. If your total income is from 3 lakhs to 6 lakhs, 5%. 6 lakhs to 9 lakhs, 10%. 9 lakhs to 12 lakhs, 15%. 12 lakhs to 15 lakhs, 25%. And more than 15 lakhs, 30%. If your total income is up to 3 lakhs, up to 3 lakhs of your total income, you don't have to pay any taxes at all. From 3 lakhs to 5 lakhs, you will have to pay tax of 5%. From 6 lakhs to 9 lakhs, you will have to pay taxes of 10%. From 9 lakhs to 12 lakhs, 15%. And from 12 lakhs to 15 lakhs, 25%. And more than 15 lakhs, 30%. Fantastic. Tax rates are also changed when compared to what is there in the previous edition material. So what is happening over here? The income is increasing by 3 lakh rupees. Your income is increasing by 3 lakh rupees. The amount of tax which you are paying is increasing by 5%. Up to 15 lakh rupees, you increase your income up to 15 lakh rupees. Okay, by 3 lakh rupees. So for 3 lakhs 0, 3 to 6 5%, 5 to 3 to 6 5%, 6 to 9 10%, 9 to 12 15%, 12 to 15 it is 25%. Sir, what about 20%? Sir, the 20% has been removed. Now before the 20% point was there, but 20% has been removed now. Fantastic provision they have made, very useful for salaried employees if they are not making any investment. Up to 3 lakhs no tax, 3 lakhs to 6 lakhs 5%, 6 lakhs to 9 lakhs 10%, 9 lakhs to 12 lakhs 15%, 12 lakhs to 15 lakhs 25%, and more than 15 lakhs it is 30%. How much, sir? 30%. Sir, is surcharge applicable for 15 BSc persons also? Answer is 100% yes. Sir, what is the surcharge applicable to them? For up to 50 lakh of total income there is no surcharge. If your total income is from 50 lakhs to 1 crore, 10%, from 1 crores to 2 crores 15%, and more than 2 crores 25%. What does this mean, sir? 37% surcharge is not available for them. Surcharge limit of 37% shall not apply to 115 BSc assessees. So for 115 BSc assessees, the surcharge limit is normally same. Up to 2 crores it is same. More than 2 crores it will be flat 25%. 37% criteria is not there. Maximum surcharge to be levied on special incomes shall not exceed 15%. And what do you mean by special incomes, sir? The dividend income taxable under 111A, 112, 112A. On this income, maximum surcharge which can be levied is how much, sir? Maximum surcharge which can be levied is 15%. And needless to say, health and education cess is compulsory, that will be levied at 4% of tax amount including surcharge amount. Now 115 BSc persons also get something called as rebate. 115 BSc persons also get something called as rebate. Now rebate will be given to these types of assessee in two different ways. Let us see the first way. Rebate under section 87A. It is available to a resident individual if his total income over here is up to 7 lakh rupees. See, normal cases 5 lakh. Here 7 lakhs. 115 BSc 7 lakhs. It is available to a resident individual whose total income is up to 7 lakh rupees. The rebate under section 87A which will be given to him will be the tax amount or rupees 25,000 whichever is less. Tax amount or rupees 25,000 whichever is less. This is the rebate which we are going to give him. Tax amount or rupees 25,000 whichever is less is the rebate which is going to be given for 115 BSc person. Or there is one more method of computation of rebate for these types of assessees. This method is not available for normal individuals. For normal individuals, similar provisions like this is available. But for them, no, 115 BSc person, there is one more mechanism, one more criteria which they have got. What they are telling is, we will give you an extra rebate. We will give you an extra rebate if your income is slightly more than, 7 lakh rupees. Only slightly more than, like 7 lakh 500, 7 lakh 1000, 7 lakh 2000, 7 lakh 5000. Only up to slightly more than 7 lakh rupees. Then also we'll give you extra rebate. We'll give you some rebate. What is that? That rebate is nothing but the concept of marginal relief which you have studied. Marginal relief will be given for 115 BSc if his total income is slightly or marginally more than 7 lakh rupees. In such cases, rebate will be calculated in the following manner. Step number 1, tax on total income. Whatever they have given in the question, no, total income, on that you compute the tax as per that 3 lakh, 3 to 6, 6 to 9, etc. Then step number 2, tax if the total income is 7 lakh rupees. If your total income is exactly 7 lakh rupees, what is the tax amount which is going to come? What is the difference between step number 1 and step number 2? That is nothing but increase in tax. Then take your increase in income by comparing it with 7 lakh rupees. Take 7 lakhs as base and what extra income you have. Now if the step number 3, meaning if the tax which you are paying, the extra tax which is there is more than the extra income, then you will get a marginal relief. If the tax amount is, the extra tax which you are paying is more than the extra income which you have, then you will get a marginal relief, which is the difference between step number 3 and step number 4. It is a difference between step number 3 and step number 4. Now, when the lawmakers are giving you benefit, sir, this is better, no sir, this is better, no. What is better? Sir, 115 BAC is better, no sir, because we are going to get so many, the tax rates up to 15 lakh rupees, I have to pay tax only at 25%, no sir. This is always better, no sir. Up to 12 lakhs, it is only 15%, no sir. It is always better, no sir. Normal cases, once it crosses 10 lakh rupees, you will have to pay 30%, sir. Here it is only 15% up to 12 lakh rupees. So this is better, no sir? See, when lawmakers are giving you some benefits, no, they'll always take many benefits from you. Now, please note, I am assuming that those who are watching this marathon lectures have already studied income tax law. Please note, there is a complete different way of studying income tax and the indirect taxes. In case of indirect taxes, no, even if you start with marathon and then study your, then you do your studies, etc., you will be able to manage. But in case of direct tax, it is not like that. Because direct taxes, we are doing marathon. We are revising the entire syllabus in a very fast manner, correct? In case of direct taxes, the direct tax syllabus is very vast when compared to indirect tax. The syllabus is normally very vast when compared to indirect taxes. So for direct taxes, marathon videos will be only useful if you have already studied your normal one revision or one study is already done from your material. Then only you will get maximum advantage from this. Because now we will be, while discussing 115 BSc, we will be taking reference of all the other heads of income. So you should be knowing what it is. It does not mean that we are not going to discuss. We will definitely discuss all those heads of income. But then for this particular point, we will have that discussion. Conditions, or what are the benefits which the government is taking? Government is giving you the benefit of paying tax at a lesser rate. No, so government is also taking many benefits from you. What are those benefits? If you are from under income from salary head, no, they will not give you leave travel concession. If you are a salaried employee, if you are having salary income, you will not get leave travel concession under section 10(5). That exemption will not be given. House rent allowance deduction under 10(13)(a) will not be given to you. The exemptions under section 10(14) for allowances will not be given to you. What are those allowances, sir? You cheat, duck hat. What is this you cheat, duck hat, sir? Array, underground allowance, commutation allowance, hostel allowance, education allowance, all these allowances, that benefit which was there under 10(4), that will not be given. Transport allowances, conveyance allowances, daily allowances, and tour or travel allowance or transfer allowance, this will be given. Apart from these allowances, all the other allowances which are there under you cheat, duck hat will not be given to you. Transport, travel, daily and conveyance allowances will be given. Further, entertainment allowances and professional tax under section 16(1) and 16(1)(3) will also not be given to you. Meaning, if you are a person who is opting for 115 BSc under salary, only one benefit which you are going to get is standard deduction of 50,000. Only one benefit which you are going to get is standard deduction of 50,000 rupees plus these 4 allowances. So standard deduction plus 4 allowances. Apart from this, no other benefit will be given to you if you are a 115 BSc person. Further, from income from house property, is there any benefit which is taken, sir? From income from house property, in respect of interest for self-occupied. Interest for self-occupied property under section 24B will not be given. Interest deduction. Normally, when we are computing income from house property, we are reducing our interest income. That interest income reduction will not be given to you. That interest income reduction will not be given to you if it is a self-occupied property. Sir, what about let-out property? Let-out property definitely they will give, but for self-occupied they will not give that interest deduction. Then for PGBP, profits and gains from business and professions, no additional depreciation will be given. Additional depreciation will not be given to you. If you make any donation to scientific research organizations, associations, etc., institutions, they will not give you deductions. In-house scientific research allowed, but if you give donations, not allowed. Then deductions for 35 AD businesses, specified businesses, that also will not be given to you. Then further we have section 33 AB for tea, coffee, rubber businesses, that benefit will not be given. All those benefits have been taken from us. Then capital gain, there is no impact because the income is taxable at special rates. From income from other sources, if you are getting any daily allowance or constituency allowances, if you are an MLA or MP, you will get something called as daily allowance and constituency allowance. Normally it is exempt under section 10(17), but that exemption will be withdrawn. That exemption will not be given to you. Similarly, exemption for clubbing of minors income. Whenever you are clubbing a minor's income, under section 1032, 1,500 benefit will be given, but that benefit also will not be given if you are following 115 BSc. Then chapter 6A deductions will not be given to you. There are so many deductions, section 80C, 80C, CC, CCC, CCD, CCH, 80D, 80DD, DDB, 80E, EEB, etc. All these deductions which are there under section 80C series, chapter 6A deductions will not be given to you except 80CCD2, except 80CCDH2, except 80JJAA. That all the other deductions will not be given. Even 10AA deductions benefit which is given to SEZ units, that will not be given. Then set off and carry forward. Now set off and carry forward of losses. Set off of losses under the head house property will not be allowed with other incomes. Normally house property losses can be set off with any other types of income, but if you are following 115 BSE, I will not allow it. Further, if you have any brought forward losses because of any of the above reasons, then that cannot be adjusted in the current year income. Sir, what are the other important points with respect to 115 BSE, sir? Income tax for special incomes, no, for special income, the income tax will be levied at special rates only. Income taxable at special rates will continue to be taxed at special rates, irrespective of whether the assessee is or has opted for 115 BSE or not. Alternate minimum tax, there is something called as 115 JC. Alternate minimum tax under section 115 JC is not applicable to an assessee who is opting for 115 BSE. Now, what is the time limit, sir? If I want to opt for 115 BSE or if I want to come out of 115 BSE, when do I do it, sir? So normally, see, at the time of filing of your income tax return, you are supposed to tell the government. If you are having a business income, then you can opt out of 115 BSE anytime before filing of your return. If you don't have any, if you don't have any business income, you can opt out anytime before filing your income tax return. And once you opt, every year you can do this: opt in for 115 BSE, opt out of 115 BSE. But if you have a business income, no, if you have a business income, see, normally 115 BSE is default digit. But if you opt out of 115 BSE for all the subsequent years, you cannot opt in for 115 BSE. Once you come out of 115 BSE, you cannot come back to 115 BSE if you have a business income. If you have a business income, sir, what if my business income is gone, sir? I don't have business income anymore. Then you can opt in for 115 BSE again. Now, normally, what is the general rule, sir? General rule is previous year income will be taxable in assessment year. What is the general rule? What is the normal rule? The income of the previous year will be taxable in which year, sir? The income of previous year, normally the income of previous year will be taxable in which year? The income of previous year will be taxable in assessment year. But there are some situations, in these situations, no, the income of previous year will be taxable in previous year itself. Which are the situations? Income of a non-resident from shipping business. Income from shipping business of a non-resident. If you are a non-resident assessee doing shipping business in India, then your previous year income will be taxable in the previous year itself. Similarly, income of a person who is leaving India. If you are a person who is leaving India, you are going to and there is no expectation that you are going to come back to India on a shorter period of time, etc. Come back very soon. In such cases, say for 1 year, 2 year, 3 year, 4 year, you are going out of India, then your previous year income may be taxed in the previous year itself. Then an AOP, BOI, artificial judicial person which have been formed for a particular reason, particular purpose, after that purpose is over, they may not come back again, correct? So that person's previous income may be taxed in that year only. Or a person who is likely to transfer the property to avoid taxes. Now, say Vijay Mallya, etc., they are going to abscond. They are selling all the properties because they know that they have defaulted many loans, they have defaulted many taxes, etc. So they are transferring the property. In such cases, their tax will be collected in the previous year itself. Or income from discontinued business. You have discontinued your business, meaning what? I was doing some business, I have closed the business during the middle of the year only. Now lawmakers are telling I cannot wait till assessment year, you pay the taxes now only. Please note, in all these cases, which cases, sir? In case number 2 to case number 5, you will have to pay taxes only if the assessing officer feels that you are not going to pay the taxes. In case of income of shipping business of a non-resident, compulsorily he'll have to pay tax of in the previous year itself. But for other people, no, only if the assessing officer feels that it appears to the assessing officer that you may not pay the taxes. Only if he feels that you may not pay the taxes, then only he'll collect the taxes in all these cases. Then let us discuss one more point called as what is this, sir, deemed income, or what is this undisclosed income. There are some cash credits. Say for example, in your bank account, no, for a normal individual, in your bank account, normally your bank balance is 3,000 rupees, 10,000 rupees, 50,000 rupees. Someone transferred 1 crore rupees to your account. Someone transferred 1 crore rupees to your account, and no one is coming back and asking you. You are enjoying your life. You are enjoying your life. That I got 1 crore rupees in my bank account. Lawmaker says, hey, mister, you have got 1 crore rupees now. You have got 1 crore rupees now. This is cash credit. The cash has been credited in your books of accounts. The cash has been credited in your bank account. This will be deemed as your income. You don't know from where it came. It will be deemed as your income, and you'll have to pay tax on this income. You'll have to pay tax on this income. Then Unexplained investment. Say I have invested in 5-6 properties. I have invested in properties, but I have not recorded it anywhere. I have not told the income tax department about my investments, etc. In this case, it is unexplained investment. If the income tax department comes to know about that, then it will be deemed as my income. Unexplained money. Many times you would have seen in movies, etc. Raid will be conducted in the bathroom or pillars, etc. You'll find the wall of the house, etc. When they are digging, they'll find so much gold. They'll find so much cash, etc. These are all undisclosed income. In this Shivaji the Boss movie, you would have seen that Shivaji is taking all this money and keeping in gunny bags, etc. Correct? So all these are undisclosed income, unexplained money. In that case, unexplained money will be treated as your income. It is deemed as your income. You have to pay the taxes. In the sense, when it is deemed as your income, because you don't have any explanation for this income, no, I am going to deem that it is your income. If you have a proper explanation, no problem. You give me the explanation and pay the taxes accordingly. Amount of investment not fully disclosed. I have gold, 1 kg gold. I have disclosed only 500 grams. I have disclosed only 800 grams. 200 grams I have not disclosed. No. So this is what is this, sir? This is investment which is not fully disclosed by me. That extra investment which I have, 200 grams gold which I have, no, that will be taken as my undisclosed investments, and accordingly I will have to pay the taxes. Unexplained expenditure. I am a normal individual. I am a normal teacher, etc. I am spending 1,000 crore, 200 crores for my son's wedding. Or 1,000 by saying someone, I am also spending. I am also calling Rihanna. Hey, Rihanna, come here, do waka in my son's marriage, etc. Now I am also doing all these things. Unexplained expenditure. How did you get so much money, Mr. Dilip? Where did you get the money from to make this expenditure? So in such cases, what, sir? In such cases, unexplained expenditure, if I am doing, then also it will be deemed as my income. Amount borrowed or repaid from hundi. This concept is no more there. There was a concept back in 90s. No, there was a concept of hundi wherein the amount was transferred by one person to another person. That time, this core banking system, internet banking system was not there. So basis on hundi, the money was transferred from one place to another place. It is like a check. It is a letter. It is a letter which a bank will give. Using that letter, you can go to another bank in other country or bank in other state and take the money from there. So this hundi concept is no more there. So if you have borrowed or repaid the money through hundi and you don't have proper explanation from where you got that hundi, then it will be deemed as your income. Now this deemed income which we saw, all these incomes which you saw, they are taxed at very high rate. They are taxed at what rate, sir? They are taxed at the rate of 60% and surcharge of 25% will be levied on them. Plus 4% health and education cess will be levied. So effectively the tax rate may be 78%. See, whenever a raid is conducted, why a person is scared, sir? He is not scared that government is going to collect the taxes. He is scared because government is going to collect 78% taxes plus penalty will be levied. Almost when 100% penalty will be levied. So almost the 78% will become double. So that is the reason why people are scared. Now, apart from this, so this is with respect to your basics. Now, let us see agricultural income and residential status and scope of total income. Then we will take a chota sa break. Agricultural income is very easy chapter, very small and compact topic. Agricultural income. What is this agricultural income telling, sir? Normally I cover this agricultural income also under basic topics only. Agricultural income. We all know agricultural income is exempt from payment of taxes. If that agricultural income is from land in India, it is exempt under section 10(1). If agricultural income is from an agricultural land outside India, not exempt. If an agricultural land is in India and you are getting agricultural income from that, then only exemption will be given. What do you mean by agricultural income, sir? 4 points are there. What do you mean by agricultural income? 4 points. Any rent or revenue derived from land situated in India and used for agriculture purpose. Income derived from such land. By agricultural operations, or income from a farm building or a dwelling unit on agricultural land used for agriculture purpose, and income from nursery plantations, sapling and seedling, etc. Any rent or revenue derived from an agricultural land situated in India, it should be situated in India used for agriculture purpose, or any other type of income which you are deriving from an agricultural land in India by doing agricultural operations. I don't have any rent. Say, for example, first case, I have an agricultural land which I have given it on rent to someone, and that person is doing agricultural activities. I am just generating rent. So that is an agricultural income. Now, income from such land by agricultural operations. For example, that land did not belong to that person. He is using my land, he is doing agricultural operation, whatever income he is deriving from that land is also treated as agricultural income. Income from farm, building or dwelling unit on agricultural land. Or agricultural land, no, I may have a farmhouse wherein all the people nearby my agricultural land are storing their agriculture produce. So that will be treated as what's agricultural income. Income from nursery, plantations, sapling and seedling is also treated as what's agriculture income. Say for example, I don't have an agricultural land. I have a terrace garden wherein I'm small this kothambari or the tomatoes etc. I'm cultivating over there only. I'm consuming it for myself also and I'm selling also. In such cases, these are nursery plantations. That income is also treated as agricultural income. Now, very important point is the meaning of agricultural operation or agricultural activity is not given in Income Tax Act. It is not at all given in Income Tax Act. Now, how do I know whether a particular activity is an agricultural activity or agricultural operation? You will have to see, there was a case law, Raja, Binoy, Kumar, Sahas, Roy. In this case law, Supreme Court gave the criteria for determining this. Supreme Court told, check whether a person is doing basic operation or subsequent operation. So basically there are two operations in agricultural activity, basic operation and subsequent operation. So what is this basic operation, sir? Up to the stage of germination, no, up to the stage of germination it will be called as basic operation, and post that it is called as subsequent operation. If a person is doing only basic operation, then he is involved in agricultural activity, therefore his income will be agricultural income. If a person is doing only subsequent, then he is not doing agricultural activity, therefore his income is not agricultural income, therefore it will be taxable. If a person is doing both basic as well as subsequent operation, it is treated as agricultural activity and it will be treated as agricultural income. Whatever income is going to get is treated as agricultural income. Next, sometimes what may happen is you as a person, say for example, I am a person who's cultivating potato. So this potato I can sell it in raw form. If I am selling the potato in raw form, that means whatever income I am getting, no, that is agricultural income only. Sometimes what may happen, this potato I may not sell it in raw form. I may do some process on this potato, convert this potato into potato chips and sell potato. So I am the cultivator of potato. I am converting them, applying some process on them and converting them into potato chips and selling the potato chips. In such cases, the income which I am going to get from the potato chips will be treated as composite income. It will be divided into two categories: income from agricultural. It will be divided into agricultural income and business income. How much is agricultural income? How much is business income? That criteria they have given in rule number 7. Composite income from sale of agricultural produce. Now, agricultural produce you are selling in raw form, no problem. It is treated as agricultural income, therefore fully exempt. If you are selling it in raw form, no problem at all, fully exempt. But if you are selling after applying some process, check whether that process was mandatory or not mandatory. Whatever process you have applied under that agriculture produce, whether that process was mandatory. For example, when I am a cultivator of potato, when I take out potato, no, mud will be attached to it, mud will be stick on that potato. So I am cleaning, washing those potato and then selling. So is this process mandatory for selling agriculture produce? Yes, sir, it is mandatory, no problem. So the income which I am going to get by selling those potatoes will be treated as agriculture income only. But what if the process is not mandatory? I am using those potato for making potato chips. In such cases, my income, agricultural income, will be computed in following manner. If the process is not mandatory for sale of agriculture produce, then computation of income shall be done as below. Your agricultural income and business income, there will be two incomes. Agricultural income will be how much, sir? Agricultural income, take the fair market. See, you have not sold the agriculture produce, but take the market value of this agriculture produce. If you would have sold this agriculture produce, how much you would have won? So what is the fair market value of agriculture produce used for further processing? Take that, subtract from that cost of cultivation. How much expenses you are incurring for cultivating that will give you agricultural income. Then particulars, what is the business income, sir? Business income, what is the sale value of final product? Whatever the potato chips you have manufactured, no? What is the sale price of that? Less. What is the fair market value of agriculture produce used for processing? Meaning, which is nothing but this value. Meaning, this agriculture produce I have not sold. I have this agriculture produce which is there, man. This agriculture produce I have not sold. This agriculture produce which is there, no. If I would have used it for my business purpose, if I would have purchased it from whatever I have used for my business purpose, if I would have purchased it from open market, how much I would have paid? Subtract that. And what is my cost of cultivation. What is my cost of cultivation, or what is my cost of processing this potato into potato chips? That will be giving what, sir? My business income. That will give my business income. Now, in case of rubber, in case of what, sir? In case of three business, tea, coffee, and rubber business, normally to find whenever there is a composite income, no, this is the procedure which I have to apply. This is the procedure which I have to apply. But in case of tea business, coffee business, and rubber business, for computing the composite income, the lawmakers have only directly given. See, if you are a person who is manufacturing and selling, if you are growing and manufacturing, if you are growing and manufacturing tea, growing and manufacturing coffee, or growing and manufacturing rubber, in these cases, if you are growing them and manufacturing them, then you will have to follow this process. Meaning, see, for example, I am a person who is cultivating tea leaves, using them for making tea powder. I am only cultivating and making tea powder. So I am growing tea and also manufacturing tea. So I am growing and manufacturing tea. In such cases, lawmaker says, in case of tea, 60% of what is the product which you are selling? It is tea powder, no? So whatever price you are selling, 60% of that, say assuming I sold that tea for 1 lakh rupees. I have first grown tea leaves, converted into tea powder, and sold the tea. Now I sold it for 1 lakh rupees. 60,000 will be treated as agriculture income, and 40,000 will be treated as what, sir? My business income. 40,000 will be treated as my business income. So you are growing and manufacturing tea, 60% agriculture income, 40% is my business income. Now you are growing and manufacturing coffee. Now the coffee can be of two types. You can either grow, manufacture, and sell it like that only, or you can roast those coffee, ground those coffee, and then sell. So if you are growing and manufacturing coffee, you are just growing and curing those coffee, removing the upper layer of that. Then 75% will be agriculture income, 25% will be business income. If you are growing, curing, roasting, and grounding that coffee, oh my god, so many processes you have applied, then 60% will be your agriculture income and 40% will be business income. And in case of rubber, 65% is agriculture income and 35% is business income. So rubber plantation, you are growing and manufacturing rubber. So by doing rubber plantation, from that you are manufacturing rubber, or latex, also called as what, sir? Latex. Then in such cases, 65% of your income is agriculture income, 35% is business income. Basically, in simple words, 60-40, 60-40, 75-25, 65-35. Whichever is higher is your agriculture income, whichever is less is your business income. And in your agricultural income, no, there is one more small concept called as what, sir? There is one more small concept called as concept of partial integration. There is one more small concept called as what, sir? Concept of partial integration. Now, what is this partial integration concept telling? Partial integration will be applicable to those people for whom slab rate is applicable. You should satisfy three conditions. Then for applying partial integration. See, normally agriculture income is exempt, but this partial integration concept, what does it do? They'll also include your agriculture income for computation of tax liability. So some concept is there. Let us see what it is saying. So concept of partial integration will be applicable only if you satisfy three conditions. Condition number one, assessee should be an individual HUF, AOP, BOI, artificial judicial person. And he should be having agricultural income which is more than 5,000 rupees, and his non-agricultural income should be more than basic exemption limit. Assessee should be individual HUF, AOP, BOI. Agricultural income should be more than 5,000 rupees. Non-agricultural income should be more than basic exemption limit of 2.5 lakhs or 3 lakhs or 5 lakhs. It should be more than basic exemption limit. Then the concept of partial integration will apply. What is this concept telling? Step number one, add your non-agricultural income with your agriculture income. Add your non-agriculture income with agriculture income, do the total of this and compute the tax on this total amount. Then add your agricultural income to basic exemption limit. Add your agriculture income to step number two, what, sir? Add your agricultural income to basic exemption limit amount and compute the tax on that. Difference between step 1 and step 2, take that. That is the amount of tax which you have to pay. Difference between step number 1 and step number 2 is the amount of tax which you have to pay. Obviously, you will also have to apply the provisions of rebate, surcharge, health and education cess. So compute tax on agriculture income and non-agriculture income. Then compute tax on agriculture income plus basic exemption limit. The difference between step number 1 and step number 2 is the tax which you have to pay. Of course, you will have to apply the provisions of surcharge, rebate, health and education cess. Now this is with respect to basics. Now let us do one thing. I'll take a chota sa break. and continue the discussion. We'll continue the discussion on the other topics which are there. Hello friends, welcome back. Welcome back. So let us continue our discussion with this beautiful topic of income tax marathon. We'll start now with the next topic which we have is residential status. So let us start our discussion on residential status. Residential status. Now, whenever you are computing total income of any person, what is important to check is his residential status. So there are two topics, which is one is called as residential status, another one is called as scope of total income. One is called as what's a residential status, another one is called as scope of total income. For understanding, see basically if you see section number 5 talks about scope of total income and section number 6 talks about residential status. Okay, but then when we are studying, we'll first have to study residential status so that we better understand the topic of scope of total income. Basically, why are we studying this topic, sir? Residential status. To check whether a person is a resident of India or not resident of India. Why, sir? Why are we checking that, sir? Because only if you are a resident, then normally your income will be taxable in India, and if you are a non-resident, then you don't have to pay any taxes in India. Okay, we'll see which are the income taxable for non-residents also in India, which are the income which are taxable only for residents, etc. We'll see all those incomes one by one. Let us straight away start our discussion with this topic called as residential status. Now, residential status, which sections are? Section 6. Now, what is most important is residential status for individual. Residential status for individual is the most important residential status. Apart from that, the other residential status which we have like for company, firm, HUF, etc. They are very, very, very simple. Now, and one more thing, before we start our discussion, let me just tell you this point, that residential status is not equal to citizenship. I am a citizen of India. I am also a resident of India. Say for example, Chris Gale, he is a citizen of say West Indies, but he may be a resident of India. He may be a resident of India. So residential status and citizenship is not equal. They both are not equal. So we have residential status. So first is for, see basically how many types of residential status we can have, sir? For individuals and HUFs, they can be resident and ordinary resident. For individuals and HUF, they can be resident and ordinary resident but not ordinary resident, or they can be non-resident. And for others like company, firm, AOP, BOI, etc., they can either be a resident or they can be non-resident. So for individual and HUF, there is, if they are resident, they can either be resident and ordinary resident but not ordinary resident, or they cannot be resident, they are non-resident. Now let us see the residential status for individual. Residential status for individual, section 6, subsection 1, basic conditions. Now residential status of individual, section 6, subsection 1 talks about the conditions. If you satisfy this condition, you will be called as resident. Basic condition is given in which sections are? Section 6, subsection 1. Section 6, subsection 1 says an individual will be said as resident of India if he satisfies any one of the basic condition. If he satisfies what, sir? If he satisfies any one of the basic conditions. Now there are basically two conditions. This is condition number 1 and condition number 2. So this is point number 1 and point number 2. Now if he satisfies any one among them, then he will be called as resident. I am an individual. Please note, individual means what, sir? Mr. Dilip is an individual, Obama is an individual, Priyanka Chopra is an individual, Akshay Kumar is an individual, then we have Will Smith is an individual, Ratan Tata is an individual, Mukesh Ambani is an individual, etc. Individual means people like you and me. We are all individuals. So for an individual to be called as a resident, he will have to satisfy any one of the basic conditions. He will have to satisfy what, sir? He will have to satisfy any one of the basic conditions. What are the basic conditions? What is there in basic conditions, sir? Basic conditions is he should stay in India. Oh, what is this point telling? He should stay in India for a period of 182 days or more in the previous year. So if in the previous year, in our we have seen that year can be divided into two categories. One is called as previous year, another one is called as assessment year. Previous year is the year in which you are earning the income, and assessment year is the year in which the tax has been paid. For your examination, what is the previous year, sir? For your examination, previous year is equal to 23-24. So what are they telling? If you are staying in this previous year, if you are staying in India in this previous year for a period of 182 days or more, if you are staying in India for 182 days or more, then you will be called as resident. If you are staying in India for a period of 182 days or more in the previous year, or second condition is, or what, sir? You are staying in India for a period of 60 days or more in the previous year, and 365 days or more in 4 preceding previous year. 365 days or more in 4 preceding previous year. So basically if you see in the first condition says in the previous year, which is previous year 23-24, your stay in India should be what, sir? Your stay in India should be 182 days or more than 182 days. Second basic condition says in the previous year 23-24, in the previous year your stay should be in the previous year for which we are computing the residential status, your stay should be 60 days or more, and in last 4 years, in 4 preceding previous year, in last 4 years your stay in India should be for 365 days or more. Your stay in India should be for 365 days or more. Okay, so basic condition if an individual satisfies basic condition, there are 2 conditions. Any one of the basic condition he'll be called as resident. If he does not satisfy, then obviously he is non-resident. What are the basic conditions, sir? His stay in India should be for 182 days on or more in the previous year, or 60 days or more in the previous year, and 365 days or more in 4 preceding previous years. Once an individual satisfies basic condition, he will have to go to the next stage, meaning there are in this game there are 2 stages. So first stage only, if you are not satisfied, you are not a resident, you are not at all resident, you are a non-resident person. If you clear the stage 1, then you have to go to the stage 2. So once you satisfy the basic conditions, I will check for additional conditions. What are additional conditions telling, sir? Additional condition says you should, sir, see sir, if I satisfy, I am a resident. If I satisfy basic condition, I am a resident. If I don't satisfy basic condition, I am a non-resident. Now, this residence can be of 2 types. It can be resident and ordinary resident, or resident but not ordinary resident. To check whether he is a resident and ordinary resident or resident and not ordinary resident, we will have to see what's the additional conditions. What is the additional condition says? Additional condition says he should be resident for a period of 2 or more previous years in 10 preceding previous year. He should be resident for 2 or more previous year in 10 preceding previous year. Basically, what does this point say, sir? He should be resident for at least 2 years. He should be resident for at least 2 years. In last 10 years, ignore the previous year, ignore the year for which you are computing. Apart from that, in last 10 years, he should at least be resident for 2 years. Resident for a period of 2 or more years in 10 preceding previous year. Meaning what, sir? He should satisfy in last 10 years, he should satisfy what, sir? He should satisfy 6-1 condition at least for 2 years. He should satisfy the basic condition for at least 2 years. And whenever the word end is there, that means what, sir? Both the conditions should be satisfied. And his stay in India should be for 720 days or more in 7 preceding previous year. And his stay in India should be for how many days, sir? 729 days or more in 7 preceding previous year. I'll repeat. Once I satisfy basic condition, I'll check for additional condition. Additional condition says resident for 2 or more years in 10 preceding previous years, and stay in India should be for 729 days or more in 7 preceding previous years. Now, what are some important points for the above? What are the important points, sir? Note number 1, date of coming to India, that is date of arrival, and date of leaving India, date of departure, should also be included when you are calculating the number of days of stay in India. So date when he is coming and date when he is going should also be included. Where is he staying is not important. Whether he is staying at same location it is not mandatory. The stay should be in India, and that stay, whether it is continuous or not, also it does not matter. The term stay in India includes stay in territorial waters also. Now, India does not mean only the land region of India up to 12 nautical miles from the Indian region, no? From the seashore, from the land region, this area is called as territorial waters. India will include that territorial waters of India. Now, what do you mean by India, sir? India means territory of India as per the Constitution, Article 1 of Constitution. Its territorial waters, seabed and subsoil underlying the territorial waters, continental shelves, exclusive economic zone, etc. Not so relevant for your exam purpose. Next point is with respect to exceptions. Now we saw the basic conditions. There are some exceptions for that basic conditions. Exception to second basic condition. In the following cases, individual is said to be resident if he satisfies first basic conditions. Meaning these 2 cases. This is case number 1 and case number 2. These are exceptions to the second basic condition. It is an exception to what, sir? Second basic condition. See, basic condition 182 days or more. First basic condition. Second basic condition is what? 60 plus 365. So this 60 plus 365 will not be seen in these cases. In which cases, sir? In these two scenarios which you are seeing over here, in these two scenarios, 60 plus 365 will not be seen. What are we going to see? We are going to see first condition, first basic condition. When, sir, when you are a person, if an Indian citizen is leaving India, if a Indian citizen is leaving India during the previous year for employment outside India or as a crew member of Indian ship. If you are leaving India, why are you leaving India? Because you want to do employment outside India, because you want to start your own company outside India, because you want to work in a company outside India, or you are leaving India as a crew member of Indian ship. You are working for some Indian shipping company and therefore you are acting as a crew member of that Indian shipping company. Because you are a crew member, you will have to go along with that ship. So that crew member of Indian ship, a person who is leaving India for employment outside India or as a crew member of Indian ship, for these two kinds of people who are leaving India, I will check 182 days or more conditions. So in the previous year, if they have stayed in India for a period of 182 days or more, then only they will be called as resident. Then only they will be called as resident. Indian citizen or a person, or second category of persons are who, sir? An Indian citizen or a person of Indian origin who visits India. An Indian citizen or a person of Indian origin who visits India. An Indian citizen or a person of Indian origin who visits India during the previous year. Who is coming to India, who is visiting India during the previous year. In such cases, I will check his total income. I mean, in such cases also, normally a person who is an Indian citizen or a person of Indian origin. Sir, what do you mean by a person of Indian origin? Person of Indian origin means either you or your parents or your grandparents are born in undivided India. So if you are a Indian citizen or a person of Indian origin who is visiting India means what, sir? Coming to India. See, case number 1, leaving India. Case number 2 is visiting India during the previous year. You have come to India during the previous year and the total income, your total income in India is less than 15 lakh rupees. Your total income, meaning from Indian sources, your total income is less than 15 lakh rupees. Then I am going to check 182 days condition for you. I am not going to check the second basic condition. Similarly, what if, sir, my total income is more than 15 lakhs or equal to 50 lakhs? If your total income is more than equal to 15 lakhs, then you will be called as a resident if you satisfy any one of the following conditions. Which conditions, sir? Your stay in India should be for 182 days or more in the previous year, or your stay in India should be 182 days or more, same point is applicable for them also, or there is one more extra point which is added for them, or 120 days or more in the previous year and 365 days or more in 4 preceding previous year. 120 days or more in the previous year and 365 days or more in 4 preceding previous year. So if you are a person who is coming to India from outside India, you are an Indian citizen or you are a person of Indian origin who is coming to India, then I am going to check either 182 days condition or 120 plus 365 days condition. Now, once extra point or specific note for crew member of Indian ship. In case of an individual who is a crew member of Indian ship, the date mentioned in the continuous discharge certificate, there will be some, it is like attendance sheet, continuous discharge certificate. The date mentioned in the continuous discharge certificate as date of joining the ship and date of signing of the ship shall be excluded while calculating the number of days stay in India. So in case of a crew member of Indian ship, that while calculating number of days, the date of joining the ship and the date of leaving the ship should be excluded while calculating the number of days stay in India. Then there is one beautiful section added, section 6, 1 capital A, section 6 subsection 1 capital A, which talks about deemed residents. Sir, what is this deemed resident, sir? Deemed residents means what? They are basically not a resident. They are basically not a resident, meaning they are not satisfying the above condition, but we are going to deem that they are resident of India. We are going to deem that they are resident to India. Now, what is this point telling? Notwithstanding to anything contained in 6.1. Array, not following what is there in 6.1. I ignore what is there in 6.1. An individual who is an Indian citizen having a total income exceeding 15 lakh rupees shall deem to be resident of India in that previous year if he is not liable to tax in any other country or territory for the reason of his domicile or residence or any other criteria of similar nature. Meaning, what is this point telling? If you are a person who is an Indian citizen and you are having income from Indian income or income from Indian sources more than 15 lakh rupees and you are not a resident of any other country, meaning you are not paying taxes in any other country, then you will be deemed as a resident of India. You will be deemed as resident of India. Therefore, you will have to pay taxes in India. Explanation: for removal of doubt, it is hereby clarified that section 6(1) capital A shall not apply to an individual who is resident as per 6(1). So if you are already a resident as per 6(1), then 6(1) capital A is not applicable to you. So this was a residential status for individual. Individual residential status is important. Next, residential status for HUF. HUF, very simple. You should see where is the control and management of HUF. If the control and management of HUF is wholly or partially in India, if it is fully in India or partially, little bit at least, or either completely the control and management is in India, or at least some part of that control and management is in India, then he will be called as resident. If your control and management is wholly outside India, completely outside India, then the HUF is called as non-resident. So for HUF, I will check what's the control and management. Once I check the control and management, if it is wholly or partially in India, then it is a resident. If it is completely fully outside India, then it is non-resident. Once I check HUF is a resident or non-resident. Once I check HUF is a resident or non-resident, once it satisfies this 6(2) conditions, then I will have to check whether HUF is resident and ordinary resident or resident but not ordinary resident. Now, when you are checking this, when you are checking whether an HUF is a resident and ordinary resident or resident but not ordinary resident, you should check this information for Karta. Meaning, you should check whether our Karta satisfies the additional condition. Sir, which condition, sir? 6(6) condition. Who should satisfy? Karta should satisfy. Array, to check whether HUF is resident or not, I should see 6(2) condition. I should see what's the control and management of HUF. I should see control and management of HUF to check whether that HUF is a resident and ordinary resident or resident but not ordinary resident. I will check additional conditions. Once it is resident, I will check additional conditions for Karta. Once HUF is resident as per 6(2), we need to check if Karta satisfies additional conditions mentioned in 6(6). If he satisfies additional condition mentioned in 6(6), then it will be treated as resident and ordinary resident. Else HUF will be treated as resident but not ordinary resident. Sir, what about residential status for other categories of people like partnership firm, AOP, BOI, artificial judicial person, etc.? There also I will check control and management. If the control and management is wholly or partially in India, it is a resident. If it is wholly or fully outside India, it is a non-resident. Control and management means what, sir? It means the place where the policy taking policy decisions relating to business. Meaning you are taking, basically your business decisions are taken wherever your business decisions are taken. It does not matter whether day-to-day operations are happening over there or not. Where is the decision taking? Maybe your company is outside India, HUF is outside India, but all the decisions are taken in India. Therefore, it is an it is said that control and management is happening in India. Section 6, subsection 3, residential status of a company. In case of a company, I will see poem of the company. I will see what's the poem of the company. What is the poem of the company, sir? We'll see that. Now, please note, Indian company is always a resident of India. If you are an Indian company, you are always a resident of India. For a foreign company, I am going to see the poem. What is poem, sir? If the poem is in India, then it is a resident, or else it will be non-resident. Poem means place of effective management. Poem means what, sir? Place of effective management. For a Indian company, always a resident of India. Foreign company, I will see place of effective management. If the place of effective management is in India, it is a resident. What do you mean by place of effective management? The place where key managerial and commercial decisions are taken. That place where key managerial decisions or key commercial decisions are taken. Now, why is it important for us to understand this residential status, sir? Because we have to know whether a person has to pay tax in India or not. Depending upon what is your residential status, the tax which you have to pay will also come. The tax which you have to pay will also come depending upon what's your residential status. Now, please note, if you are a resident of India, all the income, whether it is Indian income or foreign income, whatever type of income it is taxable in India. If you are a non-resident, then only Indian income is taxable in India. In simple words, I am telling this. Only Indian income will be taxable. See, for resident, all the types of income will be taxable. But for non-resident, only Indian income will be taxable. Other incomes will not be taxable. Now, what is this Indian income, foreign income? Let us understand this. Section 5. Section 5 talks about what's the scope of total income. Now, total income can be of two types. One is Indian income or foreign income. Indian income and the residential status can be resident and ordinary resident but not ordinary resident or non-resident. So, Indian income is taxable for everyone irrespective of what is your residential status. I don't care whether you are a resident and ordinary resident or resident but not ordinary resident. resident, non-resident, resident but ordinary resident, resident but not ordinary resident. I don't care who you are. I don't care what is your residential status. If it is an Indian income, irrespective of who you are, it is always taxable in India. But if it is a foreign income, then it will be taxable. It will be taxable only for resident, Sir, what do you mean by foreign income, sir? Now, foreign income are divided into two categories. Foreign incomes normally are divided into two categories. If the income is from a business or profession controlled from India, or profession set up in India. If the income, the foreign income which you have is, say for example, I have Priya sarees outside India. I have a saree shop outside India, so I am controlling it from India. Then it will be treated as foreign income, because the income is generated outside India. It is a foreign income only. It is income generated outside India. So in this case, income from business controlled from India or profession set up in India will be taxable if you are a resident and ordinary resident but not ordinary resident, and it will not be taxable if you are a non-resident. If you are a non-resident, then that income will not be taxable. Any other type of foreign income, say I have building outside India, I have any business or profession outside India which I am not controlling from India, etc. In such cases, all those incomes will be treated as foreign income. Any type of foreign income will be taxable only if you are a resident and ordinary resident. If you are a resident but not ordinary resident or a non-resident, foreign incomes will not be taxable for you in India. Normally, foreign income will be taxable only for resident and ordinary resident. For resident and not ordinary resident, foreign income will be taxable only if it is from a business controlled from India or profession set up in India. Now, sir, what do you mean by this Indian income, foreign income, sir? In simple words, Indian income means the income which is received in India. If you are receiving that income in India, it does not matter where the income is accruing. It does not matter from where the income has arisen. If the income is received in India, that means it is an Indian income. Income received in India. Income deemed to be received in India. If the income is deemed to be received in India, then also it is an Indian income. Now, there are totally four items covered over here. That 4 items will be treated as income deemed to be received in India. What are these 4 items, sir? Say if the contribution made in recognized provident fund more than 12%, or the interest in excess of 9.5% in RPF account, transfer of balance from unrecognized provident fund to recognized provident fund, and contribution made to ATCCD pension fund. These 4 incomes are always treated as Indian income. Okay, it is always treated as deemed to be received in India. Income received in India means what you are actually receiving in India. It does not matter where it is earned, whether it is earned in India or outside India. If it is received in India, then it is an Indian income. Income deemed to be received in India means these 4 items. Income accrued or arising in India. For example, I have a property in India. That means income is, I am getting rent from that. Income is accruing in India, arising from India. Income deemed to accrue or arise from India. Income deemed to accrue or arise from India. There is an Indian company which is giving me dividend. Indian company, I have made an investment. I am selling the shares of that Indian company, etc. Income deemed to be accrued or arise in India. So income, foreign income means any income other than Indian income. So what is important for you is to know Indian income. Any other type of income is a foreign income. Important points. For resident and ordinary resident, global income, irrespective of where that income is earned or received, etc., global income will be taxable in India. It will be taxable in India. Income received means it's first received. When we say income received, that means we are talking about the receipt of the income for the first time. If the income is first received outside India, then it is remitted to India, then such income will not be treated as received in India. Now, if I have earned the income outside India, I received the income outside India, then I am getting that income to India. Will it be taxable in India, sir? No, it is not treated as income received in India. It is not treated as income received in India. Income may be in cash or it may be in kind also, it does not matter. Income accrued in India means income generated in India or having its source in India. Income which is generated from India. Any past untaxed foreign income brought to India in the current year shall not be taxable. So the income was pertaining to some previous years, meaning not our exact previous year, but some last year, say 5-6 years back, I had went to foreign country, I had earned some income. Now I am bringing that income was not taxed at that time. Now I am bringing that income to India. Is it taxable, sir? Answer is no, that is not taxable. So this is the summary of this. So if it is an income accrued, deemed to accrued, received or deemed to be received in India, it is taxable for everyone. If it is accrued outside India but received or deemed to be received in India, it is taxable for everyone. accrued or deemed to be accrued in India but received outside India, then also it is taxable for everyone because it is accrued and deemed to accrued. Income accrued and received outside India from a business or profession set up in India, then also it will be taxable only for resident people. For non-resident people, it will not be taxable. Income received outside India, profession also outside India, taxable only for resident or not resident, others not taxable. Income accrued and received outside India in the previous year. Basically, you should check whether it is foreign income or Indian income. Say it is Indian income, Indian income, Indian income. This is foreign income but taxable for first two cases. Foreign income taxable only for this person. Foreign income taxable only. Past untaxed income will never be taxable for anyone. Okay, so this is all about your residential status. Very simple topic, very easy topic. The main discussion of the income tax law will start now. The important discussion of income tax law we are going to start now. So please note, we are going to start with house property. Meaning there is a proper mechanism of learning this, okay? Income tax law, no? Income tax law, people feel that income tax law is difficult. It is not difficult. People feel that income tax law is very vast. Yeah, it is vast, but it is not difficult. Vast does not mean it is difficult. One of the easiest paper when you see is income tax paper. Tax paper basically is an easiest paper. The easiest being indirect taxes. Easiest being indirect taxes because there is nothing to think a lot about indirect taxes. The provision is there. Any layman also while reading the provision can understand the provision. But when we talk about income tax law, no, when we talk about direct taxes or income tax law, no, you have to use your brain. The problem comes when we are asked to use our brain. That is the place where the problem comes. In income tax law, you have lot of provisions to remember. There is a linkage between one provision and another provisions. So there is a proper mechanism in which you should learn your income tax law so that you start loving this chapter, the income tax subject. So if you want to start loving this subject, no, you should start with this in the same format in which we are going to study. Okay, so we are starting our discussion on heads of income. Please note, in your syllabus, income tax is divided into three categories. First is your basics, which will come for around say 5 marks, which will cover this basics, computation of tax and residential status. Then we have, I think 5 or 10 marks maybe. Then we have what? Your heads of income. Heads of income in your examination almost around 25 marks is minimum 25 it will come, but what I have seen is almost around 32 to 36 marks will be from heads of income, and the balance topic will be for another 15 marks. The balance topic will be for another 15 marks. So this heads of income which you are seeing now is very beautiful, very important from exam point of view. And if you have not watched the IDT video, no, these GST and customs marathon, you please watch that, because first 15-20 minutes, no, almost around 17 to 18 minutes, first 18 minutes I have just discussed what is the question paper pattern, what happens in examination, how they are asking questions in the examinations, etc. Okay, so let me straight away start my discussion with this income from house property. Let us start our discussion on what topics are heads of income. So first head of income which we are going to start is income from house property. Let us start. Okay. Income from income from house property. Section 22. Section 22 is what? Section 22 is the charging section of income from house property. Section 22 is the charging section of income from house property. Section 22 says rental income of an house property will be taxable under the head income from house property if two conditions are satisfied. And section 22 says rental income from an house property will be taxable under income from house property if two conditions are satisfied. Which are these two conditions? Are there should be a house property and assessee should be owner of such house property. What is this point telling? Rental income of an house property will be taxable under the head income from house property if two conditions are satisfied. What are these two conditions? There should be a house property and assessee should be owner of such house property. Sir, what do you mean by house property? Sir, house property means building and land appertaining to such building. What do you mean by house property, sir? Building and land appertaining to such building. So what is this point telling? Basically, if you have a house property, from this, if you are receiving a rent, that rental income will be taxable under income from house property. But by selling the property, if you are getting any capital gain, that will be taxable under capital gain topic. But we are discussing only about the rental income. Okay. Now, what do you mean by house property, sir? Building. This is the building and land appertaining to that building. Land appertaining to that building. Now, sir, this house property, should it be commercial building, sir? It said building, sir. Should it be commercial? It can be any type of building, whether it is commercial, industrial, residential, etc. It does not matter. Any type of house property, any type of building will be covered over here. Now, basically, for our computation purpose, no, for our income tax purpose, for our what purpose, sir? For our income tax purpose, the house properties are divided into two categories. One is called as let out property, another one is called as self-occupied property. One is called as what, sir? Let out, another one is called as self-occupied. Now, what do you mean by let out property, sir? The property which you have given on rent is called as let out property. What is self-occupied property, sir? The property which is occupied by you yourself. For example, I am having a house, in that house I am staying, so that is called as self-occupied property. I am having a house which I have given on rent, that is called as let out property. So let out property which is there, no, it will always be taxable under income from house property. It does not matter to whom it is let out, etc. So let out property, what, sir? Let out property will always be taxable under income from house property. It will always be taxable. Self-occupied property, what they are telling is self-occupied. A person may self-occupy a property. Say, for example, I have a property. Now, this property is occupied by me. It is self-occupied by me. I may self-occupy this property for two cases. One is for my residence purpose or for my business purpose. A property, a self-occupied property can be self-occupied. An house property can be self-occupied for two cases. One is residence purpose, one is for business purpose. If it is self-occupied for business purpose, lawmaker says please ignore, because you are already earning income from this property from under the head business. I don't want to tax you over here. I don't want to pay the taxes on this property anymore again, etc. So you please ignore that property. If it is a self-occupied property for your business purpose, kindly ignore. If it is self-occupied property for your residence purpose, if you have a self-occupied property and it is for your residence purpose, then 2 arrow marks. Check how many properties you have. Do you have one property? Do you have two properties? Okay, you have two properties. Up to two properties is exempt. Up to two properties, no problem at all. It is exempt. If you have more than two properties, I have 3 properties, 5 properties. I have 5 houses. I have 8 houses. Now, lawmakers are telling, if you have 5 houses, 8 houses, Mr. Dilip, if you have 5 buildings, 8 buildings, etc., self-occupied. Okay, I have more than 2 self-occupied property. Then what will happen, sir? 2 arrow marks. What will happen if there is more than 2 self-occupied property? If there are more than 2 self-occupied property, they are telling, okay, no problem. Up to 2 properties, you claim the exemption. You claim the exemption for the remaining self-occupied property, which are there. No, please note. If you have self-occupied property for residence purpose, then up to 2, no problem. If you have more than 2, then 2 will be exempt. The remaining properties will be deemed to be let out property. They will be deemed to be let out property. They will be deemed. We are going to assume that these properties are let out. It will be deemed that it is a let out property. Then, now there is a specific format for computation of why, sir, we should start the discussion. You said, sir, we should start our learning from this house property chapter, because the house property topic is a very simple topic. There is a specific format which they have given for computation of your income from house property. If you know this format, you will get the answer. Just applying this format will give you the answers. What is this format telling? Say, how do I compute the income from house property? Basically, when you are computing the income from house property, they are going to check your actual rent which you are receiving and compare that with expected rent. They are going to compare your actual rent with expected rent. Once they compare both of them, they will take whichever is higher of that. Whichever is higher will give you what's a gross annual value. That will give you gross annual value of the property. Now, this is the annual value of the property. From this, whatever municipal taxes, property taxes you are paying towards the property, please subtract that. You will get your net annual value. From the net annual value, please allow some deductions. You please allow some deductions of flat 30% for repairs, etc., which you have incurred. And if you have taken any loan for the property, then interest on loan. These deductions you allow, then the amount left over after that deductions will be called as income from house property. Basically, what am I supposed to do, sir? In computation, I will have to compare expected rent with my actual rent. What is this expected rent, sir? Expected rent, you will have to arrive at this figure of expected rent. You will have to take your municipal value of the property. You will have to take your municipal value of the property. Now, this municipal value which is there, just a second, I'll zoom this up again. You will have to take your municipal value. This municipal value you will have to compare with your actual rent. Okay. So first we need to compare your expected rent with actual rent, and you will get your gross annual value. Sir, what is this expected rent, sir? Expected rent is nothing but your you should take your municipal value of the property. What do you mean by municipal value? The value of the property as per municipal record. Compare that municipal value with fair rent. Sir, what is this fair rent, sir? Fair rent means similar, if there are similar properties nearby that property, no, what is the value of that property? Fair rent means what, sir? The reasonable amount of rent which similar property is fetching in that particular locations. So compare your municipal value with your fair rent, take whichever is higher. Compare both of them and take what, sir? Whichever is higher among them. Take whichever is higher. Compare that whichever is higher amount. You take both of them and take whichever is higher. Now this whichever higher amount is there, now that you should compare with your standard rent. Sir, what do you mean by standard rent, sir? Oh, sir, what do you mean by standard rent? Standard rent is the maximum amount of rent which you can charge for the property as per Rent Control Act. There is something called as Rent Control Act. Rent Control Act is putting a restriction on how much rent you can charge. So you take whichever is higher from this and compare that with standard rent. Compare that with standard rent and take whichever is lower. Now you will get your expected rent. From this expected rent, compare that expected rent with your actual rent. What is expected rent, sir? Municipal value, fair rent, whichever is higher, compare that with standard rent, whichever is lower, you will get your expected rent. That expected rent you compare with your actual rent and you will get your gross annual value. From that gross annual value, subtract municipal taxes, you got your net annual value. Now net annual value into 30% flat deduction, you will get standard deduction. Net annual value into 30%, you will get a standard deduction of how much, sir? Standard deduction you will get of 30%. And from this net annual value, you are also required to subtract your interest on loan. If you have taken any loan for this house property, whatever interest you are paying on that loan also should be subtracted under section 24B. Then at the final amount which you get is called as income from house property. That amount will be called as what's income from house property. Many times in examination mistake will happen. What is the mistake which is going to happen, sir? In your total income questions, etc. Okay, what they are going to do, they are going to give you the rent received by this person is 1,50,000. The rent received is not an income from house property. Rent received is nothing but your actual rent. From that you are required to subtract municipal taxes if you have that municipal taxes information. From that you are allowed to subtract your NAV, flat NAV 30% deduction should compulsory given, and if interest information is given, then extra interest deduction also is required to be given by you. So income from house property, this is the total income from house property. So this is the format. Okay, name of the assessee, previous year for which you are doing the computation, what is the assessment here, computation of income from house property. Now please note, for self-occupied property, obviously we will not have to do all this computation. Directly you can start with NAV, taking NAV as 0. Why, sir? Because for up to 2 self-occupied property, it is exempt. You don't have to pay any taxes. So directly you can start the computation with NAV taking as 0. Then standard deduction will not come. Interest, if you have taken any loan on the property, then interest will come. If the loan is not taken, then that will also not come. So if you don't have this interest deduction also, then the income from house property will be 0. If you have an interest for self-occupied property, you have taken a loan for purchase of self-occupied property, then you may have this income from house property, which is this amount, sir. You may have this income from house property, which is negative amount. It can be a negative amount. If you have a let out property, obviously for let out property, all this information will be there, and deemed to be let out property is treated as let out property. Please note, if you have more than 2 self-occupied property, that extra properties which are there, no, they are deemed as let out property. For deemed to be let out property, they are treated as let out property, and therefore you will have to do all the computation. Everything will be there except actual rent. Sir, why, sir, we don't have actual rent? Because actually it is not rented. We are assuming it to be rented. Correct? So actual rent will not be there. Sir, municipal taxes, municipal value means the value of the property as municipal records. Fair rent means reasonable amount of rent for similar property at the same locality. Standard rent means rent as per Rent Control Act. Actual rent means rent received plus rent receivable minus unrealized rent. Municipal taxes, very important points with respect to municipal taxes. Municipal taxes means what, sir? The taxes levied on the house property by municipality or local authority. It is also known as house tax, property tax, CVS tax, local tax, etc. But this is allowed as deduction on payment basis. As and when you are paying, it will be allowed as deduction. For last 5 years, if you have paid it today, then also it will be allowed as deduction today. It is not allowed on payable basis. It is allowed on payment basis. If you have paid, it will be allowed. It will be allowed as deduction only if it is paid by the owner. Sometimes what may happen is in question they may give the information telling municipal taxes are paid by the tenant, then not allowed as deduction. If it is paid by the tenant, you cannot take it as deduction. Municipal taxes paid by the tenant later reimbursed by the owner, that will be allowed as deduction because owner is repaying it to the tenant. So only if it is paid by the owner, municipal taxes will be allowed as deduction. If municipal taxes is given in percentage form, you should take it as a percentage of what, sir? You should take it as percentage of municipal value. Next we have what, sir? Now, sir, you did not tell us anything with respect to actual rent. You said actual rent is rent received plus rent receivable minus unrealized rent. Sir, what do you mean by this? Actual rent is what, sir? Actual rent is rent received, rent receivable minus unrealized rent. You take your rent received, what you have actually received, rent receivable, what you are supposed to receive but not received, and unrealized rent. Sir, what is this unrealized rent, sir? What is this unrealized rent? Now, let me just give an example by, let me just give this, explain this concept of actual rent with simple example. Say, for example, I have a property. The rent of this property is rupees 10,000 per month. I have given this property on rent for a period of 12 months to Pushpa. Now, Pushpa, I have given this property on rent to whom, sir? Pushpa. Now, Pushpa paid the rent for 9 months and he did not pay the rent for 3 months. Okay, not okay. So, rent received is nothing but the rent for 9 months because it is actually paid by that person. So, it is rent received. Rent receivable means what, sir? The rent for 3 months because it is not paid by him. That rent becomes rent receivable. Now this is rent receivable. Okay, this unpaid rent is treated as rent receivable. Now 3 months rent he has not yet paid, so it becomes rent receivable. Now out of this 3 months rent, 20,000 he paid and 10,000 rupees 1 month rent he will never pay. He never paid and he is not going to pay it in the future also. Okay, so this amount becomes unrealized rent. This amount becomes what, sir? Unrealized rent. What is unrealized rent? The rent which I was supposed to receive but which I am never going to receive. That is called as unrealized rent. Rent receivable is rent which I am supposed to receive. Correct? Rent which I am supposed to receive is rent receivable. Unrealized rent means rent which I am never going to receive in my life. I am never going to receive. Now what they are telling is actual rent should be taken as rent received plus rent receivable minus unrealized rent. Unrealized rent can be subtracted only if you satisfy 4 conditions specified in rule number 4. What are these 4 conditions specified in rule number 4? They say that it should be unrealized rent will be allowed to be reduced if 4 conditions are satisfied. Which are these 4 conditions, sir? Condition number 1, the tenancy should be bona fide. The tenancy which is there, no, the tenancy, you have rented the property, you should have genuinely rented the property. The tenancy should be bona fide. The tenant should have actually vacated the property. The tenant should have vacated the property. The property for which the rent is not realized, that property should have been vacated by the tenant. The tenant should have not occupied any other property of the same assessee. It is not that I have 2 properties, I have asked him to vacate from one property and I have given him another property. It may happen that tomorrow he may not pay the rent for this property also. So the tenant should have not occupied any other property of the same assessee, and tenant should have and reasonable steps should have been taken to recover this unrealized rent. Meaning I should have taken proper steps to recover this unrealized rent. Say for example, I have given police complaint. Say for example, I have given any legal notice to him. Only if all these 4 conditions are satisfied, no? Only if these 4 conditions are satisfied, unrealized rent will be allowed to be subtracted. Only if all these 4 conditions are satisfied, what will happen, sir? Unrealized rent will be allowed to be subtracted. Only if all these 4 conditions are satisfied, unrealized rent will be allowed to be subtracted from actual rent plus rent receivable. So actual rent is what, sir? Rent received plus rent receivable minus unrealized rent. Unrealized rent will be subtracted only if 4 conditions are satisfied. Then comes, so now once we find this actual rent, that means we came to gross annual value. From gross annual value, we have to subtract our municipal taxes. We will get our net annual value. From this net annual value, you can take deductions. Deductions are given under section 24. There are only 2 types of deductions which you can claim under your house property. One is deductions under 24A and another one is deductions under 24B. Section 24A talks about standard deduction. Section 24A talks about what, sir? Standard deduction. It says flat 30% deduction will be allowed. Flat 30% of NAV will be allowed as deduction. Standard deduction is how much, sir? Flat 30% of NAV will be allowed as deduction. Section 24A standard deduction, how much, sir? Flat 30% of NAV will be allowed as standard deduction. Now, please note, For your house property, you may incur repair expenses, you may pay water charges, electricity charges, insurance charges, maintenance charges, parking charges, etc. All these are required to be ignored. I don't care what you are paying, what is received, etc. For all these expenses will be ignored. Whatever net annual value you are getting, of that flat 30% will be allowed as standard deduction. Flat 30% of NAV will be allowed as standard deduction. Now for self-occupied properties, obviously it will not be allowed. For two self-occupied properties, because they are exempt, it will not be allowed. But for let out and deemed to be let out property, you can take flat 30% deductions. Apart from that, other type of deduction which we have is very important. Please note, you should remember the section number also for this. 24A standard deduction, 24B interest on loan. I have a house property, I have taken loan on that house property for construction, purchase, repairs, renovation. You have taken loan for what purpose, sir? You have taken loan for construction, purchase, repairs, renovation of the house property, and on that loan, if you are paying any interest, then that interest will be allowed as deduction under section 24B. If you have taken any loan for construction, purchase, repairs, renovation of house property, and if you are paying any interest for that house property, that interest will be allowed as deduction under section 24B. It does not matter from whom the loan is taken. It does not matter from whom the loan is taken, whether it is taken from bank, financial institutions, family members, friends, etc. It does not matter from whom you are taking the loan. It does not matter how much you are paying the interest also. Whatever interest is paid by you or for construction, purchase, repairs, innovation for an house property will be allowed as deduction. It will be allowed as deductions. What are the different important points over here? What are the important points over here? Important points over with respect to interest is that interest on loan will be allowed as deduction if the loan is taken for construction, purchase, repairs, innovation of house property. The loan can be taken from any person. It does not matter from whom you are taking the loan. Interest will be allowed as deduction whether it is paid or not. It does not matter whether you have actually paid the interest or not. A municipal taxes point said that municipal taxes should be actually paid if you want to claim as deduction, but interest point says I don't care whether you have actually paid it or not. Interest will be allowed as deduction whether it is actually paid or not. Then interest on fresh loan. If you have taken a new loan for repayment of existing house property loan, then whatever interest you are paying for that new loan is also allowed as deduction. For example, I already have a property for which I have taken a loan. I already have a property for which I have taken a loan. I have already having a property on which I have taken a loan. This loan interest rate is high, so I am taking one more loan to repay this existing house property loan. Can I claim deduction of that interest? And answer is yes. Any interest paid to a non-resident, sir, if I take loan from outside India, then also will it be allowed as deduction? Yes. Any interest paid to a non-resident from outside India will also be allowed as deduction if TDS on such interest is deducted and paid to the government. If you are deducting and paying taxes to the government, no, if TDS is deducted and paid, then interest will be allowed as deduction. Any interest paid to non-resident outside India will be allowed as deduction if TDS on such interest is deducted and paid to the government. If TDS is deducted and paid to the government, it will be allowed as deductions. Now, sir, how much interest is allowed as deduction? Sir, you told interest is allowed as deduction, interest is allowed as deduction. How much interest, sir? Section 24B says to check whether how much interest is allowed as deduction, you should check whether the property is let out or deemed to be let out property, or is it a self-occupied property. If it is a let out or deemed to be let out property, it does not matter how much is the interest amount without any limit. Full amount of interest will be allowed as deduction. Meaning, because the property is generating revenue to you, because the property is let out or it is set as in to be let out, because you are computing its income and paying the taxes on that property, irrespective of how much interest you have paid for that property, all the amount of interest will be allowed as deduction. But if it is a self-occupied property, then there is a restriction, there is a limit. Normally, the interest which will be allowed as deduction is only 30%, but in some special circumstances, you will get 2 lakh rupees. How much interest will be allowed for self-occupied properties, sir? Normally, it is 30%. 30,000 rupees, 30,000 rupees, and for in some special circumstances it will come to 2 lakhs. Sir, when will I get the benefit of 2 lakh rupees, sir? When can I claim the deductions of 2 lakh rupees for self-occupied property? In case of self-occupied property, you can take interest deduction of 2 lakh rupees if the loan is taken on or after 1/4/1999. If you have taken loan on 1/4/1999 or any time after 1/4/1999, and the loan is taken for construction or purchase of the house property, and the loan is taken for construction or purchase of the house property, and if the loan is taken for construction of the house property, the construction should be completed within a period of 5 years from the end of the financial year in which loan was taken. If the loan is taken for construction purpose, no, the construction should be completed in a period of 5 years from the end of the financial year in which loan was taken. If you satisfy all this condition, then whatever interest you are paying can be claimed as deduction. Sir, what is the maximum interest allowed as deduction for self-occupied property? It is 2 lakh rupees. Sir, what if I have 5 self-occupied property? I don't care. Only 2. Anyways, 2 self-occupied property only you can take the benefit, correct? So irrespective of how much interest you are paying, maximum interest allowed as deduction for self-occupied property is how much, sir? 2 lakh rupees. It is maximum how much is allowed, sir? 2 lakh rupees. So I given one case. For example, I have one self-occupied property. 3 lakh interest I am paying. 2 lakh only I can claim. 2 self-occupied property, house properties I have. Interest I am paying 5 lakh rupees, but it is let out property. No limit. I can take full deduction. I have 2 properties. 5 lakh rupees interest I am paying. Both are self-occupied. Maximum only 2 lakh for self-occupied property. I have 2 properties. One is self-occupied. One is let out. In such cases, how much, sir? For self-occupied, up to 2 lakhs, and for let out, it is no limit. Okay. Now, this is what, sir, this was with respect to interest. One more point with respect to interest is there. There is one more point with respect to interest. There is a concept called as pre-construction period interest or pre-acquisition period interest. There is a concept called as what, sir? Pre-construction period interest or pre-acquisition period interest. Sir, what is this pre-construction period interest or pre-acquisition period interest? Now, pre-construction period means what, sir? Pre-construction period means the years, not the period, the years before the year in which construction was completed. The years before the year in which construction was completed. The years before the year in which construction was completed is called as pre-construction period. Pre-construction period interest which is there, no, it will be allowed as deductions in 5 equal installment. If you have any pre-construction period interest, that pre-construction period interest will be allowed as deduction, and it will be allowed as deduction in 5 equal installment from the previous year in which construction was completed. Pre-construction period interest means what, sir? Pre-construction period means the years before the year in which construction was completed, that will be allowed as deduction in 5 equal installment from the year in which construction was completed. In simple words, say for example, for construction of this house property, I have taken a loan. The loan was worth rupees 50 lakh rupees. I had taken it on 1st of January 2021 for construction of house property. So in the year 2021 only the digging activities, etc., laying foundation activities happened. Then the construction was work was happening in 21-22, and the construction was almost completed by 22-23, but actual construction was completed on 28th of actual construction was completed on which date, sir? Actual construction was completed on 28th of January 2023. In this case, what is pre-construction period, sir? Pre-construction period means the years before the year in which construction was completed. So in which year construction got completed? 23-24. Okay, so ignore this year. Before this, what are the different years? The years before the year in which construction was completed. So we have 22-23, 21-22 and 20-21. This period interest combined together is called as pre-construction period interest. It is called as what, sir? Pre-construction period interest. Pre-construction period means the years before the year in which construction was completed. Okay, in simple words, what you are supposed to do now, whenever this question type like this is asked, you compute the interest for all the years. Do the computation for all the years. Just mark that particular year in which construction was completed. So once you mark that year in which construction was completed, now all the years before that is called as pre-construction period. Now do the total of this pre-construction period interest. Divide the total by 5 because it is allowed as reduction in 5 equal installment. Meaning in the year in which construction was completed, no, you from that year you can take it for 5 more years. 5 more years you can take. So the amount comes to 93,500. So from that year, what will happen in the year in which construction was completed? You will have that year's interest. Along with that year's interest, you can claim 93,750 rupees extra. So that will continue for all the future periods also. It will continue to for all the future periods also. So say for example, so previous year 23-24, what is the interest available with me for the previous year? 23-24, I have a total interest of what, sir? 5 lakhs plus 93,000, which is equal to 5,93,750. Now, if it is a let out or deemed to be let out property, no problem at all. It is fully allowed as reduction. But if it is a self-occupied property, though the interest is 5,93,000, maximum I can claim only 2 lakh rupees. Sir, what will happen to the balance interest, sir? It is gone. What will happen to the balance interest? Nothing can be done. It is gone. Next, Now, the major computation part we have understood. Now in this chapter, no, there are chota concepts. Okay, there are different concepts, and for each and every concept there are two three problems which are given in the institute material. Concept of vacancy. The next concept which you are seeing is what, sir? Vacancy. Now sometimes what may happen is your property may remain vacant. What do you mean by this, sir? Now your property, no one would have occupied your property. Sometimes what may happen, your property may be vacant. What do you mean by this word? The property may be vacant. Say for example, vacancy means the house property is empty or it is not occupied by any person. What do you mean by vacancy or vacate, sir? Your house property is empty or it is not occupied by any person. If the house property is not occupied by any person, then it is said that the house property is vacant. For example, I have this house property. Okay, I have this house property. This house property is given on rent by me to Virat Kohli from 1st of April. On 30th of June, Virat Kohli left the property. He left the property. Okay, the rent which I was getting from him is 15,000 per month. Now what happened later? He left the property on which date, sir? 30th of September. The next tenant. So once he leaves the property, now the property is empty, vacate. No one is there in the property. The next tenant, Mahendra Singh Dhoni, MSD, came on 1st of December. 1st of December. So now please note. What is happening over here? What is happening over here? From 1st April till 30th of September, it was occupied by Virat Kohli. And from 1st December till 31st of March, it was occupied by Dhoni. In between, no, from 1st of October till 30th of November, basically October and November months, 2 months, this property was vacant or it was empty. So in this case, how do I do the computation? Now what institute material, if you see your institute material, they talk about this particular summary. What they say, whenever we have a vacancy, how will I come to know, sir? When the property is not occupied by any person during that any period, that means there is a vacancy. Okay, in the question they will specify about vacancy. Whenever there is a vacancy, you are required to compare expected rent with actual rent and vacancy period rent. You take your expected rent. What is your expected rent? Municipal value, fair rent, whichever is higher, compare that with standard rent, whichever is lower. That will be expected rent. That expected rent you compare with actual rent. What do you mean by actual rent, sir? Actual rent received. Ignore the vacancy period. Whatever actual rent received plus rent for that vacancy period. Obviously, the property was vacant. I would have not received that rent for vacancy period. But just add. You compare now. You compare what, sir? You compare this expected rent with actual rent plus vacancy period rent. If your actual rent plus vacancy period rent is more than or equal to expected rent, if it is more than or equal to expected rent, then that actual rent which is there, no, only that actual rent will be taken as gross annual value. But however, if your expected rent is more than actual rent and vacancy period rent taken together, okay, if your expected rent is more than actual rent and vacancy period rent taken together, then your gross annual value will be what, sir? Your gross annual value will be your expected rent. Expected rent will be taken as your gross annual value. In simple words, let me explain with an example. Now say for example, my expected rent of the property is 3 lakh, actual rent is 30,000 per month and property was vacant for 3 months. So let me calculate. So what is my expected rent, sir? 3 lakhs. My actual rent for 12 months it will come to 3 lakh, but however I have the property was vacated for 30,000 per month into 9 months. So my actual rent will be only, my expected rent over here is 3 lakhs. My actual rent, the property was rented for 30,000 per month into for 9 months, which is equal to 2.7 lakhs. And for a vacancy period, my rent is 30,000 into 3 months, which is 9,000 rupees. It is how much, sir? 90,000 rupees. Now, what is my expected rent? I should see expected rent, actual rent plus vacancy period rent. Expected rent is 3 lakh. Actual rent is 2.7 lakhs plus 90,000. Okay, now I know that my actual rent plus vacancy period rent is more than expected rent. So what will be my gross annual value, sir? My gross annual value will be my actual rent. How much is my actual rent? 2,70,000 will be taken as my gross annual value. Let me give one more example to explain this. Let me take one more example to explain this. My expected rent, example number 2. My expected rent is 3 lakhs. My actual rent is 20,000 per month. And the property was vacated for vacancy period is 1 month. So my expected rent, I'll compare that with actual rent, 20,000 into 11 months plus vacancy period rent 20,000 into 1 month. So 3 lakhs, here I get 2,20,000 plus 20,000. So I get 3 lakhs, compare that with 2.4 lakhs. Who is higher, sir? Expected rent is higher. Therefore, my gross annual value will be taken as my 3 lakh rupees. How much will be gross annual value, sir? My gross annual value will be my expected rent. Okay, so this is how you are required to do this. So this is the crux of vacancy. So whenever there is a vacancy, you should always do the computation in this manner. You should compare your expected rent with actual rent and vacancy period rent. Then, now many times what may happen is your property may be partly let out, partly self-occupied. For example, I have a building, ground floor is rented, first floor is self-occupied. Or I have a house, in that 20% of the house is let out, 80% is self-occupied. Or I have a house, 5 months it was let out and the balance remaining 7 months it was self-occupied. So what is happening in all these cases? The property is partly self-occupied and partly let out. Whenever the house property is partly let out and partly self-occupied, then what am I supposed to do? This is what you are supposed to do. Property, partly let out property, partly let out property, partly let out and partly self-occupied. Partly let out property means the house property is let out and also self-occupied in the previous year. The house property is let out as well as self-occupied. Partly let out can be either area wise or it can be time wise. Area wise means what, sir? Say 50 ground floor is rented and or self-occupied and first floor is rented. So 50% is self-occupied, 50% is rented. Or say I have a house, in this house 60% is self-occupied, 1 room, 40% is let out by me. So this is called as partly let out area wise. What do you mean by partly let out time wise? 8 months the property was let out, 4 months was self-occupied, etc. This is partly let out time wise. Now, whenever there is a partly let out property, what wise, sir? Area wise. 50% of the property is let out, 25% of the property is let out, 1/3 of the property is let out, etc. Then what the lawmakers are telling is, what the lawmakers are telling, take everything in that ratio. Take everything means what, sir? Take your municipal value, standard rent, fair rent, municipal taxes, interest, etc. Take everything in that ratio. Which ratio, sir? The ratio of let out and self-occupied. Take everything in that ratio, the ratio of let out and self-occupied. Take your municipal value, fair rent, standard rent, municipal taxes and interest and divide them or apportion them or distribute them in the ratio of let out. In the ratio of let out, you please divide them or distribute them. Now, how much is let out and how much is self-occupied? Now, in case of interest on loan, say interest on loan you divide this everything and do the computation. You divide everything and do the computation. Meaning, say for example, the municipal value is 10 lakh rupees. Assuming it is 40% let out. So 40% let out means 4 lakhs rupees will be taken for let out cases, and for self-occupied part, you will take 6 lakh rupees. You will take 6 lakh rupees. So when the property is partly let out and partly self-occupied, I am going to do division of everything. I am going to do what, sir? I am going to do division of everything. I will divide municipal value, fair rent, standard rent, municipal taxes and interest in the ratio of their let out and self-occupied. Now, what is important in this is with respect to interest. What is important in this is with respect to interest. What is important in respect to interest, sir? Say for example, interest for this kind of properties 6 lakh rupees. Say I have a property, 60% is self-occupied, 40% is let out. I am paying interest of how much, sir? 6 lakh rupees for that entire property. Now divide in the same ratio. 60% for let out will be 3,60,000 and for self-occupied for self-occupied it will be 3,60,000 and for let out it will be 2,40,000. Now in this case they are telling for self-occupied how much is this 3,60,000. How much can you take, sir, for self-occupied? Maximum 30,000 rupees or 2 lakh rupees if it is for construction or purchase. Correct? For let out the ratio comes to 2,40,000, you can claim full amount is allowed as deduction. Full amount will be allowed as deductions. But when the property is let out time wise, when the property is let out time wise, no, meaning for 6 months it is let out, for 5 months it is let out, 2 months it is let out. When it is let out time months, then you are required to do the computation of income from house property. You are required to do the computation of income from house property by assuming that the property is let out throughout the year. Assume that the property is let out throughout the year and do the computation. Therefore, you will have to compute the income for house property for the entire year, full year. Meaning, take your municipal value, fair and standard rent, municipal taxes for the full year. Actual rent, you take it only for that rented period. Municipal value, fair and standard rate, municipal taxes, take it for the full year, but actual rent, take it only for that actual rented period and do the computation. You do the computation, you get your answer. Computation mechanism is same. Computation mechanism for entire house property topic is same. Next, we have a concept of co-ownership or joint ownership. Co-ownership or joint ownership. Sir, what do you mean by this word co-ownership or joint ownership? When there are more than one owner for a house property, then it is said that that house property is co-owned or that house property is jointly owned. When there are more than one owners for a house property, then it is said that it is a co-owned house property or it is a jointly owned house property. Now, where the house property is owned by 2 or more persons, then such house property is called as co-owned house property or it is called as jointly owned house property. When the house property is owned by jointly owned by 2 or more person, it is said that it is co-owned house property or jointly owned house property. The owners of such house property are called as co-owners. Now, in that case, the owners of those property, so there are assuming 3 owners for a single property. So these 3 owners will be called as co-owners. Computation of income from house property in case of co-ownership. Sir, in case of co-ownership, how will I do the computation, sir? Step number 1, compute the income from house property as if there is no co-ownership. You do the computation as if there is no co-ownership and then divide the income from house property of step number 1. This step number 1, meaning do the normal computation. Just do the normal computation. At the end, whatever amount you get, divide between the co-owners. So compute the income from house property as if there is no co-ownership. Do the computation and divide at the end. Divide the income from house property as per step number 1 between the co-owners in the ratio of their ownership. Now here, one major advantage which you get is, one major advantage in case of co-ownership which you get is that interest amount which is there. No, if self-occupied property is co-owned, then each of the co-owner will get the benefit of 30,000 and 20,000. Each co-owner will get that interest benefit of 20,000 rupees. Each co-owner will get that interest benefit of 30,000 rupees. For example, I have a house property, 50% is owned by Dilip and 50% is owned by Nora. In such cases, what will I do? Do the computation normally. Do the computation normally. At the end, whatever income you are getting, you will divide that income between each co-owner in the ratio of co-ownership. Now, what is important with respect to interest. Now, interest, each co-owner will get the share. Each co-owner will get the share of 30,000 rupees and 2 lakh rupees. For example, say interest for my property which is owned by me and Nora is 3 lakh rupees. 1.5 lakh will be given to me, 1.5 lakhs will be given to Nora. Now, in this case, Nora can claim up to 2 lakh, I can claim up to 2 lakhs. So, in this case, we will claim entire 3 lakh rupees deduction. Sir, what if interest is 5 lakhs? 2.5 lakhs distributed to me, 2.5 lakhs is distributed to Nora. I can claim 2 lakhs and Nora can claim how much, sir? 2 lakh rupees. Maximum 2 lakh rupees we can claim for that property. Next concept which we have, this was concept of co-ownership or joint ownership. Next concept which we have in this topic of income from house property is taxability of arrears of rent and unrealized rent. I am having arrears of rent, I am having unrealized rent. What do you mean by this arrears of rent, sir? Say in any last years, say 2-3 years back, I had rented the property to someone and he did not give the rent to me for a particular period, and that rent was under dispute. That is called as arrears of rent. And unrealized rent, I had rented the property to someone, that rent for that period was not at all given to me. Now, this arrears of rent means rent under dispute. Unrealized rent means the rent which is not at all paid by the tenant. What may happen is, after 5-6 years, I may receive money from that person. Say, for example, I had rented the property to someone and I was I had rented it 5 years back and he did not pay the rent of 50,000 rupees to me. Now, after 5 years back, I saw him on the road. When I met him, I caught his collar. I told him, hey, where is my rent? Why you have not paid me the rent of 50,000 rupees and from last 5 years you are absconded. Then he suddenly told, oh, I'm really very sorry, Mr. Dilip. That time I was not having proper money, etc. Now I have good money. Please take your rent. He gave me this amount. He gave me this amount. So this is called as what, sir? Recovery of arrears of rent or recovery of unrealized rent. So what will happen when you realize this, when you recover this arrears of rent or unrealized rent? So they say that arrears of rent and unrealized rent is taxable. It is taxable in the year in which it is received or it is recovered. How much amount will be taxable, sir? Whatever amount you receive into 70%. How much will be taxable? Whatever you are receiving into 70% will be taxable. Okay, that is the only thing. Whatever amount you are receiving into 70% will be taxable. Then we have a small concept of composite rent. So what is this composite rent? Composite rent means renting of house property along with other assets. When you are renting your house property along with other assets, it is said that it is a composite rent. For example, sir, I am renting the house along with furniture. I am renting the house along with, say, AC, washing machine, sofa, TV, etc. Everything is installed. In such cases, the rent which I am getting is called as composite rent. Composite rent means renting of a building along with other assets. Treatment of composite rent. Now there are two possibilities. I have rented a property for 15,000 rupees along with furniture. Now there is the rent of furniture is 5,000 and rent of house is 10,000. I can separate that. Or second possibility is I cannot separate that. So what is going to happen? Tax treatment for composite rent. Income from composite rent is separable. Check whether it is separable or not separable. If the income is separable, then the rent of house property will be taxable under income from house property. And if the rent the rent of other assets will be taxable under business or other sources, depending upon what whether it is your main business or not. I have a house property which I have rented with other assets. Now this rent are separable. Renting of house property with other assets, is it separable or not separable? If it is separable, the income will go under income from house property. If it is not separable, then if it is separable, if that is separable, the income from house property will go under house property and income of other assets will go under PGBP or other sources. If it is not separable, what is not separable? If composite rents are not separable, the total rent will go either under income from business or profession or from other sources. Now similarly, they also say if letting out of a house property is not at all possible, it is not at all possible without other assets, then the total rent of such property will be taxable under income from other sources or PGBP. Whether composite rent or agreement is separable or not, whether composite rent is separable or not, it does not matter. If the property is not accepted by anyone without other assets, for example, when I am going to an hotel, when I go to an hotel, they will give me a bed, they will give me a TV, correct? So you can see, basically hotel is what's renting of that particular room, renting of that particular room. So renting of room is nothing but renting of house property. But then you don't take that room without other assets. So that hotel rooms which are there, no, there is compulsory that they'll install an AC, they'll install a bed, they'll install a TV, etc. So that property is rented along with other assets only. You will not accept it if it is not rented with other assets. In such cases, the entire rent, whether it is separable or not, I don't care. Lawmaker says, in such cases, whether it is separable or not, I don't care. Entire rent will be going to PGBP or income from other sources. Now, many times what may happen is you are a builder. For you, the house property may be treated as stock in trade. You are a builder and for you, the house property may be treated as stock in trade. In such cases, what will happen, sir? There are two possibilities. Income from house property, you may receive the income by selling of house property or by renting of house property. Whatever is received by sale of house property is taxable under PGBP. Whatever is received by renting of house property is taxable under income from house property. I am a builder. What is a builder's work, sir? He is constructing and selling, correct? Say, I have these properties, Now, I have sold these properties. I have sold 5 of the properties. Whatever income I receive will be taxable under PGBP. 2 properties I have given it on rent. I am receiving rent from those properties. This income will go under income from house property. Whatever rental income I am receiving from the property will go under which head, sir? Whatever rental income I am receiving from these properties will go under income from house property. Now, where the house property is held as stock in trade and it has not been let out. Now, one more important point with respect to builder. If the house property is held as stock in trade, if you are a builder having an unsold property, unsold flat, if the house property is held as stock in trade and it is not let out during the previous year, and then the NAV of such house property shall be treated as nil. If you have a house property which is held as stock in trade and it has not been let out by you during the previous year, then the NAV of such property shall be taken as nil for a period of 2 years from the end of the financial year in which construction was completed. From the end of the financial year in which construction was completed, for 2 years period, I will take the NAV of that property to be equal to nil. Even after 2 years, if you are not selling that property or if you are not giving it on rent, I am going to deem it as let out property. Basically, what they are telling is they are asking the builders to either sell the properties or to give it on rent. I say, for example, I have constructed this 6 flats. One of the flats I have not sold yet. It is kept by me. It is an unsold flat. It is an unsold flat. I have not sold this flat, nor have I rented this flat to anyone else. Lawmakers are telling for 2 years I'll wait. For 2 years, once the construction is completed, after that 2 years from the end of the construction is completed, I'll take the NAV of this property to be 0, meaning I'm not going to do any computation of the income from house property for this property. Even after 2 years, if you are not selling, it will be treated as deemed to be let out property and you will have to pay the taxes. Sir, does a non-resident also has to pay the taxes in India, sir? Income from house property located outside India for resident and non-resident. Sir, what will happen if the property is located outside India? What will happen if the non-resident person is there and a property is located in India? Now, house property can located in India, irrespective of who you are, whether you are a resident or non-resident, whether you are resident, ordinary resident, not ordinary resident, or you are a non-resident. If there is a property located in India, it will always be taxable in India. If there is a property located in India, it will always be taxable in India. How house property is located outside India? Sir, what if house property is located outside India, sir? If the house property is located outside India, if the house property is located where, sir? If the house property is located outside India, then I am going to check who you are. I am going to check whether you are a resident and ordinary resident or resident and not ordinary resident, etc. If the house property is located outside India, are you a resident and ordinary resident? Yes, sir. Then it will be taxable in India. Whatever rent is received by you, or whether it is received in India or not, it does not matter, because you are a resident and ordinary resident, it will be taxable in India. But if the house property is outside India, you are a non-resident or you are a resident but not ordinary resident, it will be taxable. The rental income will be taxable only if the rent is received in India. Now, sir, you said there are 2 conditions for taxing house property. One, there should be a house property and the assessee should be owner of that house property. House property meaning, though we understood, sir, building and land appurtenant to that building. Sir, what do you mean by owner? Owner definition is a very simple definition. It says whatever you generally understand by this word owner is an owner. Apart from that, owner shall include legal owner, beneficial owner and deemed owner. Owner will include what, sir? Legal owner, beneficial owner and deemed owner. Sir, what do you mean by deemed owner, sir? Deemed owner means, please note, legal owner means whoever is the owner of the property as per the document, the purchase deed or sale deed. Beneficial owner means, say the owner may be a trust but the beneficiary may be someone else. Deemed owner means, fantastic provision, you will be deemed to be the owner. You are not the actual owner. Legally the owner may be someone else, but the lawmakers are telling I am going to deem that you are the owner. Section 27, deemed owner. Transfer of house property by an individual to his or her spouse without consideration or for inadequate consideration. If an individual is transferring the house property to his or her spouse without any consideration or for inadequate consideration, in such cases, no, that individual will be considered as deemed owner. Sir, who is a deemed owner, sir? Deemed owner means, say there is a house property. This house property is transferred by you without consideration or for inadequate consideration to your spouse. So to my wife, I have transferred this house property without any consideration or for very less consideration, inadequate consideration. Lawmakers are telling, hey, Mr. Dilip, you will be deemed as owner of this property. You will be deemed as owner of this property. Exception is there, except in case there is an agreement to live apart or in case of divorce. For example, if there is a divorce between husband and wife and because of that reason he's transferring, or after that he's transferring, then this point is not applicable. And if there is an agreement to live apart, if they have entered into an agreement between themselves that they are not going to stay with each other. Then transfer of a house property by an individual to his minor child. If an individual is transferring the house property to his minor child except minor married daughter without consideration or for inadequate consideration. Basically what they are telling, if without consideration or for inadequate consideration you are transferring the property to your wife or your spouse, in the sense not wife, not only wife, your spouse, or to your minor child except minor married daughter, then whoever is transferring the property, that person will be deemed as owner. That person will be deemed as owner. Or you are a holder of impartable estates, or you are a member of cooperative society, or you are transferring the possession of immovable property as per Transfer of Property Act, or you have given a property for a long-term lease, that is for a period of 12 years or more. In all such cases, whoever is giving that property will be treated as deemed owner. Now, extra points with respect to income from house property. Now, self-occupied property exemption is there, no, that can be claimed only by individuals. Only if you are an individual and HUF, you can claim the self-occupied property exemptions. Up to 2 self-occupied properties are exempt only for individual and HUF. Municipal taxes paid in foreign country can also be allowed as deductions while computing income for a property which is located outside India. Now, roof is not compulsory or necessary for a non-residential house property. See, house property means building and land appertaining to such building. Building means roof also should be there. Lawmakers are telling if it is a non-residential house property, if it is not a residential, if it is a commercial property, then roof may or may not be there. So in such meaning what, sir? This stadiums, swimming pools, etc., which are given on rent are also covered under income from house property. If the building consists of different flats and or many flats, then each and every flat will be taken as separate house property. Refund of municipal taxes will be taxable under income from other sources, and it will not be taxable under income from house property. If the house property is acquired by a person by paying an amount in installment, then whatever interest you are paying on that installment will also be allowed as deduction under section 24B. If an assessee lets out property to his employee where such letting out is supporting smooth flow of his business, then such letting out shall be deemed to be incidental to business and not be taxable, and shall be taxable under PGBP. For example, I have a property. One of my employee is coming almost around 30 kilometers away on daily basis. Now this person, because he's coming from 30 kilometers away to work in my Priya Sarees, this person takes lot of time to come to Priya Sarees. Meaning he comes late, he goes early, etc. But he's one of my best employee. Now what I have done is, I have one small house property right next to Priya Sarees. So I have given it to him. I am receiving a rent also from him. I have given it to that employee on rent. I am receiving a rent from him. This rent will be taxable under income from business or profession, because I have given this house on rent to a employee, and because I have given this property to him, my business is working smoothly. Similarly, if the business is carried on by a firm, and should be regarded as carried on by all the partners, annual letting value of the property belonging to the assessee which is in occupation of the firm is not to be included in the assessee partners. In simple words, what is this point telling? This point telling is, if there is a partnership firm and one of the partner has given the property on rent to whom, sir? Partnership firm. If there is a partnership firm, one of the partner has given the property on rent to the partnership firm. In such cases, this property will be treated as used for business purpose, and therefore you are not required to do any computation of income from house property. Now let us take a small break and continue our discussion on the next topic called as what, sir? Income from capital gain. So let us continue, students. Next topic for our discussion is a fantastic topic, income from capital gain. CMA Inter students, one of the most important topic for you. Almost 8 marks question will come in examination. 6 to 8 marks for sure is going to come from this topic. So very important topic. Income from capital gain. Section 45 is the charging section of this. Section 45 subsection 1 is the charging section. Section 45 subsection 1 says, any profit or gain arising from transfer of a capital asset shall be taxable under the head income from capital gain in the year in which transfer took place. What is this point telling, sir? If you are getting any profit or gain, If you are getting any profit or gain, how are you getting this profit or gain? If you are getting any profit or gain by transferring a capital asset, you should what, sir? You should transfer a capital asset. If you get any capital gain by transferring a capital asset, then that capital gain, that profit or gain will be taxable under the head income from capital gain in the year in which transfer took place. Now, what is important over here? There should be a transfer of capital asset plus there should be a capital asset. Basically, there should be a capital asset plus there should be transfer of that capital asset. Only if there is a capital asset and there is a transfer of capital asset, capital gain arising from that will be taxable under this head. Sir, what do you mean by capital asset, sir? Sorry, sir, what do you mean by capital asset, sir? What do you mean by capital asset? Section 2, clause 14 gives the meaning of capital asset. Capital asset means property of any kind held by the SSC, whether connected to the business or not. A property of any kind held by the SSC, whether connected to business or not, will be treated as capital asset, but it shall not include stock in trade. Any type of property which you have. Do you have a phone? This is a property of any kind. Do you have a necklace? Do you have a jewelry? Property of any kind held by the SSC, whether connected to the business or not. Property of any kind held by the SSC, whether connected to the business or not. But it shall not include, it shall exclude stock in trade. It shall exclude movable personal effects. It shall exclude gold bonds and certificates. It shall exclude rural agricultural land. See, normally lawmakers are telling property of any kind held by the SSC, whether connected to the business or not, will be taken as capital asset. However, when I say property of any kind, it shall not include the following things. What should not be included, sir? Your stock in trade should not be included. The stock in trade should not be considered while calculating this property of any kind. You should not take movable personal effects. Sir, what do you mean by movable personal effects? Say, for example, now this mobile phone, I said it is a property of any kind held by the SSC, but then it is movable property, correct? It is a movable property used for my personal purpose. It will be called as movable personal effects. This will not fall under the category of what, sir? This will not fall under the category of capital asset. Property of any kind held by the SSC, whether connected to the business or not, but it shall not include what, sir? It shall not include movable personal effects. Movable personal effects should not be excluded. However, they have given some exception. They say the following things are also movable property. The following things are also movable property. You may say that this is also movable property. You may not include this point also, but they says no. These are movable, but still it will be regarded as capital assets. What are these movable personal effects which are regarded as capital assets? Are DJ Passo. Sir, what do you mean by DJ Passo, sir? Drawings, jewelry, paintings, archaeological collections, sculptures, and any other work of art. Drawings, jewelry. What do you mean by DJ Passo, sir? DJ Passo means drawings, jewelry, painting, archaeological collections, sculptures, and any other work of art. This will also be regarded as what, sir? This will also be regarded as, these are all what? DJ Passo. They will also be regarded as capital asset. They will be regarded as capital asset. I'll repeat. Capital asset means property of any kind held by the SSC, whether connected to the business or not, but it shall not include your stock in trade. If you're dealing in a particular property, then it will not be treated as capital asset. For example, I am a builder. I am dealing in building. It is not a capital asset for me. I am a jewelry store owner. So I am dealing in jewelry. It is a stock in trade for me. It is not a capital asset. Then movable personal effects will not be treated as capital asset. My shirt, my pant, my pen, my specs, they are all not capital asset unless until, except what, sir? DJ Passo. Jewelry, except what's the drawings, paintings, archaeological collections, sculptures, any other work of art. Drawings, jewelry, paintings, archaeological collections, sculptures, and any other work of art. Now, jewelry, though it is your personal effect, it's a movable personal effect, it will be considered as capital. It will be considered as what's a capital asset. And then gold bonds or certificates. And then what's gold bonds or certificates also will not be regarded as capital asset. Rural agricultural land also will not be regarded as capital asset. One more thing which will not be regarded as capital assets is what, sir? Rural agricultural land. Sir, what do you mean by rural agricultural land? Agricultural land located in rural area. Sir, what do you mean by rural area, sir? Area which is not an urban area is called as rural area. Area which is not an urban area is called as rural area. Basically, they have given the meaning of urban area. Under income tax law, they have given the meaning of urban area. So, any area other than urban area is rural area. What is urban area, sir? Now, what they are telling, urban area means an area whose population as per cantonment board or municipal board, as per cantonment board or municipal board as per the latest census, if the population is 10,000 or more, then it is urban area. If you are staying in a place where the population is 10,000 or more, then your area is called as an urban area. Now, they have went a step even further and they have told, if your area's population is, say for example, this is a particular area, okay? This blue marked point which you are seeing, this is a particular area. Now this area's population is 10,000 or more. This is an urban area. This area is an urban area. Now they say if this area's population is more than 10,000 up to 1 lakh rupees, if this area's population is more than 10,000 up to 1 lakh rupees, then obviously this area is an urban area, and up to 2 kilometers from this region also, up to 2 kilometers from this range is also called as an urban area. Urban area means what, sir? An area whose population is 10,000 or more. If your area's population is 10,000 and up to more than 10,000 up to 1 lakhs, and your area is 100% urban area, from your area up to 2 kilometers will also be taken as urban area. If you are staying in an area whose population is more than 1 lakh up to 10 lakhs, then your area is obviously an urban area. From your area up to 6 kilometer area will be taken as urban area. If you are staying in an area whose population is more than 10 lakhs, then your area plus 8 kilometers from your area will be treated as urban area. Sir, how should I measure this distance of 2 kilometers, 6 kilometers, 8 kilometers, sir? You should measure it aerially as the bird flies. How should you measure, sir? Aerially as the bird flies. Now, sir, what about utensils, sir? Are utensils also treated as capital assets, sir? We have gold utensils, silver utensils. Now, in case of gold utensils, yes, it is treated as capital asset. Silver utensils are not treated as capital asset. Then apart from that, what is capital asset, sir? Any type of securities held by foreign institutional investors. Any type of securities. Please note, they are not specifying which type. So they are telling any type of securities held by whom, sir? Foreign institutional investors. Okay, whether they have held it for long-term purpose, short-term purpose, irrespective of what type of securities it is, whether it is held by them as a stock in trade or not, it does not matter. It will always be taken as capital asset. And ULIP, unit-linked insurance policy, which is not exempt under section 1010D. There is something called as ULIP, unit-linked insurance policy. Normally, whatever insurance policies are there, no, the amount which you receive on maturity is exempt under 1010D. But there are some policies for which the amount is not exempt under section 1010D. Those policies are covered over here. They are called as capital asset. Now, sir, 45(1) charging section told there should be a capital asset and there should be a transfer of capital asset, and you should get any capital gain. You will get you should get a profit or gain from transferring a capital asset, correct? So we understood the meaning of capital asset. What do you mean by transfer, sir? Transfer means what, sir? Transfer includes, so whatever you generally understand by the word transfer is a transfer. Apart from that, transfer shall include sale of a capital asset, exchange of a capital asset, relinquishment or extinguishment of a capital asset, and then compulsory acquisition of a capital asset, conversion of a capital asset into stock in trade, or allowing possession of immovable property, or transferring share in a cooperative society or certificate in a cooperative society, or redemption of zero coupon bonds. They are all treated as transfer. What is transfer, sir? Transfer means sale of a capital asset, exchanging of a capital asset, relinquishment of capital asset, or meaning you are surrendering the capital asset, or extinguishment, the capital asset is destroyed. They are all different forms of transfer. If you are converting your jewelry into your if you have your personal jewelry, you are converting into your stock in trade. Your personal jewelry was treated as capital asset. Now you are converting into stock in trade. Now in this case also it will be treated as what's the conversion of capital asset into stock in trade is also called as transfer. Allowing possession of immovable property. Allowing possession of immovable property, there is a compulsory acquisition of your capital asset under any law. Say you have a land, etc. Now this land is compulsory acquired by government for construction of bridge. That will be treated as what's a transfer. And accordingly capital gain is required to be paid. Now, normally capital assets, we understood the meaning of capital asset and we also saw the meaning of transfer. So, whenever there is a capital asset and there is a transfer of capital asset, capital gain will come, and capital gain will be taxable under income from capital gain topic. Sir, capital loss also may come. No, sir. Yes, that loss also is taxable under this head only, income from capital gain. Now, the capital asset can basically be divided into two types. One is called as long-term capital asset, another one is called as short-term capital asset. Now, long-term capital asset, if you transfer, you will get a gain called as long-term capital gain. Short-term capital asset, if you transfer, you will get a gain called as short-term capital gain. So basically capital assets are of two types: long-term capital asset and short-term capital asset. Long-term capital asset you transfer, you will get long-term capital gain. Short-term capital asset you transfer, you will get short-term capital gain. Sir, how will I come to know whether a capital asset is a long-term capital asset or short-term capital asset? Sir, how will I come to know whether a capital asset is a long-term capital asset or short-term capital asset? For that, you are required to see their period of holding. You should see what's its period of holding. Period of holding, what do you mean by period of holding, sir? Period of holding means the age of that particular capital asset, meaning the time, how long are you holding that capital asset. So the period of holding is nothing but the date of acquisition, the period from the date of acquisition of that capital asset till the date of transfer. The period from the date of acquisition till the date of transfer is stated as period of holding. So date of acquisition till the date of transfer, this period is called as what's a period of holding. Now what lawmaker says, if the period of holding is more than 1 to 3 years, it is long-term capital asset. If less than 1 to 3 years, it is short-term capital asset. Meaning for some assets, the period of holding is 1 year, which is nothing but 12 months. 24 months for some capital asset, and for some capital asset it is 36 months. If you hold any capital asset for a period more than 12 months, 24 months and 36 months, it is long-term capital asset. If you hold it for less than 12 months, 24 months and 36 months, it is short-term capital asset. Now sir, for which is it 12 months, for which is it 24 months, for which is it 36 months? Sir, 12 months period will be taken for any securities listed in recognized stock exchange of India. If you are having any securities which are listed in recognized stock exchange of India, I will take the period of holding as 12 months. If it is an units of unit trust of India, I will take it as 12 months. If it is an unit of equity oriented mutual fund, then also I'll take it as 12 months. I don't care whether these units of unit trust of India or units of mutual fund are listed or not. So if it is listed securities, 100% 12 months. Units of unit trust of India, 12 months. Units of equity oriented mutual funds, 12 months. And for zero coupon bonds, I will set the period of holding 12 months. Meaning what, sir? Basically, in simple words, shares of Reliance Industries, shares of Tata Motors, they are listed securities, correct? Now, if I hold them for more than 12 months, then it is called as long-term capital asset for me. If I sell it within a period of 12 months, then it is called as short-term capital asset, and therefore short-term capital gain will come. Now, for some assets, the period of holding is 24 months. Which are those assets, sir? If you are having an immobile property being land, building, or both, for that it is 12 months. And for unlisted shares, meaning the shares which are not covered above, for unlisted shares, for shares of foreign company, whether it is listed in foreign country or not, it does not matter. Tesla shares, though it is listed, it will come under this category. Unlisted shares of any private companies in India. And 3 years or 36 months will be taken for all other type of capital asset. Normally for long-term capital asset, to check whether a capital asset is long-term or short-term, it is 36 months. Only for some cases it is 1 year to 2 years. But for immobile property, how much, sir? 2 years. For all other capital assets, it is 36 months. For example, jewelry, debt-oriented mutual fund, unlisted shares and securities, bullion, etc. For all these things, what is the period of holding which I am going to see? I am going to see a period of holding of 36 months. Now, just like your income from house property, under capital gain also there is a specific format. You follow that format, you will get the answer. Under capital gain also there is a specific format. Follow that format, you will get the answer. How do I compute the capital gain? Section 48 says computation of capital gain. Computation of capital gain. So first take your full value of sale consideration. That is nothing but the sale value of the property less expenses incidental to transfer. Have you incurred any expenses for making this transfer, like brokerage you have paid, some property tax, registration fees, etc. you have to pay, etc. So take full value of sale consideration, the actual selling price less expenses incidental to transfer, you will get your net sale consideration. From this net sale consideration, subtract cost of acquisition and cost of improvement. Subtract the cost of purchase of the property. If you have incurred any improvement cost, subtract that improvement cost, you will get your capital gain. If it is a negative, then you will get your capital loss, short-term capital gain or short-term capital loss. From this, you claim the exemptions under section 54. If you have any 54 series, okay, exemption under 54 series, if you have any, you will get your taxable long-term short-term capital gain. Now, in case of long-term capital gain also, the format is exactly same. Only instead of taking, normally what do we take, sir? Cost of acquisition, cost of improvement. But in case of long-term capital assets, you are required to take indexed cost of acquisition and indexed cost of improvement. Okay. In case of long-term capital asset, take full value of consideration less expenses incidental to transfer, you will get your net sale consideration. From that net sale consideration, instead of taking cost of acquisition, you should take your indexed cost of acquisition and take your indexed cost of improvement. You will get your long-term capital gain or long-term capital loss. From that gives section exemptions, give the benefits of exemptions under section 54. You will get your taxable long-term capital gain or taxable long-term capital loss. Now, please note here, in case of long-term capital asset, instead of taking cost of acquisition, what are we taking, sir? In case of long-term capital asset, instead of taking cost of acquisition, we are taking index cost of acquisition. Now, what lawmakers are telling is, because you have holded the property for a longer period of time, I am going to give you some extra benefit. I'm going to give you some extra benefit. What is that benefit, sir? That benefit is of a indexation, meaning normally, say, let me give a simple example. In our school days, in our school days, etc. Now in Bangalore, if I talk about Bangalore, one idli was costing, say, one plate idli used to cost 10 rupees. But the same idli today is costing rupees 30. You get 2 idlis, it is costing rupees 30. Now, before what used to happen, what used to happen, sir? Parle-G biscuit, in that Parle-G biscuit, 5 rupees Parle-G biscuit which we have, we used to get around 12 biscuits. Okay, we used to get around 12 biscuits. Now, the same Parle-G biscuit which consists of 12 biscuits is costing 10 rupees. So, what is happening, sir? There is an inflation happening. So, they are telling, whenever you are holding the capital asset for a longer period of time, I will give you the benefit of inflation. I will give you the benefit of indexation or inflation. Index cost of acquisition or index cost of improvement. Okay, I will give the benefit of indexation. Now, how do I take the benefit of indexation, sir? Meaning, how do I take the indexed value of a cost of acquisition, sir? Very simple. Take your actual cost of acquisition. Now, in the question only, they will give you the indexes. They'll give you the index for the year of, multiplied by index for the year of transfer divided by index for the year of acquisition. Meaning, basically, say if something was costing 100 rupees 10 years back, and now if it is costing 150 rupees, if I ask you, now it is costing 50 rupees. Now, what is the increment which has happened, sir? It is increased by 50%. Correct, not correct? So, if I ask you, say for example, what if my cost was 500 rupees? What if my cost was 5 lakh rupees? How much it would have been today? What will you do, sir? If you want to find this value, what will you do, sir? Sir, simple, sir. Cross multiplication, 5 lakhs into 150 divided by 100, which is nothing but 7.5 lakhs something. Correct? So that is what you are doing over here also. They will give you the value of indexation. They will give you the index values. They will give you the index values in the question. So by applying that, you will have to find the index cost of acquisition and index cost of improvement. So take your actual cost of acquisition multiplied by with index for the year of transfer divided by index for the year of acquisition. Similarly, index cost of improvement, take cost of improvement multiplied by index for the year of transfer divided by index for the year of improvement. Now, many times it may happen that now here the lawmakers, what they say is, lawmakers in your income tax law, no, the index amounts, the index rates they have given, from the financial year 2001 to, they have given index rates from which year, sir? 2001 to. So for us, the base year is 2001 to. Okay, so the base year is what, sir? 2001 to. For period before that, if the property was purchased anytime period before that, then indexation benefit for that before period will not be available. So what lawmakers are telling, because we don't have, for us the base year is 2001 and 2, for that base year the index value is 100, and for your examination, which is your examination 23-24, for your examination the index value is 348. They have already given, meaning they have told 100 rupees in 2001-2 is equal to 348 rupees today. 348 rupees as on previous year 23-24. Now, what if the property is purchased before that day, sir? What if the property is purchased before 1/4/2001? What if the property is purchased before 1/4/2001? In such cases, lawmakers are telling you should take a separate different value. If the capital asset is acquired before 1/4/2001, then the cost of acquisition will be taken as actual cost of acquisition of the property or the fair market value of that property, whichever is higher. You take the actual cost of acquisition, the actual purchase price, or the market value of that property as on 1/4/2001. As on 1/4/2001, what is the market value of that property? Compare both of them, take whichever is higher. Take whichever is higher. Whichever is higher will be taken as your cost. It will be taken as your actual cost, and then apply this indexation by using that formula. Sir, what will I take in the denominator, sir? Instead of taking index for the year of acquisition, you take index for the base year. If the property is purchased before 1/4/2001, cost of acquisition will be actual cost of acquisition or fair market value as on 1/4/2001, whichever is higher. Then apply index for the year of transfer divided by index for base year. Sir, what if any improvement is done before 1/4/2001? Lawmakers are telling, please directly ignore that improvement. Please ignore those types of improvement. Please ignore any improvement done before 1/4/2001, because instead of taking the cost, I am taking the fair market value now. So that fair market value will also compensate the improvement. Now, later in our discussion, we are going to see a concept of stamp duty value, section 50C. There they talk about stamp duty value. Now, there is one point with related to, I mean, obviously when you are seeing this marathon video, means you would have already know what is 50C, you already know what those sections are, you would have already done one studies. Now, the concept of stamp duty value says, if the property, one very important note they have given over there, the fair market value of the property as on 1/4/2001 cannot exceed the stamp duty value of the property as on 1/4/2001. Whatever fair market value of the property is there, no, as on 1/4/2001, it shall not exceed the stamp duty value of the property as on 1/4/2001. In simple words, if the capital asset is acquired before 1/4/2001, your cost of acquisition will be actual cost. Take your actual cost amount and compare fair market value of the property as on 1/4/2001 with the stamp duty value as on 1/4/2001. Compare both of them. Take whichever is less from them. Now, this whichever is less, you should compare with. This whichever is less, it should be compared with what, sir? It should be compared with the actual cost, and then you should take whichever is higher. Normally we take actual cost or fair market value, whichever is higher. But if they also have given the information, if in the question, if they have also given the information of what, sir? Stamp duty value, first compare stamp duty value with fair market value, take whichever is less from them, and compare that whichever is less amount with actual cost, take whichever is higher. For example, actual cost is 3 lakh, fair market value 9 lakh, stamp duty value 7 lakhs, take whichever is less from them, 7 lakhs. Compare this with 3 lakhs, whichever is higher, cost of acquisition is 7 lakhs. Now, next concept, exceptions to section 45(1). What is 45(1) telling? 45(1) says, fantastic. 45(1) says what, sir? Section 45 subsection 1 says, section 45 subsection 1 says, normally capital gain tax you have to pay in the year in which transfer took place. Correct? Section 45 subsection 1 is telling any profit or gain arising from transfer of a capital asset shall be taxable in the year in which transfer took place. In the year in which transfer took place. So normally capital gain tax which you have to pay in which year, sir? Normally capital gain tax you will have to pay in the year in which transfer has taken place. But there are some exceptions for this. There are totally 4 exceptions for this. Which are these 4 exceptions, sir? Which are these 4 exceptions? We are going to see. Meaning in this case, no. Capital gain tax you don't have to pay in the year in which transfer is taking place. You will have to pay in some other year. Meaning what, sir? In the below cases which you are going to see over here, transfer year may be a different year, and the year in which you have to pay the tax will be different year. Normally, when should you pay the tax on capital gain, sir? In the year in which transfer took place. But there are some exceptions for this. Exception to the above general rule. In the following 4 cases, capital gain is taxed in some other year. It is not taxed in the year of transfer. Which are these cases, sir? If there is a conversion of capital asset into stock in trade, if you are converting a capital asset into stock in trade, if there is a compulsory acquisition of a capital asset under any law, if insurance claim has been received for damage or destruction of a capital asset, or in case of joint development agreement. I will give an explanation for this point. Same explanation is applicable for everyone else. Okay. So let us see what is conversion of capital asset into stock in trade. For example, I was having a land. I was having a land which I purchased for 10 lakh rupees in the previous year 2001-2. Now I converted this land. This land was my capital asset. Okay, this was my capital asset. So now I converted this land into stock in trade, meaning I went into real estate business. So now I started selling this. I started making them into small pieces of plots. 100-acre land was there. I divided this 100-acre lands into small different plots of equal sizes, different sizes, etc. And I started my real estate business. So what have I done, sir? I have converted my capital asset into stock in trade. This capital asset which was there is now converted into my stock in trade. When was it converted, sir? It was converted in the previous year 17-18. Now we saw the transfer definition said if there is a conversion of capital asset into stock in trade, then transfer takes place. If there is a conversion of capital asset into stock in trade, transfer takes place. Sir, but on what amount should I pay the taxes? Even if I have to pay the taxes, sir, where is the amount to pay the taxes? I have not received any money at all, no, sir. I have just done the conversion. I have not sold the stock, no, sir. Correct. So lawmakers are telling whenever there is a conversion of capital asset into stock in trade, the transfer will happen in the year in which conversion took place. Transfer will happen in which year, sir? In the year in which conversion took place. But however, capital gain tax you will have to pay in the year in which the stock in trade is sold. In the year in which stock in trade is sold, in that year you will have to pay capital gain tax. For example, I purchased it for 10 lakhs and the conversion happened in the year 17-18, and the actual sale of the stock took place in the year 23-24. For how much, sir? 75 lakhs. So what lawmakers are telling, in the year of sale of that capital asset or stock in trade, in the year of sale of that, not conversion, I am talking about in the year of sale of that stock in trade, when that converted stock in trade is sold, no, in that year, two incomes I will have. One is income under capital gain and another income is business income. Another income is what, sir? Business income. Sir, what is the income under capital gain, sir? The income under capital gain is take full value of sale consideration. Take your selling price, which is equal to 40 lakh rupees, full value of sale consideration. Meaning, in the year in which conversion took place, what was the market value of this property? What was the fair market value of the property in the year of conversion? You take that as full value of sale consideration. From that full value of sale consideration, subtract expenses incidental to transfer, you will get net sale consideration. From that net sale consideration, subtract indexed cost of acquisition. Take what's an indexed cost of acquisition. Indexation benefit is given from the year of acquisition till the year of transfer. It will not be given till the year of sales. No. Because transfer took place in which year? Transfer took place in the year of conversion only. So indexation benefit will be given only till the year of conversion. So you give that indexation benefit, you will get your long-term capital gain. And you will also have business income. For business income, what is the sale value, sir? 75 lakh rupees is my sale value of stock in trade. And what is the cost of that stock in trade, sir? It is nothing but the fair market value on the date of conversion. So that will be my business income. Now what if, sir, the stock is sold in lots? Then this capital gain amount will remain same, because the capital gain will be calculated as on this date only. But the capital gain amount will be taxable in installments as and when the stock in trade is sold. So now let me read the provision for it. Okay, section 45 subsection 2, conversion of capital asset into stock in trade. Section 2 clause 47 says conversion of capital asset into stock in trade is regarded as transfer, and transfer takes place in the year of conversion. When is transfer happening, sir? Transfer will happen in the year in which conversion takes place, and capital gain tax is payable in the year in which stock in trade is sold. Now what is this point telling? Whenever there is a conversion of capital asset into stock in trade, then transfer will take place. When will transfer happen? In the year of conversion, and capital gain tax is required to be paid in which year? In the year in which stock in trade is sold. So basically, in the year in which stock in trade is sold, two types of income will arise. One is your income from capital gain, another one is income from business or profession. If the stock in trade is two incomes will arise, how to do the computation we have already stated. Now what if the stock in trade is sold in lots or installments, sir? Then the capital gain also will be taxable in the lots or installment as and when the stock in trade is sold. Now, sir, what is the period of holding which I should take for capital assets, sir? Should I take it till the date of sale of the stock in trade? No. The period of holding of the capital asset should be taken from the date till the date of transfer. That is, till the date of conversion. From the date of acquisition till the date of conversion of capital asset into stock in trade. And indexation benefit also will be given till the date of conversion only. Full value of sale consideration for the capital asset will be taken as what, sir? Fair market value of that capital asset as on the date of conversion. On the date of conversion, what was the market value? That will be taken as full value of consideration for computation of capital gain. Now similarly, there are other points also. Now what will happen if there is a compulsory acquisition of capital asset? What will happen compulsory acquisition? Meaning compulsory acquisition, what will happen? Say for example, I have a land. Government is compulsory acquiring this land for construction of an highway. Now what may happen is government may acquire the property today, pay me after 2 years, 3 years. So transfer will take place in the year when compulsory acquisition is happening, but capital gain tax I will have to pay in 2-3 years later whenever I am receiving that money. Now as per section 2 clause 47, compulsory acquisition of a capital asset under any law is regarded as transfer. The transfer will take place in each year. So transfer will take place in the year in which compulsory acquisition took place. However, capital gain tax is payable in the year in which compensation is received. So I will have to see transfer, it takes place in the year in which they are compulsory acquiring, but I will have to pay capital gain tax in the year in which they are paying the money to me, in the year in which the compensation is received. Here also there are two possibilities. Compensation is received in installment. Now here there are two possibilities. One, say they have told that I am going to give, they have compulsory acquired, the government has compulsory acquired my property and they have told that I am going to give 40 lakh rupees. But then I feel that this 40 lakh rupees is very less, so I am disputing that particular case and the case is going to court. The court is increasing the limit. The court is increasing the limit. In such cases, what will happen, sir? So there are two types of compensation which I may receive. One is called as initial compensation, another one is called as additional compensation. Initial compensation will be taxable in the year in which it is received. Additional compensation will be taxable in the year when additional compensation is received. Now, what will happen if the compensation is received in installment, sir? What will happen, sir? Previously you told it is taxable under installment. Is it applicable for this also? No. If the initial compensation is received in installment, then the total or full capital gain tax is required to be paid when the first installment is received. The entire capital gain tax is required to be paid by you when the first installment is received. However, when additional or enhanced compensation is received in installment, capital gain is taxable as and when the compensation is received. When the additional compensation is taxable, in case of additional compensation, if it is received in installment, as and when it is received, it will be taxable. Computation of capital gain. Whenever you receive initial compensation, take your full value of sale consideration, which is nothing but whatever compensation is agreed, less expenses inserted to transfer, net sale consideration, cost or index cost of acquisition, cost or index cost of improvement will give you capital gain. But when additional compensation are received, no, obviously you are not going to subtract the cost again because it is already subtracted. So whenever you are receiving additional compensation, from that additional compensation amount, you can only subtract one thing which is called as litigation expenses or legal charges for receiving that extra money. That whatever difference is there will be taken as capital gain amount. Now, many times what will happen, there will always be a delay. Say property is acquired now by the government, after 3 years, 5 years, they are giving me the money. So there is always a delay. There is always a delay. For the delayed period, no, they will charge interest from me. For this delayed period, what the government is going to do, the government is going to pay me interest, because they are making a delay in making paying this amount. They are going to also pay me extra thing called as interest. If any interest is received for delay in payment of initial compensation or additional compensation, then such interest is taxable in the year of receipt. If you receive any interest for delay in payment of initial compensation or additional compensation, whenever they are paying initial compensation or additional compensation, now there is a delay. You are receiving interest for the delay. That interest will be taxable under which head, sir? Income from other sources. How much amount will be taxable, sir? Whatever interest you have received into 50%. 50% of interest received will be taxable. Then there is a damage or destruction of capital asset. Now there is a damage here. Basically, this is a fantastic point. Section 45, 1 capital A. Whenever there is a damage or destruction of capital asset, for example, due to fire, due to tsunami, etc., the capital asset was damaged or destruction. Now, if you satisfy two conditions, only when these two conditions are satisfied, only when these two conditions are satisfied, this provision is applicable. When is this provision applicable, sir? 45(1)(a) provision is applicable. 45(1)(a) provision will be applicable if two conditions are satisfied. Condition number 1, there is a damage or destruction of capital asset because of natural calamities, riots, or because of, say, fire, or because of enemy attack. If there is a damage or destruction on capital asset, the capital asset is getting damaged because of natural calamities or riots or enemy attack or fire, then and condition number 2, insurance claim is received by you, and insurance claim is received by you. In such cases, this provision shall apply. Damage or destruction of capital asset, damage or destruction of capital asset, and insurance claim is received for that damage and destruction. This provision is applicable. If any capital asset is damaged or destructed because of following reasons: natural calamities, riots, enemy attack, or fire explosion. Natural calamities, riots, enemy attacks, and fire explosion, then it shall be regarded as transfer. It will be regarded as transfer. Transfer will take place in the year in which capital asset is damaged or destroyed. However, capital gain tax is required to be paid in the year in which insurance claim is received. Okay, so if you have a house, if there is a house of Mr. X, Mr. X house was damaged due to floods or due to any other natural calamities, it was damaged or destructed. Now, he had not taken any insurance on this house. then obviously is not going to receive any insurance claim. So no capital gain concept, the question of paying capital gain will not come. He had taken insurance claim on that house. Now that insurance claim is received by him, in such case this provision will be applicable. How do I compute the capital gain amount, sir? You take your full value of sale consideration. What will be full value of sale consideration? Whatever insurance claims you have received. You may receive money and other assets also. You take the entire amount. Whatever money you have received plus whatever other assets you have received, take that. From that, subtract expenses incidental to transfer. You will get your net sale consideration. Subtract cost or index cost of acquisition, cost or index cost of improvement. You will get your capital gain amount. You will get your capital gain amount. Now there is one more small concept which is from intermediate point of view, it is not important. They will not ask question in the examination. For CA students, though, it is not there in the syllabus at all. But for CMA students, they have given this. But from exam point of view, it is not important. Concept of joint development agreement. Now, what is this joint development agreement? Say, for example, I have a 10 acres land, which I purchased for 5 lakh rupees. Now, there is a builder who is coming to me. He is telling me, Dilip, let us jointly build you have a land, I have money. I will construct apartments on this land and let us sell this constructed apartment. So we are entering into a joint development agreement. So I gave the property to the builder for construction purpose in the year 1920. So in the year in which I gave him, that year it will be treated as transfer. But I should not pay capital gain tax on this year. Capital gain tax I will have to pay in the year in which completion certificate for this property is received. Once the construction is completed, they are required to obtain something called as completion certificate. In the year in which completion certificate is received, that year capital gain tax is required to be paid. Please note, capital gain tax is not required to be paid in the year in which construction is complete. No. Once the construction is complete, you are required to obtain something called as completion certificate. Once you receive this completion certificate, from that day, in that year, I will have to pay capital gain tax. And sir, what will be taken as full value of sale consideration? That is very important. Full value of sale consideration will be the stamp duty value of that flat. What will be full value of sale considerations? It will be stamp duty value of that flat as on the date of completion certificate. Whenever you are receiving completion certificate, what is the stamp duty value of that flat? That will be taken as full value of sale consideration. If he has given flats in this constructed property, okay. If he has given you money, then obviously that money only will be taken as full value of sale consideration. Now these are the 4 exceptions for this case. These were these were 4 exceptions for the general rule. Now, next one chota sa concept we'll see, section 50C, concept of stamp duty value. Section 50C is applicable only for an immovable property if that immovable property is held as if that immovable property is held as capital asset. Now, what may happen is sometimes you may not give the actual sale price. You may not intimate the government actual sale price, or maybe there may be a possibility that I have a house. This house is sold by me. I have a house. This house is sold by me for 50 lakhs, but I may receive 20 lakhs in cash and receive only 30 lakhs in my bank account. And therefore, I may tell government that I have sold house only for 30 lakh rupees. So these types of activities may happen. So lawmakers are telling, we will apply something called as 50C. We will apply concept of stamp duty value. What is this concept of stamp duty value telling? Section 50C, concept of stamp duty value. Normally, full value of sale consideration is what, sir? Full value of sale consideration is the price at which the capital asset is actually sold. However, by this 50C says, however, if the stamp duty value of the property is more than 110% of selling price, whatever your actual selling price is there into 110%, or whatever actual selling price is there, plus add 10% to that. So that if my stamp duty value is more than that amount, then my full value of sale consideration for computation of capital gain, I will take full value of sale consideration to be equal to what, sir? Stamp duty value. I will take full value of sale consideration to be equal to what, sir? Stamp duty value. I'll repeat. Normally, when I am computing capital gain, what do I take full value of sale consideration? I'll take it as my selling price, whatever selling price I have. But lawmakers are telling in this, if your stamp duty value of the property is more than, if your stamp duty value of the property is more than 110% of selling price, then your stamp duty value will be taken as full value of sale consideration. Meaning what's in simple case? In simple case, say for example, my selling price is 20 lakhs, stamp duty value is 21 lakhs, full value of sale consideration is 20 lakhs. What will be my selling price, sir? I'll do 110% of selling price. It is how much, sir? 22 lakhs. 22 lakhs. So selling price is 20. 22 lakhs is 110% of selling price. Is my stamp duty value more than 110% of selling price? No, sir. So my selling price only will be taken as full value of sale consideration. My selling price is 20 lakhs. Stamp duty value is 23 lakhs. So what is 110% of 20 lakhs? 22 lakhs. Is my stamp duty value more than 110% of selling price? Yes, sir. Sir, 110% of selling price is 22, but my stamp duty value is 23. So it is more. Therefore, what will be my full value of sale consideration, sir? 23 lakhs. Similarly, all the other examples are also there. Selling price is 50 lakhs. Stamp duty value is 55 lakhs. Now it is not more. It is not more. Therefore, my selling price only will be taken as full value of sale consideration. Selling price is 50 lakhs. Stamp duty value is 45 lakhs. Is it more? No, sir. Therefore, my selling price only will be taken as full value of sale consideration. Okay, so 50C in simple words says only one line. If the full value of sale, if the stamp duty value will be taken as full value of sale consideration if stamp duty value is more than 110% of selling price. Now, many times it may happen that I may not be happy with the stamp duty value. Whatever stamp duty value is given by the government may be too high, and actually I would have sold the property for a lesser price. Whatever stamp duty value is there, no, it may be too high. Actually, I would have sold the property for a very less price. So in that case, no, I can go to the assessing officer, income tax officer, for reviewing this. So if the assessee is not satisfied, if the assessee is what, sir? If the assessee is not satisfied with the stamp duty value, then he can make a request to the assessing officer. If the assessee, if I am not satisfied with the stamp duty value, I can make a request to the assessing officer. And assessing officer will transfer the case to whom, sir? Valuation officer. Assessing officer will send the case to the valuation officer. Now, meaning I am not happy with the value, I'll go to the income tax officer, I'll request him, sir, the stamp duty value is too high, sir, please, sir, I request you to please reduce it, sir. Now, assessing officer will not reduce it. He will send me to whom, sir? Valuation officer. Now, I'll compare my stamp duty value with valuation officer's value. If valuation officer's value is more than stamp duty value, I will take what, sir? Stamp duty value as my full value of sale consideration, because valuation officer is telling even more price. So I'll take stamp duty value only as my full value of sale consideration. If valuation officer's value is less than stamp duty value, I'll take valuation officer's value as my full value of sale consideration. If the valuation officer's value is less than selling price or is equal to selling price, in such cases, I'll take selling price as my full value of sale consideration. Now, one question which normally student ask is, sir, stamp duty value, should I take it as on the date of sale, or that is date of transfer, or should I take it as on the date of agreement, sir? Stamp duty value should be taken as on the date of transfer or sale of the immovable property, or should it be taken as on the date of agreement? Lawmakers are telling normally stamp duty value you should take as on the date of registration or date of transfer of immovable property. Stamp duty value as on date of transfer should be taken. However, you can take the stamp duty value as on the date of agreement if there is an amount paid by account pay check, account pay demand draft, or any other electronic clearing system on the date of agreement. On the date of agreement, if you are making any payment in this ways, account pay check, account pay demand draft, or any other electronic system, electronic clearing system, any amount, say token advance, some say the sale value is 50 lakh rupees, you have paid 10,000 rupees and advance that yes, I am going to purchase the property. So only in that cases this provision will apply. Now next, one more chota sa point we will see and take a chota sa break. Section 51 talks about what, sir? Advance money forfeited. Many times what may happen is, say for example, you may come to me to purchase my property. Okay, you may come to me to purchase my property, and we would have agreed also that I am going to sell my property for 50 lakh rupees. But you are telling me that you are going to make the payment to me after 1 month. So what I may do is, I may take some money from you as advance. You may give me 50,000 rupees as advance, or 1,000 rupees as advance, 10,000 rupees as advance. And you, after giving this money, no, you never come back to me. You never come back to purchase the property. So what will I do? I keep this money with myself. This is called as advance money forfeited. You had given an advance for purchase of the property. Now you have not come back to me. Therefore, I have forfeited the advance. This is called as what's advance money forfeited. In case of advance money forfeited, section 51 says, check when is the advance money forfeited. Is the advance money forfeited before 1/4/2001 or after 1/4 on or after 1/4/2001? If it is before 1/4/2001, then that advance money which is forfeited by you should be reduced from cost of acquisition. Whatever cost of acquisition of the property is there, no, from that subtract what, sir? Your advance money. Whatever advance money is forfeited by you, subtract that amount. Now please note, this subtraction should be done before giving the indexation benefit. Whatever advance money is forfeited by you, reduce it from cost of acquisition of that property before indexation. Sir, what if the advance money is forfeited on or after 1/4/2001? Then that advance money forfeited will be taken as your income. It will be taxable as your income. It will be taxable as your income, and it will be taxable in the year in which it was forfeited. It will be treated as your income, and it will be taxable in the year in which it was forfeited. Meaning it will be taxable under income from other sources. Now, sometimes what may happen is the owner of the property may be transferred from someone to someone else. For example, father's property may be transferred to son without consideration. Okay, it is not regarded as transfer. It is not regarded as transfer. Now, in such cases, the son, say for example, father would have forfeited some advance. So now the property is sold by the son. So should he reduce from cost of acquisition? Answer is no. In simple words, advance money forfeited by the previous owner shall be ignored. Advance money forfeited by the previous owner shall be completely ignored. So this was with respect to what, sir? Advance money forfeited. Let us take a chota sa break and continue our discussion after a small bit. Let us continue our discussion. Next topic which we have under income from capital gain is section 49. Section 49, there is one section called as section 47. Now, what is this section 47 talking about, sir? Section 47 talks about transactions which are not regarded as transfer. It is also called as what, sir? No transfer, or transactions which are not regarded as transfer. Section 49 subsection 1 gives what is the cost we should apply for these transactions. Now, there are some transactions which are not regarded as transfer. Basically, if you see the institute material, they have given list of around 18 to 20 transactions, but you don't have to read or mug up or by heart all those things. These things are more than sufficient. I have listed around 10 transactions over here, more than sufficient if you know this. And mostly questions in examination will be related to, say, this point number 2. Yeah, mostly the question will be point number 2 and point number 4. Mostly the question also will revolve around these points only. Okay, so following transactions are not regarded as transfer. Please note, we saw some cases. We saw what is the meaning of transfer, sale, barter, exchange. We saw the meaning of transfer. Transfer includes sale, relinquishment, conversion, compulsory acquisition, etc. Accordingly, now we are going to see what are the transactions which is not a transfer. Transactions which are not regarded as transfer. Distribution of asset on partition of an HUF. Whether it is a total partition or partial partition, it does not matter. Distribution of asset on partition of an HUF, whether it is a total partition or a partial partition, it does not matter. So if any asset is distributed by whom, sir? An HUF upon to its members on the at what time, sir? At the time of dissolution of that partition of that HUF. Similarly, if any capital asset is transferred by way of a gift or will. For example, I have a capital asset. I gifted this capital asset to my girlfriend. I gifted this capital asset to my relative. I gifted this capital asset to my father. I gifted a capital asset to my say wife, etc. In that cases, this transaction will come. What is it telling, sir? It is not a transfer. Meaning what, sir? I have purchased a gold ring. Now this gold ring, it is a capital asset for me. I am giving this gold ring to my wife. So in this case, is it a transfer? Lawmakers are telling no, it is not a transfer. Therefore, Mr. Dilip, when you are giving this gift to your wife, no, you don't have to pay capital gain tax. You don't have to pay any capital gain tax. If it is not a transfer, no capital gain will come. No. So these are the different transactions which are not regarded as transfer. Distribution of asset on total or partial partition of HUF. Transfer of a capital asset by way of gift or will or inheritance, etc. Transfer of a capital asset by way of succession or inheritance. So father's property is succeeded or inherited by the son or daughter, etc. Distribution of asset. Next is what, sir? Very important. Distribution of asset. 8-mark questions has been. This question has come for 8 marks in 2 times in your examination, in 2 attempts. Okay. Distribution of asset on liquidation of a company, sir. What question they have asked about this point, sir? What will happen? They have given the balance sheet of a company, and they have told that this company is getting liquidated, and they have distributed the asset to its shareholders. Now, what are you supposed to do? What is the capital gain which is going to come in the hands of shareholders, in the hands of company, etc. So that specific point is there. We'll see the computation. We are just seeing the list first, and we'll talk about what is going to happen in these cases in subsequent discussion. So first, distribution of asset on total or partial partition of HUF, transfer of a capital asset by way of gift or will, or transfer of a capital asset by way of inheritance or succession, etc. Distribution of capital asset on liquidation of a company, transfer to a revocable or irrevocable trust, or transfer by holding company to subsidy company wherein the subsidy company is an 100% subsidy company and it is an the transferee company, that is the subsidy company, is an Indian company. Amalgamation, merger, demerger, etc. Amalgamation, transfer of assets by amalgamating company to amalgamated company in the scheme of amalgamation wherein the amalgamated company, the new company, is an Indian company. Transfer of capital asset by demerged company to the resulting company as per the scheme of demerger wherein the resulting company is an Indian company, or individuals are transferring their personal property to his or her HUF. Individual is transferring his personal property to his HUF. Now in all the above cases, what is going to happen, sir? See what has happened over here. If I want to just explain with a simple example, if I want to explain this concept to you with a simple example, let me just explain this concept to you with a simple example. Ding, 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 ding. Just a second. Here comes a discussion. Yeah. Now, say for example, what happened? Ranveer Singh is there, no? Ranveer Singh gifted a property to Deepika Padukone. Now, when Ranveer Singh gifted the property to Deepika Padukone, now Deepika Padukone never purchased this property from anyone. So, for her, what will be the cost of acquisition, sir? For her, at what price did she get the property? For zero value. For zero value. Say tomorrow when Deepika is selling this property, say she sold the property to Siddharth for 75 lakh rupees. For 75 lakh rupees. Now the question is, what will be the cost of acquisition which I am going to take for Deepika? Because Deepika never purchased this property. What will be the cost of acquisition which I am going to take? So in these cases, no, see, this property was actually belonging to Ranveer. He purchased this property for 10 lakh rupees. He gifted this property to Deepika. Because he gifted the property to Deepika, it is not a transfer. Therefore, no capital gain will arise in the hands of Ranveer. Because he gifted it to Deepika, no transfer, no capital gain in the hands of Ranveer. Now this gifted property, Deepika sold it to Siddharth for 75 lakhs. She sold it. She did not gift. She sold it for 75 lakhs. Now Deepika, there is full value of sale consideration which we have. Then we have, if there is an expenses we can subtract, we got net sale consideration as 75 lakhs. Now the question is, what should be the cost of acquisition for Deepika? And what should be taken as period of holding for Deepika? So that is the question over here. For this, they say, see, Ranveer was the previous owner of the property and Deepika is the present owner of the property. So the present owner of the property is selling this property. Therefore, the cost of acquisition for Deepika should be taken as the cost of previous owner. Whatever price Ranveer purchased this property, that will be taken as cost of acquisition. That will be taken as cost of acquisition for whom, sir? Deepika. So at the time when Deepika is selling this property, what will I take cost of acquisition, sir? 10 lakh rupees. Obviously, I am going to give indexation because it is a long-term, long-term capital asset. Now, sir, okay, I understood that I should take cost of previous owner, sir. Now, sir, what about period of holding? Should I take period of holding from the date when Deepika held this property, or should I take the period of holding from the date when the Ranveer was holding this property till the date of transfer? Lawmaker says period of holding which you are supposed to take should be the period of holding of present as well as previous owner. Meaning, when was the property purchased by the previous owner Ranveer? From that date till the date of actual transfer of this property or actual sale of this property, the period of holding will be taken. So the period of holding of present as well as previous owner will be taken. Similarly, sir, if any improvement is done, say for example, Ranveer did an improvement on this property and again further improvement was done by Deepika also. So should I take the improvement only of Deepika or should I take the improvement of Ranveer also? Lawmaker says cost of improvement of present as well as previous owner also should be taken. Cost of improvement of present as well as previous owner should also be taken. Now, sir, okay, I understood that. See, sir, what I understood for Deepika, I will take cost of acquisition as cost of previous owner, period of holding from previous owner, cost of improvement of present as well as previous owner. Sir, next question comes to which is coming to my mind is with respect to indexation, sir. Sir, we know that I should take cost of acquisition and cost of improvement of the previous as well as present owner, sir. Now, in this case, sir, I will have to give indexation benefit, no, sir. So indexation benefit, you told period of holding should be seen from Ranveer. So, sir, indexation benefit will be given from which date? Lawmaker says, very important over here. Lawmaker over here says indexation benefit will be given from the date when the capital asset was first held by the assessee. Meaning what, sir? Indexation benefit will be given from the date when Deepika became the owner of the property. From the date when Deepika became the owner of the property. Please understand this carefully. Whether this property is a long-term capital asset or short-term capital asset, if you want to check that, for that you will have to see period of holding. Period of holding you are required to check from the date when previous owner became the owner. But indexation benefit will be given only from the date when the Deepika, the present owner, was the owner. So when I take over here 348 divided by whatever index value is there, no, for 1718, that index value will be taken by me, 217 or whatever amount it is there. Okay, so indexation benefit will not be given from previous owner. It will be given from the date when the assessee became the owner of this property. Yeah. So this point which we discussed is equally applicable for all these transactions. Sir, what do you mean by this? Now we discussed about gift. Now say for example, there is a partition of HUF happening. In the case of partition of HUF, HUF is going to give the assets to its co-partners, its members, correct? So in this case, it will not be regarded as transfer for, it is not a transfer for HUF, therefore HUF does not have to pay any capital gain tax. Now this co-partners, let us say this co-partners sell this property. When the co-partners are selling this property for co-partners, what will be the cost of acquisition of this property? Cost to previous owner. What will be the period of holding? Period of holding of previous owner. When will the indexation be given, sir? From the date when they became the owner. What will be the cost of improvement? Cost of improvement done by them as well as previous owner will be taken. So that is what this section 49(1) says. See, section 47 gives a list of transactions which are not transfer. Now in such cases, what should be my cost, etc. is told by whom, sir? 49 subsection 1. So in all the above cases, cost of acquisition of previous owner should be taken. Cost of improvement of previous as well as present owner should be taken. Period of holding from previous owner should be considered. Benefit of fair market value. If the property is acquired before 1/4/2001, sir, can I take the benefit of fair market value as on 1/4/2001? Answer is 100% yes. Then indexation benefit will be given from the date when the property was first held by the assessee, that is current owner. Next is section 50B. Section 50B also is a fantastic section. Very small section, but very important from exam point of view. Section 50B talks about what, sir? Section 50B talks about slum sale. What do you mean by slum sale, sir? Slum sale means transfer of one or more undertaking for a lump sum amount for a consideration without assigning values to individual assets and liabilities. In simple words, I'll tell you what slum sale is. Slum sale means transfer of an undertaking without assigning values to individual assets and liabilities. Transfer of an undertaking without assigning values to individual assets and liabilities. Sir, I'm not understanding this. Say for example, what, sir? This is Priya Industries. Okay, Priya Industries. So Priya Industries, we have different types of business under us. We have Priya Sarees, Priya Chudidar, Priya Dupatta, Priya Sweets, and Priya Headache Center. Okay, not okay. So I have Priya Sarees, Priya Chudidar, Priya Dupattas, Priya Sweets, and Priya Headache Center. Now this headache center which I have, Priya Headache Center which I have, the entire business is transferred by me to Salman Khan. I am transferring the entire business to Sallu. I am transferring the entire business to Sallu. I am not saying how much assets I have, how much liability I have. Without assigning the values to individual assets and liability, entire business completely is transferred to Sallu for 500 crores. For how much, sir? 500 crores. Now in this case, this is called as what, sir? Slum sale. So without checking the value of individual assets and liabilities, when I'm transferring my entire business, without assigning values to individual assets and liability, when I'm transferring my entire business, entire undertaking is transferred by me without assigning value to individual assets and liabilities, then it is said that it is a slum sale. Section 50B, slum sale. Slum sale means transfer of one. Okay. Now, how to do the computation of capital gain in case of slum sale? Fantastic concept. It is important from exam point of view. Now, slum sale. Now, in case of slum sale, computation mechanism is same. Take full value of sale consideration less expenses incentive to transfer. You will get net sale consideration less cost of acquisition will give you capital gain. Now, here the procedure is very simple, but there is the computation which is involved over here. Now, here normally what is full value of sale consideration, sir? The selling price. But here full value of sale consideration is fair market value as per rule 11 UAE. Normally, what is full value of sale consideration, sir? Full value of sale consideration is fair market value of the property. But here, full value of sale consideration is what, sir? Here, full value of sale consideration is fair market value of the property as per Rule 11 UAE. And normally, what is cost of acquisition, sir? You should take your normal cost of acquisition. But here, the cost of acquisition will be the net worth of the company which you are transferring. Now here full value of sale consideration is what, sir? Full value of sale consideration will be full value of sale consideration as per Rule 11 UAE. And what is cost of acquisition, sir? Over here cost of acquisition is cost of acquisition as per, here cost of acquisition will be what, sir? Net worth of the company undertaking which is transferred by you. Now let us see what is this fair market value as per Rule 11 UAE and what is this net worth, how to compute our full value of sale consideration, how to compute our cost of acquisition, then we'll see other points. Now they say full value of sale consideration will be fair market value as per Rule 11 UAE. Now how to do this computation of Rule 11 UAE that is applicable in your final level? So what is Rule 11 UAE is telling, sir? Rule 11 UAE says fair market value, there will be two fair market value which will be given to you. Fair market value 1 and fair market value 2, or fair market value A or B, whatever you want to write, you can write it. There will be two fair market values which will be given. One will be the fair market value of unit which is transferred by you. Another will be the fair market value of consideration received. So whatever business you are transferring, what is the market value of that business? Fair market value of that business which is transferred, or fair market value of consideration received. What is the consideration received by you? What is the market value of this consideration? Now say for example, I am transferring this property. So I am transferring this entire business for 500 crores. 500 crores. So this is fair market value of unit transferred. The unit which is transferred by me, what is the market value of that unit, sir? 500 crores. Now, fair market value of consideration received. Say Salman Khan gives me 50 crores and his Galaxy apartments. He gives me 50 crores and his Galaxy apartment. So what is the fair market value of consideration received? 50 crores plus Galaxy apartments. Say cost of this Galaxy apartments comes to somewhere around 400 crores. Okay, so how much is the fair market value of unit consideration received? It is 450 crores. So I take fair market value of unit transferred or fair market value of consideration received, whichever is what, sir? Higher. So what will be my selling price over here? Full value of sale consideration. In this case, my full value of sale consideration will be 500 crores. Okay, fair market value of unit transferred and fair market value of consideration received, whichever is higher. Then cost of acquisition is net worth of the company. And I think net worth is something which you have already you have already learned in your FM. You have already learned in your accounts. Sir, what is net worth, sir? It is nothing but assets minus liabilities. Asset minus what, sir? Shareholders funds or liabilities. Correct? Not correct. So net worth means what, sir? Assets minus liabilities. So here assets can be basically of two types. One is depreciable assets and other types of assets which are non-depreciable, etc. Now, if it is a depreciable assets, you are required to take the depreciable assets at their WDV value. If it is a depreciable assets, what value should be taken by you? WDV value of that asset should be taken by you. And if it is other assets, you should take those other assets. The book value of those assets should be taken. Now, normally depreciable assets should be taken at their WDV value. Now, this WDV you should do the computation as per which law, sir? As per income tax law. So, depreciable assets you take WDV as per income tax law, and for other assets you take whatever the book value is there. Sir, what if the asset is revalued, sir? Revaluation should not be taken. Revalued value should not be taken. Normal book value should be taken. If any asset is revalued, if it is upward revalued, then bringing it back to the normal valuation. If it is downward revalues, then also bringing it back to the normal valuation. So asset, if it is a depreciable assets, take there. If it is a depreciable asset, take WDV, and if it is non-depreciable assets, take book value of those assets. Now from this subtract liabilities. Sir, what is this liability? Sir, liabilities is nothing but book value. Liabilities means what, sir? Liabilities in the liabilities will be taken by you at the book value of those liabilities. So assets minus liabilities will be giving you the cost of acquisition, which is nothing but the net worth. Some important points which are required to be noted. So if the net worth is negative, then the cost of acquisition should be taken as nil. Sometimes it may happen that my liabilities are more than my assets. So at that time, take cost of acquisition as 0. Now, even when normally when you are transferring the entire business, then obviously your stock also will be transferred. So, sir, should this income which I am getting for transfer of stock, should it be taxable under PGP? No, lawmaker says now you are not assigning the values to individual assets and liabilities over here in case of slum sale. So even if the stock in trade is transferred in case of some sale, the income will come under which head, sir? The income will come under capital gain. then revaluation of asset should be completely ignored. If you're doing any revaluation of asset, then that revaluation of asset should be completely ignored. If any deduction under section 35 AD is taken for any asset, now it may happen, so revaluation should be ignored. If any asset is revalued, please ignore that revaluation concept. Next, if there is an asset, any asset for which you have claimed deduction under section 35 AD of income tax law, PGBP chapter, you will learn about 35 AD. If there is any asset for which you have taken deduction under section 35 AD, then the value of such asset should be taken as nil at the time of computation of net worth. So when you are calculating the net worth of the unit transferred, if that unit is a 35 AD unit, and if you have purchased any asset for which you have claimed deductions under section 35 AD, then the cost of that asset should be taken as nil. Then similarly, if intangible assets are transferred by you for calculation of net worth, no, at the time of calculation of net worth, if there is any intangible assets in my assets, then check whether those intangible assets means what, sir? Goodwill, patent, trademark, brand name, etc. So if you have any intangible assets, check whether that intangible asset is self-generated or is it purchased. If it is a self-generated, then take the cost of acquisition to be equal to nil, meaning at the time when you are taking the value of asset, and in that asset value you have goodwill. Now this goodwill is self-generated or is it purchased? If it is self-generated, take the value of that goodwill to be 0, and if it is purchased, take the value of that particular asset at their purchase price. So in case of intangible assets, if it is self-generated, the cost should be taken as 0, and if it is purchased, take the cost to be equal to purchase price. Now please note, these important points are with respect to what, sir? Computation of net worth. So over here, in case of slump sale, computation of capital gain is not a difficult part. I mean, obviously this is also not difficult, but then there is a calculation involved for computing net worth and full value of sale consideration. Full value of sale consideration is fair market value of unit transferred, fair market value of consideration received, whichever is higher. Then cost of acquisition is assets minus liability. If it is a depreciable assets, take WDV as per income tax law. Other assets book value, and liability should be taken at book value. So if the net worth is negative, if the cost of acquisition comes as negative, take it 0. Stock, even if the stock is transferred, it will be taxable under capital gain. Revaluation should be completely ignored. 35 AD asset, take the value to be equal to 0. Intangible assets, if self-generated, take it to be 0, and if it is purchased, take the cost as purchase price. Now let us come back to this point. Computation of capital gain in case of slump sale. You take full value of sale consideration less expenses incidental to transfer. You will get your net sale consideration. You will get what, sir? You will get your net sale consideration. From this net sale consideration, you are required to subtract. You are required to what, sir? Subtract the net worth of the company, which is cost of acquisition. Now, sir, I should subtract cost of acquisition. No, sir. Yes, you are required to subtract the cost of acquisition. You are required to subtract what, sir? Cost of acquisition. When you are subtracting the cost of acquisition, please make sure that even if the capital asset is a long-term capital asset, there is no indexation benefit which should be given. Even if it is a long-term capital asset, no indexation benefit will be available. So now capital gain. Now, sir, if indexation is not available, if indexation is not available, how will I come to know whether that capital asset is a long-term capital asset or short-term capital asset, sir? Oh, sir, you are telling that indexation benefit will not be available, no, sir? Just a second. Sir, when you say that indexation benefit is not going to be, just a second, I'll adjust the screen properly. So yeah, sir, so if you are saying that if I should take cost of acquisition, indexation benefit should not be given, then how will I come to know whether a capital asset is capital gain is a long-term capital gain or short-term capital gain? Now capital gain can either be long-term or short-term. Okay. Now to check that, you should check the period of holding of that undertaking which you are transferring. The business which you are transferring, that business, whether that business, you are doing that business for more than 3 years or less than equal to 3 years. If you are doing it for a period more than 3 years, it is a long-term capital asset. If it is for less than 3 years, it is short-term capital asset. Okay. So this undertaking which is transferred by me, I will check the period of holding of that undertaking to compute the, to check whether the capital gain is long-term or short-term. Now there are certain intangible assets like goodwill, right to carry on business, right to manufacture, patent, trademark, tenancy right, LUMARs, and stage carriers permits, etc. Now for all these things, the cost of acquisition should be taken as what, sir? For all these things, cost of acquisition, if it is self-generated, it should be taken as nil, and if it is purchased, then it should be taken as purchase price. Now cost of improvement will be taken as nil for these items. Now please note, basically this is linked to this point. Okay, this is linked to this point. This is a point which I have added in the material. I mean, it may not be there in the institute material, but I have added just to explain this concept. To explain this concept in the classroom, I have discussed about these points also. Basically, you will find all these points in your final level. But still, yeah. So cost of acquisition in case of intangible assets, it will be taken as nil if it is self-generated, and purchase price if it is purchased. Now, there are some assets for which indexation benefit is not available. Very fantastic point it is. There are some assets for which indexation benefit is not going to be available. Which are those capital assets on which I cannot take any indexation benefit at all? There are totally how many assets? Sir, 6 assets on which you cannot take any indexation benefit. Which are the 6 assets on which I can never take indexation benefit, sir? It is debentures and bonds, equity shares or equity oriented mutual funds, which are listed equity shares and listed equity oriented mutual funds, virtual digital assets, global depository receipts, non-resident, when you are doing the computation of capital gain in case of non-resident and you are doing the computation in foreign currency as per proviso to section 48, and in case of slump sale. So there are totally how many cases? Totally 6 cases in which you will not get what, sir? In which you will not get your indexation benefit. So which are these cases, sir? Devgans. Which are these cases, sir? Devgans. Which are these cases, sir? Devgans. Ajay Devgan, you will be knowing Vimal Pan Masala. Okay. So which are the cases, sir? Devgans. In case of Devgans, you cannot take indexation benefit. D for debentures and bonds, E for equity shares, V for virtual digital assets, G for global deposited receipts, and for non-resident for when you are doing the computation as per foreign currency, and S for in case of slump sale. So in these 6 cases, you cannot take indexation benefit. Please note, capital gain computation you should do. Even if the asset is a long-term capital asset, indexation benefit will not be given. Full value of sale consideration. Full value of sale consideration for transfer of a capital asset where consideration is not determinable. Section 50D is there, one section is there which says if the consideration is not determinable, if you cannot determine what is the sale price, then the sale price should be taken for your computation should be the fair market value of asset transferred. If you are not able to determine the sale price, then take the sale price to be equal to what, sir? Fair market value of asset transfer. Then, sir, what about shares and debentures, sir? What about shares and debentures? Now, in case of debentures, you will not get any indexation benefit. In case of shares, if it is listed shares, no indexation benefit. Unlisted shares, you can take indexation benefit. Now, the capital gain computation of shares is also same as what you have discussed for other assets. Okay, it is exactly same. It is exactly same. Only one thing which is going to change is in case of bonus shares and right shares. In case of bonus shares and right shares, what is the cost of acquisition? That is the only thing which is important. Capital gain in case of shares and debentures. Capital gain in case of shares. Capital gain is required to be computed normally like transfer of any other assets. Just like the way you transfer any other assets, computation should be done. However, following are the important points which are required to be considered. For example, I'll just give you an example. Say, for example, I purchased shares of Reliance Industries for 1 lakh rupees and sold the shares at I purchased it at rupees 100 per share, 1000 shares I purchased and sold it for 500 per share, rupees 500 per share. So it will be same, sir. Full value of sale consideration is 500 into 100, 500 rupees into 1000 shares, and cost of acquisition will be 1 lakh, my actual cost, into indexation benefit will be given, assuming it is unlisted shares. If it is a listed shares, indexation benefit will not be given, and accordingly I will get my capital gain. What is important is, in case of shares, what is important is you get something called as, what is important over here in case of shares is you get something called as what, sir? You get something called as bonus shares. You get something called as right shares. Now this bonus shares, the bonus shares which are there, you have not purchased them, you have not acquired them, you have not purchased them. So what will I take it, the cost of acquisition, sir, for this bonus shares? Similarly, right shares, it is a right which is given to you by the company to purchase the shares of the company at a lower value. So in that case, what will be the cost of acquisition, sir? So lawmaker says, in case of bonus shares, check when was the bonus given to you. The bonus shares is received by you before 1/4/2001 or after 1/4/2001, on or after 1/4/2001, or is it given to you before 1/4/2001? If the bonus share is given before 1/4/2001, then the cost of acquisition of that bonus share shall be actual cost, which is 0, or fair market value of that share as on 1/4/2001, whichever is higher. Fantastic it is. If the bonus was given to you before 1/4/2001, then the bonus, then the cost of acquisition will be the actual cost or fair market value as on 1/4/2001, whichever is higher. But if the bonus is issued to you after 1/4/2001, then the cost of acquisition should always be taken as nil. Because see sir, bonus, in case of bonus, I'm getting it for free. No, bonus shares I'm not paying anything, I'm getting it for free. So cost of acquisition should be taken as nil normally. But if the bonus share was given before 1/4/2001, cost of acquisition will be actual cost or fair market value as on 1/4/2001, whichever is higher. Then sir, what about right shares, sir? Now right shares, no, right shares, two possibilities are there. In case of right shares, two possibilities are there. What happens in case of right shares, sir? In case of right shares, no, I get a right to purchase the shares of a company at a lower price. What is this right shares, sir? Right shares basically gives us an right. It gives us a right to purchase the shares of a company at a lower price. Purchase the shares of a company at a lower price. Say for example, the market price of the share is 250 rupees. The right issue price may be only 160 rupees. Meaning, if I want to purchase, I can purchase the shares at 160 rupees from the company directly instead of purchasing at 250 rupees from the market. So I get a benefit or discount of 90 rupees. So now in case of right shares, two possibilities are there. The shareholders may either exercise the right or renounce the right. I may either take the right, I may either exercise the right, or I may renounce the right. Shareholder has exercised the right, shareholder has renounced the right. Right shares, shareholder has exercised the right. In such cases, my cost of acquisition will be what, sir? Because I have taken the right, whatever right issue price is there, whatever a price at which I am supposed to exercise the right, that price will be taken as cost of acquisition. So I gave an example, market value is 250 rupees and 90 rupees is what, sir? Right, 160 rupees is right issue price. So what will be my cost of acquisition? Right issue price. Now sometimes what happens, this is when I am exercising the right, I am taking the right. Sometimes what may happen is I am renouncing the right, meaning the right, I am the shareholder of the company, therefore I have the right. Okay, now I don't want to exercise, I give this right to someone else. Now this person, if he wants to purchase the share, this person does not have the shares of the company, so if he wants to purchase the shares of the company, he will he has to purchase it from market by paying 250 rupees. So what he does is, he comes to me, he tells Dilip, see Dilip, you are not taking the right, no, you are not taking the right, no, you are not exercising the right, no, why don't you transfer that right to me? So what will happen if I transfer that right to him? He will be eligible to take the shares of the company at rupees 160. Instead of taking it from market, he will be able to take the shares of the company at this 160 rupees. At what rupees, sir? 160 rupees. So what am I doing? I am renouncing the right. So in such cases, no, in such cases, obviously, because he gets a benefit to purchase the shares of the company at a discount of 90 rupees, I will obviously charge something from him. I may take say 50 rupees from him or 40 rupees from him. So in that cases, shareholder has renounced the right. In case when I am renouncing the right, no, whatever price I am getting from that person, okay, I have, say assuming I got 40 rupees from that person, I gave my right to another person and got 40 rupees from him. This renouncement price, the price at which I have renounced, that renouncement price fully will be treated as short-term capital gain. Whatever price I am giving it to someone else, that entire money which I have got will be taken as what, sir? Short-term capital gain. It will be treated as transfer, that is relinquishment of capital asset, and therefore renouncement price will be equal to short-term capital gain. Now, sir, what will be the cost of acquisition for that friend of yours who have purchased the rights, sir? For him, what will be the cost of acquisition? He is paying 160 rupees to company plus 40 rupees to me. So for him, cost of acquisition will be what, sir? 200 rupees. So for purchaser of the right, cost of acquisition will be amount paid to the company plus amount paid to the amount paid for purchase of the right. So which is nothing but right issue price plus renouncement price. Now, what will be the period of holding for above cases, sir? For purchase of shares, it will be date of purchase. For bonus shares, the date of issue of bonus, and for right shares, the date of allotment of right. It will be taken as what, sir? Period of holding. From that date, it should be taken. Now, sir, some shares may be unlisted, sir. When the shares are unlisted, no, sir, it may be difficult for us to get the selling price, or sometimes a selling price may be understated or overstated, etc. I may not get the exact selling price. So what is the concept? Section 50C says, Section 50C says full value of sale consideration for unquoted shares or unlisted shares. Normally, what will be the full value of sale consideration for any type of share? Full value of sale consideration will always be sale price. Full value of sale consideration will always be what's our sale price. However, if the sale price is less than the fair market value, then the full value of sale consideration will be fair market value. Now, there is one more fantastic concept called as what's ESOP. Nice and fantastic concept it is. Next concept for us is ESOP. ESOP means what, sir? Employee stock option plan. What happens is many company, they may give option to their shareholders. They may give the option to their employees. Now to retain the employees, to make sure that employees does not jump from one company to another company, to retain the good employees, what companies do? The companies will tell, see, why don't you become owner of my company? This company will tell what, sir? Why don't you become the owner of the company? Sir, how an employee will become owner, sir? So company will have shares. Okay. Now, to some of the employees, who are very good employees, who are in the company from a longer period of time, etc., the company may give an option called as employee stock option. ESOP means employee stock option plan. It may give option to whom, sir? The company may give options to these employees for purchase of the shares of this company at a very lesser price. It may give option for purchase of the shares of this company at a very lesser price. This concept is called as ESOP. Now, what happens in case of ESOP? What will be the cost of acquisition for this employee? What will happen when the sells this shares which is acquired on ESOP? What will be the period of holding for computation of this capital gain in case of ESOP shares, etc.? We will see now. Okay, ESOP. Tax treatment in the hands of employee. Now, the employee will have two types of income. One is income under the head salary and income under the head capital gain. What is the salary income which is going to have, sir? See, what is happening? Say the shares of the company may be trading in the market for 500 rupees, but the employee may get an option to purchase these shares at 200 rupees. So, that employee is getting a benefit of 300 rupees. This benefit is nothing but perquisites. This benefit will be treated as what, sir? Perquisites. So, income under the head salary, perquisites will be taken in the hands of whom, sir? In the hands of employee, perquisites will be taken. Perquisites which will be how much, sir? Fair market value of shares as on the date of exercising the option. What is the market value of the shares as on the date of exercising the option? Less issue price of those shares will be taken as perquisites for in the hands of employee, and it will be taxable under the head salary. Now, but we are concerned with capital gain topic, correct? So, for example, in case of capital gain, under the head capital gain, what will be the income, sir? Cost of acquisition. The cost of acquisition will be the cost of acquisition of shares acquired through ESOP will be the fair market value of that shares as on date of exercising the option. What is the market value of the shares as on the date on which option is exercised? That will be taken as cost of acquisition, and period of holding will be taken from the date of allotment of shares. Period of holding should be taken from which date, sir? Date of allotment of shares. Now, very important point. Normally, gift of capital asset is not regarded as transfer. But however, if you gift shares which is acquired through ESOP, then it will be regarded as transfer, and accordingly, you will have to pay capital gain tax. Now, just one small question I have given for understanding, because this one simple question will make you understand this concept. So, this is value of perquisite, which is nothing but income under the head salary, and this is the income under the head capital gain. Now, there are some concepts which are going to see now. Before starting the exemptions under capital gain topic, we are going to see this chota concepts. From exam point of view, not relevant, but because it is there in the institute material, I am just discussing this. From exam point of view, you don't have to study this, because whatever is more relevant for examination, I have already discussed above. So, in case of amalgamation, merger, demerger, what will happen, sir? So, in case of amalgamation, what will happen? There are two companies, they are becoming one company, or a small company is getting merged into a big company, correct? So, amalgamation or merger. In case of amalgamation, income tax law says amalgamation means merger of two or more companies into one new company, or one or more companies are getting merged with another company, where all the assets and liabilities of the amalgamating company, that is old company, is transferred to the new company, that is amalgamated company, and the shareholders holding at least 75% of the equity shares of the old company, that is amalgamating company, should become the shareholders of amalgamated company. Now, in case of amalgamation, what is the tax treatment? For the old company, whatever shares assets it is transferring to the new company, it is not regarded as transfer. We saw section 47, it is not regarded as transferred. As per section 47, in case of amalgamating company, as per section 47, amalgamation is not regarded as transfer. Therefore, no capital gain will arise in the hands of amalgamating company, old company. So, in the hands of old company, it is not a transfer. Sir, what about new company, sir? For new company, apply those that concept of Ranveer and Deepika. For the new company, for the amalgamated company, the cost of acquisition will be cost to previous owner. Period of holding will be period of holding shall be taken from previous as well as present owner. Indexation benefit will be given from the date when you became the owner of the asset, etc. Now, in case of amalgamation, what is important is what will happen to shareholder. See, what is going to happen for amalgamating company and amalgamated company is same. But in case of shareholders, what is happening for shareholders? Say I had shares of old company, which is gone now. On behalf of this, I am getting shares in new company. I am getting shares in new company. I never purchased the shares in new company. I had actually purchased shares of old company. This old company is only gone. I have got the shares of new company. So, sir, what will be the cost of acquisition of these shares in new company? When I sell these shares in new companies, what will be the cost of acquisition? For that, they say in the hands of shareholders, as per section 47, where shareholder receives any shares in amalgamating company in lieu of shares in amalgamating company. So, if you receive the shares in a new company because you are having the shares in the shares in the old company, then such transfer is not such transaction is not treated as transfer, and therefore no capital gain will arise in on receipt of shares of new company. So it will not be treated as transfer. When you receive the shares of new company, it is not a transfer. But when you sell the shares of new company, it is a transfer. At such cases, the cost of acquisition of the shares of new company will be the cost in the old company. The period of holding shall be taken from old company as well as new company, etc. Now, sir, what in case of demerger? Same to same concept, exactly same concept. What is going to happen in case of demerger, sir? Now, in demerger, what is going to happen? Only in case of shareholder, the concept is little different over here. Now, what do you mean by demerger? Let me just explain this concept. Say, for example, there is a company called as Reliance Industries. Now, this Reliance Industries has many. This Reliance Industry, which is there, no? This Reliance Industries has many different sub branches in it. Reliance Fresh, Reliance Digital, Reliance Oil, Reliance Jio, etc. This Jio which is there, now this is all falling under one single company called as Reliance Industries. Okay. So the net worth of this entire Reliance Industry is 500 crores. 500 crores is the entire net worth of this Reliance Industry. Now what they are doing is one of their business which is Jio, they are demerging and forming a new company. So old company is Reliance Industry. One of the business which it has is of Jio, that is telecommunication business. They want to demerge this. So in case of demerger, what will happen, sir? There will be this demerged, the old company which is the demerged company, and there will be a new company which will be formed called as resulting company. There will be a new company formed called as resulting company. Now, I as an investor, I had invested money in Reliance Industries. I never invested money in Jio. But whenever demerger is happening, whenever demerger happens, I will also get shares in the new company. Because I had invested in the old company, I will also get the shares in the resulting company. Now the question is, what will be the cost of acquisition of shares in resulting company? That is the main concept. Apart from that, everything else which is there in this point is very easy and simple. Now, what do you mean by demerger, sir? Again, from exam point of view, it is not so relevant. It is something which is very easy. Just run with Deepika, you understand. Demerger. In case of demerger, transfer of an undertaking by demerged company to resulting company. Where, so what is demerger, sir? Demerger means transfer of an undertaking by demerged company, that is old company, to the resulting company, where all the assets and liabilities of the undertaking transferred, all the assets and liabilities of the undertaking is transferred, and such assets and liabilities are transferred at book value. Then undertaking should be transferred as a going concern, meaning all the assets and liabilities of the resulting company should be transferred. It should be transferred at book value. It should be transferred as a going concern, and at least 75% of the equity shareholders of the old company should become the shareholders of the resulting company, and the shareholders of demerged company should also receive shares in the resulting company on pro rata basis, on proportionate basis. I should also receive the shares in that new company. So what will be the tax treatment, sir? In the hands of, in case of demerger, what will be the tax treatment? So in the hands of demerged company, that is the old company, there is no transfer, therefore no capital gain will arise. In the hands of resulting company, the cost of acquisition will be taken as cost to previous owner, period of holding from previous owner, indexation benefit will be given from the date when they became the owner. Basically, this is nothing but that Ranveer Deepika example. What is important is for shareholders. Because shareholder had invested the money in Reliance Industry. He never invested the money in Reliance Fresh, Reliance Jio, etc. separately. No, he had invested the money in the main company, Reliance Industry. Now, Reliance Industry, one of the unit is going out. One of the unit is going out means what, sir? I am going to get shares in this new unit also. So what will be the cost of acquisition of shares in new unit? Lawmakers are telling divide your cost on proportionate basis. You had purchased the shares in the old company. No, now your cost, assuming I invested 1 lakh rupees in this Reliance Industries. Now Reliance Industries dividing Geo business separately. So now how much assets they have transferred to the new business? The value of old company was 500 crores. Assets worth rupees 200 crores were transferred to this company. So lawmakers are telling Mr. Dilip, your investment was 1 lakh rupees. So 1 lakh into 3 by 5 will be your cost of acquisition now in the new company after demerger, and 1 lakh into 2 by 5, 200 crores by 500 crores will be the cost of acquisition in new company. Proportionate basis, you should, in simple words, on proportionate basis, you should also divide your cost in the both the companies. So in the hands of shareholders, the cost of acquisition in resulting company will be cost of acquisition of the shares in demerged company into asset transfer to resulting company divided by net worth of the company before demerger, and cost of acquisition in demerged company will be difference of this. I mean actual cost of acquisition minus cost to resulting company, or what I can do, sir, or what I can do, sir, cost of acquisition into assets in demerged company after demerger divided by assets in demerged company before demerger. Now comes one of the most important point of your capital gain topic, which is exemptions. Under capital gain, no, the beauty of this capital gain chapter, why capital gain topic is so much appreciated, sir, or that is because of this exemption chapter. This is because of which topic, sir? This exemption topic. Now exemption topic, beautifully I will explain with this particular diagrammic presentation, etc. There are some amendments also in this topic. Let us see all those things. Section 54, most important from exam point of view. Section 54, 54F and 54 EC are most important from your exam point of view. And there is an amendment in this section 54 and 54F. There is an amendment in this section. Small amendment. Now section 54. Exemption for residential house property. Meaning what, sir? They are telling when you are transferring a residential house property, whatever capital gain you get from transfer of a residential house property, I will give exemption of that. Now what is this provision telling? Section 54 says, I am applicable to individual and HUF. I am not applicable to everyone. I am applicable only to individual and HUF. Section 54 exemption is available only for an individual as well as an HUF. If you are having a residential house property and if you transfer that residential house property, by transferring that residential house property, you should get a capital gain, and that capital gain should be a long-term capital gain. If it is short-term capital gain, then this section will not apply. So if you are an individual HUF having a residential house property and you are transferring that residential house property, by transferring that residential house property, you are getting a capital gain. What capital gains are? Long-term capital gain. Now I will exempt this long-term capital gain. I will exempt this long-term capital gain if you acquire another residential house property in India. I will exempt this long-term capital gain if you acquire one residential house property in India. When I say acquire means what, sir? Acquire means you are required to purchase or construct another residential house property in India. Sir, is there any time limit for purchase and construction? Yes. For purchase, the time limit is, say for example, whatever the date of transfer is there. For purchase, you can purchase a new property, another residential house property within 2 years from the date of transfer or within 1 year before the date of transfer. So if I have transferred in on 15th of August 2023, within 2 years from the date of transfer or within 1 year before the date of transfer, I can purchase another residential house property. Or if I am constructing, then the construction should be completed within 3 years from the date of transfer. So what is this point telling? If you are an individual and HUF having a residential house property, you transfer that residential house property, whatever capital gain you are getting from transfer of this capital asset should be a long-term capital gain. This long-term capital gain will be exempt if you acquire another residential house property in India. If you acquire what, sir? Another residential house property in India. If you are acquiring another residential house property in India, then this capital gain amount will be exempt. This capital gain amount will be what, sir? This capital gain amount is going to be exempt. If you acquire another residential house property for purchasing, the time limited 2 years from the date of transfer and 1 year before the date of transfer, and for construction it is within 3 years from the date of transfer. Now there are some extra points. This new property which you have acquired, whether constructed or purchased, this should not be sold within a period of 3 years. There is a lock-in period of 3 years. This new property which is acquired by you, it should not be transferred by you within a period of 3 years. Sir, what will happen if I transfer, sir? Then whatever exemption was given to you earlier, no, that exemption will be subtracted from cost of acquisition of this property at the time of computation of capital gain. For example, say this new asset is sold by me for 75 lakhs. I purchased it for 60 lakhs. Now from my cost of acquisition, whatever capital gain I got, that will be subtracted. That capital gain amount will be subtracted. Now, sir, how much exemption will I get, sir? You told capital gain amount will be exempt. How much exemption will I get, sir? The exemption which you are going to get is the capital gain amount, the long-term capital gain amount, or the amount invested in the new residential house property or capital gain account scheme, or rupees 10 crores, whichever is less. This limit which is there now is newly added, and this will not be there in the old material. If you are referring the old 2022 material, if you are referring 2023 March 23, if you are referring March 24 addition material, then this amendment will be there in that material. Okay, this is a major amendment applicable for June as well as December students. So exemption, how much exemption will I get, sir? I will get an exemption of the capital gain amount or the amount invested in the new residential house property or capital gain account scheme, or there is a limit of 10 crore rupees, whichever is less. There is a limit of 10 crore rupees, whichever is less. Now, basically, this is how I explain this concept. For this theory, how you are supposed to write, sir? So I'll write that theory part also. I hope with that above explanation you would have understood this, but I'll just read. This section 54, section 54, it is applicable only to individual and HUF. The asset which you are transferring should be a residential house property. The capital gain which you should get by transferring that property should be a long-term capital gain. And the asset which is acquired should be another residential house property, one residential house property in India. The time limit for acquisition in case of purchase, it is within 1 year from within 1 year before the date of transfer, or within 2 years from the date of transfer. And for construction, it is within 3 years from the date of transfer. How much is the exemption, sir? Capital gain amount or amount invested, or case number 3, newly added point is what, sir? Or there is a statutory limit of 10 crore rupees. There is a statutory limit of 10 crore rupees. Compare all of them and take whichever is less. And there is a lock-in period. The new asset which you have purchased, no, that should not be transferred within a period of 3 years from the date of acquisition or construction. And there is also a concept of capital gain account scheme which is applicable. Normally, they are telling you should purchase or acquire within a period of 2 years or 3 years. Correct? Purchase or construct within a period of 2 years or 3 years. Now, normally, we are required to file our return, income tax return in the assessment year only. So if I want to claim an exemption, I should claim that exemption before filing my income tax return, correct? At the time of filing my income tax return. So lawmakers are telling, by the time of filing your income tax return, if you have not purchased or constructed, then no problem, invest the money in capital gain account scheme. Invest the money where, sir? Invest the money in capital gain account scheme and use it for construction or purchase within the time limit of 2 years or 3 years. Even this investment which is made by you in this capital gain account scheme account will also be regarded as, it will be deemed that you have purchased the new property. Accordingly, exemption will be given. But however, if you don't use it for the said purpose, for construction or purchase of that new residential house property, in the year of misutilization, it will be taxable as capital gain. Section 54B. Section 54B. Section 54B talks about what, sir? Section 54B, B for BUN. B for what, sir? BUN, urban agricultural land. Section 54B, urban agricultural land. Section 54B, urban agricultural land. If you exemption for transfer of urban agricultural land. What is this point telling? If you are an individual and HUF and you have an urban agricultural land. If you are an individual or an HUF, you have an urban agricultural land. If you transfer this urban agricultural land, by transferring this urban agricultural land, what type of capital gain you are getting? It does not matter whether it is a long-term or short-term capital gain. That long-term or short-term capital gain will be exempt if you acquire another agricultural land in India. You are an individual HUF having an urban agricultural land. You transfer that urban agricultural land and get a capital gain, whether it is long-term or short-term, it does not matter. This capital gain amount will be exempt if you acquire another agricultural land in India. If you acquire another agricultural land in India, this newly acquired land should not be transferred within a period of 3 years. So there is a lock-in period of 3 years. Sir, how much is the exemption which I am going to get, sir? Whatever capital gain amount you have, that or the amount invested in the new land, new agricultural land, whichever is less. Amount invested in new agricultural land or capital gain account scheme, whichever is less. Sir, what do you mean by urban agricultural land? The agricultural land located in urban area. Urban area means something, if your area's population is more 10,000 or more, then your area is called as urban area. So urban agricultural land means an agricultural land situated at urban area which is used for the purpose of agriculture either by the individual or his parents or the members of HF at least 2 years before the date of transfer. So at least 2 years before the date of transfer, that land should be used for what purpose, sir? Agriculture purpose. Then I will call it as urban agricultural land. Then section 54D, D for D for what, sir? Industrial agricultural land and building. Section 54D, D for industrial land and building. So compulsory acquisition of industrial land and building. If this exemption is applicable for all types of assessee. So first two exemption which we saw was applicable only for individual and HF. Now here section 54D is applicable to everyone, because industry can be made by anyone. Anyone can make or create industry, etc. It can be an individual HF, etc. It does not matter. Individual HF, company, partnership firm, all the types of assessees. So what type of assessee you are, it does not matter. If you have an industrial land and building, and if your industrial land and building is compulsory acquired, what is this point telling? What type of assessee you are, it does not matter. If you have an industrial land or building, and if that industrial land or building is compulsorily acquired, then it will be regarded as transfer. If you have an industrial land and building, and if that industrial land and building is compulsory acquired, it will be regarded as transfer. By transferring, whether you are getting a long-term capital gain or short-term capital gain, it does not matter. This long-term capital gain or short-term capital gain will be exempt. It will be exempt if you acquire another industrial land or building within 3 years. If you acquire another industrial land or building within a period of 3 years from the date of receipt of compensation, then whatever capital gain is there, that will be exempt. How much exemption I will get? You will get the amount exemption of capital gain amount or amount invested, whichever is less. Please note, any type of assessee, if your industrial land and building is compulsory acquired by under any law, then that compulsory acquisition is regarded as transfer. So whether you are getting short-term or long-term capital gain, that short-term or long-term capital gain amount will be exempt if you acquire another industrial land or building within a period of 3 years. Within a period of what, sir? 3 years from the date of receipt of compensation, not within the 3 years from the date of transfer. In the above two cases, it was within 3 years from the date of transfer, but here within 3 years from the date of receipt of compensation. And this asset which is purchased, new industrial land and building which is purchased by you, should not be transferred within a period of 3 years. This is a lock-in period of 3 years. Sir, what will happen, sir, if I transfer? If you transfer this new industrial land and building within a period of 3 years, then whatever capital gain was exemption was given to you will be reduced from cost of acquisition. Meaning same thing is required to be done. So exemption will be capital gain amount or amount invested, whichever is less. Section 54 EC, very important section. Section 54 EC. Section 54 EC talks about exemption for immobile property. This exemption is applicable to all the different types of assessee. If you have an immobile property means what's a land or building or both. So if any type of assessee, I don't care who you are, any type of assessee you can be. If you have an immobile property and you transfer that immobile property, by transferring that immobile property, you get a capital gain. That capital gain should be long-term capital gain. What type of assessee you are, it does not matter. If you have an immobile property, whether land, building or both, and you transfer that immobile property, by transferring that immobile property, if you are getting a capital gain, which is long-term capital gain, this long-term capital gain amount will be exempt if you invest the money or purchase government bonds. If you invest the money or purchase government bonds within 6 months from the date of transfer. Remember, 54 EC. 54 EC is applicable to all type of assessee. You are purchasing an immobile property, being land, building or both. By transferring this immobile property, you are getting a capital gain, and it should be long-term capital gain. Your long-term capital gain amount will be exempt if you acquire government bonds within a period of 6 months from the date of transfer. Sir, what do you mean by government bonds, sir? Government bonds means bonds of NHAI, RECL, PFCL, IRFCL, National Highway Authority of India, Rural Electrification Corporation of India, Power Finance Corporation Limited, and Indian Railway Finance Corporation Limited. If you acquire the bonds of this company, then your capital gain amount will be exempt. So how much exemption will I get, sir? You will get an exemption of amount invested, the capital gain amount, or the amount invested, or rupees 50 lakhs, whichever is less. So maximum exemption which you can claim is amount invested or capital gain amount invested in bonds, or rupees 50 lakhs, whichever is less. Here the concept of capital gain account scheme will not come, because you have time limit only of 6 months for making the investment. Now The government bonds which you are taking, this government bonds which you are acquiring, it has a lock-in period of 5 years. It has what lock-in period, sir? Lock-in period of 5 years, meaning this government bond should not be sold or converted into money within a period of 5 years. If you sell it or convert into money within a period of 5 years, on the date when you are selling it or converting into money, on that date only, whatever capital gain was exempted will be taxable It will be taxable. On that date only, straight away it will be taxable. If the bonds are converted into money within the lock-in period, then the capital gain exempted earlier will be taxable in the year in which violation has happened. Next is most important, section 54F. Section 54F is applicable only for individual and HUF. If an individual and HUF is transferring any type of long-term capital asset excluding residential house property. If you are an individual HUF, you have any type of long-term capital asset except what's the residential house property. It can be jewelry, shares, land, etc. It should not be a residential house property. So section 54F says I am applicable for long-term capital asset. Exemption for long-term capital asset. If you are an individual or HUF having any type of long-term capital asset, and by transferring that long-term capital asset, if you are getting a capital gain which is a long-term capital gain, your long-term capital gain amount will be exempt if you acquire one residential house property in India. If you acquire one residential house property in India, so the period within which you are required to acquire is within 2 years from the date of transfer, or before 1 year before the date of transfer you should purchase. And if you want to construct within 3 years from the date of transfer, you can construct. Now exemption, please understand this concept is little important. Exemption criteria is also little different. Section 54F says what, sir? You are an individual and HUF, you have any type of long-term capital asset except residential house property. You are transferring that and getting long-term capital gain. You acquire another residential house property in India, your capital gain amount will be exempt. Acquiring means what, sir? Either purchase or construct. For purchase, the time limit is within 2 years from the date of transfer, or 1 year before the date of transfer, or within 3 years from the date of transfer you can construct. Now, how much exemption will I get, sir? The exemption which I am going to get is fantastic over here. The exemption which I am going to get is will depend upon the capital gain amount. If you have invested what, sir? If you have invested amount equal to net sale consideration or amount more than net sale consideration, if you have invested amount equal to or more than net sale consideration amount, then your full long-term capital gain will be exempt. But if you have invested amount less than capital gain amount, then the exemption will be given to you on pro rata basis. The capital gain, if you have invested amount less than net sale consideration, the capital gain amount which will be exempt will be amount invested by you divided by net sale consideration, whatever amount you get. For example, I sold jewelry which was a long-term capital asset for 120 lakhs. 20 lakhs was my expenses incidental to transfer, and 100 lakhs was my net sale consideration. 40 lakhs is my index cost of acquisition. Now 60 lakhs is my long-term capital gain. Now this 60 lakh exemption, if I want to get, I should invest either 100 lakh rupees or more than 100 lakh rupees. If I invest less than 100 lakhs, proportionately exemption I am going to get. So if I invest 60 lakhs, if I invest 100 lakhs entirely, exemption will be 60 lakhs. If I invest less than 60 lakhs, say how much, sir? Say case number 1, I invested 1.5 crores or 1.5 crores or 150 lakhs, entire 60 lakhs is exempt. If I invest 100 lakhs, entire 60 lakhs is exempt. If I invest 80 lakh rupees, then in such cases I'll get an exemption of 48 lakhs only, which is nothing but what, sir? Capital gain amount 60 lakhs into amount invested divided by net sale consideration. Okay, 80%. So this is how we are supposed to calculate. Now, very important point here also, there is an amendment. What is that amendment telling, sir? Maximum exemption which you can take under section 54AF is restricted to 10 crores. Maximum exemption which you can take under 54F is restricted to 10 crores. And there is also a condition under 54F which says that on the date of transfer, you should not have more than one residential house property. On the date of transfer, you should not have more than, the associate should not have more than one residential house property. Okay, he should not have more than one residential house property. Sir, what will I have? Is there any lock-in period? Yes, there is a lock-in period of for this also. For a lock-in period is of 3 years. If you transfer the property within a period of 3 years, the cost of acquisition will be reduced by the amount of exemption given earlier. Same thing which you are doing right from the beginning. Now, the last point which is there in your capital gain topic is what, sir? Tax rates under capital gain. Now, normally we understood that capital gain can be of two types. One is long-term capital gain or short-term capital gain. If it is a long-term capital gain, it is taxable under section 112 or 112A. And if it is short-term capital gain, it is taxable under 111 and 111A. If it is a long-term capital gain, normally it is taxable at 20%. Short-term capital gain is taxable at slab rate. But for some assets, we have 112A and 111A. The assets which are covered under 112A and 11A are same. Same assets are covered under 12A and 11A. Normally for long-term capital gain, 20%. For short-term capital gain, slab rates. Normally for long-term capital gain, 20%. For short-term capital gain, slab rates. But in case of some specified capital assets, it is 10% in excess of 1 lakhs and 15% in case it is short-term capital gain. So normally for long-term capital gain, 20%, short-term capital gain, slab rates. But 112A is applicable for some assets, tax on long-term capital gain for certain capital asset. In case of equity shares, in case of what's equity shares, where at the time of purchase as well as sale, you have paid security transaction tax. In case of equity oriented mutual funds or units of business trust of India, wherein at the time of sale you have paid security transaction tax. Okay, meaning basically it should be listed. It should be listed on the date of transfer. Long-term capital gain will be what, sir? 10% in excess of 1 lakh rupees. Now, very important points to be noted for the above cases. For these three assets, rebate under section 87A is not available. No indexation benefit will be given. Cost of acquisition, where 112A is applicable, the cost of acquisition, now please note, normally cost of acquisition is your actual cost only, but if the asset is purchased before 1/2/2018, 1st of February 2018, the cost of acquisition will be actual cost or fair market value as on 31st of January 2018, or sale price, whichever is less. Sale price, whichever is less, compare both of them and compare with actual cost, take whichever is higher. Fair market value in case in this case means what's the fair market value? If it is a listed shares, then the highest price, highest trading price. If it is a listed shares, in all other cases you will take. In case of unlisted share, the fair market value as on 31st of January 2018 will be cost of acquisition into index for the year 17-18 divided by index for year of acquisition. And in case of unlisted units, take the NAV as on 31st of January 2018 as cost of acquisition. And in case of short-term capital gain for these three assets, equity shares, listed equity-oriented mutual funds, and equity or units of business trust of India, the tax rate is 15% only. Now, security transaction tax on purchase and sale cannot be reduced on expenses. This is very important note for 112A and 111A, that whatever STT you are paying, no, you cannot reduce it as an expenses incidental to transfer at the time of paying capital gain tax. So normally tax rate for all the type of capital asset, tax rates for long term is 20%, for short term it is slab rates. And there is one more exemptions. Basically there are two exemptions, section 1037 and 1037A. 1037A is not relevant because it is specific to some one state of India. So, but this is something which is relevant. Last point for our discussion in capital gain topic. Section 1037, exemption for capital gain on urban agricultural land. So if you have an urban agricultural land, and if that urban agricultural land is compulsory acquired by government, and by compulsory acquisition, urban agricultural land which is used for agricultural purpose at least 2 years before the date of compulsory acquisition, that urban agricultural land is compulsory acquired, then it will be regarded as transfer. Whatever type of capital gain you are getting, that capital gain amount will be fully exempt. You don't have to pay even 1 rupees tax. It is fully exempt under section 1037A. This exemption is available only for individual as well as HUF. This exemption is not for everyone. It is available only to whom, sir? For an individual or an HUF. So this completes our discussion on capital gain. Now please note, the problem with capital gain topic is not with respect to getting the right answer. Every student who is going to do capital gain topic is going to get the right answer in examination. The problem is getting the marks. When it is an 8 marks question, for the right answer you will get only 4 marks. Extra 4 marks if you want. Not only my subject I am telling, all the other chapters, all the subjects also, you will have to write some important notes. So I have given some reference over here. Say for example this question. This is a 6 marks question. Now, when I answer this 6 mark question, how should I answer, sir? What students will mostly do? They'll do this computation part. Okay, they'll do this computation part, right? The name of the SSC, previous year assessment, computation, particulars, rupees, then full value of sale consideration, expenses incident to transfer, cost or net sale consideration, cost or index, cost of acquisition, cost or index, cost of improvement, then long-term capital gain, etc. You'll compute this, but you'll not get full marks for this. You'll not get full marks for this. If you want to get full marks for this question, you will have to write extra notes. You will have to write extra notes. What are those extra notes, sir? Say for example, now here, when was the asset acquired? The asset was acquired before 1/4/2001. So in the present case, since the asset is acquired in the previous year 89-90 and it is transferred in 22-23, it is a long-term capital asset. First point I am writing that since the period of holding is more than 2 years, it is treated as long-term capital asset. So first point, I should compulsory like I should tell them no whether it is a long-term capital asset or short-term capital asset. I will have to tell the examiner. Then formula for finding index cost of acquisition. So when it is a long-term, so next line, when since it is a long-term capital asset, here we are going to take index cost of acquisition, index cost of improvement for our computation. The formula to find is cost into index for the year of transfer divided by index for the year of acquisition or improvement. Correct? Apart from that, what is this index cost of acquisition? You will have to write that. So cost of acquisition, since the asset is acquired before 1/4/2001, see, I am making a reference to this question and telling you the answer. If the asset is acquired before 1/4/2001, actual cost is cost of acquisition is actual cost or fair market value as on 1/4/2001, whichever is higher. And any improvement done before 1/4/2001 should be ignored. Therefore, improvement for the previous year, which is done in 90 to 93, is ignored. These points you will have to compulsory write and show the computation. See, this computation which is there, no, is compulsory required to be shown by you. If you don't show this computation, you will lose half of marks for each of this computation. Compulsory should show this. So I have done this. Say what will happen in case of conversion of capital asset into stock in trade. What are the points which you have to write? See, this answer anyone can write, but this point is something which will give you that extra marks. Okay, so this just for reference purpose, your reference purpose, I have added this. You can go through from the material. Now see this question. It is an 8-mark question, very simple question, but 8 marks question. If you see the answer of this question, no, the answer is just 4 lines. Just 4 lines. But by writing these 4 lines, you will not get full marks. 8-mark question. If you want to get 8 marks, no, you will have to write all these notes. See the notes. Each note is more than 4 lines. Your main answer is 4 lines. Each note is more than 4 lines. So these notes are very important in your capital gain topic. Not only capital gain topic, all the other chapters also, be it all the other subjects also, be it our income tax law or our GST law or our accounts paper, costing paper, etc. All the papers, same procedure you have to follow. Now let us quickly revise topic called as income from other sources. Very small and easy chapter it is, income from other sources. Exam point of view, relevance is also good. Around 3 to 4 marks, 2 to 4 marks you can expect from this chapter. Very easy. I mean, I think in 3 pages I have completed the entire discussion on this topic. In 3 pages only. Where is the 3rd page, bro? I'll get the 3rd page. Just a second. The 3rd page is here. So in these 3 pages only, this entire chapter is done. So let us see what is this topic talking about. Income from other sources. The major point in income from other sources is taxation of gift. Taxation of gift. Section 56 to 10. Section 56 to 10 says taxation of gift. If gift is received from these people or gift is received during this time, Mr. Dilip NC. Mr. Dilip NC, if gift is received during this time, which time, sir? If the gift is received at the time of your marriage, or if the gift is received at the time from your relative, if the gift is received in contemplation of death due to inheritance, will, etc., or it is received from local authority, trust, or any university, or any fund, or any hospital, or in no transfer cases or in COVID cases, then that gift is completely transferred. If you are receiving any gift during your marriage, very important points are these 2 important points. If any gift is received at the time of your marriage, completely exempt. I am getting married, I am getting a Rolls Royce car, I am getting gold ring, I am getting gold jewelry, I am getting lot of different gifts, I am getting a car, bike, etc. I am getting refrigerator, I am getting TV, etc. I am getting a property. Whatever type of gift you are receiving at the time of your marriage, completely exempt. You can enjoy. You can enjoy completely. It will be exempt. If you are receiving the gift from your relative also, then also it will be completely exempt. It does not matter what that relative is giving you the gift. It will be completely exempt. And other cases, normally they will not ask. Mostly important is what, sir? Marriage and relative. Gift received at the time of marriage and relative is exempt. Now, sir, what if it is not received in these cases, sir? In all other cases, check what is the type of gift you are receiving. Are you receiving money, or are you receiving movable properties, or are you receiving immovable properties? If the gift which is received by you, is money, then the total money received in a year is more than 50,000, it will be taxable. If you are receiving money, say your friends are transferring 5,000, someone is transferring 2,000, someone is transferring 10,000, someone is transferring, etc. It is not received from, it should not be received from relatives or at the time of your marriage. Normal time, if you are receiving the money from your friends and in a year it is more than 10,000. Sir, from one person, no. In aggregate, in total, if you receive more than 50,000 rupees, not 10,000, sorry. If you receive more than 50,000 rupees in a year, then it will become fully taxable. If you receive money, then the aggregate money which is received by you is more than 50,000 rupees, then it is fully taxable. Then you are receiving movable properties. You are receiving what, sir? Movable property. What is this movable property? DJ Passos BV. You are receiving what, sir? DJ Passos BV. DJ Passos BV. DJ Passos BV means what, sir? D for drawings, J for jewelry, P for painting, A for archaeological collections, S for sculptures, O for other works of art, S for shares and securities, B for bullion, and V for virtual digital assets. If you are receiving movable property, so in such cases, you are in case of movable property, what is movable? Which movable properties are covered, sir? Movable property which are covered over here is DJ Passos BV, drawings, jewelry, painting, archaeological collections, sculptures, O for other work of art, S for shares and securities, B for bullion and virtual digital assets. So if you are receiving what, sir? If you are receiving movable property, in case you are receiving movable property, please note, any other type of mobile property, say for example, I am receiving a mobile phone, I am receiving a t-shirt, I am receiving a car, etc. They are not covered. Only DJ Passos BV is covered. Only DJ Passos BV is covered. So if you are receiving DJ Passos BV, check whether you are receiving it for consideration or without consideration. Okay, check whether you are receiving it without consideration or you are receiving it for a consideration. If it is received without consideration, then the aggregate fair market value is more than 50,000. Now, when you are receiving DJ Passos, you should, in such cases, you will have to take the aggregate amount of the gift which is received. If the value is more than 50,000, if it is without consideration, check whether the value is more than 50,000. If it is more than 50,000, it will be fully taxable. What if, sir, if it is for inadequate consideration? Sir, one is I am getting for free. What if I am getting for a lesser price? Say a gold chain worth rupees 1 lakh, I am getting only for 5,000 rupees. So I am getting it for inadequate consideration. Even in such case, it will be taxable under 56(2)(10). So if DJ Passos BV you are getting for inadequate consideration, then the aggregate fair market value, the aggregate difference between fair market value and consideration is more than 50,000. Then the difference will be taxable. If the difference between fair market value 1 lakh and consideration 5,000 is more than 50,000, it is 95,000. Therefore, it is more than 50,000. Then this entire difference amount, which is 45,000, will be taxable. The difference amount, which is 95,000, difference between the consideration and fair market value, will be taxable. So if movable property are received without consideration, aggregate fair market value of that movable property is more than 50,000, taxable. If the it is received for inadequate consideration, then difference between fair market value and consideration is more than 50,000, then it will be fully taxable. Now please note, sir, one question which I normally students ask is, sir, what if I receive 5 different types of movable properties? What if I receive 5 different types of movable properties? Should I take total of all those things, or should I do the computation separately for this assets, sir? You are required to do this computation separately for the assets, separately. Okay. Then, in case you are receiving movable property, check whether it is received for without consideration or is it received for inadequate consideration. If you are receiving immovable property, if it is received for it without any consideration, and if the stamp duty value of that immovable property is more than 50,000, fully taxable. If stamp duty value is more than 50,000, fully taxable. If it is received for inadequate consideration, stamp duty value minus consideration is more than 50,000 and the stamp duty value is more than 110% of consideration, then the difference amount will be taxable. So I am receiving a building, I am receiving a flat for free of cost without any consideration. Stamp duty value of that flat is more than 50,000, then fully taxable. If I have paid some consideration, then the stamp duty value minus consideration, is it more than 50,000? Yes. And stamp duty value is more than 110% of consideration, then the difference amount will be taxable. Now, There were some amendments made in the year 2022. Now these amendments are not so relevant. If you receive any money at the time of COVID, no, that would have been exempt, provided there is the money which you have received is used for the purpose of COVID, and this money is received during that COVID period only. No more relevant. This point is no more relevant. Now, this was with respect to taxation of gifts, but there are many other incomes also which are taxable under other sources. There are some income which are always taxable under other sources only. Following incomes are always taxable under income from other sources. Which are these incomes? Dividend incomes. Now, it does not matter whether that stock is that shares and securities are stock in trade for you or it is an investment for you. The dividend which you are getting will always be taxable under other sources. And your casual incomes, lottery, betting, gambling, rummy, online games, etc., they will all be taxable under other sources. The gift which you are receiving, always taxable under other sources. The share premium, when you are receiving this, when you are issuing a shares at a price less than its market value, then the share premium will also be taxable under this head. Then the interest which is received on compensation or enhanced compensation. There is a compulsory acquisition of your capital asset, and there is a interest which you are receiving for that. Advance money which is forfeited by you on or after 1/4/2014, and any money which you are receiving from owning and maintaining resource business. If you receive any money by owning and maintaining resource business, that also will be taxable under this head. Then this income, following income will be taxable under income from other sources if it is not taxed under PGBP. Now, normally these incomes can be taxed under PGBP also, but if it is not taxed under PGBP, it will be taxable under other sources. Employees' contribution to PF ESIC superannuation fund. Then interest on securities, income from letting out of machinery, plant, furniture, etc., and composite rent. It will be taxable. These points will be taxable under other sources if it is not taxed under PGBP. Then there are some incomes which will be taxable under other sources if it is not taxed under PGBP or salary. Following incomes will be taxable under other sources if it is not taxed under PGBP or under the head salary. Which are these incomes, sir? Which are these income? The amount received under key man insurance policy. Normally it will be taxable if it is received by the employee. It will be taxed under salary. If it is received by the employer, PGBP. If it is received by any other person, it will be taxable under other sources. Compensation received for or due to termination of employment or modification of terms of employment. So whatever money you are receiving will be taxable under salary. If it is not taxed under salary, it will be taxable under this head. Now, apart from this, there are many other incomes which, if you see the questions, you will understand that there are so many other types of incomes which they give in the questions. These incomes, I have just given it for reference purpose over here. So you can just quickly glance. These incomes will be taxable under other sources. Which are these incomes, sir? Income which you are receiving by subletting and house property, interest on bank deposits, saving account, fixed deposits, etc. Remuneration which a person is receiving for paper checking, renting of vacant land, insurance commission if you are receiving, in undisclosed income if I am receiving. Undisclosed income means that this thing. Raid is happening, then from property I got some money, etc. Or private tuitions I am conducting, interest on income tax refund, family pension I am receiving, sitting fees received from a director, stipend which you may receive tomorrow, agricultural income which is from outside land outside India, then royalty income, income of MLA, MP, MLC, etc. Family pension. Please note, income of MLA, MP, MLC is taxable under other sources. However, they also receive something called as daily allowances and constituency allowances. This daily allowances and constituency allowance is exempt. Family pension is also taxable under income from other sources. It is also taxable under income from other sources, but in whosoever hand you are taxing it, that person will get exemption. How much exemption will be given? 1/3 of the pension or rupees 15,000, whichever is less. And whatever awards you are receiving from government, if it is government awards, exempt, or if it is other types of awards, it will be taxable. Now, with respect to interest income we all know it is taxable under income from other sources. Now, interest can be of different types. Interest for compensation or compensation, the compensation for compulsory acquisition of capital asset, or for delayed compensation of compulsory acquisition of capital asset will be taxable under which head, sir? Under other sources. How much will be taxable? 50% of amount received. Whatever amount is received into 50% will only be taxable. Then if you are receiving any interest from post office saving account, 3,500 is exempt. Say for example, post office saving account, 10,000 rupees interest I am getting, 3,500 is exempt. Taxable amount will be only 6,500 rupees. Sir, what if it is a joint account, sir? Then 7,000 rupees will be given. Now, following interests are completely exempt, always exempt. Which are the interests which are always exempt, sir? Interest which you are receiving from gold bonds, deposit certificates under Gold Monetization Act, interest from Public Provident Fund (PPF), interest on Sukanya Samriddhi account, etc. These interests are always exempt. Any other type of interest which you are getting, whether it is an FD interest, saving account interest, or interest on loan which is given by you to someone, etc., it is fully taxable, and it is always taxable under which head, sir? Income from other sources. Now, one last point is there is a concept called as deemed dividend in your income from other source topic. In income from other source topic, there is one more last concept, taxation of dividend, and a concept of deemed dividend. I'll discuss that point. Taxation of dividend. Taxation of what, sir? Dividend. Now, if you are receiving dividend from an Indian company, it is taxable under the head other sources in the hands of shareholders, whether it is received, and if the dividend is received from foreign company, also it is taxable under other sources in the hands of shareholders. But there is also a concept of deemed dividend. Now, in this concept of deemed dividend, so no, most important is 222C, and second most important is 222A, and third most important is 222E. Apart from that, nothing is important in this. 222A. What is this deemed dividend concept telling, sir? Please note, this amount which you are going to receive is not a dividend, but we are going to deem that it is a dividend. We are going to assume that it is a dividend, and accordingly we are going to tax it. Section 2 clause 22 subclause A says a distribution of asset, any distribution of asset. If any domestic company distributes assets to its shareholders, if any domestic company is distributing assets to its shareholders, then it will be treated as, it will be deemed as dividend to the extent of accumulated profit of that company, whether it is capitalized or not, and it will be taxable in the hands of the shareholders under the head income from other sources. So if there is a domestic company which is distributing any assets to its shareholders, then it will be deemed as dividend. Domestic companies distributing assets to its shareholders, it will be deemed as dividend to the extent of how much accumulated profit, whether it is capitalized or not. Then 222B, if a distribution of debentures, deposit certificates. So if any domestic company is distributing, please note this 222 deemed dividend concept is applicable only for domestic companies. So if any domestic company is distributing debentures, debenture stocks, or deposit certificates to any type of shareholders, or bonus share to its preference shareholders, then it will be treated as deemed dividend to the extent of accumulated profit, whether capitalized or not, and it will be taxable in the hands of shareholders. Now, distribution of asset by the company at the time of liquidation. If any domestic company distributes any asset to its shareholders at the time of its liquidation, then it will be treated as deemed dividend in the hands of shareholders to the extent of accumulated profit, whether it is capitalized or not, and it will be taxable under their income from other sources in the hands of that shareholders. Sir, everywhere you have written this word to the extent of accumulated profit, whether capitalized or not. What do you mean by this, sir? See, accumulated profit means what, sir? Reserves of the company, the profit which is not distributed to anyone, the profit which is accumulated by the company. Now, this accumulated profit can be used for issuing bonus shares or issuing right shares, etc. Now, if the accumulated profit is used for issuing bonus shares, then it is said that accumulated profit is capitalized in the books of accounts. See, normally whatever accumulated profit is there, that is accumulated profit which is not capitalized. But if you use this accumulated profit for issuing bonus shares, then it is said that accumulated profit is capitalized in the books of accounts. Section 2 clause 22 subclause D, reduction in share capital, not so important. If any domestic company reduces its share capital and distributes assets to its shareholders, then it will be treated as, it will be deemed as dividend to the extent of accumulated profits, whether it is capitalized or not, and will tax it, and it will be taxable in the hands of shareholders under income from other sources. Then 222E, any loans and advances given by closely held company. If there is a closely held company, what do you mean by closely held companies? A company in which public are not substantially interested, or private companies. If any closely held company is giving any loan or advances to its shareholders, which type of shareholders, sir? That shareholder who is having 10% or more equity shareholding in the company, then it will be treated as deemed dividend. Or if the closely held company is giving loan or advances to any other person for the benefit or on behalf of these shareholders who is having 10% or more of the equity shareholding, then in such case also, though the loan is given to someone else, it will be deemed as dividend in the hands of these shareholders. Or this closely held company is giving any loan or advances to any company or any concern wherein the shareholder has substantial interest, meaning 20% or more equity shareholding or profit sharing ratio, then it will be deemed as dividend in the hands of these shareholders. Now, this above 222E concept shall not be applicable if the company's business is only giving loans and advances. And how much will be deemed as dividend, sir? It will be deemed as dividend to the extent of accumulated profit. Above provision shall not apply if the company's business is only giving loans or it is a business advances which is given by the company. 222E shall apply even if the loan is called off in the same day. Say morning I give the loan, evening I repay the loan, then also this will be applicable. 222E shall apply even if the interest is charged at market rate. For the loan which is given by the company is charging interest, I don't care, 222E will be applicable. 222E will be applicable in such scenarios also. Now with respect to liquidation of company, I'll just show one question because it is an important concept. So let me just show one question. Sir, you said gift received from relative. Gift received from relative is not taxable. Sir, what do you mean by relative, sir? Say for me, for Mr. Dilip, who is a relative? For Dilip's my brother, sister are my relative. My father, mother are a relative. My son, daughter is my relative. My spouse is also my relative. So for me, my brother, sister, my spouse should be right because wife is always right. So my spouse is my relative. My brother, sister are my relative. My parents are my relative. My son, daughter are also my relative. Now, apart from that, who are my relatives, sir? My father, mother's brother, sister are also my relative. My father, mother's brother, sister are my relative. My spouse, father, mother, and brother, sister are also my relative. So for Dilip, his own brother, sister, spouse, parents, son, daughter, brother, sister of parents, spouse's father, mother, and spouse's brother, sister. So, and apart from that, my lineal ascendant and lineal descendant, me, my father, my grandfather, etc., are all my relative. For me, my son, my sons, etc., they are all my relative. So, and also spouse of all these people are also my relative. Meaning my brother is my relative, brother's wife is also my relative. And for HUF, who is relative, sir? For HUF, members of HUF are treated as relative. Ding, 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 ding. Now see, in case of 222C, distribution of asset by a company upon its liquidation. So it will be deemed as dividend, and also there will be taxation of capital gain. There will also be taxation of capital gain. So what is the tax treatment at the time of liquidation? I'll just tell you. So in the hands of company, because liquidation is not regarded as transfer, no capital gain will arise in the hands of company. Therefore, no tax the company has to pay. But however, in the hands of shareholder, no, he will have two types of income. One is dividend income and one is capital gain income. How much will be the dividend income and how much will be the capital gain income, sir? Dividend income will be to the extent of accumulated profit, his share in accumulated profit. So deemed dividend is how much, sir? Under section 222C, deemed dividend to the extent of accumulated profit, whether capitalized or not. And capital gain, how much will be capital gain, sir? How much ever amount you are receiving at the time of liquidation minus this deemed dividend, the difference will be taken as full value of sale consideration. From this, subtract your cost of acquisition in this shares in this liquidated company. That will give you capital gain. Now this question is there in your capital gain topic. Very important question. Very important question. So there is an answer also which is given by me over here. In the hands of company, asset sold in the market. Since in the present case it was sold in book value, therefore no capital gain. So this is Utkarsh question. There is a question called as Utkarsh. Okay, in your institute material only it is there. Utkarsh question. You can have a check into that. So for company, you know, whatever asset they are selling in the market, if they are selling at book value, no capital gain will arise. If they are selling it as a higher price, then obviously capital gain will arise. Whatever asset they are distributing to the shareholders, it is not written as transfer, therefore no capital gain. In the hands of shareholders, he will have two types of income. One is under capital gain, one is under other sources. What is the income under other sources? It is nothing but the deemed dividend. How much will be the deemed dividend, sir? Whatever is the share accumulated profit of the company. If you see, the reserves of the company is 2 lakh rupees. So this is accumulated profit of the company. Now what is the share in the accumulated profit of Mr. Utkarsh? Utkarsh is a shareholder in this company. He has 10% equity shareholding in this company. So 2 lakh rupees into 10%, which is 20,000, will be deemed as dividend. So Utkarsh has received how much, sir? From this company, Utkarsh has received totally 5 lakh rupees. Okay, 5 lakh rupees, 20,000 is deemed as dividend, and the balance amount will be taken for computation of capital gain. It will be taken as full value of sale consideration for computation of capital gain, and accordingly capital gain will be computed. Okay, so this is all about this topic called as income from other sources. Now let us take a chota sa break, small break we'll take, and continue our discussion on salary and business income. So we'll complete which topics salary and business income after a short break. Welcome back, students. So let us continue our discussion. Now there are two more heads of income left over. Both the heads of income which you are going to see now are very important. From exam point of view, the most important topics are these two topics, almost income from salary as well as profits and gains from business and professions. So income from business or profession. These topics will almost, so out of your 50 marks paper, no, almost around 15 to 20 marks will be from this topic. It will be 15 marks to 100% it will be there. 2 8 marks questions will be asked, and they can ask some extra questions of 4 marks, 3 marks, etc. So almost 15 to 18 marks questions will be from these two topics which you are going to see now. Let us right away see what is income from salary telling, sir. Income from salary says section 15, section 16 and section 17 covers income from salary. Section 15 is the charging section. Section 16 gives the definition, and section 17 gives section 16 talks about deductions, and section 17 talks about meaning and definitions of salary, etc. Basically, if you see section wise, it is the smallest topic, but then this covers a lot of different things which is there. Okay, so what is this income from salary telling? This chapter says, what I see, what is important for me is relationship. I see relationship. Relationship is very important for me. There should be a relationship, master-servant relationship, employer-employee relationship. So if there is an employer-employee relationship, master-servant relationships, and any payment is made by the employer to the employee in the capacity of the employer, then that income which the employee is receiving will be taxable under the head salary. So what is important over here? Relationship. What type of relationship should be there? Employer-employee relationship, and the payment which is made by the employer to the employee should be in the capacity of employer. Okay. Now say for example, the Dilip is working. Dilip is an employee of Reliance Jio, and I'm getting 50,000 per month. Now this company Reliance Industries is my employer, and I am the employee, and whatever payment they are making to me, it is in the capacity of what, sir? It is in the capacity of the employer. Now say for example, I am a chartered accountant. I am not working for Reliance Industries. I am filing, however, I help them in filing income tax return. So for filing this income tax return, I am earning 1 lakh rupees. Now the payment which is made by them, I am a service provider to them, and they are the service recipient. The payment which is made by them to me is not because of this employment. It is not because of employment. This is a separate contract which is entered into between Reliance Industries and me, and whatever payment I am receiving is not taxable under salary. It will either be taxable under business income or under income from other sources if it is not my business. So basically, relationship will be of two types: employer-employee relationship and principal-agent relationship. Principal-agent relationships are not covered under salary. What are covered, sir? Only employer-employee relationship is covered. Now, please note, salary, different people will get salary. Now, if the sole proprietor is getting, now there is a sole proprietorship concern. Please note, these are basic things which we are going to see before starting the actual discussion. So whatever salary and sole proprietorship concern is giving to its proprietor will not be taxable under the head salary. Normally they cannot give only because sole proprietor should be interested in the profits of the company. He should not be interested in salary. So whatever salary he gets will not be taxable under the head salary. Similarly, partners getting salary from partnership firm or LLP, that salary will not be taxable under the head salary. It will be taxable under the head PGBP. You'll see that in PGBP chapter. Then companies paying salary to the director. Companies paying any money to the director. Now director is an employee director or non-employee director. If he is an employee director, then that will be taxable under then the amount which is paid by them will be treated as salary and taxable under income from salary. And if he is a non-employee director, company is paying the money to whom, sir? Non-employee director, then that amount will not be taxable under the head salary, it will be taxable under income from other sources. Then similarly, MLA, MP, MLC, etc., whatever payment they are receiving will be taxable under income from other sources. MLA, President of India, Prime Minister of India, they are not government employees. They are all not government employees. Who is a government employee? Police officer is a government employee. Income tax officer is a government employee. The MP, President, Prime Minister, they are all not government employees. Therefore, the money which they are receiving will not be taxable under the head salary. Similarly, judge also is not a government employee. Judge is also not a government employee, but whatever money is paid to the judge will be taxable under the head salary. Even in such case, even though he does not have any employer, whatever money is paid to him will be taxable under the head salary. Now, there are two more things. One is called as contract of service and contract for service. Contract of service is an employment contract. Contract for service means you are taking a contract for doing a service. Contract of service, employment contract covered under salary. Contract for service is a professional contract which is not covered under salary. Now, what is the charging section? Section 15 telling. Section 15 says charging section of salary says salary is taxable on due basis or on receipt basis, whichever is earlier. Are salary is taxable on what basis, sir? Salary is taxable on due basis or on receipt basis, whichever is earlier. Salary is taxable on due basis or receipt basis, whichever is earlier. It does not matter whether you have actually received or not. If the salary is due to you, then also you'll have to pay tax on salary. Similarly, it does not matter whether the salary is due to you or not. If you have received the salary, say for example, future period salaries I am receiving now only, advance salary I am receiving, in such cases also it will be taxable. Salary is taxable on due basis or on receipt basis, whichever is earlier. Now, salary can be in cash or it can be in kind also. Some salary in cash, meaning that they are giving the money. Sometimes company may give you an house to stay. So salary can be in cash or it can be in kind also. Now, salary forgone or salary surrendered will also be taxable. If you forgo any salary, if you surrender any salary, then that also will be taxable. It will be treated as application of money. It will be treated as what, sir? Application of money. However, if the salary is surrendered to central government, meaning by central government employees, etc., then it will be exempt. Now, for understanding this chapter, there are various different components of salary. There are what, sir? So many different components of salary. Once we understand each and every component of salary, this topic is over. Very as simple as that. Very beautifully, very easily, I am going to explain all these things. Please understand or read this topic in the same manner. Read this topic in the same manner. I am going to give very beautiful hints also with respect to these topics. Now, components of salary components. So there are various different components. If we study about all these components, you will know what do you mean by salary. Okay. Now, so what are the different components? Let me just go through those components. One is called as basic salary or basic pay, dearness allowances, bonus, commission, advance salary, arrears of salary, then gratuity, pension, leave salary, retrenchment compensation, and voluntary retirement compensation, allowances, provident fund, superannuation fund, perquisites. This total of all these things will be giving you gross salary. From that you subtract deductions under section 16. Once you subtract deductions under section 16, you will get your net salary. Now, one by one, let us start the discussion. Sir, what do you mean by basic salary, sir? Now, basic salary is nothing but your basic pay. Basically, your salary, whenever a person says my salary is 50,000, no, that salary will have various different components. It will have basic pay, dearness allowances, HRA, travel allowance, telephone allowance, etc. It will have different components. So the basic pay is nothing but the base salary. This is the minimum amount of salary, and all the other amounts, extra amount which you are getting over here, they are the additional benefits which are given to you. So basic pay is your base salary. Now, whenever you get any increment, normally that increment will be based on your base salary. So basic pay, it is your base salary. Now, this basic pay is a taxable component of salary. It is a taxable component of salary and it is fully taxable. Sometimes whatever happen is that basic pay may be given to you in the question in grade pay scale basis or grade scale basis. Grade pay, grade scale pay or grade pay. What is this basic? See, normally, say when I say my salary is 25,000 per month, assuming I am not receiving any of the allowances, etc., any extra benefit. So this means what, sir? My basic pay is 25,000. Now this basic pay which I am receiving is taxable. Now sometimes what they can do is they may give you grade pay. In the question, what they may do, sir? They may give you grade pay. They may say the basic pay is 20,000 -2,000 -30,000. Now, sir, when the question says something like this. What does it mean? When the question says salary is 20,000 2,000 30,000, this means that at the time when you have joined the company, at the time of joining of this company, your salary is 20,000 rupees per month for every completed year of services. So once you complete 1 year, say today I have joined this company on 1st of May. So I have joined the company on 1st of May 2024. So I will be completing 1 year in on 30th April 2025. So once I complete 1 year, so for this year, first year my salary will be 20,000. So once I complete 1 year, my salary will be increased by 2,000 rupees. Now what is this, sir? This is called as grade pay. So this increment is going to happen every year. Every year my salary will be increased by 2,000 rupees till the time my salary becomes 30,000 rupees. So what do you mean by grade pay? At the 20,000 2,000 30,000 means at the time when you are joining the company, your salary will be 20,000. Then it will increase by 2,000 every year. Then once this increment will happen till the till your salary reaches 30,000 rupees. I have given this beautiful example over here. Now, very important checkpoints which you have to keep in mind when you are when the information with respect to basic pay is given, etc. Normally, in the question, if they are giving net basic pay, if they give net basic pay, no, you should not take net basic pay. First, you are required to compute gross salary. So you should take gross basic pay for your computation. If they give net basic pay, also you should take gross basic pay. Check for, very important, you should always check for date of joining, date of resignation, date of retirement, etc. because salary will be given from the date when you are joining till the date of your retirement, or till the date of the year end, or till the date of your resignation, etc. So that is very important. Next component of salary is dearness allowances, also called as what, sir? Also called as dearness allowances, also called as the allowances which is given for increase in cost of living. Allowances which is given for what purpose, sir? For increase in cost of living. It is for inflation purpose. Because of inflation, your cost of living may increase. To meet that cost of living, they will give you something called as dearness allowances. They will give you something called as dearness allowances. Now, dearness allowances is a taxable component of salary, and it is fully taxable. It is a taxable component of salary, and it is fully taxable. Now, dearness allowances in question, what they do is the dearness allowances may be given in two ways. Meaning they'll give dearness allowances, and they'll tell 50 say dearness allowance is 50% of basic pay, and 60% of dearness allowances is forming part of retirement. So basically, dearness allowance is divided into two parts. One is dearness allowances forming part of retirement, and dearness allowances not forming part of retirement. So dearness allowances forming part of retirement and dearness allowances not forming part of retirement. Meaning, for the computation of your retirement benefit, there are some DAs which will form part of that. This is called as dearness allowances forming part of retirement. It is also called as dearness allowances in terms. Dearness allowances in terms. Then we have dearness allowances not forming part of retirement benefit. Meaning what, sir? For computation of your retirement benefits, dearness allowances will not form part. So it is also called as dearness allowances not in terms. Sir, I am not understanding this point, sir. You will understand this point when we discuss the future points. Meaning there are different definitions of salary, different formulas given under salary topic. In some formulas, they will say that while computing the salary, please take only DA in terms. In some cases, it will tell you take the entire DA, whether it is in terms or not in terms. So that you'll understand once we discuss that particular point. Now, what is important over here, sir? Checkpoint. DA in terms may also be written as DA forming part of salary, or DA forming part of retirement, or DA forming part of pay. Now, sir, sometimes what may happen is DA may be given in percentage format. So when it is given in percentage format, you should take it as a percentage of what? Always you should take it as a percentage of basic pay. Always it should be taken as a percentage of basic pay. Now, many times it will happen that the question is silent about DA. When the question is silent about DA, what assumptions should I make, sir? If you are a CA student, you should make an assumption that it is DA not in terms. But we guys, CMA student, we should follow what our institute says. We should always follow what our institute says. Now, whenever the question is silent, whether the DA is in terms or not in terms, always assume that DA is in terms. Always make an assumption that DA is in terms. And please also write a note about it. Also, please write a note about this particular point. Write a note that since the question is silent about the earners allowances, it is assumed that it is in terms, or it is assumed that it is not in terms. This note is compulsory required to be written. Then the next component of salary is bonus. Many of the employers may also give bonus, yearly bonus, turnover bonus, etc. Whatever type of bonus it is, it does not matter. Bonus is a taxable component of salary. It is always taxable and fully taxable. Bonus is taxable on receipt basis. See, normally salary is taxable on due basis or receipt basis, whichever is earlier, but bonus is that component of salary which is taxable on what basis, sir? Bonus is that the component of salary which is taxable only on receipt basis. Only if you have received the bonus, you will have to pay the taxes. Now, bonus can be contractual bonus or voluntary bonus, meaning it can be as per your employment agreement, or it can be voluntarily given by the employer. Now, some important point which you should keep in mind is when they give only when they give in the question bonus declared, please ignore it. When they give only bonus declared, please ignore it because it is not paid. When they say bonus paid, take it. When they say bonus, only bonus is given, then also take it for computation of your salary. Then the next component of salary is commission or fees. Commission or fees. Now, next component of salary is what's a commission or fees. This is also a taxable component of salary, and it is always taxable and fully taxable. This commission or fees is also a taxable component of salary. It is always taxable and fully taxable. Now, commission can be based on the turnover, or it can be based on product, or it can be based on profits, etc. It can be based on what, sir? Commission can be based on turnover, product, or profits. Now, when the question is silent about the type of commission, you should assume what, sir? What should I assume? You should assume, if you are a CA inter student, you should assume that it is a turnover based, it is not turnover based commission, but for CMA students, for us, we should make an assumption that it is turnover based commission. When the question is silent, you should always make an assumption. CMA students, we should always make an assumption that it is turnover based commission. Next component of our salary is what's our advance salary. What is this next component of our salary? Advance salary. Advance salary is a taxable component of salary. It is fully taxable. Advance salary means what's our salary received in advance. Therefore, because it is received in advance, it is taxable on what basis? It is taxable on receipt basis. It will be taxable only when it is received. It is taxable on receipt basis. Now, there are two things. Please note. Many people get confused with respect to this. There is something called as advance salary, and there is something called as advance against salary. Advance salary means salary is received by you in advance, and advance against salary means it is a loan. Advance against salary means what, sir? It is a loan, so it is not a salary. It will not be treated as salary, therefore it will not be taxable under salary. Advance against salary means you have taken a loan against your salary. Next is arrears of salary. Arrears of salary means what, sir? Arrears of salary means any increment in salary made from a retrospective date. Any increment in salary made from a retrospective date. Meaning, say for example, I joined a company 5 years back. Today, by seeing my performance, the company says, Mr. Dilip, I think we have undervalued you. We are paying you very less. So what we are going to do, Mr. Dilip, for last 2 years also we are going to pay you an incremented salary today. For last 2 years, they never paid me any incremented salary. Today, they are telling for last 2 years also, because of your hard work, where the company grew well, so we are going to pay some increment to you. So any increment in the salary with retrospective, retrospective effect. What is arrears of salary, sir? Any increment in the salary with retrospective effect, which is not taxed in earlier years, will be called as what's arrears of salary. This is a taxable component of salary, and it will be taxable only on receipt basis. Only when you receive this arrears of salary, it will become taxable. Now, this is a very good question from CMA material. Fantastic question it is. You should definitely go through and see this question. And of course, please do like, share, and subscribe. If you have not yet liked the channel, please like the if you have not yet liked the video, please like the video. If you have also share the video with your friends and family members, and 100% you should subscribe to the channel for more updates. Next, retirement benefits. Now let us see the next component of salary, retirement benefit. Fantastic component it is, retirement benefit. First retirement benefit which you are going to see is gratuity. Gratuity can be received during the course of your employment, at the time when you are working in the company, at the time of retirement, or upon death of the employee. It will be received by legal heirs. If you are receiving any gratuity amount, gratuity amount. Gratuity means what, sir? The company is giving some benefit to you because you have completed some minimum period of time in the company. The company is going to give some extra benefit to you. So gratuity says if you are receiving the gratuity at the time of if you are receiving any gratuity during the course of your employment, it will always be taxable. It will always be taxable because you are still working in the company, so it will always be taxable. It does not matter what type of employee you are, whether you are a government employee or non-government employee, it will always be taxable. But if the gratuity is received by the legal heirs of a deceased employee has died and the legal heirs of the employee is receiving gratuity, now in that cases it will always be exempt to them because they've never, this legal heirs never worked in the company, therefore government does not want to tax this legal heirs. What is important is gratuity received at the time of retirement. If you are receiving any gratuity at the time of retirement, then it is exempt under section 1010A. Sorry, it is exempt under section 1010. If you are receiving any gratuity at the time of retirement, it is exempt under which section, sir? Section 1010. How much exemption will be given, sir? If you are a government employee, then it is fully exempt. Whatever gratuity you are receiving, 100% of the gratuity amount is exempt. But if you are a non-government employee, I am going to check whether you are covered under POGA or you are not covered under POGA. Are you a person who is covered under Payment of Gratuity Act? Or are you a person not covered under Payment of Gratuity Act? If you are a person who is covered under Payment of Gratuity Act, in such cases, the amount of exemption will be 15/26 into salary per month into completed years of service, or actual gratuity amount received, or a statutory limit of 20 lakhs, whichever is less. So if you are a person who is a non-government employee and you are covered under POGA, then for you the gratuity amount which will be exempt will be 15/26 into salary per month into completed years of services, or actual gratuity received, or statutory limit of 20 lakh rupees, whichever is less. Sir, what do you mean by salary per month over here, sir? Over here, salary per month means your last drawn salary. At the time of retirement, what was your salary? So your last drawn salary. Now this salary will include basic pay plus dearness allowances. This salary, what is this salary per month, sir? It is last drawn salary, meaning you should take your basic pay and dearness allowances, whether it is in terms or not in terms. You will get your salary per month. You will get your salary per month. Now, please note, for this purpose, when so salary per month into completed years of services, meaning how many years you have completed in service, how many you have worked in that particular company. So when you are computing the number of years of completed years of services, if there may be possibility that there are some fractions. Say you have worked for 26 years 5 months, 26 years 9 months, 26 years 6 months, etc. So sir, whenever there is a fraction, what should I assume, sir? Should I take it 26 years 5 months? Should I take it 26 years, or should I take it 27 years, sir? Lawmaker says if there is a fraction in completed years of service, if you are a POGA employee, if you are covered under Payment of Gratuity Act, if there is any fraction more than 6 months, then consider it as full year. So if it is more than 6 months, okay, so 26 years 5 months, take 26 years, 26 years 9 months, 27 years, 26 years 6 months, only 26 years. Why, sir? More than 6 months, then only I will take. Now, for calculating the salary per month, no, please do not take into consideration the salary for the month of retirement. Meaning, say for example, a person retires on 15th of August. So you should not take salary for the month of August. Last drawn salary means you should take salary from before August. What was the month? July month. You should take salary for the month of July. Meaning it should not be from 15th of July till 15th of August. No. You should ignore the month of retirement. Take the last month salary. Now, sir, what if I am not a POGA employee? If you are an employee who is not covered under Payment of Gratuity Act, then the exemption which you are going to get is half into average salary per month. There it was salary per month. Here it is average salary per month into completed years of services, or actual gratuity received, or a statutory limit of 20 lakh rupees. Sir, here it is average salary per month. What do you mean by average salary per month, sir? The average salary per month means you should take average of the salary, average of last 10 months salary. Whatever salary you are receiving in last 10 months, you should take the average of that salary. So you will take basic pay plus dearness allowances plus turnover commission. You take the total of this will give you average salary. Now, sir, whenever there is a fraction, what will I do, sir? In case you are a non-POGA employee, whatever type of fraction it is, it does not matter. It should completely be ignored. Fraction in completed years of service, whether it is 26 years 5 months, 26 years 9 months, 26 years 6 months, always take 26 years only. Completed years only should be taken. And needless to say, the month of retirement should be ignored while calculating last 10 months. No, say for example, a person has retired on 15th of August. Please ignore August month. Take last 10 months from July. So July, June, May, April, March, February. You go back like this for 10 months. Now, very important notes which you are for gratuity point is what, sir? Very important notes is the statutory limit of 20 lakh rupees which is there. No, it is applicable to a single person, individual as an employee throughout his lifetime, irrespective of number of employers he has. Meaning, irrespective of how many companies you work, the limit of 20 lakhs is fixed. So if I work for a company and take the benefit of gratuity over there, so assuming I got an exemption of 3 lakhs in the first company. So now my limit will not be again 20 lakhs. From 20 lakhs, 3 lakhs will be reduced. My limit will be, statutory limit will now be reduced to 17 lakh rupees. So Mr. Dilip is working for Tata Motors and Reliance Industries. He got gratuity of 15 lakhs and 18 lakhs on his retirement. Therefore, in the present case, that statutory limit only of 20 lakhs will be taken. Though I have received 15 plus 18, maximum how much benefit I can take? Only 20 lakhs combined together. It is for a single person throughout his lifetime. If the gratuity is already received by an employee from employer earlier years, that gratuity amount should be reduced. Now, if the question is silent about the type of employee, what am I going to assume, sir? When the question is silent, the question is not telling whether it is a POGA employee or not POGA employee, then always make an assumption that he is a non-POGA employee and do your computation. Next retirement benefit which a person gets is what, sir? Next retirement benefit which a person gets is pension. So pension can be basically of two types. It can be uncommuted pension or it can be commuted pension. Uncommuted pension means what, sir? The monthly pension which you are receiving. If it is a monthly pension received by you, it is always taxable whether you are a government employee or non-government employee. I don't care. The monthly pension which you receive is always taxable. Commuted pension means the lump sum amount of pension which you receive at the time of retirement. So this lump sum pension will be exempt under section 1010A. It will be exempt under which sections are 1010A. If you are a government employee, then it is fully exempt. Not even 1 single rupees will be taxable. If you are a non-government employee, then it will depend upon whether you are receiving gratuity along with pension or you are not receiving gratuity. You are receiving only pension amount. If you are also receiving gratuity amount, then the amount of exemption will be the total pension. Whatever total pension is agreed into, 1/3 will be exempt. If you are not receiving gratuity, then the exempt amount will be your total pension into half. Please note, if it is an uncommuted pension, monthly pension, it will always be taxable irrespective of which type of employee you are. Then the next type of what, sir? The next type of retirement benefit which we have is leave salary or leave encashment or leave credit encashment or leave salary encashment. Many times what may happen is the company may tell, in a month you can take 2 days leave. In a month you can take 2 days leave, wherein for that leave also we are going to pay. So that is called as paid leaves. That is called as what, sir? Paid leave. In case of paid leaves, many people, they are workaholic, they don't take any leave at all. So what they can do, sir, they can encash this leave. This leave can be encashed by them. This is called as leave salary. Even during the leave days, they are getting paid salary. Now here, what are we supposed to see? For example, say a company says in a month you can take 2 days leave. So therefore in a year you can take a leave for 24 days. Now this is the leave allowed by the company. Now out of this, I take leave for 4 days. That means I have taken leave for 4 days, and 20 days is the leave which is not taken by me. It is called as leave credit, leave balance, or unutilized leave or leave saved by me. So basically, in simple words, leave credit is what, sir? Leave credit means leave credit is leave allowed by the company minus leave taken by you. So leave credit. So you are going to get salary for this period. Leave credit. Leave credit is equal to leave allowed minus leave taken. Now leave salary means encashment of leave credit. Leave salary means what, sir? Whatever leave credit you have, you are encashing it. You are taking money. Now income tax law says the leave which is allowed for a completed year of service is 1 month. For every year you complete in service, as per income tax law, only 1 month leave will be allowed. Only 30 days leave will be allowed. So many companies may give a policy of allowing a leave of 2 months, 3 months, etc. I don't care. As per income tax law, how much leave will be allowed for a completed year of service, sir? Only 1 month will be allowed for a completed year of service. Now, leave salary, 2 arrow marks. Leave salary, if you are receiving at the time of employment, during the course of employment, it will always be taxable. Please note, whatever retirement benefit you are receiving at the time of your employment, during the course of employment, it will always be taxable whether you are a government employee or non-government employee. Now, because it is a retirement benefit, exemption will be given only when you receive at the time of retirement. So, if you are receiving leave salary at the time of retirement, you will get an exemption under section 1010 AA. 1010 AA. Sir, how much exemption, sir? If you are a government employee, the full amount is exempt. Whatever amount you are receiving, it is fully exempt. But if you are a non-government employee, then you are required to do the computation. And here there is a small amendment. There is an increase in this limit. So, non-government employee, how much is exempt, sir? Take your leave credit into average salary per month. Take 10 months into average salary per month. Actual amount received by you or a statutory limit of 25 lakh rupees. So, leave credits computed as per income tax law. Income tax law allows only 1 month leave credit. Leave credit into average salary per month or 10 months into average salary per month. In simple words, last 10 months salary, or actual amount received or statutory limit of 25 lakh rupees, whichever is less. Sir, what do you mean by average salary per month? Sir, average salary per month means last 10 months average salary. You should, average salary per month means what, sir? Last 10 months average. You should take the salary till the date of your retirement. See, in the previous two cases, we saw that the date of retirement, the month of retirement should be ignored, but here you should take the salary till the date of your retirement. Sir, what is salary over here? It is basic pay plus dearness allowances in terms and turnover commission. Over here the salary is basic plus DA in terms plus turnover commission, that will give you salary. You should take this for last 10 months. You should take average salary per month. You should take last 10 months divided by 10, so that will give you average salary per month. Now, sir, what if there is a fraction in completed years of services, sir? In case there is a fraction in completed year of service, it should not be ignored, meaning you are required to take the salary till the date of retirement. Then we have something called as retrenchment compensation, which is exempt under section 1010B. Section 1010B exempts retrenchment compensation. Now, there are two types of compensation. One is retrenchment compensation and another one is voluntary retirement scheme. Now, what is the difference between retrenchment compensation and voluntary retirement scheme, sir? Now, what happens is when the company says that please you leave the company, please leave the company, we request you to please leave the job. In such cases, it is a retrenchment compensation. Voluntary retirement compensation means I myself am telling the company that, sir, I want to leave the job. So that is voluntary retirement. So retrenchment compensation exempt under section 1010B. How much is exempt, sir? 15/26 into average salary per month into completed years of services, or actual amount received or statutory limit of 5 lakh rupees, whichever is less. 15/26 into average salary per month. What is average salary per month? You should take last 3 months average. Over here, what you should take, sir? Last 3 months average. You should take basic pay plus dearness allowances and turnover commission. That dearness allowances with, sir, dearness allowances in terms. And in completed year of service, please ignore the fraction. If there is any fraction, please ignore that fraction in completed years of service. Then we have VRS compensation, which is exempt under section 1010C. VRS compensation, how much is exempt, sir? Your salary per month into 3 months into completed years of service, or salary per month into remaining months of service, or actual amount received or limit of rupees, how much, sir? 5 lakh. Limit of statutory limit of 5 lakh rupees, whichever is less. Statutory limit of 5 lakhs, whichever is less, is exempt. This is the VRS compensation which is exempt. Sir, what do you mean by completed year of service? Please ignore the fraction. And what do you mean by salary over here, sir? Salary over here means basic plus DA in terms plus turnover commission. See, normally the salary, normally in most of the cases, the salary definition will be this. Salary will be basic plus DA in terms plus turnover commission. Most of the cases. Okay. Next we have what, sir? Allowances. Fantastic point. Next we have what, sir? Allowances. Sometimes the company may give you some extra money for meeting some cost expenses. That is called as allowances. See, along with your basic salary, bonus, etc., you may get some extra amount for meeting some expenses. For example, for your transportation from office to house, house to office. Say, for example, you are in a company where there is an uniform. To meet this uniform cost, also they may give you the money, etc. So, in such cases, what, sir? These things are called as allowances. When the company gives you money for meeting a particular expenses, it is called as allowances. Always students get confused between allowances and perquisites. See, for example, the company is giving an house to you. You are staying in that house. This house which is given by company is called as perquisites. It is called as what, sir? Perquisites. The company is giving you money, 15,000 rupees per month, so that you can stay in the house which you want. This is called as allowances. So allowances are always in monetary terms. The company will give you a money for meeting a particular expenses, whereas perquisites can be monetary or non-monetary. Perquisites means they are giving you that particular thing. They are giving you a car for transportation purpose. The company is only giving a car. That is perquisites. Case number 2, the company is giving you money so that you can fill your petrol, etc. for your transportation purpose. That is called as allowances. So we are seeing allowances. Allowances which are there under income tax law. Now please read the allowances in the same manner. You will understand it in a fantastic manner. Now there is an allowances called as commutation allowances. One more name of this commutation allowances is transport allowances. This is basically, normally it is fully taxable. It is taxable allowances. It is a taxable allowances. However, exemption will be given to a handicapped employees. 3,200 per month will be exempt if you are a handicapped employee. If you are blind, deaf, dumb, etc. Handicapped, then you will get an exemption. Children hostel allowance, maximum exemption you are going to get is rupees 300 per month per child. And how many children can I take the benefit for, sir? 2 children. Now please note, this allowances will be allowed as deduction if you are getting this money from the company. For example, if I am getting children hostel allowance from the company, if I get children hostel allowance, I can take the benefit of this exemption even if I don't have any children, even if my children are not going to any hostel, etc. So for children hostel allowance, how much exemptions are? Maximum 300 rupees per month per child for a maximum of 2 children. And children education allowance, how much is exempt, sir? Maximum rupees 100 per month is exempt. Per child, how much is exempt? Maximum 100 rupees is exempt. For how many children I can take the benefits, sir? For a maximum of 2 children. Tribal area allowances, maximum 200 rupees per month is exempt. And allowances for employees of transport undertaking, also called as truck driver allowances, actual amount received into 70% or rupees 10,000, whichever is less, will be exempt. Underground allowances, rupees 800 per month. Many times it may happen, if you would have watched this KGF movie, people over there work under the ground, correct? So in such cases, they will get something called as underground allowances. They are 800 rupees per month will be exempt. Now these allowances are exempt based on limit. There is some limit, based on that limit exemption is given to them. 300 rupees, 100 rupees, 200 rupees, 800 rupees, 10,000 rupees. So you cheat. This is also called as what, sir? You cheat or cheat you. This is also called as cheat you. Cheat you are exempt based on limit. How, sir? Limit. Commutation allowance 3,200 per month for handicapped employees. Children hostel, H for hostel allowance, 300 rupees. Education allowance 100 rupees. Tribal A for area allowance, tribal area allowance 200 rupees per month. Then T for truck drivers allowances 70% or 10,000 rupees, whichever is less. U for underground allowance. So you cheat are exempt based on the limit. Then we have duck hat. We have what, sir? Duck hat. These duck hat are exempt based on what you are actually spending. You may get the money, but exemption will be given to you only if you spend that money. Duck hat. What do you mean by duck hat, sir? Your daily allowances for your food, etc., tiffin, etc. Uniform allowances. So if your company, if you are working in a security company, or you are working in a blue collar job wherein there is uniform which are there in your company, etc., the company may pay you uniform allowances. That also will be exempt only if you are spending. Say for example, the company has given you 2,000 rupees as uniform allowances. You have spent only 1,000 rupees. How much will be exempt? 1,000 will be exempt. You have spent 1,500. How much will be exempt? 1,500 will be exempt, and 500 will be taxable. Then we have conveyance allowances, helper allowances. Helper which company helper you have appointed for your office work. Helper allowance, also called as academy allowance, also called as assistant allowances, or you are getting academy allowances or research allowances or professional development allowances. All these are exempt based on your actual spending. Whatever money you are getting will be first taxable, then subtract what is spent by you. Exemption will be whatever you spend. Then traveling allowances or tour allowance or transfer allowance, it will also be taxable. It will also be what, sir? It will be exempt only if you are actually spending any amount. Then one of the most important allowances is house rent allowances, HRA. This is exempt under section 1013A. Please note, these allowances which we saw, you see duck hat, they are exempt under 1014. They are all exempt under which section, sir? 1014. HRA is exempt under section 1013A. How much is exempt, sir? 40% of salary or 50% of salary, or actual HRA which you are receiving, or rent paid minus 10% of salary, whichever is less. 40% or 50% of salary, HRA amount received by you, rent paid minus 10% of salary. Sir, sir, you said 40% or 50% of salary. Whether it is 40% or 50%, normally it is 40% of salary. You take 50% of salary if you are in metro cities. Meaning if you are in metro cities like Delhi, Mumbai, Chennai and Kolkata. Now salary means what, sir? Over here salary means basic pay plus dearness allowances plus turnover commission. Basic plus dearness plus turnover commission. Now please note, HRA exemption is allowed only when you are actually paying the rent. Only when you are actually paying the rent, only when you have having a rented property, then only this HRA exemption will be available. The place of residence is important, not the place of employment. Now when you are taking 50%, 40% of salary, etc., where you are staying is important, not where you are working. You may be working in Delhi but staying in some place nearby Delhi, then it will not be covered over here. Say for example, I am working in Chennai by staying in Kathpadi but staying in Vellore, etc. In such cases 40% should be taken. Then any other type of allowances you see, any other type of allowances apart from you cheat duck hat HRA, any other type of allowance apart from you cheat duck hat HRA will be taxable, and it will be fully taxable. For example, entertainment allowance, taxable. For example, city compensatory allowance, taxable. Medical allowance, taxable. So any type of allowances apart from you cheat duck hat HRA, apart from you cheat duck hat HRA, any other type of allowances if you are seeing, then what should be the first thing which should come to your mind? It is taxable. What should be the first thing which should come to your mind, sir? It is taxable. Next we have what, sir? Next we have provident fund. Next we have provident fund. Provident fund can be basically of two types: employee provident fund and public provident fund. Public provident funds investment can be made like by people like you and me who are not working anywhere, who are not employees of any company. But if you are an employee provident fund, means you are working somewhere and the employee is deducting. Employee provident fund can be of three types. It can be statutory provident fund, recognized provident fund, or unrecognized provident fund. Now say for example, normally what will happen is there will be a fund. In this fund, contribution will be made by employer as well as employee. Whatever contribution is made by employer as well as employee, we know that some exemption benefits will be given. You will get interest on the contribution also, and then you will receive the lump sum amount. In case it is a statutory provident fund, employee makes contribution to this statutory provident fund. Please ignore this. You don't consider this amount in the salary. Then whatever contribution is made by the employer to this statutory provident fund, that also should be ignored because it is exempt. Now you get interest on employees contribution and interest on employers contribution. Whatever interest you are getting on employees as well as employers contribution is exempt. Now after a period of time, you will withdraw the lump sum amount from this. You will withdraw lump sum amount from this fund, statutory provident fund. After 20 to 30 years, you will withdraw the lump sum amount. This lump sum amount which you withdraw will be exempt. This amount which you withdraw is what, sir? It is exempt. Then we have what, sir? Recognized provident fund. Very important from exam point of view, because in case of statutory provident fund, your contribution, interest on your contribution and the lump sum amount, everything is exempt only. But in case of recognized provident fund, the exemption will be given based on some limit. Therefore, that is very important from exam point of view. Let us see recognized provident fund. In recognized provident fund, whatever contribution is made by the employee, exempt. It should be ignored. He can take a benefit under section 80C. Whatever contribution is made by the employee. Employer makes the contribution to this provident fund, recognized provident fund. It is exempt up to 12% of salary. So whatever salary is getting, up to 12% of the salary, employer's contribution will be exempt. Meaning what, sir? Say for example, see, there is a fund. Now I am working in Reliance Industries. Okay. So I am receiving salary from Reliance Industries. So from my salary, I am going to put some money in this fund. That you should ignore. I can, whatever amount I am putting, I can take the benefit under section 80C. Then Reliance Industries is also going to put the same amount of money or equal amount of money in this particular fund. So whatever contribution is made by Reliance Industry, that should actually be added to my salary. It should be added to my salary. Once you add it to my salary, I will give exemption. It should actually be added to my salary. But you don't have to add it in the salary. You don't have to add it in the salary if it will be exempt. How much will be exempt, sir? Up to this amount, 12% of salary. For example, my salary is 1 lakh rupees. So my contribution is 10,000. Employer's contribution is also 10,000 rupees. My salary is 1 lakh rupees. So in this case, is it more than 12%, sir? No, sir, it is not more than 12%. Mine anyways, I should ignore. And this 10,000 rupees will not form part of my salary, meaning even if you add it in my salary, I will have to give a deduction of 10,000 rupees. I'll have to give a benefit of 10,000 rupees. Next, say for example, I have contributed 15,000 rupees and he has, employer, Reliance Industry has also contributed 15,000 rupees. My amount to ignore, you take the benefit under section 80C. But employer's contribution 15,000 rupees he has contributed, I will give an exemption only up to 12,000 or 12% of salary. So balance 3,000 rupees will be taxable. Balance 3,000 rupees will be taxable. Okay, not okay? Recognized provident fund. We have what's a recognized provident fund. Recognized provident fund. Employees contribution ignore, can take benefit under section 80C. Employer's contribution is exempt up to 12% of salary. Now whatever interest you get on employees contribution, that will be exempt up to 9.5% of salary. If the interest rate is up to 9.5%, very no problem, it will be exempt. If it is more than 9.5%, that extra interest will be taxable as salary. Then interest on employer's contribution is also exempt up to 9.5%. Any interest more than this 9.5% will be taxable. Now, so your contribution we have understood, the interest on your contribution we have understood. Now you receive the lump sum amount at the time of retirement. At the time when you are leaving the company, you receive the lump sum amount, it will be exempt. That lump sum amount will be exempt if you have completed minimum 5 years in service in that company. If you have completed minimum 5 years of service in that company, it will be exempt. However, this time limit of 5 years will not be applicable if you leave the company because of your ill health, because employer has discontinued his business, or you have left that company and transferred the amount which is there in this recognized provident fund amount to the recognized provident fund amount of the new employer, or you have transferred it to 80CCD pension fund. Now, very important point with respect to interest. Please understand this carefully. Interest on employer's contribution, whatever interest is in excess of 9.5%, it will be taxable as salary. Similarly, interest on employee's contribution also in excess of 9.5% will be taxable as salary. Now, what they have done is they have made an amendment. They have made an amendment and they have added this extra point. They say for employees' interest only this point is applicable. However, see, interest on employees' contribution, interest accrued in excess of 9.5% per annum is taxable in the hands of employee as salary in excess of 9.5%. Then, however, if the employee has contributed to recognized provident fund more than 2,50,000 rupees, if the employer's contribution, employee's contribution in the fund is more than 2,50,000 per annum, the interest on such contribution in excess of 2.5 lakhs is fully taxable. Say for example, employee has contributed 3 lakh rupees, so he has contributed more than 2.5 lakhs. Therefore, on 50,000 rupees, any amount of interest, even 1 rupee, 1% interest is taxable. Okay, that will be fully taxable. To explain this, I have given good examples. You can go through this. Next, we have unrecognized provident fund. Unrecognized provident fund is a fantastic fund. In case of unrecognized provident fund, no, whatever employee's contribution, please ignore. Whatever employer has contributed, exempt. Interest on employee's contribution, exempt. Interest on employer's contribution is also exempt. Now, in case of unrecognized provident fund, no, the taxability will not come upon your contribution or interest on your contribution. The taxability will come when you receive the lump sum amount from the fund at the time of your retirement. When you receive the lump sum amount, no, this lump sum amount will have 4 things. It will have your own contribution, interest on your contribution. It will have your employer's contribution and interest on your employer's contribution. In such cases, when you receive this lump sum amount, no, employee's contribution is not treated as income. You please ignore, because I have already paid the tax under the head salary. I get interest on employee's contribution. Employee's contribution, whatever contribution employee has made, he get interest on that. That interest amount will be taxable under income from other sources. Then we also have employer's contribution and interest on employer's contribution. This also will be taxable under. This will be taxable at the under the head salary at the time of retirement when you receive the lump sum amount. Now, just like this fund, which fund, sir? Just like this provident fund, we have one more type of fund called a superannuation fund. These also can be of 2 types, approved or unapproved superannuation fund. Approved superannuation fund, whatever contribution is made by employee, you please ignore. He can take the benefit under section 80C. Whatever contribution is made by the employer is exempt up to 7.5 lakhs per annum. Interest on employee's contribution as well as employer's contribution is exempt. And the lump sum amount which you receive at the time of your retirement is exempt. Lump sum amount which you receive at the time of retirement is what, sir? Exempt from, if it is approved superannuation fund. If it is unapproved superannuation fund, it is exactly equal to unapproved recognized provident fund. Your contribution you should ignore. Employer's contribution is exempt. Interest on your contribution as well as your employer's contribution is also exempt. Whatever amount you receive on lump sum at the time of retirement will be taxable. That will contain 4 things. In these 4 things, your contribution amount should be ignored. Interest on your employer's contribution is taxable under income from other sources. Employer's contribution and interest on employer's contribution is taxable under the head salary. Then we have pension scheme. Very important. This is something which is related to your deductions topic, ATCCD pension scheme. Now, contribution which is made to national pension scheme or central government pension scheme or Atal Pension Yojana or new pension scheme. In such cases, no, say for example, there is a pension fund. Let us call this as central government pension fund or national pension fund. A contribution will be made by employee as well as employer. Whatever contribution is made by the employee, please ignore this while computing your salary, because it is already whatever amount of salary you are receiving is already taxed. You will get a deduction under section 80 CCD 1 for your contribution. Employer is also contributing some money in this fund. Whatever contribution is made by the employer, first add it in your salary and then deduction will be given under section 80 CCD 2. Sir, how much deduction will be allowed, sir? If you are a employee, if you are working somewhere, then if you are an employee, for you the deduction will be, for your contribution you will get a deduction of amount which is invested by you in this pension fund or contributed in this pension fund, or 10% of salary, whichever is less. And for your employer's contribution you will get your 80 CCD deduction under 80 CCD 2. That deduction which will be equal to the amount which is contributed by the employer or 10% of salary, whichever is less. This salary should be taken as 14. This contribution, this limit will be 14% of salary if you are a government employee. Then, apart from this, we have deductions under salary topic. We have perquisites and deduction left over. Let us see deductions first. Deductions under section 16. Now, please note, we have completed what, sir? We have completed the basic components, then retirement benefits, then allowances. Now we are seeing deductions. Deductions are under section 16. Deductions under salary topic, section 16. There are 3 types of deduction. One is called as standard deduction, one is called as entertainment allowances, another one is called as professional taxes. Standard deduction is available to all the employees. The deduction will be the amount of your salary or 50,000 rupees, whichever is less. This 50,000 rupees is per annum. So if you are working in 5-6 companies, will this 50,000 be given for each company? No, the 50,000 is per employee. So if the employee has received the salary from more than one employer, then the deduction will be allowed only once. Then we have what's our entertainment allowances. Entertainment is allowances. It should first be added in your salary, and then deduction will be allowed only if you are a government employee. How much deduction will be allowed, sir? 20% of your basic pay, basic salary, and actual amount of entertainment allowance received or 5,000 rupees per annum, whichever is less. Then professional tax. Professional tax, it is a tax on your employment which is collected by the state government. It is allowed as deduction only if it is paid by the employee. Only if it is paid by the employee. Sir, what if employer pays, sir? If employer is paying, then first add it in your salary, then give the deduction under section 16. Maximum deduction allowed is how much, sir? 2,500 per annum for 1 year. So, sir, for 5-6 years, if I paid today, sir, then it will be given today. It is allowed on payment basis. Deduction is allowed on what basis, sir? On payment basis. Now comes most important point in our salary topic, wherein normally student will get confused because of perquisites. They will get confused under allowances and perquisites. Perquisites is extra benefit which the company is giving. What are perquisites, sir? Perquisites are the extra benefit which the company is given to you. Normally it is a non-monetary benefit, like house is given by the company, a maid is given by the company, a car is given by the company, a mobile phone is given by the company. This is what's an extra benefit which the company is giving. Normally perquisites are non-monetary benefits. However, sometimes it can also be in monetary terms. Reimbursement of expenses or expenses incurred by the company on behalf of the employee is also treated as perquisites. Now, what are the different types of perquisites? First is leave travel concessions. The company is giving you money for your travel purpose. Travel benefit which is given by a company for travel anywhere in India. It is exempt under section 10(5). How much is the exemption, sir? If you are traveling by, if you are an employee who is traveling by air, then the amount of exemption will be actual expenses which you have incurred for your travel, or economy class fare, whichever is less. So if you're traveling by air, it does not matter which class you are going. You may go in business class, you may go in economy class, but the the exemption will be whatever actual expenses you are incurring, or economic class fare, whichever is less. If you are traveling by any other mode, say you are traveling by car, train, bus, truck, bullock cart, etc., whatever mode you want to travel, if you are traveling by any other mode, then check whether the railway facility is available at that location where you are going. It does not matter how you are going. Check whether railway facility is available at that location where you are going. If yes, then actual expenses or first class AC rail ticket, whichever is less, will be exempt. If the railway facility is not available at that location, then check whether recognized transport facility is available at that location or not. If yes, then take actual expenses or deluxe class bus fare, whichever is less, will be exempt. And if that recognized public transport facility is also not available, then take your actual expenses or first class AC ticket for similar distance. Please note, how you are going, it does not matter. We are going to check, say even if I go by car, I am going to check whether railway facility is there. If it is not there, then okay, take deluxe bus fare. Now sir, what if that recognized public transport is also not there? Then take actual expenses or first class AC rail ticket for similar distance. The place where you are going, for similar distance, how much will be the first class AC rail ticket? That will be taken as deductions. Exemption, that is the amount of exemption allowed. So in simple words, in case of leave travel concession, if you are traveling by air, then it is economic class fare or actual expenses or economic class fare. If you are traveling by any other mode, then actual expenses or first class AC ticket or actual expenses and public or deluxe class bus fare. If all this information is not available, then actual expenses or first class AC rail fare for similar distance. Now sir, this leave travel concession can be will be given only to the employee's travel, sir? No, an employee can take along with him his employee. This benefit will be given to the employee. He can take his spouse, children's or dependent relative like mother, father, brother, sister along with them. They can take the benefit for all of them. So leave travel concession benefit is available only for two children's if they are born on or after 1/10/1998. Now normally the exemption which will be given to you is for two journeys or two travels within a single block. So one block will contain 4 years. In a block, how many times you can take benefits, sir, of leave travel concession? 2 times. So year over here means calendar year. Present running block is 2022 to 25 block. Next type of perquisite which the employer may give you is gift. Now here gift means what, sir? Gift can be in cash or it can be in kind. For example, we in Priya Sarees, we to our lady employees who are there, no, to all the women employees at Priya Sarees, we give washing machine to them, we give refrigerator, we give TV to them, etc. So in that cases, this is the gift given by us. So whatever type of gift I am giving, it does not matter. If it is a gift in cash, it is always taxable. Full amount will be taxable. If it is a gift in kind, what type of gift it is, it does not matter. It will be taxable if the market value of that gift is more than 5,000 rupees. If it is less than 5,000 rupees, it is exempt. If it is more than 5,000 rupees, it is fully taxable. Full amount will be taxable. Then the employee may also get some extra benefit from the company. What is that extra benefit, sir? We have also seen this in our Capital topic. What is this called as, sir? ESOP. ESOP means what, sir? Employee is getting the shares of a company. The employer is offering the shares of the company to the employee at a concessional rate. So because he is giving the benefit of purchasing the shares of the company at a concessional rate, the employer is getting perquisites or benefit. How much is the benefit, sir? The market value of that shares and the price at which the employee is purchasing that shares. So fair market value of the shares minus issue price will be taken as perquisites. Note, fair market value as on the date of exercising the option should be taken. So fair market value over here means what, sir? Fair market value as on date of exercising the option. Next benefit which you get is what, sir? Next benefit which you get is medical facility from the company. Medical facility, the company may give medical facility for treatment. Now the treatment is happening either in India or it is happening outside India. If the treatment is happening in India, then I will check where the treatment is happening. Is the treatment happening in government hospital? Is the treatment happening in any government approved hospital, or is the treatment happening in employer own hospital? Then it is fully exempt. For example, treatment is happening in any government hospital, say AIMS, let us say it is a government approved hospital, treatment is happening over there, or employer's own hospital. Say an employee of Reliance Industry is getting treated in Dhirubhai Ambani hospital, or Kokila Ban, whatever that hospital name is, and then an employee of Tata Motors is getting treated in Tata's hospital, etc., then it will be fully exempt. It will be fully exempt. But if the treatment is happening in any other type of hospitals, etc., it is fully taxable if the treatment is happening in India. So what if treatment is happening outside India, sir? If the treatment is happening outside India, no, expenditure incurred for treatment and stay will be exempt as per the RBI limit. RBI is going to tell what is the limit, and the expenses will be exempt. For travel, so exemption will be given based on RBI limit. So for treatment and stay, for travel purpose, normally it will be taxable. However, the travel benefit also will be exempt if your gross total income is up to 2 lakh rupees. Then, sir, for who note, sir, whom can I take the benefit for, sir? The employee can take the benefit for himself, his spouse, children, or dependent relatives. The treatment outside India, travel and stay will be given only for patient and one attendant. Just because the treatment is happening outside India, you should not take your entire family. Benefit will be given only for one patient plus attendant. Exemption is allowed irrespective of the type of illness. Now, please note, there was one point which was added during the time of COVID. If it is with respect to COVID, irrespective of the type of, irrespective of the place where the treatment is happening, the benefit was given to them. Because normally, if your treatment is happening in any other type of hospital, it is taxable. But in case of COVID, it is exempt wherever the treatment is happening. Now, many times question will also talk about medical claim or health insurance or medical insurance. It is exempt. It is not treated as perquisites. Life insurance, it is taxable. It will be treated as perquisites. So if the company is taking medical insurance, no problem. Health insurance, no problem. Life insurance, problem. Then many times what may happen, company may give you loan at a very concessional rate, or interest-free loan may be given. I want money. So company may give me money at a concessional rate or without any interest. Now the loan is given for what purpose? The company is giving loan for what purpose? Is it for your medical treatment or any other purpose? If it is for your medical treatment and if it is for specified disease, no, then it will be exempt. But if the loan is given for any other purpose, you want to go for honeymoon, or you want to get married, etc., for that purpose, if the loan is given by the company, then the loan amount, if it is up to 20,000 rupees, then it will be exempt. If the loan amount is more than 20,000 rupees, it will be taxable. Sir, how much will be taxable, sir? How much will be taxable? The taxable amount will be the benefit which you are getting. What is the benefit which you are getting? The benefit which you are getting is the interest which you are not paying. So that take the loan amount at the end of outstanding at the end of the month, multiplied by SBI rate of interest specified by the State Bank of India as on the first day of the previous year, minus the interest charged by the employer. So whatever SBI rate interest rate is there as on 1st April of the previous year, minus the interest rate charged by the employer, will be exempt. Then lunch facilities may be given, meal facilities may be given by the company. If the value of that meal facility is up to 50 rupees, then it is fully exempt. More than 50 rupees, then amount in excess of 50 is exempt. If refreshment, snacks and non-alcoholic beverages are given, then also it is fully exempt. And if you are on a remote location for offshore duty, then also whatever refreshments you get, food items you get, is exempt. Next, what, sir? Education facilities also may be given by the company. Education facilities, if it is given to the employee, then no problem, it is fully exempt because there is no perquisites. If it is given to child of employee, then where is the education given, sir? Is it given in the employer own school, or is it given in any tie-up school of employer? If it is given in employer's own school or tie-up school, then if the value of that education is less than or equal to 10,000 rupees per month, only 1,000 rupees per month exempt. If it is more than 1,000, it is fully taxable. If the education is happening in any other type of institute, it is always taxable. And if the education facility is given for any other person, it is not for employee, it is not for employee's children, say it is for employee's wife, it is for employee's brother, sister, etc., then it is fully taxable. Then company may also give you movable assets. It may give you washing machine, it may give you refrigerator, sofa, AC, etc. So if the movable assets except car, if the company is giving you movable asset, check whether that movable asset which is given by the company is owned by the company, or the company has taken that movable assets on rent. If it is a movable asset which is owned by the company, then it will be taxable. So it can be owned or it can be rented. So whatever type of movable asset it is, check whether it is owned or rented. If it is owned, then 10% of its actual cost, purchase price, will be treated as perquisites. If these movable assets are taken on rent, then the rent which is paid by the company, the higher charges which is paid by the company, will be taken as perquisites. Now please note, the amount recovered from the employee should be reduced. Say for example, the company is giving me a AC and it is taken by the company on rent, and they are paying a rent of 3,000 rupees. From me, the company is recovering 1,000 rupees. So in this case, the perquisites will be only 2,000 rupees. Laptop and computer, if the company is giving, if the movable asset which is given by the company is a laptop or a computer, it will be exempt. Then transfer of movable assets or sale of movable assets by employer. Now, many times what will happen, I am working in a company, the company had given an AC to me, a movable asset to me, or a car to me, etc. Now, after working for some period of time, I am leaving the company and I am telling the company, why don't you sell this asset to me? So, whenever there is a sale or transfer of movable assets by the employer, what will happen, sir? Then what will be the value of perquisites? Now, if it is a laptop or a computer, then the perquisites value will be take WDV of that movable assets minus consideration, which the amount which the employee has paid. So how will I find the WDV? By taking depreciation at the rate of 50% under WDV method. Find the WDV. Find the WDV, and then what is the amount paid by the employee? Whatever difference is there, that will be the benefit. So in case of car, take WDV by computing the by calculating depreciation at 20% per annum, subtract consideration amount. And in case of any other type of asset, take the perquisites will be equal to WDV minus consideration. And here for all the other types of asset except laptop and cars, the depreciation should be calculated at SLM method. Now depreciation shall be calculated for a completed year, meaning part of year should be ignored. So completed year over here means from the date of purchase till the date of transfer, you should take the number of years which is there. Part of year should be ignored. Then rent-free accommodation or house facilities, very important from exam point of view. Rent-free accommodation or house facilities. Now, rent-free accommodation may be given. There is an amendment also in this, so it is very important. There is an amendment over here. Rent-free accommodation may be given to government employees or it may be given to non-government employees, other types of employees. If you are a government employee, then it will be taxable as per the license fees which is decided by the government. If you are a non-government employees, for all the other types of employees, there is an amendment over here. For all the other types of employees, check whether the house which is given is owned by the company employer or is it taken on rent by the employer. If it is owned by the employer, then the value of perquisites will be 5%, 7.5% or 10% of salary. It will be 5%, 7.5% or 10% of salary. If it is rented by employer, then the perquisites will be 10% of salary or rent paid, whichever is less. Whatever rent the company is paying or the 10% of salary, whichever is less, will be taken as value of perquisites. Sir, how will I come to know whether it is 5% of salary, 7.5% of salary or 10% of salary, sir? Now it depends on the population of the place where you are staying. If the population is up to 15 lakh rupees, take 5% of salary. It is more than 15 lakhs up to 40 lakhs, take 7.5% of salary. If it is more than 40 lakhs, take 10% of salary. Sir, you are telling 10% of salary, 7.5% of salary, 5% of salary, but what do you mean by salary? Salary over here means BD Bumsy. What is salary, sir? Sir, BD Bumsy. Sir, what is this BD Bumsy, sir? The salary over here is BD Bumsy. BD Bumsy means B for basic pay, D for DLS allowances in terms, then B for bonus, A for allowances, only taxable amount you should take, M for monetary benefits, and C for commission or any type of commission should be taken. Now, when you are calculating this BD Bumsy, take salary only on due basis. Whether you have received, whether it is received or not does not matter. Only on due basis it should be taken. For calculating BD Bumsy, do not consider compulsory. You should not take retirement benefits. You should not take any type of perquisites. You should not take contribution to PF and interest thereon, etc. And you should not take advance salary and arrears of salary. Now, what may happen is many times with this house, with the house, the company may also give other assets, furniture. So if in the above cases, accommodation is with furniture, then check whether the furniture is owned by the employer or is it rented by the employer. If it is owned, then the value of perquisites will be 10% of cost. If it is rented, then the rent paid into higher charges will be taken as value of perquisites. Then many times it may happen that the company may give us hotel benefit. It may not give us house, but it may ask us to stay in an hotel. In such case, value of perquisites will be 24% of salary or rent charged by the hotel, whichever is less. Now, if the hotel facility is provided by the company for a period up to 15 days because of transfer of employee from one place to another place, in such cases it will not be taxable. Now, with respect to rent-free accommodation, one very important point, many times what may happen is you are staying at one place and then you are transferred to another place. Now, many times it may happen that the transfer may happen in middle of the year. Therefore, your kids' education should not be disturbed. So what will happen? The company will give you will give you house, meaning this house which you are already staying in will be given to you, plus they will also allot a new house to you at the new place which you have gone. So there may be possibility that you are staying in, the company has given you 2 houses. In such cases, what will be the value of perquisite, sir? Lawmaker says if the company is giving you 2 houses, sir, if the company is giving you 2 houses, then in such cases, you should take value of any one of the house only. You should take the value of any one of the house only for a period of 90 days. For a period of 90 days, you take the value of only any of the one of the house, whichever value is coming less, you take the value of that house as value of perquisites. And after 90 days, also if you are having 2 houses, then both the values will be added in computation of perquisites. Very good questions are there in the institute material, and obviously if you are not, but if you are a person who is only watching the videos but not watched my lectures or not purchased the lectures, then you can definitely go and purchase the lectures. It is available on ArivuPro website and mobile app. So exemption for 90 days in case of allotment of 2 houses, where an employee has transferred from one place to another place, and he is provided with an accommodation at a new place also, then the value of perquisite shall be taken only for one of such house whose value is less for a period of 90 days, and thereafter value of both the houses will be taken. Next, what, sir? Company may give you car facilities. Company may give you what, sir? Again, important point. Company may give you car facility. Company may give you what, sir? Company may give you a facility called as car facility. Now, the car is used by you only for your office purpose, or the car is used for any other purpose. Car is used only for your office purpose. Company has given the car and you are using only for office purpose. And what is the benefit which you are getting? You are not getting any benefit, therefore there is no perquisites. But if the company has given the car and you are using it only for your personal purpose, then 2 arrow marks. Then what's the 2 arrow marks? Check whether it is a car owned by the employer or it is a car which is taken on rent by the employer. If it is a car owned by the employer, then 10% of the cost will be taken as perquisites, and if it is a car which is taken on rent by the employer, whatever rent they are paying will be taken as perquisites. This is common sense. Okay, now along with the car, if running and maintenance charges is also borne by the company, add that running and maintenance charges which is incurred by the company. Along with that, if driver salary is also paid by the employer, then add that amount also. But mostly what will happen is the company may give you a car which you are using for personal purpose also and office purpose also. In such cases, fantastic provision. This is applicable. Now, car is partly used for personal purpose and partly used for office purpose. In such cases, check whether the car is owned by the employee or is the car owned by the employer. Let us see what will happen if the car is owned by the employee. I am working for Reliance Industry. I am having my car which I am using for office purpose and personal purpose also. It is my car. So if the car is owned by the employee, check who is paying the running and maintenance charges. If the running and maintenance charges is also borne by the employee, or my car I'm using for office purpose also, house purpose also, and I am only incurring the expenses, running and maintenance expenses, no benefit is there, therefore completely exempt. Yeah, but however, if the running and maintenance expenses is given by the employer, then whatever running and expenses he is paying less up to thousands, if the car is up to 1600 cc or 1.6 liters, then 1800 rupees per month you should reduce. And if it is more than 1600 cc or 1.6 liter, 2400 per month you should reduce. That will give you value of perquisites. Then if it is a car which is owned by the employer, check who, if it is owned by the employer, then again check who is paying the running and maintenance charges. If running and maintenance charges paid by the employer, then the perquisites value will be, if the car is up to 1.6 liters or 1600 cc, 600 per month will be exempt. If it is more than 1600 cc, 900 per month will be value of perquisites, not exempt. It will be taken as value of perquisites. Now, if the car is owned by the employer and running and maintenance charges is also paid by the employer, then value of perquisites will be for up to 1600 cc, 1800 per month, and for more than 1600 cc, 2400 per month. Now, if driver facility is also given by the company along with this car, then 900 rupees per month will be added for the driver. And if more than one car is given for partly office and partly personal purpose, then one of such car will be taken as partly, and the other cars which are given will be all assumed as fully personal purpose, and accordingly computation will be done. Month over here means completed, means part of the month should be ignored. Then other types of perquisites which we have, there is only hardly one
two pages which is left over, other types of perquisites. Other types of perquisites is the company is giving, the company may give you gas facility, free gas, electricity, water facilities, it is fully taxable. Free servant, gardener, watchman, fully taxable. Now this gas facility and servant facility, etc., it is provided, if the facility is provided by employer to employee, then it is taxable only for specified employee. But if you are only taking that gardener, you are only appointing that servant, you are only paying the gas facility, and it is reimbursed by the company, it is taxable for all the employers. Employees obligation incurred by the, or paid by the, or reimbursed by the employer. So there is an expenses which was incurred, which was supposed to be incurred by the employee, but which is incurred by the employer, or it is reimbursed by the employer, then it is fully taxable in my hands, employee's hands, it is fully taxable. Then credit card facility, then what, sir? Then what do I have? Then company may give me what, sir? The company may also give me something called as credit card facility. The company may give me credit card facility. In such cases, if the credit card is used by me for my office purpose, then it is exempt. If it is used for my personal purpose, if that credit card is used for what purpose? If that credit card is used for my personal purpose, it will be taxable. Then I may get club facility also, say some gym membership club or corporate club, health club, etc., or golf club, etc. So it is normally fully taxable. But if that club is what, sir? If that club is a corporate club or an health club or a sports club, it will be exempt. Then lawmaker says if the employer is contributing more than 7.5 lakhs combined together, if the employer is contributing in recognized provident fund, approved superannuation fund, and pension scheme of ATCCD in excess of rupees 7.5 lakhs in a year, then that excess amount will be treated as perquisites. Now the company may also give transport facility. Now the transport facility, transport facility. Now check whether the transport facility is given to employees of a transport company. For example, I am employee of Indian Railway. I am employee of Indigo. I am employee of AirAsia. I am employee of any bus company, VRL Transport, SRS Travels, or KSRTC, etc. Now transport facility. If the transport facility is given by employee of transport company or other employees, if it is given to an employee of transport company, then check whether you are an railway employee or airline employee. If you are a railway or airline employee, then exemption will be given. If you are any other type of employee, then it will be fully taxable. And if you are an not employee of transport company, for example, I am working in Infosys and they are giving me transport facilities, it is fully taxable. Now transport facility from house to office, office to house is exempt for all kind of employees. Now following perquisites will always be exempt if the company is giving you a laptop or a mobile phone or a telephone or a computer. If the company is giving you tea, coffee, snacks, non-alcoholic beverages, if the company is giving you any goods at a concessional rates, if the company is undertaking health insurance, medical insurance, personal accidental policy, or group employees policy. Okay, apart from this, we have under salary topic, we have relief under section 89A. Many times the employee will get relief under section 89A. Sir, when is this computation is done over here? When is this relief given? Say for example, you were supposed to receive some amount of salary in a particular year. Now in that year you received less salary, and that year's salary you received in some other future year. Now because it is received in a future year, the tax which you are supposed to pay in this future year is more. It has increased. So you were supposed to receive in year number 1. You are supposed to receive a salary of 7,20,000 in year number 1, but the company paid you only a salary of you are supposed to receive a salary of 8,40,000 in year 1, but the company has paid you only a salary of 7,20,000 in the year 1. They did not pay you bonus. Whatever was agreed was not paid by the company. This bonus was paid to you in a future year after 3 years, etc. So what is going to happen, sir? In year 1, my income, the salary which I have received is less. Since my salary is less, the tax also will become less. But in the year 4, because my salary is more, because I am also receiving that arrears of salary, because my salary is increasing, what may happen? The amount of tax which I am going to pay will also increase. So in that case, the company is going, the lawmaker says, I am going to give you a relief under section 89. That relief under section 89 will be calculated based on what would have been the tax which you would have paid if that salary which you were supposed to receive in year 1 would have received in year 1 only, and what is the tax which you would have paid in this current year when you have received the salary as if that amount was not received. Whatever difference is there, that will be the value of relief which will be given to you. So what is the tax which is less paid by you in that year, and what is the extra tax paid by you in this year. The difference between this is relief under 89. This is the relief under what section, sir? It is a relief under section 89. Now let me just take a chota sa break and continue the discussion on PGBP. Next topic for our discussion is what, sir? The next topic for our discussion is profits and gains from business or profession. PGBP, profits and gains from business or profession. Section 28. Let us straight away start our discussion with so section 28 to section 44. All these different points which are there, no, they are under this chapter. Section 28 to section 44. Of these are the different sections which are there under this chapter. PGBP, very important from exam point of view. Fantastic topic. Now what this chapter says, basically profits and gain from business and profession. Under this chapter, when you read this chapter, you will come to know that the incomes are given in section 28. Section 28 gives a list of different incomes which are taxable under this head, and section 41 gives a list of different incomes which are deemed as business income. So basically you are just required to prepare a profit and loss account wherein all the incomes you should take as per section 28 and section 41, and you should take all the expenses as per section 30 to 37. Plus you should also consider the other sections which are there under other sections, meaning from section 38 to section 44 while computing this business income. You will get your profit. This profit is nothing but your GBP income. Now what do you mean by business? A business includes trade, commerce, manufacture, and profession includes vocation. Section 145 of income tax law says there are two methods of accounting. One is cash method of accounting, another one is accrual system of accounting. Cash method of accounting is used for computing this method of accounting, section 145 method of accounting, whether cash or accrual system of accounting, is used for computing the income under the head PGBP or income from other sources, and any one of the method can be used for computing the income under these heads for throughout the financial year. So for other sources you can use cash basis, for PGBP you can use accrual basis, or for different businesses you can use different method. That is all on you. Now section 28 talks about charging section. It says following incomes are taxable under PGBP: any profits and gains from business or profession, any amount received by a person for termination of his business or profession or modification of terms of his business or profession, income from services rendered by an association to its members, any benefits or perquisites arising from business or profession, or any remuneration and interest received by a partner from his partnership firm, subject to limit of 40B, any amount received for carrying on in business or for not carrying on any business or profession or not sharing technical know-how, for export businesses when you receive duty drawback, duty entitled passbook, cash compensatory support, or some amount received by under key man insurance policy, and whenever you are converting stock in trade into capital asset, fair market value of that stock in trade on the date of conversion. Now normally business is business only, but for the purpose of our set off and carry forward chapter, business will be divided into two categories. One is called as normal business and speculation business. Normal business is all the types of business which we are doing, like shoe business, sari business, garment business, electronic business, etc. Speculation business means buying and selling of shares and securities without taking the actual delivery. Please note, speculation is not trading. Intraday trading, same day trading in shares is speculation, but if you are trading in derivatives like futures, options, it is not speculation. Now section 29 says, next section is section 29, which says for computing the income under the head business and profession, you should consider all the sections from section 30 to 43D. Section 30 talks about rent rates, taxes, insurance and repairs of building. So if you are paying any rent rate, taxes, insurance of building, that will be allowed as deductions. Section 31 says if you are paying any insurance and repairs of the plant, machinery and furniture, that also will be allowed as deduction. Section there is important note: if any expenses incurred under section 30 or 31, expenses incurred under 30-31 is allowed as deduction only if that expenses are incurred only if it is for your business purpose or your profession purpose. Now many times it will happen that you have taken a property on rent and your capital expenditure. Normally expenditure which you incur can be revenue expenditure or capital expenditure. If it is a revenue expenditure, no problem, you can take the deduction. If it is a capital expenditure on a rented property, then it will be deemed as your building, etc. It will be deemed as your assets, and accordingly you can take depreciation on that. Section 32, very important section. Section 32 talks about what's depreciation. Section 32 says depreciation is allowed as deduction. Section 32 says what, sir? Depreciation will be allowed as deduction if you satisfy two conditions. What are these two conditions, sir? Assessee should be owner of that asset, and that asset should be used for business or profession. Depreciation will be allowed as deduction if two conditions are satisfied. Assessee should be owner of such asset, and that asset should be used for business or profession. Some important point which you should keep in mind for depreciation while computing depreciation. Depreciation will be allowed whether the asset is whether the assessee is a registered owner or beneficial owner, it does not matter. In case of asset purchased under hire purchase system, depreciation will be allowed from the date of possession of the asset, not from the date of getting the ownership. So from the date of possession only you can take the depreciation. If the asset is taken on lease, the depreciation will always be given only to lessor, it will not be given to lessee. Depreciation will be allowed from the date when asset is put to use and not from the date of purchase. It will be given from the date the asset is put to use. In case of co-owner and joint owner of an asset, depreciation will be allowed proportionately to each of the co-owner or joint owner. Depreciation will be allowed whether the asset is under passive use or active use, it does not matter. Then classification of asset. Now asset can be basically for depreciation purpose, for our income tax purpose, asset can be classified into tangible assets, intangible assets. Tangible assets will include building, furniture, plant and machinery, and intangible assets are patent, trademark, etc. All the types of intangible assets except goodwill. Under income tax law, there is no depreciation given on goodwill. Methods of depreciation, there are two methods, SLM method and WDV method. Normally we follow WDV method. Under WDV method, we use a system called as block of assess system, and it is required to be followed by all the types of assessee. And we have one more method called as SLM method. Under this we follow individual asset system. This can be followed only by power generation or power generation and distribution people. It is an optional method for them and not mandatory. Now, what are the different rates of depreciation, sir? The rates of depreciation is residential building 5% boyfriend, which is normal building and furniture 10% mom, which is nothing but what is this? M for what's a motor vehicle, O for other plant and machineries, and M for motor vehicles, O for oil wells, and M for other plant and machineries. It is 15%. For ship, it is 20%. For ABC temporary wind pollution. For ABC temporary wind pollution, it is ABC 40%. What is ABC, sir? A for aircraft, B for books, C for computer and computer peripherals, temporary structures, wind pollution, windmills, pollution control equipment, etc. It is 40%, and for intangible assets, it is 25%. Now, how do I compute the depreciation, sir? Very fantastic method is there for computing depreciation. First, take opening WDV or WDV at the beginning of the previous year. Add to it assets which are purchased during the year. Now, this asset which are purchased during the year is required to be divided into three categories. Asset which is purchased during the year and put to use for 180 days or more. Asset purchased and put to use for less than 180 days. Asset purchased by you and not put to use. So then subtract from this sale proceeds of assets sold during the year. You will get WDV for depreciation. From that subtract depreciation, you will get your closing WDV. Now, this WDV for depreciation should be divided into three categories. This WDV for depreciation should be divided into three categories. Asset. So this amount will have asset which is purchased and put to use for more than 180 days, put to use for less than 180 days, and asset which is not put to use at all. So this divide that amounts. So WDV for depreciation will be divided into asset not put to use, asset put to use for less than 180 days, asset and balance asset which is used for 180 days or 180 days or more. If asset is not put to use, then no depreciation will be given. Asset is put to use for less than 180 days, 50% of the actual depreciation rate will be given. Asset is put to use for more than 180 days or equal to 180 days, 100% of depreciation. If it is not at all put to use, no depreciation. More than 180 days, 100% depreciation will be given. Less than 180 days, 50% depreciation will be given. Please note. If the asset is acquired during the previous year and put to use for less than 180 days in that previous year, then only 50% depreciation will be given for that previous year. Meaning, if an asset is purchased during this year and put to use for less than 180 days in this year, then only 50% depreciation will be given this year. If the asset is purchased in this year and put to use for less than 180 days in next year, then next year you will get 100% depreciation. Section 32(1)(2)(a) talks about additional depreciation. Additional depreciation is given to power people and manufacturing people. Whether you are a power generation, distribution or transmission unit, or you are a manufacturing business, additional depreciation will be given to you. Additional depreciation will be given at the rate of 20%. Additional depreciation will be available only to an assessee who follows WDV method of depreciation. It will be given only if you are following what's a WDV method of depreciation, and additional depreciation will be allowed only on plant and machinery. It will not be given on building, furniture, intangible assets, etc. There are some exceptions also. Additional depreciation will not be given in case it is a second-hand plant and machinery or used plant and machinery, or in case or if it is a vehicle, vessel, ships, etc. Or in case the plant and machinery is installed at residential accommodation or office premises, or it is a plant and machinery for which 100% deduction is allowed under any other provisions of income tax law. Additional depreciation will be allowed in the previous year in which asset is put to use, and if it is put to use for less than 180 days, then 50% of additional depreciation will be allowed in this year, meaning the rate is 20%. So in this first year it will be allowed 10%, and the next 10% will be allowed in the next year. Then now capital gain, section 50 talks about capital gain in case of depreciable assets. Now please note, in case of WDV method of under income tax law, no, the WDV of an asset can be 0, but it can never be negative. Now I'll just tell the crux of under WDV method, when will I get capital gain. Capital gain in case of depreciable assets, cost of asset will always be WDV before sale proceeds, and capital gain will always be short term. In case of depreciable assets, no, the capital gain which you are getting will always be treated as short term capital gain. When will I get a capital gain, sir? You will get a capital gain only when your sale price, if you don't have any assets and the sale price is more than the WDV of the asset. You will get a capital loss when you don't have any assets and your sale price is less than the WDV of assets. Or you may get capital gain in one more scenario, wherein you have assets but no WDV. You have assets but no WDV. In such case, say for example, I don't have any assets and I don't have any WDV. In such cases, I will get what, sir? Depreciation. If I have an assets, if I have no assets but WDV, I may get capital gain. If I have assets but no WDV, then also I may get capital gain. It can be capital gain. It can, when I say capital gain, it can be loss also. Okay. So when can I claim depreciation in case of income tax loss, or only when you have a positive WDV and positive assets. Now in case of SLM method, no, we follow individual asset system. We give the depreciation for each and every asset separately. Now under SLM method, very simple. The logic is very simple. Now whatever the cost is there, whatever the cost of asset is there, check what is the WDV of the asset and what is the cost of the asset. If the asset is sold at a price less than its WDV, then the difference will be treated as terminal depreciation and it will be allowed as business expenses. If the asset is sold at a price more than its WDV but less than cost, then it will be treated as balancing charge and it will be treated as business income in the year of sale of asset. Only when the asset is sold at a price more than its cost, the difference between the sale price and the cost of that asset will be taken as what is, sir? It will be taken as capital gain. It will be taken as capital gain, and the difference between the WDV and the cost will be taken as balancing charge, as business income. Then actual cost, when you are computing the actual cost of an asset, take the purchase price of the asset, add to that purchase price all the expenses which is incurred by you till the asset is put to use. All the expenses incurred by you till the asset is put to use. Add all such expenses, you will get you will get your actual cost. If you have got any benefit for purchase of this asset, such as government subsidies, and if you have sold trial run products, etc., subtract them, you will get your actual cost. Now if while computing this actual cost, if any expenses is incurred by you in excess of 10,000 rupees in a single day for a single to a single person, if you have made that expenses through account pay check, account pay demand draft, or any other electronic clearing system, you can take the benefit. If it is made through any other mode like cash, etc., that deduction will not be allowed. Now, if stock in trade is converted into business asset, then the fair market value of that stock in trade as on the date of conversion will be taken as the actual cost. If the asset is acquired by way of gift or will or inheritance, then the actual cost will be the cost to the previous owner minus depreciation as if it was used for business purpose. Then there are some examples which I have given. In case of building, no, in case of building which was earlier used for personal purpose, now you are using it for business purpose, then the actual cost will be the actual cost of building less notional depreciation as if it was used for business purpose. Now please note this actual cost of this provision of asset which was used for personal purpose now brought into use for business purpose is applicable only for building. This point is applicable for only for building. If there is any other asset which I was using for personal purpose, now I am using it for my business purpose, then the actual cost will be taken as purchase price only. Now, sir, what if asset is purchased for partly business purpose and partly asset is used partly for business purpose and partly for personal use? Then proportionate depreciation only will be given to you. Then there is a concept of unabsorbed depreciation. What is this unabsorbed depreciation, sir? If your current year business income is not able to fully absorb or fully absorb the depreciation, then the unadjusted depreciation will be called as unabsorbed depreciation. This unabsorbed depreciation will be treated as your loss. It is your loss, and this unabsorbed depreciation can be carried forward for indefinite number of years, and it can be adjusted against any type of income except salary income. Then 43A, there is a section called as 43A which talks about consequences for change in rate of exchange in case asset is acquired from outside India. So if you are purchasing an asset from outside India, or you have taken any loan for purchase of that asset from outside India, etc., then it may happen that at the time of making the payment, that at the time of purchase and at the time of making the payment, there may be difference in foreign currency. So you may incur either gain or loss due to this difference. This gain or loss should be adjusted on the cost of the asset. If any gain or loss arises at the time of making the payment for an asset which is acquired from outside India, then such gain or loss shall be adjusted to the cost or WDV of such asset in the year when payment is made. So one example I have given, you can all refer this example. Then next section is section 35. Section 35 talks about what, sir? Scientific research. Scientific research can be of two types. It can be either in-house scientific research, or you may make a donation to scientific research. So in-house scientific research means I am doing research for my own business. Now expenditures incurred by you after commencement of business, or expenses incurred by you before commencement of business, meaning I am already doing a business, and for my business only I am doing scientific research. For example, there is a company called as Lace. Now Lace is already into chips business. Now to make new types of chips, yeah, it is doing research, scientific research. So in that case, it is in-house scientific research. Expenses are incurred after commencement of business. Now before starting the business only, I am a person who is starting a new product. For making that new product, I am incurring scientific research expenses, and I'll start selling that product once my product is ready. So that is expenses incurred before commencement of business. So in-house scientific research means I am doing research for my own business. Expenses incurred after commencement of business, whether it is a revenue expenditure or capital expenditure, 100% deduction will be allowed. But in case of capital expenditure, deduction will not be allowed for land. But if any expenses is incurred before commencement of business, then deduction will be allowed. If any expenditure is incurred before commencement of business, then if it is a capital expenditure, it will be allowed as deduction. 100% deduction will be allowed except on land. If it is a revenue expenditure, then only on material and salary excluding perquisites deduction will be allowed. For any other type of revenue expenditure, deduction will not be allowed. A very important point to be kept in mind is, if you are incurring any expenses before commencement of business, then that expenses should be incurred within 3 years before commencement of business. Now please note, if you have claimed any deduction for any asset under section 35, then you cannot claim depreciation on such asset, because 100% deduction you have claimed. Now sir, what if I purchase land and building together? If you purchase a land and building together, then only fair market value of land, fair market value of land and fair value of building you should check, and only the market value of land building will be allowed as deduction. Fair market value of land should be subtracted, and because for land no deduction is allowed under section 35. Now the unabsorbed capital expenditure is also treated on par with unabsorbed depreciation. It is also available to be carried forwarded for unlimited number of years and be set off like depreciation. Now many times it may happen that I have incurred any capital expenditure and claim deduction under section 35. What will happen if I sell that asset for which I have claimed deduction under section 35? Sale of asset on which deduction has been claimed under section 35. Now following shall be business income. How much will be treated as business income, sir? Your deduction which you have claimed or sale price of the asset, whichever is less. If the sale price is more than cost, then the business income will be cost or deduction which is claimed, whichever cost or business income whichever is higher, or cost or deduction whichever is higher, and capital gain amount will be sale price minus the cost of asset. Will be taken as what, sir? It will be taken as your capital gain amount. Then deduction to research organization or association. Now you are donating the money. Scientific research, two types. You are donating the money for scientific research. You are doing in-house scientific research. In-house scientific research we just now saw. Now, if you're donating the money for scientific research, this is the provision which is applicable. Now, if you're donating to approved research association, approved research institution, college or university for scientific research, social research or statistical research, 100% of whatever amount is donated by you is allowed as deduction to you. You have donated the money to approved Indian company whose business is only doing research and development and they are doing scientific research, then 100% deduction is allowed to you. You are donating the money to national laboratory, IIT, university, etc. for approved scientific research, then 100% deduction is available. Now, please note, deduction will be given to you even if the approval is withdrawn from the institute once you make the donation. Then this is not so relevant. I'll just read it. Section 35 to AB. In-house research and development in case of certain companies. Deduction under this section is allowed only for expenditure incurred for in-house scientific research and development. Conditions: assessee should be a company and he should be in the business of manufacturing or biotechnology. He can take deduction for capital expenditure on 100% deduction can be taken except on land and building, and for revenue expenditure also 100% deduction can be taken by him. Then there are section 35 AD. There are some businesses, list of 14 businesses which are called as specified business, like cold chain business, beekeeping, honey business, or storage of sugar, crude oil, petroleum, natural gas business, or starting an hotel of 2-star or above category, etc. Housing, accommodation, some real development, fertilizer, production of fertilizers, or new infrastructure facility you're having, or you're building and operating a hospital with at least 100 beds, etc. There are totally list of 14 businesses. For these businesses, deduction, these are called as specified business. If you start with the businesses, you will get some deduction. What is that provision telling? Let us see. Now, this section 35 AD says, you can be any type of assessee. If you are engaged in specified businesses, you are going to, and if you incur any capital expenditure for the specified businesses except on land, goodwill and financial institution, then 100% of that expenditure incurred by you will be allowed as deduction under section 35 AD. What is important over here is section 35 AD is an optional section. It is not mandatory that every person who is doing that business should follow 35 AD. It is an optional section. If an assessee feels like following, he can follow. That business under 35 AD should be a new business. It should not be split up or reconstruction of existing business. It should be exactly completely new business. Then the plant and machinery which you are buying in this business should be a new plant and machinery. It should not be an used or second hand plant and machinery. But however, 20% of your total plant and machinery can be used plant and machinery, and imported second hand plant and machinery will also be treated as new plant and machinery only for the purpose of section 35 AD. Now, how much deduction will I get, sir? For capital expenditure, you will get 100% deduction under this section for capital expenditure. Now, if you are incurring the expenses after commencement of business, you can claim the deduction straight away over here. If you have incurred the expenses before commencement of business, then that deduction will be allowed to you in the year in which that deduction will be allowed to you in the year in which business is commenced, provided you have capitalized this expenditure. No double deduction will be given. If you have already claimed deduction under any other section of this income tax law, then no deduction will be given under section 35 AD, and no depreciation will be given for asset which is for whom you have claimed deduction under section 35 AD. Now, whatever asset for which you are claiming deduction under section 35 AD, this asset should be there is a lock-in period that asset should not be transferred within a period of 8 years. If I transfer within a period of 8 years, what will happen, sir? Deemed as business income. Then. Now, set off of losses. What will happen for losses, sir? Set off of losses. 35 AD losses can be set off only with 35 AD business incomes, and this can be carry forwarded for indefinite period. Other points, so if you are incurring any expenses in excess of 10,000 rupees in a single day for a single made to a single person by any mode other than account, paycheck, demand draft or electronic clearing system, then that will not be allowed as deduction. Normally 35 AD businesses should be done only by that person who is deduction will be given to only to that person who is owning that business. But however, in case of hotel businesses, deduction will be given even if the operation is transferred to someone else. Say for example, I have constructed the hotel, I am transferring the operations to Taj. Even in such cases, deduction will be given. Now, petroleum, natural gas pipeline and new infrastructure business should compulsorily be done by Indian company or group of Indian company. New infrastructure will include road, water facilities, sanitization facilities, toll, bridge, rail, highway, etc. 35 AD deduction is allowed only if the books of accounts are audited by a chartered accountant. Okay, section 35D talks about preliminary expenses. Preliminary expenses, what are expenses incurred before commencement of any business. So this deduction will be available only if you are a resident assessee. You can be an individual Indian company or any other type of resident assessee. Expenses which are incurred before commencement of business or after commencement of business for starting a new business or extension of existing business will be covered over here. This 35AD says whatever preliminary expenses are incurred by you will be allowed as deduction for in 5 equal installment from the year in which the business is commenced. Sir, how much deduction will be allowed, sir? Actual expenses or limit. What is the limit, sir? If you are an Indian company, your actual expenses or 5% of capital employed or 5% of cost of project. First take whichever is higher, then compare that with actual expenses. Take whichever is higher, that will be allowed as reduction in 5 equal installments. Then if you are a resident assessee, actual expenses or 5% of cost of project, whichever is less, divided by 5%, 5 years will be allowed as reduction. Capital employed means what's a share capital excluding reserves and surplus, debentures and long-term borrowings. Cost of project means the amount which is invested in fixed assets of that new project. Now, preliminary expenses, lawmaker says only these types of expenses will be called as preliminary expenses. Expenses incurred for preparation of feasibility study reports, expenses incurred for preparation of MOA, AOA, legal expenses, engineer expenses, marketing expenses, and expenses for public issue of shares and debentures. Section 35DDA, expenditure incurred for voluntary retirement scheme will be allowed to all the assessees as deduction, but it will be allowed in 5 equal installment. It will be allowed in what, sir? It will be allowed in 5 equal installment for all the assessees. Then section 36 talks about expenses which are allowed as deduction. If you are an so fantastic section. If you are paying any insurance premium on stocks, health of employees, cattle, etc., it will be allowed as deduction. But if you are paying insurance, health insurance of employees, it will be allowed as deduction only if it is paid by any mode other than cash. If you are giving any bonus commission to your employee, that will be allowed as reduction subject to 43B restrictions. If you are taken any loan and if you are paying any interest on that loan, that interest on loan will be allowed as reduction. If the loan is taken from scheduled bank, cooperative bank, public financial corporation, state industrial corporation, NBFC, state finance corporation, that will be allowed as deduction only if it is paid within the due date of filing return of income. That is, it is restricted subject to the restriction of 43B. If you are paying interest to any other person, that will be allowed as deduction whether it is paid or not. In case of zero coupon bond, if you are amortizing zero coupon bond, the discount on zero coupon bond can be amortized over the useful life of zero coupon bonds. Now, whenever the employer is making a contribution to employees welfare fund, that will be allowed as deduction, provided the fund is recognized. It can be recognized provident fund, approved superannuation fund, approved gratuity fund, approved provident fund, or statutory provident fund, or any other approved welfare fund. This deduction will be allowed subject to the condition of 43B, meaning that should be paid within the due date of filing income tax return. And even in 80 CCD pension fund, the deduction will be allowed. Actual contribution or 10% of salary will be allowed as deductions. Then, sir, what about employees contribution? Employees contribution, see, whatever employees contribution is there, no, first it will be treated as income for the employer, and then deduction will be allowed only if that amount is paid within the due date of that particular act, PF Act, ESIC Act, etc. Employees contribution to PF, superannuation fund, ESIC will be treated as income first, and then a deduction will be allowed only when it is paid within the due date of that particular act. Then bad debts. Bad debts can be related to your business or related to the loan which is given by you. If my business is not giving loan, and if I give loan to someone, and if that someone runs away, it is not a bad debts for me. That will not be allowed as reduction. Okay, if my business is only giving loans, then it is my business, so therefore it will be allowed as deduction. So the bad debts, if it is business related bad debts, for example, I have sold, I am into sari business, I have sold sari to someone. Now he has not paid the money, so this is my business related bad debts. It is allowed as deduction. It will be allowed as deduction only if two conditions are satisfied: that debt should be treated as income in some year, and that debt should be written off in my books of accounts. Please note, provision for bad debts is not allowed as deduction under income tax law. Now, recovery of bad debts will be taxable in the year in which it is recovered. It will be taxable as business income. Section then family planning expenses. If you are incurring any expenses for family planning, then that expenses will be allowed as deduction only if you are in company. If it is a revenue expenditure, 100% will be allowed as deduction, and if it is a capital expenditure, it will be allowed as deduction in 5 equal installment. In case of any animals which becomes dead or permanently useless, the deduction will be allowed. The deduction which will be allowed will be the cost of that animal minus scrap value. And security transaction tax and commodity transaction tax will also be allowed as deduction if you are into trading business, intraday trading business. Please note, I am covering only all the important points. Okay. Obviously, if you see PGBP chapter, there will be many other sections which are there. Section 33A, B, AA, etc. All these sections from exam point of view is not relevant. Okay. So I'm covering only all the important sections. Then section 37 talks about all other types of deductions. Now section 32, section 30, section 36 talks about, they have given the list of expenses. Any other type of expenses will be covered under section 37. This talks about general deduction. This section allows deduction for all other types of business expenses. However, business loss are not covered over here. Now, what is this section telling? Section 37 says, if there is any expenses which is not specifically covered from section 30 to 36, then that expenses is wholly and exclusively for your business purpose, and that expenses is not of personal nature, and that expenses is not of capital nature, and that expenses is not for an offense which is prohibited by law, then that expenses will be allowed as deduction. Now, if there is any penalty you are paying because of breach of law, it will be allowed as deduction. Ulta I have written. If there is a penalty which you are paying for breach of law, it is not allowed as deduction because it is a offense committed by you. If it is for breach of contract, it will be allowed as deduction. Then salary which is paid to employees will be allowed as business expenses deduction. Salary paid to partners, if it is a working partner, allowed. Sleeping partner, not allowed. Director of a company, allowed. Leave salary is also allowed as deduction. Now, insurance premium, life insurance premium paid is never allowed as deduction. Keyman insurance is allowed. Health insurance, stock insurance, etc. will be allowed. Advertisement expenses is normally allowed as deduction. But however, if you are doing advertisement in newspaper, pamphlet, brochure, etc., which is owned by a political party, it will not be allowed as deduction. Now, if you are incurring any CSR spends, corporate social responsibility expenses, it will not be allowed as deduction. Now, any expenses you incur related to your income tax law, direct taxes will never be allowed as deduction, including the direct tax, interest, penalty, etc. But if it is related to indirect taxes, the tax amount and interest amount will be allowed as deduction subject to 43B restriction. But any penalty is never allowed as deduction. All other type of expenses like telephone expenses, internet expenses, printing and stationery, or audit fees, etc., they are all allowed as deduction under this particular section. Then section 40, it gives a list of expenses which are specifically disallowed. These expenses are never allowed to you. It is specifically disallowed. Section 40A1 says, if you are paying any interest, technical fees or royalty outside India or to a non-resident or foreign company in India, where you have not deducted the TDS in the previous year, or you have deducted the TDS in the previous year but not remitted to the government within the period of filing income tax return under section 139(1), then 100% of that expenses will be disallowed. Now, similarly, if you are paying any sum to a resident where TDS is not deducted by you during the previous year, or after deducting the TDS in the previous year not remitted to the government, then 30% of such expenses will be disallowed. If it is non-resident or foreign company, 100%. If it is resident, then it is 30% of expenses will be disallowed. However, these expenses will be allowed in subsequently once the TDS has been paid by you or deposited by you with the government. And it will also be allowed as deduction if the recipient has considered that income in his books and paid the taxes on that amount. In such cases, it will be allowed as deduction. If the recipient has considered and paid the taxes, it will be allowed as deduction in the year in which he has paid the taxes to the government. Now, no deduction will be allowed for income tax which you are paying, for surcharge and cess which you are paying. So, if you are a person who is doing a business and you are paying tax, income tax for that business income, etc., not allowed as deduction. Wealth tax also not allowed as deduction. Then any royalty which is paid by state government undertaking to the state government, not allowed as deduction. Then any salary, very important, any salary payable outside India or to a non-resident in India where TDS is not deducted, or after deducting TDS it is not paid to the government within the due date of filing income tax return, 100% of such expenses will be disallowed. Then 40A4 says, any contribution made to any provident fund or any other welfare fund of employees where TDS arrangement is not made at the time of payment from this fund will be disallowed. And 40A5 says, any tax on non-monetary perquisites actually paid by the employer on behalf of employee will not be allowed as deduction for the employer. 40B talks about remuneration and interest to paid by partnership firm to partners. 40B. Remuneration means salary, wages, bonus, commission, etc. And interest means interest on capital or interest on loan. This remuneration and interest will be allowed as deduction only when it is authorized or mentioned in partnership deed. If it is not mentioned in partnership deed, it will not be allowed as deduction. If you don't have a partnership deed, it is not allowed as deduction. Remuneration and interest will be allowed prospectively and not retrospectively. Now, how much is the deduction allowed, sir, for remuneration and interest, sir? Now, this remuneration and interest will be allowed. Remuneration will be allowed only if you are a working partner. Interest will be allowed for both working as well as sleeping partner. Remuneration will never be allowed for sleeping partner. How much interest will be allowed as deduction, sir? Maximum 12% per annum will be allowed as deduction. This 12% is for each partner. If it is more than 12%, it will be restricted to 12%. If it is less than 12%, then whatever that lesser rate is there, that will be the interest allowed as deduction. Remuneration paid to the partners is allowed subject to it is calculated based on the book profit. Remuneration is allowed on book profit. So if the book profit of the company, of the partnership firm is up, or LLP is up to 3 lakh rupees, then 90% of book profit, if the book up to 3 lakh rupees of your book profit, 90% of the book profit or rupees 1.5 lakhs, whichever is higher, will be allowed as deduction. More than 3 lakh rupees, balance book profit, whatever balance book profit is there, more than 3 lakhs into 60%. So combine both of this, that is the total deduction which you can claim under 40B for remuneration. Now, how do I calculate book profit, sir? Take your net profit as per PGBP before interest and remuneration, then give interest as per 40B, you will get your book profit. Now, please note, with respect to partners, there is one important point which you should note. Whatever share in profit they get from partnership firm, it is exempt under section 10(2)(a). Now, they partners also get interest and remuneration. If it is within the limit of 40B, then that interest and remuneration is treated as expenses for the company, and it will be taxable in the hands of partners as business income. If the interest and remuneration which they are getting is more than the limit of 40B, then up to that limit will be allowed as deduction for the company and also treated as business income. And if it is more than the limit of 40B, it is disallowed for the firm and not be taxed in the hands of partnership partners. It will not be taxable in the hands of partners if it is more than the limit, because it is already tax is paid by the company on that. Now, 48, very important section, which says unreasonable or excess payment made to related. If any unreasonable or excess payment is made by the business to the related person, then that excess amount will be disallowed. 40A3 says, if any assessee makes a payment for a single expenditure to a single person in a single day in excess of rupees 10,000 by any mode other than account paid check, account paid demand draft, or any other electronic clearing system, then that will be disallowed. How much will be disallowed, sir? 50. It will be fully disallowed. This limit is 35,000 rupees in case you are a transporter, if you are making a payment to transporter. 43B gives the list of different expenses which will be allowed as deduction only if that expenses is paid within the due date of filing income tax return. The due date of filing income tax return in normal cases is 31st of July of assessment year, and in case of company or in case of audit assesses, it is 31st of October of assessment year. So there are some expenses which will be allowed as deduction only if the payment is made within this time. Which are these expenses, sir? If you are paying any tax, duty, cess under any law for the time in force, bonus or commission paid to the employees, employer's contribution to statutory provident fund or recognized provident fund, approved gratuity fund, etc. Basically approved fund, leave salary or leave encashment which you are paying, or interest on loan from scheduled bank, public financial corporation, etc., or any other sum payable to Indian Railway for using railway assets. Now, please note, if the above pay amount is made after the due date, what will happen, sir? Then it will be allowed in next year, in the year in which payment is made. And interest payable, if the interest payable is converted into a loan, then it will be allowed as deduction as in when you are paying the installments. Now, the PGBP questions can be solved in two methods, sir. One is direct method, another one is indirect method. Direct method, what you have to do, take all the incomes, take all the expenses. Take all the incomes, from that incomes as per PGBP, which is as per section 28 and 41, and reduce all the expenses from section 30 to section 37, you will get your business income. But one more method which is normally asked in examination is indirect method. What they will do in indirect method, sir, they will give you profit and loss account as per books, as per accounts. They will give you P&L account. Now, from that P&L account, it should be followed when profit and loss account is given in the question, or when net profit or loss and additional information is given. Now, what you are supposed to do, sir? Take the profit as per books of accounts, add all the expenses which is not allowed under income tax law, but which is there in profit and loss account. Add all the incomes which are required to be added in which are required to be considered while computing business income but not added in our profit and loss account. Subtract expenses which is allowed as per our income tax law but which is not taken in our profit and loss account, and also subtract all the incomes which are required to be considered separately. For example, if other type of incomes are there, all other incomes except business income, if they are already given in profit and loss account, subtract those things, you will get your business income. Then we have something called as presumptive taxation, presumptive scheme. Section 44AD, 44AD and 44AE. 44AD says presumptive taxation for whom, sir? 44AD talks about presumptive taxation for business or non-professional, non-specified profession. If you are a resident individual, HUF or a partnership firm, except limited liability partnership, and doing any business or non-specified profession excluding agency business, commission business, or if you are covered under 44ADA and 44AE, then, and if your total turnover is up to 1 crore rupees, then you can pay the tax on presumptive basis. Your income will be presumed, your business income will be presumed to be 8% of your turnover or 6% of turnover. This will be your business income. 8% of turnover or 6% of turnover. 6% of turnover will be taken if you have received the sale proceeds in the previous year by any mode as account pay check, account pay demand draft or electronic clearing system within the due date of 139(1). If you receive the money within the due date under 139(1) by account pay check, account pay demand draft or electronic clearing system such as UPI, net banking, debit card, credit card, etc., then in such cases I'll take 6% of turnover. If it is not received in these modes, then 8% of turnover will be taken. I have done a computation of how to do this computation. Presumptive basis. Please note, whatever this 8% and 6% is your business income. Total of this is what's your business income. That is your business income. On that you have to compute the tax. Now please note, this presumptive basis says I will not give you any extra expenses, etc. 8% is your business income. Whatever you have not taken, 92%, no, that is deemed as expenses, business expenses. Note, no deduction under section 30 to 37 will be allowed for expenses. 40B benefit in case of partnership firm also will not be allowed. Sir, it says only 8% or 6%. If I want to claim higher income, can I claim higher income, sir? Yes. Higher income can be declared by an assessee. If an assessee wants to declare higher income, he can always declare the higher income. If the assessee wants to declare PGBP income lower than the rate specified under 44AD, sir, what if I want to declare lower income? In such cases, you should maintain books of accounts and get it audited by a chartered accountant or cost accountant. See, normally when you are paying the tax under, when you are computing your business income under presumptive basis, no, you need not maintain books of accounts also. But if you want to claim lower income, then you will have to do what, sir? Then you will have to get your books of accounts audited by a chartered accountant, also maintain books of accounts. Now, on this, whatever income is there, chapter 6A deduction will always be allowed. Brought forward business loss also can be set off with this income. Now, please note, there is a lock-in period. If you are a person who is doing a business and if you have opted for presumptive to pay tax under presumptive case, presumptive basis. Now, if you have opted for 1 year, no, for next 5 years, you should follow presumptive scheme only. But in next 5 years, in any of the years, if you opt out of presumptive scheme, then for next 5 years, you will not be eligible to become a, you will not be eligible to pay tax under presumptive basis. For example, year 1, I opted for presumptive basis. For next 5 years, I should be presumptive only. But in year 3, I opted out of presumptive basis. For next 5 years, I will not be eligible to opt for presumptive scheme. Then 44ADA, presumptive schemes for specified professionals. Specified professions, they have given list of professions. I lift come. What is this I lift come? If you are a chartered accountant, cost accountant, or you are an architect, interior designer, legal professions, then IT professionals, then film artist, or T for technical professions, company secretary, medical profession, or you are an engineer. In such cases, you will be covered under 44ADA. If you are it is applicable only if you are a resident or a partnership firm excluding LLP. If your gross receipts is up to 50 lakh rupees, only if your gross receipts is up to 50 lakh rupees. What will be your income, sir? Your income will be equal to gross receipts into 50%. Note, no deduction under section 30 to 37 will be given. All the points which you studied over there is also applicable over here. 40B deduction will not be given in case you are a partnership firm. Higher income can be claimed if the assessee wants to claim an higher income. Now, please note here, whatever your gross receipts is there into 50%. There it was 8%, 6%. Here they are telling 50% is treated as your business income. Then if you want to claim lower income, then you will have to maintain books of accounts and get it audited by chartered accountant or cost accountant. Chapter 6A deduction is also allowed against this income. Brought forward losses can also be set off against this income. Then most asked question under presumptive basis is 44A. If you are a transporter or goods carriage businessman. Section 44AE is applicable for a transporter or goods carriage businessman. It is applicable for all type of assessee, whether you are an individual, HO firm, AOPBI, etc. It does not matter. You should be involved in the business of playing, hiring, leasing of goods carriage, and you should be having up to 10 trucks at any time during the previous year. Meaning, if you have more than 10 trucks at even one day of the previous year, this benefit is not available to you. Now, so these trucks which you have, these vehicles, goods carriage which you have, should be divided into two categories. One is heavy goods vehicle and other goods vehicle. Heavy goods vehicle means what are those vehicles whose gross vehicle weight is more than 12 tons or 12,000 kgs. So in such cases, the presumptive income for one vehicle will be taken as ₹1,000 per ton per vehicle for every month or part thereof. So ₹1,000 per vehicle per ton will be taken. And if the vehicle is a light vehicle, it is not a heavy goods vehicle, other type of vehicle, then the business income which will be taken for one vehicle will be 7,500 per month per vehicle or part thereof. Now month over here should be considered from the date of purchase and not from the date when the asset is put to use. From the date when the asset is purchased should be taken. Now the last point for our discussion under PGBP is section 40, the books of accounts, etc. point. Section 44 AA, maintenance of books of accounts. Specified professionals, I lift come. So specified professionals should maintain books of accounts if their gross receipts is more than 1.5 lakhs in preceding 3 financial years. That is, in all the 3 financial years, last 3 financial years, if it is more than 1.5 lakhs, they should maintain books of accounts. Or if you are a new company and your expected turnover this year is more if your expected gross receipts in this year is going to be more than 3.5 lakhs, you should maintain books of accounts. What books of accounts should I maintain? Books of accounts specified in rule number 6F, which are cash book, journal, ledger, carbon copy of bills less than 25 rupees, original copies of bills whose value is more than 50 rupees. And if you are a medical professionals, then daily case register along with stock register should be maintained. But sir, what if my gross receipts for all the last 3 years is less than 1.5 lakhs, or my expected gross receipt in this year is going to be less than 1.5 lakhs? Then you don't maintain these books of accounts, but maintain such kind of books of accounts by which your income tax computation can be done by the assessing officer. If you are a person who is not a specified professions, or if you are carrying out any business, you are a non-specified professions or you are doing any business, then you will have to maintain your books of accounts if your profit is more than 1.2 lakhs or your turnover is more than 10 lakhs in any of the 3 preceding financial years. In case you are an individual and HUF, then the limit for you is if your profit is more than 2.5 lakhs and your turnover is more than 25 lakhs, then only you should maintain your books of accounts. For new businesses, your profit is likely to exceed 2.5 lakhs in the current year, or your turnover is likely to exceed 25 lakhs, you will have to maintain your books of accounts. Maintain books which will enable the assessee to compute the tax. Sir, what if my profit is not more than 1.2 lakhs or turnover is not more than 10 lakhs, and in case of individual and HUF, my profit is not more than 2.5 lakhs or turnover is not more than 25 lakhs, sir? In such case, don't maintain any books of account at all. Now, please note, you are required to get your books of accounts also audited. Who should audit? Who will audit these books of accounts? A chartered accountant or cost accountant. Section 44AB, audit of books of accounts. The business, in case of business, if the turnover or gross receipts of the business is more than 1 crore, you are required to get your books of accounts audited. However, the limit will be 10 crores if the total cash receipts and cash payment is less than 5% of the total receipts and payment. In case you are a professional, then this limit is 50 lakhs. Instead of 1 crore, the limit is 50 lakhs. And this limit will be 75 lakhs. This limit will be what, sir? 75 lakhs if your total cash receipts and total cash payments is less than 5% of total receipts and payment. Now, the persons who are covered under presumptive scheme may also require to get their books of accounts audited if they want to claim their PGBP income lower than the limit specified under 44AE, 44ADA or 44AD. Now, what if I don't get my books of accounts audited, sir? You will have to pay a penalty of 0.5% of turnover or 1.5 lakhs, whichever is less. This is all about your PGBP. Fantastic discussion we have done. Now, after this, what is left over, sir? Procedural aspects are left over. What is left over for our discussion? Only procedural aspects are left over. Only procedural aspects, meaning all chota topic. We have clubbing of income, set of carry forward, then deductions, then yeah, these topics are there. Then we have TDS, TCS. Then our income tax topic will be over. So let us take a short break and continue our discussion. So students, welcome back. So let us continue our discussion. So we have completed the discussion on all the different types of heads of income. Now with respect to heads of income, a question can be separately asked with respect to each of these heads of income, or there may be a question which is with respect to computation of total income, wherein 2-3 heads of income questions will be combined. 2-3 heads of income will be there in that. Apart from that, in that you may also have some provisions with respect to other 3 chapters which are left over for understanding total income, which is clubbing of income, then set off and carry forward, and deductions under chapter 6A. So heads of income along with these 3 chapters, heads of income along with this clubbing, set off, carry forward, and deductions under chapter 6A will form part of our total income topic. So now we have completed the discussion on heads of income. Let us now discuss these 3 topics before going to the other topics under income tax law. So income of other person included in assessee's total income. So income is earned by someone else, but it will be included in the assessee's total income. In simple words, it is called as what, sir? Clubbing of income. Now section 60 to section 64 talks about clubbing of income. Section 60 says if you transfer any income without transferring of an asset, if you transfer any income without transferring that asset, if you transfer only the income but not transferring the asset, then whatever income is received by that person, no, that will be clubbed in your hands. Transfer of an income without transfer of asset will be clubbed. For example, I have an FD of 10 lakh rupees. Now I have an FD of 10 lakh rupees from which I am getting an interest of 6%. This FD is of 10 lakh rupees from which I am getting an interest of 6%. This FD, the FD interest which I get is 60,000. Now what I have done is one of my students I have transferred what, sir? This income, interest income is transferred by me to one of the students, meaning this 60,000 interest which I was supposed to receive, I am not going to receive, it is received by my student. Have I transferred the FD, sir? No, I have not transferred the asset. I have only transferred the income which is received from that asset. Now in such case, lawmaker says though Mr. Gopal is receiving the interest, no Mr. Dilip, it will be clubbed in your hands. Section 60 says if you transfer in any income without transferring the asset, then that income will be clubbed in the hands of the transferee, that is transferor. Section 61 talks about revocable transfer. What is revocable transfer, sir? Revocable transfer is that kind of transfer wherein the person who is transferring, no, will have the right back to take that transferred asset. For example, I am giving you this mobile phone. I am giving you this mobile phone with a condition that in future, if I want, I will take back this mobile phone from you. This is called as what's a revocable transfer. Say for example, I have an asset. Now please note, in the previous case, I have not transferred the asset. I have just transferred the income out of the asset. Now what is happening? I have transferred the asset only. I have transferred the asset. Say for example, I have an house. This house is transferred by me to one of my student Akhil. I have transferred this house to one of my student Akhil with a condition that in future, if I want, I'll take back this house from you. In future, if I want to take back this house, I will take back this house from you. Now please note, who is the owner of this house? Akhil is the owner of this house, correct? Who is going to receive the rental income? Akhil is going to receive the rental income. Lawmaker says Mr. Dilip. Even in such cases, whatever rental income Mr. Akhil is receiving, no, it will be clubbed in your hands. Sir, why, sir, it will be clubbed in your hands, sir? Because I have transferred an asset with a condition that I have the power to take back this asset from the transferee on a future date. So this is called as revocable transfer, a type of transfer wherein the asset which is transferred can be revoked back, can be taken back. In such cases, whatever income is received on that asset, no, will be clubbed in the hands of the transferor. Now, however, there are 2 exceptions for revocable transfers. What are these exceptions, sir? If it is an irrevocable transfer, then this concept shall not apply. What do you mean by irrevocable transfer? I have transferred this asset to Akhil and I have told you only keep this asset, I will never take this asset from you. So this is what, sir, this is my revocable transfer. Whenever there is a revocable irrevocable transfer, wherein I will not take back the asset on a future date, so Akhil is only the owner of this asset from today. So in such cases it will not be clubbed. Or whenever there is a transfer with a condition that it will become revocable upon death of the transferee. Or say for example, I transfer the asset and tell him that, see sir, it will come back to me only if you die. It will come back to me only if you die. So sir, what will happen if you die before that? Then obviously it is not going to come back to me. So if it is a revocable transfer upon death of the transferee, then also what will happen, sir? Clubbing provisions will not apply. Normally, if you transfer any asset and that type of transfer is a revocable transfer, always clubbing provisions will apply. However, there are exceptions, irrevocable transfer, and if the transfer is with a condition that it becomes revocable on a future date. So what will happen in these two cases? In these two cases, it will be taxed. Whatever income which is derived from the transferred asset will be taxed in the hands of the transferee itself. Then section 64 talks about what, sir? Asset transferred to spouse or son's wife. If you are transferring any asset to spouse, your, say for example, for me it will be my wife, or for any female it will be her husband, etc. So if you are transferring any asset without transferring, so if you are transferring any asset to your spouse or your son's wife means what, sir? Your daughter-in-law. In such cases, lawmaker says, if any individual transfers an asset to his or her spouse or daughter-in-law without any consideration, I am transferring the asset to my wife without any consideration. I am transferring any asset to my wife for inadequate consideration. Okay, please note, for wife as well as for your spouse as well as son's wife, both the points are same. So I'll talk from my wife angle. Okay, so if an individual transfers any asset, to his spouse without any consideration, for free of cost, if I am transferring an asset to my wife, or for inadequate consideration for a lesser price, say 1 crore rupees asset I am transferring only for 1 rupees, 1 crore rupees asset I am transferring only for 100 rupees. So if any individual transfers any asset to his or her spouse without any consideration or for inadequate consideration, then the income, then what will happen, sir? The income from such transferred asset will be clubbed in the hands of the transferor. Then whatever income my wife is going to derive from that asset, no, it will be clubbed in my hands. It will be clubbed in whose hands, sir? In the hands of the transferor. So note what is very important over here. The marriage should exist at the time when you are transferring the asset as well as at the time when the income is received. Your marriage should be existing, meaning you both should be in that marriage relationship. You should both be husband wife at the time when the asset is transferred and at the time when income is received. And above provision shall not apply, meaning this transfer provision will not apply whenever there is a divorce or in case of agreement to live apart. If they agree not to take divorce but they agree to live apart, meaning they agree not to live together. Now please note, clubbing provisions under 64 shall not apply for transfer of house property to spouse, meaning if you are transferring an house property to spouse, no, section 22 will be applicable. If you are transferring the house property, what will be applicable, sir? Section 22 will be applicable. If you are transferring a house property, section 22 will be applicable. Section 27 deemed owner concept will be applicable. Section 27 will be applicable and not section 64, because section 27 talks about deemed owner. This specifically applicable for deemed owner provisions. Now let me just give an example. Say for example, I have transferred a car to my wife. She is getting rental income by giving this car on rent. It will be clubbed in my hands. I have transferred shares of Reliance Industry to my wife. She is getting a dividend. That will be clubbed in my hands. She sold the shares and she is getting capital gain for that. It will be clubbed in my hands. I have given a FD to my wife of rupees 10 lakhs and she has closed the FD. Whatever FD interest she is receiving, obviously it will be clubbed in my hands. Now say for example, she has closed this FD and she has encashed this FD. From this FD, she is purchasing a car and she is earning, she is giving this car on rent and she is earning a rent of rupees 1 lakh. In this case also, whatever rent she is earning by this car, no, that also will be clubbed. But sir, you had given the FD, no sir? Yes. Lawmaker says you gave something. Now the transferred asset is changed in any other form. Whatever income she is deriving from the change form also will be clubbed. Say for example, I gave an FD of 1 crore and she is receiving an interest of that FD. Obviously, it will be clubbed in my hands. Now she has closed this FD and she received 1 crore and she invested her own money of 50 lakh rupees. Now from this 1.5 crore she has purchased a house. From this 1.5 crores, what she has done, sir, she has purchased a house. Now she is receiving a rent of 5 lakh rupees from this house. She is receiving a rent of how much, sir? 5 lakh rupees. Now lawmaker says, Mr. Dilip, this house owner is your wife, correct? This house belongs to your wife, but then the income which is received from this house will also be clubbed in your hands. How, sir? Because this house was purchased by her by putting your money also. So 5 lakh into 1 crore divided by 1.5 crores, 3,33,333 rupees will be taxable in your hands, and the balance amount will be taxable in the hands of wife. Okay, so it does not matter if the changed asset is also if the asset which you are transferring is changed in any other form also. Now here one very important point. Please understand this carefully. One fantastic point I'll tell you. Say I have given shares of Reliance Industry to my wife. Whatever dividend she is getting, obviously it will be clubbed in my hands. She sold the shares, she got a capital gain of 5 lakh rupees, that also will be clubbed in my hands. Now please note, I gave asset worth rupees 10 lakhs, she sold it and got a capital gain of 15 lakhs. Now along with this 15 lakhs, she has invested her own money of 10 lakhs, and for 25 lakhs she has purchased a car. From this car she is earning a rent of 6 lakh rupees. Now in this case, sir, in this case how much clubbing will happen? In this case how much clubbing will happen? 6 lakhs into 6 lakhs is the rental income into 10 lakhs which is given by me divided by 25 lakhs. 6 lakhs into 10 lakhs by 25 lakhs. But sir, she earned 5 lakh rupees from your money. No sir, yeah, that should not be clubbed. Lawmaker says only whatever is transferred by you, only to that proportion what is transferred by you will be clubbed. If using the transferred asset any income is generated, no, whatever income is generated by using the transferred asset, from that income, if any income is generated, that will not be clubbed. Only what is transferred by you, that value of income only will be clubbed in your hands. Next is what, sir? Example number 6. Now please understand. So there is my student Sagar. Sagar has a friend. Now Sagar has a friend. She has given a FD of 5 lakhs to friends. So this FD interest will it be clubbed in the hands of Sagar? No. When she became girlfriend, he gave shares of Reliance Industry. That will also not be clubbed. When she became her fiance, he gave her a car. That rental income also will not be clubbed. Meaning what, sir? Meaning what? Whatever asset you are transferring, no, whatever asset you are transferring to your spouse only will be clubbed, or son's wife will be clubbed. It does not matter. It does not matter. Please note. Whatever assets are transferred to you, to your future wife will never be clubbed in your hands. It will never be clubbed in your hands. Once she becomes wife, after that you transfer, yes, it will be clubbed. So what is the provision telling? At the time of marriage as well as at the time of receipt of income, your marriage should exist. Now similarly, sometimes what may happen is, I have given the money to my wife and she has invested that money in her business. Now the question is, whatever profit she is going to gain from her business, will it be added? Will it be clubbed in my hands? Lawmaker says yes. Whatever profit is earned by an assessee from the income, from the money which is given by his or her spouse, will also be taxable in the hands of that person who has given the money, provided that amount is included on the first day of the previous year. It is included in the opening capital of the assessee, provided that it is included in the opening capital of the assessee. Note, business income will be clubbed in the hands of Nora on the basis of, now business income will be clubbed. So it is reference to this example. So business income will be clubbed in the hands of spouse on the basis of capital employed by her only if such capital is employed on the first day of the previous year. Only if that capital is there in that, only if that money is there in the capital as on first day of previous year. That is opening capital. That is what, sir? Opening capital or capital as on 1/4/2001, 1/4 of April should include spouse money to attract the clubbing provisions. So in case that money is invested in your business, clubbing provision will be attracted only if that money is there in your opening capital. Then section 64(1)(2). Income of spouse from a concern where assessee has substantial interest. So say for example, there is a company wherein I have substantial interest. This company is paying money to my wife. In such cases, it will be clubbed in my hands. So what do you mean by substantial interest? So substantial interest means if you have 20% or more voting rights or profit sharing ratio or equity shareholding. If you have 20% or more of voting rights or profit sharing ratio or equity holding in any concern, then it is said that you have substantial interest in that concern. So what is this telling? Section 64 subsection 1 clause 2 says, where any remuneration is paid by a concern, it can be a partnership firm, private limited company, public limited company, LLP, etc., 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 anything, okay, where any remuneration is paid by a concern in which assessee has substantial interest to the spouse of such assessee, even when the spouse does not have professional and technical qualification. So this provision will be applicable when, sir? This provision says that if any remuneration is paid by a concern where assessee has substantial interest. So concern is paying remuneration to whom, sir? Spouse of the assessee. Concern is paying, say I have substantial interest in the company, so this company is paying money to my wife, this concern is paying money to my spouse even when she does not have any professional technical qualification. Lawmaker says this money which wife has received, that will be clubbed in my hands. Where any remuneration is paid to any concern in which the assessee has substantial interest to the spouse of such assessee, even when the spouse does not have any professional or technical qualification, then such remuneration shall be clubbed in the hands of such individual. That remuneration will be clubbed in the hands of such individual. Okay, then that remuneration will be clubbed in the hands of individuals. So, say for example, Akshay Kumar has substantial interest in Dharma Productions. There is a company. Now, please note, substantial interest can be mine. Okay, substantial interest. When I say substantial interest, no, that substantial interest should be seen of an assessee. Including the investment or including the investment of his or her relative, which includes brother, sister, spouse, lenient resident and lenient dissident. For example, this 24% investment I have, Akshay Kumar has 24% profit sharing ratio or equity shareholding in a company called as Dharma Production. Dharma Production is paying money to Twinkle of 5 lakh rupees, who's spouse of Akshay Kumar. In such case, she does not have any professional technical qualification. It will be clubbed in the hands of Akshay Kumar. What if Twinkle has professional or technical qualification? No clubbing will happen. Sir, what if both of you have substantial interest? Say for example, Dharma Production is there. Akshay Kumar has 12% stake and Twinkle also has 12% stake. So if I say Akshay Kumar is also having substantial interest because stake will be 24% and Twinkle also has substantial interest because stake is 24%, because we are supposed to see substantial interest by seeing the investment of that assessee along with his relative, correct? Now say for example both of in this case what is happening, both have substantial interest and both do not have any professional technical qualification, and this concern is paying money to the both of them. Sir, in this case clubbing provisions will apply. Yeah, wo sir solunga sir, tell me sir, bolo sir, wo sir, hey sir, in this case will clubbing provisions apply? Answer is yes, in this case also clubbing provisions will apply. Sir, in whose hands will it be clubbed, sir? It will be clubbed in the hands of that assessees whose total income is more before applying these clubbing provisions. So before applying these clubbing provisions, clubbing shall be done with that assessee whose total income is more before applying the clubbing provisions. Sir, what if they both don't have any other income? Oh sir, if both the spouse have substantial interest and both of them are receiving the remuneration from the concern and they both have they do not have any other incomes, then no clubbing shall be done. If both of them don't have any other type of income, then clubbing provision shall not apply. Then last point in our clubbing topic is what, sir? Section 64 1A, income of minor child. Minor child's income will be clubbed in the hands of that parent will be clubbed in the hands of his or her parent. Any income earned by a minor child shall be clubbed in the hands of his or her parent. The clubbing will happen. The clubbing will be done in the hands of that parent whose total income is higher before applying the clubbing provisions of this minor's income. So before applying the clubbing provisions of minor's income, whosoever parent's total income is higher, in that parent's hand minor's income will be clubbed. Once income is clubbed in the hands of any parent in a previous year, then all the subsequent in all the subsequent year the income will be clubbed in the hands of that single parent only. Meaning every year you don't have to see which parent's income is high, low, etc. Once you apply the clubbing provisions, for future years also you should apply. You should club in the same parent only. Now exceptions. The following income will be not. The following incomes will not be clubbed. Which income, sir? Income which is earned by skill and talent of minor child, or knowledge of minor child. Income which is earned by manual work of minor child, or if he is a ATU disability minor child. If the minor child is what, sir? If he is a ATU disability minor child. Further, in whosever parent's hand the minor child income is clubbed, no, that parent will get an exemption under section 1032. How much exemption will get, sir? That parent will get an exemption. Parent in whose hands minor child income is clubbed will get an exemption of rupees 1,500 per minor child per annum. For every minor child, you will get an exemption of how much, sir? 1,500 rupees. Now, please note, it does not, irrespective of the number of children you have, it does not matter how many children you have, irrespective of number of children you have, this clubbing will apply. Now, please understand this carefully. Minor child will include your own child, your stepchild, or your legally adopted child. Minor child will include minor married daughter as well as minor married son. Minor child, now please note this clubbing provision. In case of divorce, no, the clubbing will be done in the hands of that parent who is maintaining the child. If divorce happens between husband and wife, between the parents, then it will be clubbed in the hands of that parent in whose hands what is there, sir? Who is maintaining that parent. Now, next is what, sir? Set off and carry forward. Fantastic topic, very easy topic. Very small topic, yet very important topic from exam point of view. Set off and carry forward. Set off and carry forward. Set off means adjustment. Set off means what, sir? Adjustment. Set off means what, sir? Adjustment. Set off means adjustment of losses. If you are adjusting your losses against the income which you have, then it is called a set off. Set off means adjustment of losses against income. There are two types of set off. One is called as intra-head set off. Another one is called as inter-head set off. Intra-head set off means what, sir? Setting of loss of under one head with income of that same head. I have two houses. I am setting off loss of one house with profit of another house or income of another house. This is intra-head set off. Inter-head set off means what, sir? Setting of loss of one head with income of different head. Income of different head. House property loss is set off with salary. So set off can be of two types: intra-head set off and inter-head set off. Intra-head set off means what, sir? Loss of a particular head if is adjusted or set off with profit of same head. Inter-head means loss of a particular head is adjusted with income of another head. Now we also have something called as carry forward and set off. We have something called as what, sir? Carry forward and set off. Your carry forwarding and your setting off. Sir, what do you mean by this? Meaning, if you are in the current year, you are not able to fully adjust your losses, what will you do? You will carry forward that losses to future year. What will you do, sir? You are going to carry forward that losses to future years. Once you carry forward that losses to future years, in future years, you are going to adjust that losses. This is called as what, sir? Set off and carry forward. This is called as what, sir? Carry forward and set off of losses. This is called as carry forward and set off of losses. So if the current year losses cannot be fully completely adjusted in the with current year income, then such losses will then such unadjusted losses will be carried forward and adjusted in subsequent years. Now let us see what are these set off and carry forward provisions. Now what I will do is individual head wise I will tell you whether what will happen in case of intra head set off and what will happen in case of inter head set off. Then we will see about carry forward. Now please note, income from salary. Now, normally loss under salary is not possible. Therefore, the question of setting of losses of salary, say I am working in two companies, one company I am making a loss under salary, another company I am making a profit under salary is not possible. So, the question of intra-head set off will not come. Income from house property. Income from house property, I may have 2-3 houses. One of the houses is giving me income and other 2 houses are giving me losses. In such cases, can I set off this incomes of house property, sir? Intra-head adjustment, can I do, sir? Answer is yes. Intra-head adjustment of loss from one house property, intra-head adjustment of loss from one house property can be done with income of another house property. For example, I have house number 1 which is giving me a loss, house number 2 is giving an income of 5 lakh rupees, house 3 is giving me an income of 1 lakh rupees. So my net income from house property will be 2 lakh rupees. So I can do this set off. Then for business and profession, now please note, for the purpose of set off and carry forward, let us divide business into 3 categories. One is your normal business, one is your speculation business, another one is your 35 AD business or specified business. Normal business means what, sir? All the different types of business you are seeing around you is normal business. Speculation business means what, sir? Buying and selling of shares without taking the actual delivery. And section 35 AD business or specified business means what, sir? That 14 business, honey business, hotel business, hospital business, etc. Now please note, Normal business, for example, sari business, kirana stores, shoe business, manufacturing business, wholesale business, chartered accountant, doctor, cost accountant, etc. all will come under this normal business. Now, what is the provision saying? If you have any normal business loss, that normal business loss can be adjusted with any type of business income. Normal business loss can be adjusted with any type of business income. For example, I have a profit in sari business and loss in shoe business. Can this adjustment be possible, sir? Answer is yes. I have a profit loss in shoe business and profit in speculation business. Can this adjustment be possible, sir? Yes. I have a loss in shoe business and profit in specified business, 35AD business. Can this adjustment be possible? Answer is 100% yes. Then what do I have, sir? Speculative business or speculation business. Now, what is speculative business provision telling, sir? The speculation business loss can be adjusted only with speculation business income. If you have loss of speculation business, it can be adjusted only with profit of speculation business. So speculation business 1 has a loss of 5 lakh rupees, speculation business 2 has an income of 7 lakh rupees. Is this adjustment possible? Answer is yes. Speculation business loss is 5 lakh, sari business income is 15 lakhs. Is this adjustment possible? Answer is no. Meaning what, sir? See, in first case, both of the business were speculation business, so adjustment was done. In second case, one is speculation, one is sari, adjustment not possible. One is speculation, one is 35AD business, adjustment is not possible. Similarly, specified business. Now your specified business loss which is there, no? Your specified business loss, 35AD business loss can be adjusted only with 35AD business income. Specified business losses can be adjusted only with specified business income. So I have hotel business where I am making a loss of 10 lakh rupees and hospital business making a profit of 15 lakh rupees. Can I adjust this? Answer is yes, because both are specified business. I have a hotel business where I am making a loss of 10 lakh rupees and sari business where I am making a profit of 15 lakh rupees. Adjustment is not possible because sari business is not a specified business. Then, sir, what about income from capital gain? Sir, what about income under the head capital gain? Under the head capital gain, no, we have two types of capital gain, long-term capital gain and short-term capital gain. See, long-term capital gain loss can be adjusted only with long-term capital gain. See, long-term can be adjusted only with long-term. Long-term loss can be adjusted only with long-term gain. However, short-term loss can be adjusted with long-term gain or short-term gain also. Meaning what, sir? Array, big fish can eat small fish. Big fish can eat small fish. Big fish can eat big fish. Okay. Big fish, small fish can be eaten by small fish, but big fish cannot be eaten by small fish. Meaning long-term loss can be adjusted only with long-term income, long-term capital gain. Short-term loss can be adjusted with long-term as well as short-term. Then income from other sources. Normally, loss under income from other sources is not possible. Normally, we will not have a loss under income from other sources. Normally, but there are cases wherein you may have losses also. Now, if it is an exempt loss, or exempt income ka loss, meaning agricultural loss, agricultural income is exempt. If it is an income earned from India, land in India. So if it is an exempt loss, that exempt loss cannot be adjusted. Array, when income is only exempt, the question of adjusting loss will not come at all. Similarly, when it is a casual income loss, what do you mean by casual income? For example, I have done lottery betting, gambling, etc. From that I am making a loss. If it is a casual income loss, then that loss also cannot be adjusted with any type of income. Array, exempt loss cannot be adjusted with any type of income. Similarly, casual income losses also cannot be adjusted with any type of income. But if you have loss from owning and maintaining racehorses, if you have loss from what, sir? Owning and maintaining racehorses, that loss can be adjusted only with income under that head. It can be adjusted only with income from owning and maintaining racehorses. Any other type of loss under house property, you can set off. Yes, set off losses under other sources can be done with taxable income under other sources. For example, I have interest income, dividend income, agricultural loss from land in USA. See, land in USA agriculture income is taxable, so therefore that loss can be adjusted with my other income from other sources. Now, in simple words, the crux is intra-head set off. Basically, when we talk about setting off the incomes with the same heads, it is possible. So, intra-head set off of losses against income under same head is always allowed, except in following cases. In case of speculation, it can be done only with speculation. Specified can be done only with specified. Long-term can be done only with long-term, and loss from owning and maintaining racehorses can be done only with owning and maintaining racehorses. Now we are talking about inter-head set-off, meaning loss from house property can I set off with salary. Loss from business can I set off with long-term capital gain, short-term capital gain. So we are doing what, sir? Inter-head set-off, inter-head. See, in the previous case, I was solving the problems of my own house, intra-head. Now I am going to solve the problems of my neighbors also. Section 71, inter-head adjustment or inter-head set-off. Income from salary. Now, please note, loss of any head of income can be adjusted with income from salary. See, normally salary will not have any losses. So any other head, if they have losses, you can always adjust with salary, except losses from business or profession. Meaning salary you have 5 lakhs, house property loss 2 lakhs. Can I adjust this? Yes, sir. Your net income is 3 lakhs. Salary you have 5 lakhs, business loss you have 2 lakhs. Can you adjust this? Answer is no. Therefore, your net income is 5 lakhs. Salary you have 5 lakhs, income from other sources loss you have 2 lakhs. Can you adjust this? Yes. Salary you have 5 lakhs. Short-term capital gain loss, can you adjust? Sir, answer is no. Meaning capital gain loss we will see later. Capital gain loss can be adjusted only with capital gain incomes. It cannot be adjusted with any other head. Then income from house property. Loss under any head of income can be set off or adjusted with house property income. So if you have loss under any other heads, you can always adjust with salary income. You can always adjust with house property income. Now similarly, loss under the head house property can be adjusted or set off with income under other heads also. If you have loss under house property, you can adjust with salary, business, other sources or capital gain. But however, there is a maximum limit. How much you can adjust, sir? Maximum 2 lakh rupees you can adjust with other incomes. In total, you can adjust maximum how much, sir? 2 lakh rupees. What will happen to the balance loss, sir? It will be carry forward to future years. So you have house property income. Can you adjust business loss? Answer is yes. You have house property 1 income, house property 2 loss. Can you adjust? Yes. House property loss adjust with business income? Yes. House property loss with capital gain? Answer is yes. Now what about business, sir? What about business? Business loss, business can adjust any other type of losses, and business losses can be adjusted with any other type of income except salary income. You can adjust business loss with any type of income except salary income. However, speculation loss will be adjusted only with speculation income, and specified business loss will be adjusted only with specified business income. Sir, what about, sir, what about income from capital gain? So please note, capital gain loss cannot be adjusted with any other head of income. This is a thumb rule. Capital gain loss cannot be adjusted with any other type of income, but however, all the other type of losses can be adjusted with capital gain. Loss from other heads can be adjusted with income from capital gain. However, loss under capital gain cannot be adjusted or set off with income under any other head. Now, income from other sources, loss from any other head can be adjusted with income from other sources. However, exempt loss and casual losses can never be adjusted with any type of income. Okay, it cannot be adjusted at all. And owning and maintaining can be adjusted only with owning and maintaining. Now, set off is done. Now, we'll talk about carry forward. Carry forward means what, sir? Current year, my loss was not able to fully be satisfied. I was not able to fully set off my losses. Now, when you are not able to fully satisfy the losses in the current year, now you can take these losses for future years and you can set off in future years. Now, one major thumb rule. What is the thumb rule, sir? Once a loss is not fully adjusted or set off in a current year, if it is getting carry forwarded in future year, it can be adjusted with only that head of income. For example, current year house property loss can be adjusted with anyone, but once house property loss is carry forwarded, it can be adjusted only with house property income. So note, losses under any head in a particular year can be adjusted with any head of income in that year. Meaning in the same year, you can adjust the loss of one head with income of any other head, provided you satisfy section 70 and section 71. However, once any loss is carried forwarded, then it can be adjusted with income under that head only in subsequent years. Once you carry forward any losses, that losses can be adjusted with income of the same head in subsequent years. Now, let us see one by one. Now, house property loss. Can you carry forward, sir? Yes. When you carry forward, you can adjust only with house property income, and it can be carry forwarded for 8 years. Now, normally when you are required to file income tax return, whether you are earning income, even if there is a loss, no, you'll have to file something called as loss return. Loss return is mandatory, required to be filed by you. But however, when it is a house property, why, sir, I should file loss return? Because if you want to carry forward your losses, no, lawmaker says I will allow you to carry forward your losses only when you file loss returns. So if it is a house property loss, that loss return is not required to be filed. Meaning you can carry forward house property loss even if you have not filed loss return. Then what about normal business income, sir? Normal business income can be carried forwarded in to future years, and it can be carried forward for a period of 8 years, and it can be adjusted only with normal business incomes. Loss return is also required to be filed mandatory if you want to carry forward this income. Speculation business loss can be carried forwarded for future years, and it can be adjusted only with speculation business income. It can be carried forward for a period of 4 years, and filing loss return is also mandatory. Section 35 AD business loss, that is nothing but specified business loss, can be carried forwarded and adjusted, carry forwarded without any limit. It can be carried forward for indefinite period and can be adjusted only with specified business income. And loss return, filing loss return is also mandatory for carry forwarding that losses. Long-term capital losses can be carried forwarded for future ends and can be adjusted only with long-term capital gain. It can be carried forward for 8 years, and filing loss return is also mandatory. Short-term capital loss can be carried forward for future years, and it can be adjusted with short-term capital gain or long-term capital gain, and it can be carried forward for a period of how much, sir? 8 years. Owning and maintaining racehorse business loss can be carried forward for future years. It can be carried forward for 4 years, and it can be adjusted only with owning and maintaining racehorse income, and filing of loss return is mandatory. Then we have unabsorbed depreciation. When is unabsorbed depreciation coming, sir? When your current year business income is not able to fully absorb the depreciation, then we have unabsorbed depreciation. This unabsorbed depreciation can be carried forward for future years, and it can be adjusted with any head of income except salary, and there is no limit for how many years you can carry forward this. Okay. Now, some important points. So this was about carry forward. Some other important points with respect to clubbing and set off and carry forward chapter. Note, what is the order of set off? First, you should always do intra-head set off. Then you should do inter-head set off. Meaning first apply section 70, then apply section 71. Then if you have any business loss, first current year adjustment you should do, then you should do brought forward adjustment. Meaning first current year losses should be set off with current year income, current year depreciation, and current year depreciation should be set off with current year income. Then brought forward business loss will first be set off, and brought forward unabsorbed depreciation, capital expenditure, and family planning capital expenditure will be set off. Losses from casual income can never be set off against any income. Brought forward losses can be set off even if the business is discontinued. Please understand this carefully. Even if you are not doing the business, brought forward losses can be set off. If there is any income under, if there is any income under any head and eligible losses under other head, then such losses shall first be adjusted with income of other head in that year, and then the brought forward losses shall be adjusted with balance income. Meaning what, sir? In simple words, first you should do the adjustment of current year income, and after doing current year income and current year losses, after doing that adjustment, you can do the brought forward adjustment of brought forward losses. Any losses, any type of losses can never be set off with this deemed incomes, and losses of income from other sources, very important, can never be carried forwarded except owing and maintaining racehorse loss. Loss under income from other sources cannot be carried forwarded except owing and maintaining racehorse losses. So this completes our discussion on what's our clubbing, and this completes our discussion on clubbing as well as set off and carry forward. Let us now continue and discuss deductions. Once we discuss deduction, our computation of total income will be done. We have already discussed what are the tax rates applicable. We have already discussed all the heads of income. We have already discussed clubbing and set off carry forward. Now the last point left over for our total income questions are deductions. Deductions are there under chapter 6A. And this chapter 6A is not from your institute material. This chapter 6A is from the Income Tax Law. Income Tax Act is there, no? Income Tax Act also has chapter number 6A talks about deductions. Now, why is this deduction important, sir? And for computation of gross total income, deduction is important. What is gross total income? Your income from salary, income from house property, income from business or profession, income from capital gain, income from other sources. This is all the heads of income. You do the total. Once you do the total of all the heads of income, do the adjustment of clubbing. You apply the clubbing provisions. You club any income if it is required to be clubbed, and also do the set off and carry forward adjustment. Do the set off and carry forward adjustments. Once you do the set off and carry forward adjustment, whatever amount you get, this is called as gross total income. This amount which you are getting is called as what's our gross total income. From this gross total income, you are required to subtract chapter 6A deductions. chapter 6A deductions. Once you subtract these deductions, you will get your total income. Now, under income tax law, what is important, sir? Computation of total income is important. Once you compute total income, you can compute tax liability on that total income. So why is this chapter 6A deductions important? Because until you compute the chapter 6A deductions, you cannot compute the you learn this topic, you cannot compute the total income. So gross total income less deductions will give you total income. Deductions under chapter 6A, some basic points before we start the deductions. Deductions under chapter 6A is available against all the incomes except long-term capital gain under 112 and 112A, short-term capital gain under 112 11A, and casual income. Meaning, in your gross total income, if you have these incomes, please subtract these incomes first before doing deductions. Meaning, deductions under chapter 6A will be available against all the different types of income, all the different heads of income, except the income under long-term capital gain 112A, short-term capital gain 111A, and casual income. Long-term capital gain under section 112 is 5 lakhs, LIC premium 50,000. Can I do this adjustment? Can I subtract this? Answer is no. You cannot subtract. Salary 1 lakh, long-term capital gain 2 lakhs, casual income 50,000, LIC premium, which LIC premium basically is chapter 6A deduction 1.5 lakhs. So my gross total income will be 3.5 lakhs, but though my investment under ATC is 1.5 lakhs, I can take benefit only of 1 lakh because against these incomes I cannot do adjustment of my chapter 6A deductions. Maximum deductions should not exceed, in simple words, maximum deductions should not exceed your gross total income minus all the special incomes. Long-term capital gain 112A, short-term capital gain 111A, and casual income. Deductions under chapter 6A is available only if the assessee claims for it. You will have to claim for this deduction. Income tax officer will not come to know. You will have to tell him that I have these deductions. Now, deductions is not available if assessee has not claimed under A. Now, please note, you will not get deductions under chapter 6A if you have claimed any other benefit under income tax law for the same expenditure. Now, you have different sections under deductions. Do I have to study all the sections? Answer is no. Section 80C is very important, 80D is very important, 80E is very important, 80G is very important, 80 TTA and 80U. These are very, very important sections. Then we have 80CCD, which is again second best important, 80JJAA, QQB, RRB, second best important, 80TTB, second best important. Okay, first let us straight away start our discussion with section 80C. Section 80C, long-term capital gain. Section 80C talks about what, sir? Section 80C talks about what, sir? Different investments which you are making. See, deductions are given for what? Deductions are given for the investments which you are making for your future. If you are saving the money for your future, if you are using the money for your future benefit, then lawmakers are telling that you are a very nice person. Because you are a very nice person, I am going to give you some benefit. LIC premium, tuition fees, principal repayment of housing loan, etc. So LIC premium. So 80C deduction is available to whom, sir? If you are an individual in HUF, whether you are a resident or non-resident, it does not matter. Maximum deduction which will be allowed is 1.5 lakhs per annum. Now, if you are making any LIC premium, if you are paying life insurance premium, if you are an individual, you can pay it for self, spouse, or children's. Deductions will be allowed. If you are an HUF, if you are paying it for members of HUF, deductions will be allowed. How much will be the deductions allowed, sir? Whatever LIC premium you are paying or the limit as per the law, whichever is less will be allowed as deduction. What is the limit, sir? In normal cases, if the policy is issued before 31/3/20, on or before 31/3/2012, then it is 20% of sum assured. On or before on or after 1st of April 2012, 10% of sum assured. If you are a person with disability, then for you it is till 31st December 2012, 20% of sum assured. For the year 12-13, 10% of sum assured. On or after 1st April 2013, 15% of sum assured. For in simple words, how much is the deduction which you are going to get for LIC premium, sir? Whatever LIC premium you are paying or this limit. For example, there is a lady called as Manjulika. She has taken a policy for 20 years. Sum assured is 10 lakh rupees. Now she is paying a premium of 1,20,000. This policy was taken in the year 2017. So how much deduction she is going to get, sir? She is going to get a deduction of premium paid, or since the policy is taken on or after 1st April 2012, 10% of sum assured. 10% of this is 1 lakh rupees. Whichever is less will be exempt. What will be exempt, sir? Sorry, what will be allowed as deduction? 1 lakh rupees will be allowed as deductions. Now, normally what happens? Normally what happens? Whatever, see, normally we take insurance so that we can secure our life. Correct? Now, there are two possibilities. You have taken the policy for a period of 20 years and two possibilities are there. Say for example, this lady Manjulika only I'll talk. So Manjulika has taken a policy for 20 years. She has taken this policy for 20 years. Two possibilities are there. She may die within this 20 years periods, or she may be alive even after 20 years. So if she dies within this 20 years period, then some assured plus some bonus amount will be given to whom, sir? It will be given to nominee. It will be given to whom, sir? It will be given to nominee. This amount which they are getting will be exempt under section 1010D. This amount will be completely exempt under section 1010D. Now what happens? Say Manjulika does not die, she survives for a period of 20 years and after that also she is alive. In such cases, Manjulika only will get 20 lakh rupees, sorry, this 10 lakh rupees sum assured plus some bonuses. In that case also that is exempt under section 1010D. In that case also it is exempt under section 1010D. Please understand this carefully. Whatever amount you are receiving upon, whatever amount a nominee receives upon death is always exempt, upon under section 1010D. Whatever LIC maturity amount which a person is receiving, nominee is receiving upon death of an insured person is always exempt. But if the amount is received by the policy holder himself on the survival, so the policy holder has not died, upon survival, if he is receiving the money, then exemption under section 1010D will be given only if the premium for the policy was less than this limit. Only if the premium paid was less than the limit. In simple words, if I want to tell you, normally life insurance policy amount received on maturity or death is exempt under section 1010D. However, if the premium paid for the policy is more than the limit specified under ATC, then the amount received on maturity will be taxable, fully taxable. However, the amount received upon death of the policy holder is always exempt under section 1010D, irrespective of how much premium you are paying. Then, if you are depositing the ATC talks about many types of investments, some important types of investments I am covering over here. If you are depositing the money in public provident fund account, you can get a deductions. How much? Who will get deductions, sir? Individual for self, spouse, children, and HUF for members. How much deductions, sir? Amount invested or 1.5 lakh rupees. Employee makes contribution to statutory provident fund, recognized provident fund, approved superannuation fund, or all the statutory provident fund, etc. He can claim deduction over here. If you are repaying your housing loan, principal amount will be allowed as deduction if you have taken the loan from bank or financial institutions. If you are depositing the money in national savings certificates, you will get a deduction under section ATC. Then if you are paying tuition fees of your children's, tuition fees means what, sir? Tuition fees does not mean the coaching fees which you are paying. Tuition fees means your school fees which is there. No, school fees will have different components in it. One of the component is tuition fees. You can take the benefit for maximum 2 children for education in India. Other items for which you get deduction under section ATC is what, sir? You are having NABARD bonds or senior citizen savings scheme, unit linked insurance policy, pension scheme of mutual fund or unit trust of India, notified units of mutual funds or unit trust of India, Sukanya Samriddhi account, or you have taken any FD for a period of 5 years or more. For all these things, you can claim deductions under section ATC. What is the maximum deduction you can claim under ATC? For combined together, everything combined together, you can take maximum how much, sir? 1.5 lakhs. ATCCC talks about pension scheme or life insurance. It talks about what, sir? Pension scheme of life insurance or any other insurance company. Individual can take benefit under this section. And if he is making any contribution to pension scheme of life insurance company or any other insurance company, maximum benefit which he can take is 1.5 lakh rupees. ATCCD pension scheme. ATCCD pension scheme. ATCCD pension scheme is also called as National Pension Scheme or New Pension Scheme or Central Government Pension Scheme, or it is money invested or contribution made in National Pension Scheme, Central Government Pension Scheme, or Atal Pension Yojana. Now the deduction will be given to salaried employed. We have already seen about salaried employee in our salary chapter, but let me just revise. A salaried employee will since in case of salaried employee, the deposit will be made by the employee as well as the employer. For employee's own contribution, the employee is going to get deduction under section 80 CCD 1. How much, sir? For his own contribution, he'll get 1 lakh rupees, and for his his own contribution, he'll get a deduction of his contribution or 10% of salary, whichever is less. And for employer's contribution, he will get a deduction of deduction under section 80 CCD 2 equal to his employer's contribution or 10% of salary, whichever is less. Now, sir, what if we are salaried individuals? We are not working anywhere. In such case, also you can take benefit under 80 CCD 1 equal to amount contributed by you or 20% of sum assured. Now we have a section or 20% of sum assured. Now please note, whenever you are making a contribution in 80 CCD pension fund, you get an additional deduction of 50,000 rupees. You get an additional deduction of 50,000 rupees under 80 CCD 1B. When you have made a contribution in 80 CCD pension fund, you get an additional deduction of 50,000 rupees. Normally deduction under 80 CCD is what, sir? 1.5 lakhs plus extra 50,000 you will get if you are making a deduction, if you are making a contribution in 80 CCD pension funds. Now please note, there is a father. Now individually the limit of 80C is 1.5 lakhs, 80 CCC is 1.5 lakhs, 80 CCD 1 is 1.5 lakhs, correct? 80 CCD 1, the limit is there 1.5 lakhs. For all these three individually, the limit is 1.5 lakh, 1.5 lakh, 1.5 lakh. However, there is a section called as 80 CCE. It says the combined limit of all these people, will also be equal to 1.5 lakhs. Meaning, if a person is making contribution in all these different funds, together how much deduction can he claim, sir? 1.5 lakh rupees is the deduction which he can claim. 80D. Next is what, sir? Section 80D. Next is what, sir? Next is section 80D. Section 80D talks about medical premium. If you are paying medical insurance premium, health insurance premium, or making contribution to central government health scheme, or preventive health checkup, or you are doing any medical treatment for those people who do not have any medical insurance. Now please note, this medical insurance premium should be paid compulsorily by any mode other than cash, then only you will get a deduction. Now you can take medical insurance for yourself, spouse, dependent child or parents, and HF can take it for its members. How much deduction will you get, sir? Now deduction is separately given for contribution made by you for yourself, your spouse and your children's, and separately it will be given for parents also. And separately it will be given for what, sir? Okay, so 80D, medical insurance premium, etc. Who can take benefit under 80D, sir? Individual can take for himself, spouse and dependent child as well as parents. For himself, spouse and dependent child, normally the limit is what's at 25 lakhs, and for parents also normally the limit is 25 not lakhs, sorry, 25,000. So combined together, if a person is taking policy for himself and his parents, then he'll get a reduction of 50,000 rupees. Now, if among the self, spouse and dependent children, if anyone among you is a senior citizen, then you'll get an extra deduction of 25,000. And similarly, among your parents, if anyone is a senior citizen, you'll get an extra deduction of 25,000. So combined together, you can take a deduction up to 1 lakh rupees if all the four of you are, if all of you are senior citizen. Meaning in your parents also anyone is senior citizen, in you guys also anyone is senior citizen. Correct, not correct? Now normally the limit is what's sir? 25. Now say for example, I have taken policy for myself and my spouse, we are less than 60 years, and I have also taken for my parents. In such cases 25 for myself and my spouse and 25 my parents. Sir, what if my parents, any one of my parent is senior citizen, then 25 plus 50 over here. Okay. So what if in myself, my spouse, etc. we are also falling under senior citizen category, parents are also falling under senior citizen category. 50,000 plus 50,000 is the maximum deductions which I can claim. Now please note, medical treatment expenditure is also allowed as reduction under section 80D. It will be allowed as reduction only if you are incurring a medical expenditure for a senior citizen who does not have any medical insurance or health insurance. Maximum 50,000 deduction can be taken. Now if you are doing any preventive health checkup, 5,000 benefit can be taken for self, spouse, dependent child and parents. Now this also is included in the limit of 25,000 or 50,000, combined limit of 50,000, etc. This preventive health checkup can also be done by this preventive health checkup money can be given by any mode other than cash also, meaning you can give in cash also that money. 80DD talks about medical treatment and maintenance of dependent disabled. So if you have any dependent person on you who is a disabled person, and if you are incurring medical treatment expenses or maintenance expenses, then you can take deductions. If you are a resident individual, you can take deduction for dependent relative, which can be spouse, children, father, mother, brother, sister, and for HUF can take deduction for members of HUF. Deductions for normal disability you will get 75,000, and for severe disability you will get a deduction of 1,25,000. Severe disability means 80% or more disabled person. This is flat deduction irrespective of whether you are actually spending the money or not. Note, no deduction will be given for such dependent disabled person if you are maintaining him, if that person dependent disabled is already claiming a deduction for himself under section 80U, because 80U talks about if you yourself are disabled. Deduction for disabled assessee. If you are a resident assessee who is a disabled person, you will get a deduction of 75,000 in normal cases, normal disability, and for severe disability you will get a deduction of 1,25,000. Section 80DDB. 80DDB talks about what, sir? Deduction in respect of medical treatment for specified disease. If you have any specified disease, then you can take deduction over here. Specified disease like cancer, leprosy, etc. those are covered over here. Resident individual can take for self or dependent relatives such as spouse, children, brother, sister, father, mother, and HF can take it for members. Deduction limit is how much, are normal cases 40,000, and in case of senior citizen 1 lakh rupees. Now how much deduction will be allowed? Your actual expenses or rupees 40,000 or 1 lakh less insurance claim received will be allowed as deduction. Next is 80E, important section. 80E talks about interest for education loan. Higher education loan. Interest for higher education loan. Higher education means after the classes after 12th standard, your degree, graduation, etc. If an individual is taking any education loan for his higher education for self, spouse, children, legal guardian, etc., interest paid will be allowed as deduction. Whatever interest you are paying for 8 consecutive years from the year in which from the year in which you have started paying the interest continuously for 8 years, whatever interest you have paid, it will be allowed as deduction. Section 80EE talks about, not relevant from exam point of view, 80EE talks about interest on housing loan. Individual pays any interest on housing loan, maximum deduction of 50,000 he can take, provided the loan is taken from bank or financial institution. Loan amount, house property value is up to 50 lakh rupees. Loan sanctioned is up to 35 lakh rupees. Loan is sanctioned in the year 16-17 only, and assessee does not have any other house. Section 80EEA, again not an important section. Interest on loan, housing loan. If you are an individual who is not covered under 80EE and you are paying any interest on housing loan, maximum 1.5 lakh deduction you can get. Please note, these are all extra deductions apart from what is there under house property chapter. So loan should be taken from bank or financial institution. Stamp duty value of house property should be up to 45 lakh rupees, and loan sanction should be during this period of 1st April 2019 till 31st March 2022, and assessee should not have any other houses. Next is interest for electric vehicle loan. You have taken electric vehicle, electric bike, electric car, electric truck, electric bus, etc. So individual can claim deduction for purchase of electric vehicle up to 1.5 lakhs of interest deduction you can claim. Loan should be from bank, financial institution, NBFC. Loan should be for purchase of electric vehicle, and loan should be during the period 1st April 2019 till 31st of March 2023. 80G, again a very important section. 80G talks about donation. Donation. If you are giving any money, donating any money, any type of assessee or it does not matter, you can claim deduction under this section. Any type of assessee makes or gives donation will get a deduction under 80G. How much is the deduction, sir? There is limit based deductions and there is no limit based deductions. Limit based deduction has 50% and 100%. Meaning limit based deduction means what, sir? Any amount of contribution can be made by you, and whatever contribution you are going to make, equal to that, 100% of that will be given as deduction or 50% of that will be given as deductions. So if you are contributing to a fund called as PM Drought Fund, you will get 50% deduction. If you are contributing to PM Drought Fund, you will get 50%. Meaning I have contributed 1 lakh rupees. How much deduction will I get? 50% of this 50,000 deduction will be given to me. Now before over here, there was also Rahul Gandhi Fund. Sorry, there was also Rajiv Gandhi Fund. There was also Indira Gandhi Fund and Jawaharlal Nehru Fund. They have been removed. Now very important from exam point of view. No deduction, donation. If you donate to these funds, no deductions will be given. Now if you are donating to any other funds, wherein the list is very big, there are almost around 26 items. It is not possible for us to remember all these 26 items. I'll give you the crux how to remember is 26 items. So if you donate to any fund of any type of state government, say for example state government fund is there, Gujarat government fund, Karnataka government fund, any type of state government fund, 100% deduction is allowed. Prime Minister fund, any type of Prime Minister welfare fund, PM cares fund, or whatever type of Prime Minister fund, 100%. Whatever type of CM fund, 100% deduction will be allowed. Whatever type of fund wherein you see the word national, 100% deduction will be allowed. Swachh Bharat fund, Clean Ganga fund, Army fund, wherever you find the word national, 100% deduction. CM fund, PM fund, state government fund, 100% deduction. Army fund, 100% deduction. Zilla Parishad fund, 100% deduction. Here there is no limit on amount which you are going to donate. 100% deduction will be given in these cases, and 50% deduction will be given only in case of PM drought fund. Now, in case of PM drought, though the word PM is there, you will get only 50% deduction. Any other type of PM funds, you will get 100% deduction. Now, limit based means what, sir? Now, there are some funds for which you will get donation based on the limit, meaning whatever amount you donate, but I will not give you that entire amount. There is a limit based on which only I will give you deductions. Now, here also you have 50% and 100%. 50% is for totally 4 items. Minority, if you find the word minority or trust, charitable trust or temple, mosque, church, gurudwara, etc., or housing accommodation, then in such cases you will get 50% deduction. And for family planning expenditure and Indian contribution to Indian Olympics done by Indian company, Olympics done by Indian company will be covered over here. How much deduction you will get, sir? Deduction will be amount donated or 10% of adjusted total income, whichever is less. Adjusted total income is what, sir? Gross total income less income tax allowed special rates less all the deductions from chapters under chapter 6A except ATG will give you adjusted total income. Adjusted total income into whichever is less, you compute adjusted total income, 10% of adjusted total income or amount donated, whichever is less, into 50% or 100%. Now, donation cannot in kind is not covered over here. Donation more than 2,000 rupees should be done by any mode other than cash, meaning it should be done either by account pay check, account pay demand draft, or any other electronic clearing system. ATGG, again, and good section from exam point of view. I would not say it is so important, but yeah, they may ask. ATGG, rent paid for house property. What's a rent paid for house property? An individual who is not getting any HRA, who has not got HRA benefit, who has no house at place of his employment, and who has not claimed self-occupied benefit will get deduction under section ATGG. What is ATGG telling, sir? ATGG says I will give you deduction of maximum. I will give you deduction of this amount, maximum 5,000 rupees per month, or 25% of adjusted gross total income, or rent paid minus 10% of adjusted gross total income. Over here, adjusted gross total income is your gross total income minus special income except lottery income, and subtract all the other types of deductions under chapter 6A except except the deductions under ATGG, you will get your adjusted total income. Individual can note, individual spouse, minor child, HUF should not have house at the place of his employment, and a declaration also is required to be filed by those people who are claiming deduction under this section. ATGG, donation for scientific research. Now please note, section 35 talks about whenever you are conducting in-house scientific research or you are donating scientific research, if you are a businessman, you can claim deduction over there. But if I am a non-businessman, I can claim deduction under section ATGG. Donation for scientific research or rural development. All type of assessees except assessee having a business income, if they are making donations under section 35 cases, or for rural development for or poverty eradication fund, 100% of the amount donated by them can be taken claimed as deduction. Deductions, if donation is more than 2,000 rupees, it should be made by any mode other than cash. That is, it should be made by account pay check, account pay demand draft, or any other electronic clearing system. Donation to political party or electoral trust. If you are making any donation, if you are paying the money to any political party or electoral trust, you can claim deduction under section 80GGB if you are an Indian company, and you can claim deduction under section 80GGC if for all the other types of assessees except Indian companies. Now, there is no limit of amount donating. Even 1 rupee donation you can make, 100,000 rupees also donation you can make. But the only important point is the donation which you are making should be by any mode other than cash. 80JJAA. 80JJAA means what, sir? Deductions for employment of new workmen or new employees. If you are employing new people in your company, you will get a deductions. Who will get, sir? Any type of assessee who is engaged in business, and whose books of accounts are subject to audit under section 44 AB. Your books of accounts will be subject to audit if your turnover is more than 1 crore or 10 crores, or profession income is more than 50 lakhs. How much deduction you will get, sir? Normally it is available only for businessmen, not professionals. Deductions of 30% of additional employee cost which you have incurred. 30% of additional 30% deduction will be given for additional employee cost which you have incurred. For 3 assessment year you will get continuously. What do you mean by additional employee cost, sir? If you are a new company, additional employee cost means emoluments or the salary which is paid to additional employees. Meaning for new company, all the employees which is added by you during the year are called as new employees, so you can claim extra 30% deductions. For an existing company, additional employee cost means the increase in the total number of employees when compared to the employees in the last year. Increase in total number of employees compared to the employees as on last day of the preceding financial year. Additional employee shall not include the following people: those employees whose salary is more than 25,000, those employees who are employed for less than 240 days in a year, or less than 150 days in case of fall manufacturing business, which is nothing but footwear business, apparel business and leather business, and employee who does not participate in recognized provident fund. These are not covered over here. Very important is section 80 TTA. The question will never tell you about 80 TTA, but please make sure that you always, whenever there is a saving interest, whenever there is an interest income, always see whether it is a saving interest. If there is a saving interest, no, always add that income in income from other sources and claim deduction under 80 TTA. 80 TTA, interest on saving account. Individual can take benefit under this section except a senior citizen. Interest income on saving account can be taken as deductions. Saving account can be opened with bank or post office or cooperative society. Deduction which you are going to get is the interest earned or rupees 10,000, whichever is less. Now deduction is interest earned or 10,000, whichever is less. Now interest on deposit 80 TTB, it is applicable for senior citizen. See, 80 TTA was applicable for everyone except senior citizen. For senior citizen we have 80 TTA. Whatever interest you are getting on any type of deposits, which is, please note, previously it was only saving account, but here it is any type of deposit, whether you have made the whether it is fixed deposit, saving deposit, recurring deposit, which you have made with banking company, financial institution, cooperative society, you will get a deduction equal to amount of interest or 50,000 rupees, whichever is less. Now if you are getting any royalty income, then also you will get a deduction under 80 QQB or 80 RRB. 80 QQB talks about royalty income from books written by an author. It will be given only for a resident person. If the royalty fee which he is earning is less than or equal to 15% of book value, then the deductions which will be given under 80 QQB will be royalty received or 3 lakh rupees, whichever is less. If the royalty amount is more than 15%, then royalty, the deduction which you are going to get is royalty calculated at 15% of book value or 3 lakh, whichever is less. Now 80 RRB is for patent. If you are getting royalty for the patent, you will get deduction of under 80 RRB equal to royalty received or 3 lakh rupees, whichever is less. What is important over here is if you receive any royalty from foreign country, then amount brought in convertible foreign currency should be taken into consideration. Then we also have tax holidays. Under this chapter we also have something called as tax holidays, section 10 AA, tax holiday for SEZ unit. You are any type of assessee engaged in manufacturing or production business, or you are engaged in the business of provision of services at an SEZ location, you can claim deduction under section 10 AA. What is the deduction, sir? Whatever export profit you are earning, no, that export profit will be allowed as deduction. You don't have to pay tax on that. Export profit for first 5 years, 0 to 5 years, 100% of export profit. For 6 to 10 years, 50% of export profit. And for first 5 years, 100% of export profit. For next 5 years, meaning from 6th year to 10th year, 50% of export profit. And the last 5 years, from 11th year to 15th year, 50% of export profit or amount invested in amount credited in SEZ reinvestment reserves, whichever is less. Now what do you mean by export profit, sir? Your total profit from SEZ business into export turnover divided by total turnover. Export turnover means amount which is received by amount which is received in convertible foreign currency within the time limit prescribed by RBI. Note, if any account is opened outside India with prior approval of RBI and an amount is getting credited in that account, if it is coming to that account, then also it will be deemed as that it is received in convertible foreign currency. Now when you are computing the total turnover as well as the export turnover, please do not include freight charges, insurance charges, telecommunication charges, expenses for providing technical services outside India, cash compensatory service, profit on sale of duty entitled passbooks and duty drawback. Other points with respect to 10AA is what, sir? Business at SEZ should be started during the period 2005-6, between this period 2005-6 to 2019-20. Assessee should submit a CA report 1 month before filing of his return. That this deduction, whatever is claiming, is correct. During the period of deduction, depreciation will deemed to have been provided. You will not get extra depreciation. If deduction under section 10AA is claimed, no deduction under 35 AD can be claimed for the same business. And amount credited to the SEZ reinvestment reserve should be used for purchasing of new plant and machinery within a period of 3 years. Within a period of 3 years from the date when you are crediting this amount. If you don't utilize within a period of 3 years for that purpose or misutilize it, then it will be deemed as business income. Okay, now let us do one thing. Okay, let us see this one more thing. Total income point. Under total income, you have now please note, deduction is done. Now we are seeing total income. Total income has what, sir? Total income has your all the heads of income, then 115 BAC, which we have already discussed, tax rates, which we have already discussed under normal cases under 115 BAC, and one more thing which is there in your total income topic is alternate minimum tax, 115 JC. 115 JC talks about what, sir? Alternate minimum tax, AMT. It is applicable for all the types of assessees except companies. If you are individual HUF, AOP, BOI, partnership from LLP, etc., then you will have to pay an alternate amount of tax, alternate minimum amount of tax, which is computed as per section 115 JC. Now, how much tax a person has to pay normally, sir? He will have to pay tax as per normal provisions or tax as per alternative minimum tax as per 115 GC, whichever is higher. Now, alternate minimum tax is how much, sir? Alternate minimum tax is computed in the following manner. You should take your adjusted total income. 18.5% of your adjusted total income is alternate minimum tax. Sir, what is my alternate minimum tax, sir? Your adjusted total income into 18.5%. Sir, what do you mean by adjusted total income? Take your normal total income. Sir, normal total income means normal total income. Whatever total income you compute as per normal provisions, as per the provisions which you have studied till now. Compute the total income as per normal provisions, then add back to the total income deductions under deductions under section 35 AD if you have claimed deductions under 35 AD, add back deductions under 10AA if you have claimed that deductions, add back deduction under 80 JJ, AA, QQB, RRB. Add back these deductions, meaning for your normal total income, first compute normal total income by taking all the deductions, benefits, etc. To that normal total income, add back 35 AD deductions, 10AA deductions, and 80 JJ, AA, QQB, RRB deductions. You will get some amount. From this, subtract depreciation on 35 AD asset. See, 35 AD talks about capital expenditure, 100% deduction will be given except on land, goodwill, and financial instruments. On this asset, whatever 35 AD asset is there, no, because you are adding back the deduction, please provide the depreciation for this asset. Once you provide the depreciation, you will get your adjusted total income. Of this adjusted total income, 18.5% is what, sir? Alternate minimum tax. Now note, the provisions of alternate minimum tax will not be applicable to individual HUF, AOP, BOI, artificial judicial person if their adjusted total income is less than 20 lakhs. It is not exceeding 20 lakhs. And for the total income of an assessee, if an assessee is opting for 115 BAC, for him also this provision shall not apply. Now there is some question which I have given over here. Now please note, since you are paying, normally you have to pay normal taxes. But when the provisions of 115 JC comes, you will have to pay alternate minimum taxes. So it may be happening that it may when you are paying alternate minimum taxes, which is more than normal taxes, obviously you have to pay your alternate minimum tax or normal tax, whichever is higher. So if you pay alternate minimum taxes, that means what, sir? You are paying tax amount more than what is required to be paid by you. You are paying the taxes which is more than what is required to be paid by you. So lawmakers are telling, I will give you credit of that. That credit is called as alternate minimum tax credit, which is nothing but the difference between alternate minimum tax and normal tax. This AMT credit will be can be used by you. You can set off this. You can use this AMT credit. It will be carried forwarded for 15 years, and you can set off that in a future year within a period of 15 years. Now we have advanced tax, TCS, TDS, TCS, and return of income chapters. We'll discuss this chapter after a chota sa break. Let me just take a chota sa break and we'll discuss these topics. We'll discuss all the important points of advanced tax, TDS, TCS provisions, as well as return of income. All the important points we'll say and complete our marathon of income tax. Let us meet after a short break. Welcome back, students. Let us now complete the marathon by just discussing the last leftover topics, advanced tax. The next topic for our discussion is what, sir? Advanced tax, advanced tax, advanced tax, advanced tax. Okay. See, normally what happens? Normally, what do we do under income tax law? Normally, we earn the income in the previous year and pay tax on that income in assessment year. Correct? This is what we normally do. Earn the income in previous year, pay the tax in assessment year. Now, what is this advanced tax provision telling? Advanced tax provision says, pay as you earn. As and when you are earning the income, pay the tax also, because you know on this income you will have to pay taxes. Instead of paying it tomorrow, pay it today only. So advanced tax, what happens in advanced tax, sir? Advanced tax says on the previous year income, pay tax also in the previous year only. So pay as you earn concept is adopted by advanced tax. Now what happens over here, sir? You have to estimate your total income and compute the tax on that estimated total income. Estimate your total income, compute the tax on that estimated total income. Advanced tax provision says, see, obviously, unless until the year is over, you will not know what is your total income, correct? But lawmaker says no problem. You estimate your total income and according to that, you pay the tax on that estimated total income. Say, for example, I have estimated my total income to be 15 lakh rupees this year. So I'll compute the tax on that estimated total income. So tax including cess is 2,73,000. So I know that this is going to be my tax amount, so pay this to me during the year only. During the previous year only, you pay me in 4 installments. 15th of June, 15th of September, 15th of December, 15th of March. So this advance tax is required to be paid in 4 installments: 15 June, 15 September, 15 December, 15 March, 15 June, 15 September, 15 December, 15 March, 15 June, 15 September, 15 December, 15 March, 15%, 45%, 75%, 100%. So 15 June, pay 15%, 45%, 15th of September and 15th of December, 75%, and 15th of March, pay 100% of the advance tax. Now, advance tax means what's a tax which is paid by you in the previous year. So, whatever tax you are paying till 31st March of the previous year, that is called as advance tax. Advance tax liability is required to be paid by you only when your advance tax liability is rupees 10,000 or more. Only when your advance tax liability is rupees 10,000 or more, you will have to pay advance tax liability. In case of senior citizen who does not have any PGBP income, if you are a senior citizen who is not having any PGBP income, you need not pay any advance tax liability. Now, if you are a presumptive tax person, 44AD or 44ADA person, then you can pay your full amount of advance tax in one installment only, which is by 15th of March of the previous year. Advance tax on following income is required to be paid from the date when this income is generated. Normally, you can estimate your income, but some incomes cannot be estimated, like capital gain income, casual income, profit and gain, PGBP income which you are earning for the first time. This cannot be estimated. So for this incomes, no, pay the advance tax as and when you are earning. Computation of what is this advance tax liability? How do I compute the advance tax liability? First, take your adjusted gross total income, estimated gross total income. From that, subtract chapter 6A deductions. You will get your estimated total income. From this estimated total income, no, compute the tax on that estimated total income. Say, for example, I have computed the tax amount, add surcharge if applicable, then add health and education cess, add 4% of health and education cess. You will get your total tax on adjusted total income, estimated total income, sorry. So the tax on estimated total income, from that subtract any TDS which is deducted in your name, any tax which is collected for the purchases made by you. So subtract TDS deducted and collected, which is paid to the government within the due date. Now please note, just because TDS is collected, you cannot subtract it. It should be paid also to the government within the due date. Whatever difference is there, that will be your advance tax liability. This is required to be paid by you in 4 equal installments: 15 June, not equal installment, in 4 installment: 15 June, 15 September, 15 December, 15 March, 15%, 45%, 75%, 100%. Now, sir, what will happen if I don't pay this advance tax, etc.? If you don't pay advance tax, what will happen, sir? Interest will come into picture. Now, there are interest under different sections. Interest under section 234A, B and C. Advance tax interest will come only when under 234B and 234C. Now we have interest under 234A, B, C. Okay, interest under section 234A. Interest under section 234A will come for delay in filing of income tax return. If you don't file the income tax return within the due date, you will have to pay interest under section 234A. Now, what is the due date for filing income tax return, sir? Normally, it is 31st July of assessment year, and in audit cases it is 31st of October of assessment year. Normally 31st July, audit cases 31st October of assessment year. Now, if you don't file your income tax return within this date, then you will have to pay interest. What is the interest, sir? Interest is required to be paid at 1% per month or part thereof. So whatever tax liability, unpaid tax liability is there, no, on that you will have to pay interest of 1% per month or part thereof. So it is per month basis. So even if you do a delay of 1 day, say for example 31st July is my due date of filing income tax return, I have filed my return on 5th of August. In such cases, I will have to pay interest at 1%. 1% interest I will have to pay. 1% per month or part thereof. So interest will be levied from next day, from the due date of filing returns till the date of filing of returns. So this you will have to, this number of days you will have to convert into months and accordingly pay the interest. Interest should be paid on net tax liability after making all the adjustment of tax credits, advance tax paid, etc., etc. Now, for example, due date of filing return is 31st July 23. Actual date of filing annual, what is that? Income tax return is 15th of September. So there is a delay of 2 months. 75,000 is my tax liability. 75,000 into 1% is the rate of interest into 2 months delay. Similarly, 31st July is my due date of filing returns, and I have actually filed the returns on 1st of December. So there is a delay. August, September, October, November, December, 5 months delay. So my tax payable is 78,000 advance tax and TDS credit is also there. Subtract these amounts from your tax liability. Whatever amount you get on that, you calculate interest. Now, interest under section 234B. Interest under section 234B is applicable when you are not paying the advance tax or when you are short paying the advance tax. When you are not filing the return within the due date, 234A. When you are not paying the advance tax or short paying the advance tax, interest under 234B will come. Interest for non-payment or short payment of advance tax. Rate of interest is what's 1% per month or part thereof, same. Now, this interest will be applicable for not paying advance tax or short paying advance tax. Therefore, the date within which you should pay advance tax is 31st March of previous year. So if you have not paid the advance tax within this date or you have short paid the advance tax on whatever amount is unpaid by you, on that interest will be calculated from the first day of assessment year, meaning from 1st of April it will be calculated till the date of filing return. So interest will be calculated at 1% per month or part thereof. The interest shall be levied from the 1st April of the assessment year till the date of making the payment of taxes. Interest shall be paid on net tax liability, same net tax liability interest you have to pay. Interest under section 234B shall not be applicable if 90% or more of the advance tax is already paid in advance. Meaning your advance tax liability is 1 lakh, you have paid 90,000 advance tax, 95,000 advance tax, etc. No problem, no interest under 234B. You have paid only 80,000 advance tax. Now interest under 234B will come on 20,000 unpaid amount. So tax liability is 1.5 lakhs, advance tax paid is 0. So income tax return is filed on 30th June. So even in this case, 15th. Now please note 234B will come, 234A will not come because the return is filed within the due date. So interest will be calculated for 3 months period. Accordingly, I have given some more questions. Now comes one more interest called as interest under section 234C. One more type of interest called as what, sir? Interest under section 234C. Sir, what is this interest under section 234C? Now, interest under 234C will come when you have short paid or not paid your advance tax installment. That 15 June, 15 September, 15 July, March, that this installment is there. Now, if you have not paid that fully, then this interest under 234C will come. Interest for short payment or non-payment of advance tax installment. Interest at the rate of 1% per month or part thereof is going to be applicable if you are not paying your advance tax liability. Meaning normally, first installment you are required to pay by 15th of June. You should pay 15% advance tax. If you have paid 12% or more than 12%, no problem, no interest will be levied. Second installment is required to be paid by 15th of September. You are required to pay 45%. If you have paid 36% or more, no interest will be levied. If you have paid less than 36%, then interest will be levied on that unpaid amount. Then third installment is required to be paid by 15th of December. 75% you have to pay. If you have not paid the 75%, interest will be levied. Similarly, 100% by 15th of March. If you have not paid, interest will be levied. Interest will be levied for a period of 3 months. Meaning, say for example, for first installment, you are going to levy the interest till the liability of next installment. For the next installment, you will levy till next installment. Meaning, see, first installment, once you see whatever unpaid is there in first installment, calculate the tax for next 3 months till September, because September month we are going to see, whether I have paid the interest or whether I have filed the, whether I have paid the total amount in September or not. So they are telling interest will be calculated for 3 months period. Tax liability, etc. The computation part is there over here. Now, sir, what if I don't, you said if I don't file my return within the due date, I'll have to pay 234A interest, correct? No, sir. Now, is there any penalty also, late fees also, which I have to file, pay? Yes. Late fees, 234B, A, B, C is done. 234F says, late fee for delay in filing of returns. Late fee for delay in filing of returns. If you don't file the returns within the due date, if you don't file the returns within the due date, then there is a late fee which you have to pay. How much is this late fee, sir? Late fee is depending upon your total income. If your total income is less than or equal to 5 lakh rupees, late fees for you, late filing fees is 1000 rupees. If your total income is 5 lakh, more than 5 lakh rupees, late fee for you is 5000 rupees. If you file the return, now please note, once say 31st July is my due date, 31st July is my due date, I can file the return by 31st of December. Even if I want to late file, I can file it only by 31st of December. So anytime before this, if I file, the late fees is 1000 rupees or 5000 rupees. 5000 rupees if my total income is more than 5 lakh. Now, next topic for our discussion, before discussing TDS, TCS, no, let me just cover this return of income topic, very small theoretical topic it is. Let me cover all the important aspects of this TDS, TCS and return of income. The return of income means what, sir? Who has to file income tax return? What is the due date of filing income tax return? All those stories, etc. Return of income. Section 139 says, income tax return is required to be compulsorily filed by a company and partnership firm, irrespective of whether they are making income or not, irrespective of how much their income is there. Even 1 rupees income they are making, they'll have to file their income. Even if 0 rupees income is there, they'll have to file their income. Even if it is a loss, they'll have to file their income tax return. Who, sir? Company and partnership firm always have to file their income tax return, and all other types of persons other than company and partnership firm will have to file their income tax return if the total income is more than basic exemption limit. If the total income is what, sir? More than basic exemption limit. And every person who is an holder of any who holds any beneficial ownership, or who is having a signing authority, or who is a beneficiary of any asset located outside India, he also has to file his income tax return compulsorily in India. And every person whose total income, without giving the effect to section 54, 54B, 54D, 54 EC, 54F, and without giving effect to chapter 6A deduction, if his income exceeds basic exemption limit, then also he has to file his income tax return. Then who else has to file the income tax return, sir? Any person other than company will have to file, because company and partnership firm compulsory they have to file the income tax return. Any other person will have to file their income tax return if the total money deposited by them in their bank account is more than 1 crore or more during the year. If it is a current account, if the total expenditure which they have incurred for foreign travel is more than 2 lakh rupees during the year, if they have incurred a total expenditure of more than 1 lakh rupees during the year for electricity consumption, and if they satisfies any other conditions as may be notified by government. Now, sir, what is the due date of filing income tax return, sir? If you are a company, for you the due date of filing income tax return is 31st of October of assessment year. If you are any person other than company whose books of accounts are subject to audit under income tax law, then also it is 31st of October. Therefore, for companies and any person whose books of accounts are subject to audit, the due date is 31st October of assessment year. And for all other persons, it is 31st of July. And if you are an assessee for whom transfer pricing provision is applicable, which you learn in your final level, then for you it will be 30th November of assessment year. Now, sir, what will happen if I don't file the income tax return within the due date? Interest under 234A will be levied, and also you will have to pay late filing fee of 234F. We have already seen this. Now, the government may exempt few specified class of people to file their income tax return. As of now, nothing is there over here. Next important point is loss return. Now, sir, should I file my income tax return even if I am making a loss? Answer is yes. If you want to carry forward your losses, you will have to file your loss return. Loss return shall be filed within the prescribed time limit as specified under section 139(1), meaning time limit for filing loss return is also same. Loss return is required to be filed if you want to carry forward the losses. Losses cannot be carried forward unless until you find the loss return. Which losses cannot be carried forward, sir? Your business loss, loss related to specified 35AD business, speculation business, non-speculation business, capital loss, and loss from owning and maintaining racehorses cannot be carried forward if you don't file your loss return. Now, however, house property loss and unabsorbed depreciation loss can always be carried forward even if you don't file your loss return. Now, please note, if you don't file your loss return, you cannot carry forward the losses. But however, if you have a brought forward losses, you can still adjust that. Meaning last year losses can be adjusted in the current year, but current year losses cannot be carried forward. Then belated return. Sir, sir, what if I don't file the return within the due date? Is there any time, can I file it late? Can I file it late? If yes, what is the due date of filing that late return? So belated return. If the return of any previous year is not filed within the time limit specified in section 139(1), then the assessee may file the return for such previous year as a belated return at any time before 3 months prior to the expiry of the assessment year or before completion of assessment, whichever is earlier. So assessment year, see, for our examination, previous year is 23-24 and assessment year is was 24-25. So last date of assessment year is 31st of March 2025. 3 months before this, 31st December 2024 is the due date within which you are required to file the belated return or before completion of assessment, whichever is earlier. The return so filed after the due date on or above the limit shall be, meaning if you file any return after the due date within the time limit prescribed over here, that return will be called as what, sir? Belated return. What will be the consequences, sir, when it is a belated return? You will have to pay interest under 234A, interest under late fees under 234F, and your losses also may not be carry forward except house property loss or unabsorbed depreciation loss. Then we have something called as revised return. Sir, return which is filed by me, can I revise? Under GST law you cannot revise your return, but under income tax law, yes, you can revise your return. What is the due date for revising the return, sir? If an assessee has furnished a return under section 139(1), 139(3), 139(4), meaning any type of return which you have already filed, in that return, if you discover any omission or any wrong statement, then that return can be revised by you within the below time limit. What is the time limit, sir? Before 3 months before, 3 months prior to the end of the assessment year or before completion of assessment, whichever is earlier. Now, please note, any type of return which is already filed by you can be revised. Now, defective return, incomplete return. Your return, see, sometimes what will happen is, because some information is not properly provided by you, some data which is entered in the return is not correct, etc. Some arithmetic error or clerical mistakes you have done, that return which is filed by you may be called as defective return. Officer, if there is any defect, no, officer will send back that information to you for rectifying that defect. You should rectify that defect within 15 days. If you don't rectify, sir, your return only will be treated as invalid. See, where the assessing officer considers that the return furnished by the assessee is defective, he is given the discretion to intimate the defect to the assessee and give him an opportunity to rectify the defect within 15 days from the date from such intimation or such other further extended period as may be considered reasonable. If the defect is not rectified within the given time, the assessing officer may treat the return to be invalid and the provisions of Income Tax Act will apply to him as if he has failed to furnish the return. So if he does not rectify the return, it is an invalid return. It will be assumed that you have not filed the return at all. Updated return. Updated return means what, sir? Updated return is a new concept which has come. Your previous year's returns, what is already filed by you, can be updated by you. If you want to increase your previous year incomes, previous year returns which is already filed by you, if you want to show more incomes for those years, you can do it by filing this updated return. Any person may furnish updated return at any time. So important from MCQ point of view, and also theoretically they can ask because it is a new concept. Any person may furnish an updated return at any time within 24 months from the end of relevant assessment year, irrespective of whether he has furnished a return under section 139(1), 139(4) or 139(5). Now, the provisions of updated return will not apply. You cannot file updated return if the updated return of such person for that assessment year is a loss return, meaning if the updated return which you are filing, if it is a loss return, or if it is decreasing the tax liability, if because of that updated return you are going to claim any refund, etc., or if the return is furnished under 139(1), 139(4) or 139(5), meaning if you are updating your return, no, you should be paying to the government. You should not be taking from the government. Updated return can be filed only if original return Updated return can be filed if original return is a loss return and the updated return is an income return. Meaning first return was my loss return. Now I am going to show it as an income. I can file my updated return. Now, sir, what is the tax which I have to pay while filing updated return, sir? Whatever extra tax which you have to pay, that plus penalty you will have, plus interest for the delay period, plus late fees, plus penalty. What is that penalty, sir? Penalty equal to 25% of the tax if you file the updated return within 12 months and 50% of the tax and other dues if the return is filed by you after 12 months period. Now, normally under income tax law, the assessment which is there, no assessment is done on self-assessment basis, meaning a person who is earning the income, he only has to file his income tax return. He will only inform the government what is his income and he will file his income tax return. Okay, normally we do what, sir? Normally we do self-assessment. Payment of tax, interest, penalty, late fee, all this payment of taxes, etc. will be done by the SSC by doing the assessment by his own. He'll also have to pay late fees, interest under 234A, B, etc. while filing his return. Now, the last concept for our discussion is TDS, TCS. Majorly, we'll be covering the discussion of TDS. Now, again, completely theoretical topic. Okay, completely theoretical topic. Let us just quickly see what is this TDS. Now, in TDS, what will happen, sir? Say, for example, Mr. Dilip has given services to Infosys. I have filed income tax return of Infosys. I am charging 1 lakh rupees to them. Mr. Dilip is service provider, Infosys service recipient. Infosys has to pay me 1 lakh rupees, but income tax law says Infosys don't pay Dilip 1 lakh rupees. You reduce 10% of this. You reduce 10% of this, which is 10,000 rupees, and this 10,000 rupees you pay to me. That is nothing but income tax department. I will deposit this money in Dilip's name. I'll keep this money 10,000 rupees and I will give it back to Dilip when he files his income tax return. So here Dilip has to receive 1 lakh rupees, but he's going to receive only 10,000, and on his behalf Infosys is going to pay 10,000 rupees to government. I have received only 90,000 from Infosys and 10,000 is given to government. At the time when I file my income tax return, no, I can take the benefit of this TDS which is deducted. Now here Infosys is called as deductor and I am called as deductee. Okay, so this is the concept of TDS in simple words. In simple words, this is the concept of TDS. Now whatever TDS you are deducting, this TDS is required to be paid by you to the government. Whoever is deducting, it should be paid within 7th of next month to the government. Okay, some important points I am discussing before we start what is the rates of TDS. Now this TDS deducted by a person is required to be paid to the government by 10th of next month for the period April to February. By 7th of next month you are required to pay to the government, but for the month of March, no, for the month of March you will have to pay it by 30th of April. 30th of April. Now please note, you have deducted the TDS. This TDS which is deducted by you, in whose name you have deducted, you will have to inform the government. So you will have to file a return called as TDS return. Sir, what is the due date of filing TDS return, sir? This TDS return is required to be filed by you on quarterly basis. So April, May, June, July, August, September, October, November, December, and January, February, March. For April, May, June, see, basically once the quarter is ending, no, next month last date you should file. So April, May, June, next month is July month, 31st of July. July, August, September, next month is October month, 31st of October. October, November, December, next month is January, 31st of January. January, February, March, next month is April, but for last month, that is January, last quarter, January, February, March, you should file it by 31st of May, because the time limit to pay the tax is 31st of April. So once you pay the taxes, next month last date you have to file a TDS return. Now let us see what are the different types of TDS deduction which is required to be made. Now please note, I have taken into consideration only the important points which are normally repeatedly asked in examination. Now TDS under section 192 is for TDS on salary. So the nature of payment is if you are paying salary to your employee, including that perquisites amount, you will have to take into consideration the salary amount. So who is the deductor? Employer is the person who has to deduct the taxes, and who is the deductee, sir? The employee is the deductee. Whether he is a resident or non-resident does not matter. Sir, what is the rate of TDS, sir? The TDS will be deducted only when the total income is more than the basic exemption limit, and TDS will be deducted at the rate which is applicable for that particular year. Now please note, Normally, for deducting the taxes, PAN is required to be given. If PAN is not given, TDS will be deducted at a higher rate of 20%. No TDS is required to be deducted if estimated salary of the employee is not going to exceed the basic exemption limit. Now, please note, very important point you should come, the employer's very important point while deducting the tax under the head salary. The employer should take into consideration all the different types of income which is earned by the employer at the time when he is deducting the TDS on salary. No, he should take into consideration all the other types of incomes also. For example, an employee gets salary. Apart from that, he has a house property income. He has a say he has some business income. He has some long-term capital gain income, short-term capital gain income. He should take into consideration all those different types of income for deducting the taxes. Meaning, he should take all the incomes. He should not take losses. Losses only of house property can be considered. Then TDS on interest on securities. TDS on interest on securities. So if you are made any investment in any securities, etc., if you are receiving any interest, then any person who is paying that interest to you should deduct TDS at 10%. Now, this TDS shall not be deducted if the bonds are of some government bonds like defense bond or a national development bond, 7-year national savings certificate, 6% gold bond, 7% gold bond, etc., or it is a security issued by central government, state government, or where the amount is not more than 5,000 rupees, or where the interest amount is not more than 5,000 rupees. 194A. TDS on interest other than interest on securities. So if you are receiving any type of interest except the interest on securities, I have made the deposit in bank, I have given loan to someone, I am receiving interest. So in that case, TDS will be deducted under section 194A. So nature of payment is TDS on interest other than interest on securities. Who is required to deduct the taxes, sir? Any person other than individual and HUF. And individual and HUF will have to deduct if their books of accounts are subject to audit. When your books, when will individual and HUF's books of accounts will be subject to audit, sir? If their total income exceeds what, sir? If their turnover exceeds 1 crore, or if you are a profession, your gross assets exceed 50 lakh rupees, then your books of accounts are subject to audit. So who has to deduct taxes? Any person other than individual and HUF. And individual and HUF, if their books of accounts are subject to audit. And who is the deductee? Deductee can be any person. What is the rate at which TDS is required to be deducted? 10% is the rate at which TDS is required to be deducted. No TDS is required to be deducted for interest if the interest amount is not more than 5,000 rupees. And the limit will be, see, so normally if the interest is up to 5,000 rupees, no problem. If it is more than 5,000, 100% you should deduct TDS at 10%. The limit will be 40,000 and 50,000 in respect of interest on time deposits of banking company, cooperative societies and post office. So if you have time deposit like FD, etc., for that 40,000 and 50,000 limit is applicable. Okay. Other points. So no TDS is required to be deducted when the interest is paid by partnership firm to partners. No TDS will be deducted for that cases. Then section 194C, important section, section 194C, TDS on contract. Payment to contractors or subcontractors. Payment to contractors or subcontractors. Who has to deduct the TDS? Who is a deductor? Any person other than individual, and individual or HUF if their books of accounts are subject to audit. The TDS is required to be deducted if they are making the payment to resident contractor or subcontractor. The rate at which TDS is required to be deducted is 1%. Is 1% if the contractor or subcontractor is an individual or an HUF. And TDS is required to be deducted at 12% if the contractor or subcontractor is any person other than individual and HUF. No TDS is required to be deducted if the payment which you are making for a single work which you have taken, if the payment which is made by you is less than or equal to 30,000 rupees. So up to 30,000 for a single work, no problem. If in a year you are taking, you are engaging that person for more than one contract, then the combined value is less than equal to 1 lakh rupees. No TDS is required to be deducted. For single payment less than equal to 30,000, and for more than one payments, aggregate of payments in the year less than equal to 1 lakh rupees. No TDS will be deducted in case of individual and HUF if they are taking any work for their personal purpose. And no TDS will be deducted if your contractor is a person involved in the business of paying, hiring and leasing goods carriage wherein he has total less than or equal to 10 goods carriage. Important points: works contract will include, work shall include advertisement, broadcasting, carriage of transportation work and catering work, manufacturing, that is job works, etc. 194H, commission or brokerage. If you are paying commission or brokerage, if you are any person other than individual HUF, or you are an individual HUF paying commission to any resident person, you will have to deduct TDS at 5%. No TDS is required to be deducted if the commission is less than 15,000 rupees or the commission is paid by BSNL or MTNL. Then 194I, very important, 194I, TDS on rent. If you are taking any land, building, plant, machinery, furniture on rent, TDS is required to be deducted by you at the time when you are making the payment. If you are any person other than individual and HUF, and if you are an individual HUF, you will have to deduct if your books of accounts are subject to audit. What is the rate of deduction, sir? 2% in case you are taking plant and machinery on rent, and 10% if you are taking land, building, and furniture on rent. No TDS is required to be deducted if the total rent which is paid by you in a year is less than equal to 2,40,000. Only if it is more than 2.4 lakhs, you will have to pay the taxes. You will have to deduct the taxes. Now, please note, rent over here means the rent which is paid by whatever name you are calling. Now, TDS shall not be is required to be deducted even on the advance rent. Now, sir, when should I deduct the taxes? You did not tell these points. TDS is required to be deducted on payment date or on credit date. On the date when you are making the payment, or on the date when you are crediting the ledger of that particular party in your books of accounts, whichever is earlier. So if you receive any advance rent in advance, on that also you will have to deduct the TDS. Now, no TDS is required to be deducted on refundable deposits. If it is a non-refundable deposits, yes, TDS is required to be deducted. No TDS is required to be deducted on refundable deposits. No TDS for payment of passenger service fees paid by airline company to the airline operator, etc. No TDS on cooling charges will be deducted under section 194I. It will be deducted under section 194C and not under 194I. Cooling charges which are collected by warehouses. 194IB. Now, if a single individual and HUF, if they are taking properties on rent, wherein they are paying rent of more than 50,000 rupees per month, then they will have to deduct TDS under 194IB. Now, sir, before that, in 194I, sir, what if the property has two co-owners, sir? So 2.4 lakhs will be for single owner separately, or it will be combined limit. If there are more than one owners, then 2.4 lakhs will be applicable for each of the owners. Okay. 194B, rent for use of land, building, or land and building. Any individual and HUF other than those covered above, whose books of accounts are subject to audit, they'll have to deduct TDS at 5%. They'll have to deduct TDS at 5% if the monthly rent they are paying is more than 50,000. It is more than 50,000 rupees. If it is less than equal to 50,000, no TDS is required to be deducted. When should the TDS be deducted, sir? At the time when you are paying your last rent for the last month of the previous year, or last month of your tenancy, or whichever is earlier. Now, normally, whenever you are deducting the taxes, no TAN is required to be present with you. No TAN is required to be no TAN is required for deducting taxes under 194IB. 194J, again an important point. TDS on professional charges. TDS on professional, technical, and services or royalty. What are the different payments covered over here? If you are paying any professional charges, technical charges, remuneration to director of the company, royalty or non-competing fees to any person, then TDS is required to be deducted. Who has to deduct? Any person other than individual HUF, and individual HUF if their books of accounts are subject to audit. The rate at which TDS is required to be deducted is 10%. TDS shall be deducted at 2% if the person is engaged in the business of operating call centers, or he is providing technical services, or getting royalty for exhibiting cinematography films. Sir, what is the TDS limit, sir? Up to what amount should I not deduct the TDS? Up to 30,000 in case of professional charges, technical charges also 30,000, royalty also 30,000, non-competing fees also 30,000. But in case of director's fees, no, there is no limit. Even 1 rupee if you are paying to director, if he is not an employee director, you have to deduct TDS. Now, please understand this carefully. These limits are separate for each of these types of payment. Okay, these limits are separate. Obviously, when they are paying it to single person only, they will be taken separately. They will be taken. Important points: 30,000 limit for a previous year is for each nature of payment except director fees. No TDS in case individual and HUF are taking services for their personal purpose. And amount paid for right to use computer software also falls within 194J. And payment made to third party operators by insurance companies is also liable to be deduction under TDS under 194J. 194M, TDS for commission, brokerage and professional charges. Now normally commission, brokerage and professional charges are covered above, but if an individual and an HUF is taking some services for his personal purpose because of which he is paying any money to the contractor or commission to any person or professional charges, then he will have to deduct the taxes at 5%. He will have to deduct these taxes if the amount which is paid by him is more than 50 lakh rupees. No TDS is applicable when the amount paid by you is less than 50 lakh rupees in a year. Now, if any cash withdrawal is done from any bank, cooperative society, post office, etc., in excess of 1 crore rupees, if you are withdrawing the cash, then TDS will be deducted by that bank at the rate of 5%. And in case if you are a defaulter, at the rate of 2%, TDS will be deducted in normal cases. In case you are a defaulter, the bank is going to deduct the TDS at 5%. Now, in case of defaulter, the limit is also reduced. If you withdraw the cash more than 20,000 up to 1 crore, 2% is the rate. And if you withdraw more than 1 crore, it is 5%. In a year, if you are withdrawing the money from your own bank account, then also TDS will be deducted. Okay, who is a defaulter, sir? A person who has not filed the return for last 3 years. These are the different, 194N is done. 194N we have just now seen. So these are the different points under TDS topics. Then TDS for casual incomes, etc. 194B, 30% is the flat rate of TDS deduction. So these are the different points. I think I have more or less completely covered your entire syllabus, which from your exam, taking your exam point of view in the relevance, I have completely covered your entire syllabus. I feel that this will be sufficient for you to score good marks in your examination. Out of 50 marks, by doing this revision on regular basis and also solving problems, using this as your reference, and solving the problems, no doubt, without any doubt, you will minimum get 45 marks to 40 marks in your examination. All the very, very, very best for your examination. If you have not watched IDT Marathon, you can please watch that IDT Marathon. All the very best for your examinations. I'm definitely sure that you are going to get very great marks in your examinations. Do share me your results once you get your results. All the very best. Thanks for being a very good audience. Thanks for being a great student. Let me meet you in my next video. Till then, tata, bye bye, take care, enjoy.